Hello trading fanatics. You have clicked on this video, so I guess you want to trade. Now, are you a complete beginner who doesn't know anything about trading, or are you intermediate, already looking at the charts, analyzing and trading? It doesn't matter, because I have designed this massive tutorial to tailor to everybody, to give the complete beginners everything they need to get started, and to also give the intermediate traders to really level up their knowledge. My name is Ilya, the founder of Trading Fanatic. I have been trading since 2018 and I've been trading profitably in the last 2 years as well. So I decided to make this very big video to kind of consolidate all of my knowledge and to give a really comprehensive tutorial with only the essential information that you need in order to trade, because there is so much stuff out there, but you really don't need a lot of it. So without wasting any time, I guess we get started. This is gonna be zero fluff course actually, so if you expect some flashy effects and some fancy things, you're really not gonna get that. It's packed with knowledge. You gotta take notes and you also have to take some action. I'm gonna be giving you resources as well, so make sure to download. The first link in the description is gonna give you many things. It's gonna give you journals, it's gonna give you the PDF presentation, it's gonna give you Notion templates and some other things that I have prepared for you, so make sure to download that. And right now we're pretty much gonna get straight into it. So transitioning into the slides, we're gonna start with what is basically trading, okay? Because we wanna trade, but what is trading? So first we're gonna start with a little bit of foundational kind of knowledge. Financial markets, okay? Because we're gonna be trading the financial markets. So what is a financial market? It is a marketplace where buyers and sellers trade financial instruments. Now, what are financial instruments? Those can be many things. Can be stocks, bonds, foreign exchange, Forex, which is the market that we're mainly going to talk about. But the knowledge that I'm going to pass on to you works on any kind of market. We have different derivatives. We have commodities, gold, silver, oil, petrol, and all these types of stuff. Cryptocurrency markets as well that have been gotten viral. So those are all financial markets. And basically, we as traders, we trade or invest in the financial markets through brokers, okay? Because we cannot go just somewhere in the street and trade. No, we need brokers, and brokers are basically the intermediary. Okay, so they're the middleman. It's where we actually deposit our money and our funds, and this is where they actually give us access to the real market. Okay, so pretty foundational, trading the financial markets. Now, how to actually understand trading the best is by comparing it to investing, because a lot of traders say, okay, I'm trading, I'm investing, but you really have to know what you're really doing. So investing is buying and holding for the long term, all right? So you buy a financial asset, doesn't matter what that is, and you hold it for months, you hold it for years, capitalizing on the asset's price appreciation, okay? So common investments are stocks. Okay, in the stock market, you can buy the S&P 500, for example, or you can buy individual stocks like Apple, Nvidia. You can buy commodities like gold and silver. Or you can buy maybe even real estate. You can buy Bitcoin as well. Okay, and just to give you like an example for you to wrap your head around, let's say you bought 10 Apple stocks in 2020. Okay, for $100 each. So what you actually have is you have $1,000 invested. If I just get my laser pointed here, so basically 10 stocks times $100 each, you have right now invested $1,000 in 2020. But in 2026, your Apple stock might be worth right now $260 per stock. Okay, and you also get paid 25 cents dividends per share every quarter. So not only you're making money just for holding the stocks and they pay you dividends, but you're also making money on the price appreciation over time. So what actually happens is in 2026, your Apple stocks are now worth 2,600. Okay, we started from 1,000 invested, but right now 6 years later, our shares have appreciated in value. So right now we have made $1,600 of profit, or 160% return. So that is investing. You buy shares and you just wait for them to appreciate over time, and then eventually you sell them and you then realize this profit. Okay, now trading is buying or selling for the short term. Okay, you buy a financial instrument and you sell it or buy it back within a few hours, maybe within a few days, maybe within a few weeks. Now, if you start going to months, that is really kind of long-term trading / investing. But usually when you say I'm trading, it is short-term thing. And you're very often gonna hear the term I'm day trading. Okay, so then you really know that these guys are just entering trades today and closing them today. Okay, so for example, you bought, let's say, one lot of Euro USD. Now I'm going to teach you what is Euro USD. I'm going to teach you what are lots. Just going to give you some examples here. You bought one lot of Euro USD at 10 o'clock this morning and you sold it for profit at 16 o'clock. So you held it like for 6 hours and you realized profit for the day. You didn't have to wait 6 years for your shares to grow. You actually can make the same profit within 6 hours. That is the power of trading. Okay. And I had a mentor who actually taught me investing, and he was comparing trading and investing with wife-husband material versus the one-night stands. So investing in high-quality assets in the long term is like investing in your marriage, okay? Long-term sustainability. But trading is like one-night stands, okay? In, out, bye-bye. So that's kind of trading, okay? So hopefully with this also fun example, things make sense. What is investing and what is trading? Now, you might be asking how to actually make money from the market. We're just going to get into that because still we are on the foundations. So let's explore the biggest financial markets because I believe every trader should really understand the Forex markets. It is really easy to understand. It is really easy to trade as well. There are not that many details about it. I believe this is the best start for every beginner because there we have very clear market structure. It doesn't have a lot of moving variables, but of course there are also great markets that we're also going to discuss in this tutorial. But for now, let us focus on the Forex markets. But the concepts I'm going to teach you, they apply to everything. They apply to US futures, they apply to options, they apply to stocks, they apply also to cryptos, anything. Okay, now the foreign exchange, also known as the FX market, that is the biggest market in the world with a total volume of 7 trillion US dollars per day. Okay, now you shouldn't really trust that because this number can be a little bit misleading because that is the global exchange, including just absolutely everything. All right, that's going into your exchange bureau here across the street and buying some euros and exchanging them for US dollars, for example. But the pure trading volumes, what is actually traded in the financial markets, all right, online, if I can call it that, they are definitely a lot smaller, but still the amount is unthinkably large. And if you think of that big volume, you can just extract like $1,000. Like this is 7 trillion US dollars per day. So can you extract $1,000 out of that? You absolutely can. Okay, the opportunity is just crazy. Now, it is the global marketplace for the currencies of all nations. We have the US dollar, we have the euro, we have the Great British pound, we have the Canadian dollar, we have the Australian dollar, we have the Japanese yen, we have even currencies like the South African rands, the krones, and all these types of currencies. They're all traded in the financial markets. Now, the Forex market is traded by banks, financial institutions, pension funds, hedge funds, large investors, and us. We call us, right, the normal trader, a retail trader. Okay? And what you should really understand is that every big participant, they have a different purpose for their trading and for their investing. Some of these banks and financial institutions, they want to invest. For example, a pension fund, they invest the money that you give, for example, to them or to the government, and they invest it for the long term, okay, in order to potentially pay back your pension later on. But there we have also speculators or capital preservators or people that hedge. Okay, so for example, people might want to start just buying the US dollar because the euro is depreciating. So they don't want to hold a depreciating asset like the euro. So they're going to exchange euros for dollars and then the dollar climbs. So they're basically protecting their wealth this way. So you have to understand that not everybody is like trading the market to make money. A lot of these big guys are engaging in trades and different types of operations for multiple different types of purposes. Okay, so it's not all, let's just make money. Okay, now we will build a foundation in the Forex market because it's the easiest to get used to, as I told you. But again, as I said, all concepts that we will cover will apply to other markets as well. So basically, sometimes I guess like, okay, what is the Forex market? It's basically this thing, okay, the exchange bureau. And what you see here is literally, so for example, here we are where we are. We're in Thailand, okay? So you can buy a US dollar for 30 Thailand baht, I think it is, and you can sell for 33. So this is your Forex market, and this is basically the exchange rate, and this is also your spread, which we're gonna cover in a bit, okay? But you know how many of those there are in the world, okay? And they all impact the Forex market. So the Forex market works in currency pairs, okay? It is traded to currency pairs. And the whole aim is to exchange one currency for another. So if you want to sell €1 and get $1, then how much US dollars are you gonna get for your €1? That is the whole thing, okay? And this is what is called, as I just showed you, it's called the exchange rate. It's the value of a currency against another currency, okay? So maybe if you wanna if you live in the US and you wanna go to Europe and you have to buy some euros. So for $1, how much euros you're gonna get? Well, we're gonna get probably 80 cents, something like that. Okay, so that is the exchange rate. But for example, if the dollar right now is really strong, okay, then you might get more euros. Depends again on the exchange rate. And what determines the exchange rate? Well, we're gonna dive into that quite deep. Okay, so currency pairs you have to know that they're in a constant tug of war. Like this, we have the euro pushing and we have the US dollar pushing, like everybody wants to be stronger than the other, okay? But the strength is determined by a lot of factors. We have supply and demand, we have macroeconomics, we have geopolitics, we have fundamentals, we have technicals, we have a lot of things. Now, should you know everything? No. As I said in this video, we're gonna mainly discuss the main things that you must know. Now, we have base and quote currency. Now, the first currency that you see in a currency pair is going to be the base currency. This is actually what you are going to be trading. So if you have Euro USD as a currency pair, you are either going to be buying euros or you're either going to be selling euros against the quote currency. The second currency in a pair is called the quote or the counter. So basically this one is the one that is quoted against the base. Okay, so pretty basic foundations here. Now, you have different types of currency pairs as well. Now, the most common and the ones that I would actually recommend you trading are the major pairs. These are all the pairs that have USD within them, okay? So every currency that contains the US dollar within their ticker, okay? What is a ticker? It's basically what you really search for. So for example, Euro USD, GBP USD, Australian dollar USD, those are all major pairs because they contain the US dollar. Because if you know, the US dollar is the world's reserve currency for now, and it is the most traded kind of instrument that is the most important currently. The US dollar is the most important currency in the world. So basically all of those other currencies like the euro, the pound, the Canadian dollar, the Australian dollar, New Zealand dollar, they're all kind of comparing against the US dollar. Okay, there are, for example, all the major pairs. We have euro versus the US dollar, GBP versus the US dollar, Australian dollar, New Zealand dollar. Then we have USD CAT. Now you're going to see some of them have a different base currency in the quote. A lot of these ones start with Euro USD, GBP USD, Aussie USD, NZ USD, but some of them start with USD CAT or USD JPY or USD Swiss franc. Now you have to watch out for these a little bit because sometimes you might get CAT USD or JPY USD or Swiss franc USD. Is this wrong? No, it's not wrong. But basically, these are the accepted quotes for these currencies. So take note of them. Then we also have cross pairs. Now, what is a cross pair? It is a pair that does not contain the US dollar. So for example, we have currency pairs like euro versus the Great British Pound. Okay, the Australian dollar versus the Japanese yen. We have the Canadian dollar versus the Swiss franc. We have the Great British Pound versus the New Zealand dollar, and we can have so many other things. But what you have to understand and why I do not love cross pairs is because they are a combination of two major pairs. Now that'd be a little bit hard to understand, but basically we are mixing two major pairs. And if I show you how that looks like, for example, we take two major pairs like Australian dollar versus the US dollar, plus USD against the CAT. And if we combine this, we basically gain the Australian dollar versus the Canadian dollar. Okay. Now, what you really kind of have to understand is that mainly the Australian dollar is going to be compared against the US dollar. And the Canadian dollar is also going to get compared towards the US dollar as well. So when you combine those two, you can compare again the strength and the weakness of the Australian dollar versus the Canadian dollar. But what I would challenge you to do later on when we go to the charts is to kind of study and go to check out these cross pairs, because what you're going to see is that they can be a little bit erratic and they most of the times can consolidate. What is a consolidation? It means they're just moving sideways. They're not going up or they're not going down. They're just moving like in a box. Why is this? It's because due to something called correlation. How do the different instruments correlate with each other? We have a positive correlation, which means they're moving in the same direction, and we have a negative correlation, which means that two assets are moving in a different direction. So for example, Euro USD and GBP USD, they are very big percentage of the times, I would say even 90% of the times, they are going to be moving in the same direction. Okay, they're positively correlated assets. So then if you try to trade Euro GBP, which is a combination of these two positively correlated assets, you're going to get a consolidation because both of them are moving in the same way. And if both of them are moving in the same way, if you try to compare them once against each other and they both go up, so it's like you get nothing, you get sideways. In order for a pair like Euro GBP to move in a directional way, we really need to have a very big difference between Euro USD and GBP USD. This one needs to go up, this one needs to go down, and then we're gonna get, for example, a clear trade on a cross pair. Okay, so I totally do not advise trading crosses for this type of purpose. So I'm gonna show you later on the charts so you can really see it. And then of course we have exotic pairs. All right, exotic, nice. Pairs that are containing what is called exotic currencies. Those are, for example, the ZAR, the South African Rand, we have the Mexican Peso, we have the Chinese Yuan, we have the Brazilian Real, we have Czech Kronas, we have Norwegian Kronas, and all of these types of stuff. Now, I, again, in general, do not really look to trade these because they have very low volumes. Not a lot of people are trading them. They're a little bit unstructured. They're a little bit crazy, and they're not really worth it as much. Okay. So with that being said, right now we know what are currency pairs and we know what are the major pairs, which are the main pairs that we're going to be trading. Okay. So hopefully that is clear. Any questions that you get along the way, make sure to drop them in the comments. I'm going to cover them as you watch. Okay. Now, what we have to understand is that the Forex market is a decentralized market. Now, what does that mean is that this market is not regulated by a centralized exchange, or it's not offered by an exclusive source, okay? So this is the only drawback actually of Forex, because there are multiple exchanges, there are multiple dealers, there are multiple data providers, there are multiple brokers, okay? And this is always going to be giving you different prices. Okay, so if you go on the street right now and you go to one exchange bureau, they're going to sell your euro for, let's say, $1.20. But if you go to the one across the street, they're going to sell your euro for 1.10 US dollars. You see, that's a very big difference. Why? Well, because there is not a fixed price. On Forex, there's just no price that is the right price. Every broker, every dealer, they're going to give you different price, which kind of sucks, okay? But if you take a market like, for example, US index futures or even stocks, okay, which only come from the, for example, from the Chicago Mercantile Exchange, the CME. This is the organ, this is the organization that actually says this is the price, okay? And then all transactions go through there. All transactions are actually transparent and they are regulated. So you can only trade, for example, US futures through the CME. You cannot go on the street. You cannot go to, now you have different brokers, but these brokers then give you access to the CME. Okay. While, for example, the Forex, the broker that you trade with, they can mirror your trade. So if you take a buy, they're going to take a sell. Maybe they send your trade into some bank, into this bank or into this bank or into this liquidity provider or into this guy. Okay, no. For example, a regulated exchange like the futures only passes through the CME. And this is a very big benefit for this market. And again, as I told you, what we're going to learn, we're going to focus a little bit on Forex because that is a foundational market. But what you learn absolutely applies to US futures as well. Now, because of its decentralization and global usage, the Forex market is literally open 24 hours, 5 days a week. Now, you have also the futures market that also seems like it's opening 24 hours, 5. But the real market there opens, for example, at the New York Stock Exchange, which is when the CME, for example, opens at 9:30 Eastern Standard Time, while the Forex, as we're gonna learn just right now, we have 4 sessions, so it's trading literally 24 hours. We start with Australia, then we go to Tokyo, then we go to London session, and then we go to New York session, and we just go in circles. There is literally how it looks like. You can also see the overall timings in GMT. The first, pretty much you can see like we have we opened up here with Sydney, but Sydney is overlapping just a little bit with New York. Then we transition into Tokyo here, and then Tokyo and Sydney are overlapped. Then we have London here and a little bit of overlap with Tokyo. Then London takes over, then we have New York, and then we have the London and New York overlap here. And this is literally the highest trading volumes here. Okay, when we have, for example, from a little bit of an overlap from Sydney, Tokyo, and then we go into London, and then we also overlap with New York. Okay, those are your best timing when you see all of these sessions are participating. Okay, now we learned that the Forex market is a decentralized market. So let's get a little bit actionable, shall we? You are probably hearing, I'm gonna go short, I'm gonna go long, I'm bullish, I'm bearish, bulls and bears. The bulls are strong, the bears are weak, or vice versa. What is that? So let's take, for example, the most traded currency pair, that is the Euro USD. The Euro against the dollar. Shortly, we're going to call it EU. Now, if you go long on EU, or if you are long bias, you're buying the Euro, hoping that will increase in value, go up. If you go short, okay, going short, or you are short bias or bearish bias, you're selling EU, hoping it will decrease in value or go down. Okay, and if you're bullish, like the bulls on Wall Street, the bulls signify they want to push price higher with their horns, and the bears, they want to push price lower with their paws. Okay, so if you're bullish on a financial instrument, you believe that it will go up and appreciate in value, and if you're bearish on a financial instrument, you think that it's gonna go down and depreciate in value. Okay, so now we know short and long, bulls and bears. Long, we go up; short, we go down. Bullish, we go up; bearish, we go down. Now the key question, okay, so how do we actually make money from these markets? Okay, like it's an extremely big market. How do we actually make money? Now, to understand how money is actually made trading Forex or anything else, of course, we need some more basics. Okay, now I know I'm boring you a little bit here with basics, but these are really things that you must understand. Okay, I'm totally leaving everything away that you don't need, but this stuff you need. So I'm going to share with you here a little screenshot, and this is basically what you're going to be seeing when you open a broker or when you go to any type of source that is going to give you the price of something. Okay, so we have the bid and the ask, which is basically sell and buy. Okay, now we have offer. For ask you can have offer, for here you have bid. These are just different types of words to say sell or buy. Okay, now what you see right here is we are trading the Euro USD pair, and if you want to sell the Euro USD pair, this is the price at which you can sell it at. It's 1.2883. Okay, and if you want to buy the euro right now, you can buy it for 1.28853. So what you see right here is that there is a difference. Now, why is there a difference? Right, I sell it for 80 and I buy it for 85. Why? Okay, well, this is what is called the spread. Okay, this is how brokers also make money, and we're gonna talk about liquidity later, and I'm gonna tell you why that is, why the spread actually exists. But the spread is basically the difference between what you can sell the asset for and what you can buy it for. Okay, and then we also have pips. Okay, pips is kind of it's not the smallest, but is the most important kind of value that we're actually going to be getting out of the market. It is the 4th decimal, okay, in pretty much within the price. So we have 1, 2, 3, 4. Okay, that is going to be our pips, and then we also have a smaller one which is called a pipette. Okay, or fractional pip. Okay, so what you have to memorize from this slide is that the 4th here is the actual pip, and then the difference between the two prices for sell and buy is called the spread. Okay, so how to actually make money with that is, let us say that, for example, we are once again trading a financial instrument. It doesn't matter what it really is, and it is going up, and exactly at this point right here, okay, we decide that we are bullish, or we want to go long on this financial asset. Why? Because we think that it's gonna increase in value. So we buy this asset at 1.2880. Okay, we buy it at this price. And then the market goes down a little bit, then it goes up a little bit, goes down, goes up, goes down a little bit. And then as it really nicely goes up, exactly at this point in time, right here, you decide to sell it. Okay, and you sell it at the price of 1.2890. Okay, so right now you know what pips are. Okay, the difference between your purchase price and your sell price is basically right now your profit, because when you buy, so this is the foundational kind of trading, how you actually make money. You've probably heard it: buy low and sell high, or sell high and buy low. Okay, so in order for you to make money on your buy, it needs to go up, and then you need to sell it at a higher price. Okay, that is basically any business in the world. Okay, if you make phones, okay, and if you make your phones for $500 and you sell it for $1,000, well, bingo, right? You made profit. But if you buy it, or if you make it for $500 and you sell it for 400, well, you're at a loss. Same thing with financial assets. So here we moved from 2880 to 2890, which is 10 pips. So that is your profit, the difference between your purchase price and your sell price. Okay, it's as easy as that. All right, there is an example on the charts as well, going long. We enter on this chart exactly right here at price at 1.1665. Okay, so this is the pip, the 5. Okay, and then the 6 is the pipette. It's a fractional pip. And where we place our stop loss, we're going to talk about stop loss and everything. But again, this is where we can potentially exit the trade for a loss. What we can see is that we entered right here. The market pushed, it pulled back, it pushed, pull back, push, pull back, and then it pushed finally. And we closed it exactly at this point at 1.1689. Okay, so then if we count the difference between 1665 and 1689, we are going to be getting 24 pips. So in this trade, we made 24 pips in profits. We can see it right here, or we can see it by just subtracting 1689 minus 1665. Okay, that is going to be 24 pips of profit. And here is, for example, going short. Okay, we execute the trade exactly right here, and you can see the market, whoa, really nicely goes down. So we sell it at the exact price of 1.1623. Okay, the pipette, the fractional pip. And then as it goes down, we buy it back. So for example, then the other way to make money is to sell at the higher price and then buy it back at the lower price. Okay, so there it is. Okay, so we sold it at 1.1595. So then again, the difference between this is 27 pips. So again, you made profit. Okay, so that is how you make money in the market, by betting whether your instrument, the financial assets that you're trading, is going to go up so you can go long, or if it's going to go down so you can go short. Now, the very big question: how do you know? How do you know whether an instrument is going to go up, or how do you know whether an instrument is going to go down? Okay, and right now we're just going to get into this. So what you have to understand is that there are a million ways to make money in the market. There are a million ways to interpret the value of a market or a financial assets that you're trading. And what you really have to understand from now on, even already installing some proper mindset, some proper trading mindset in your minds, is that in trading, nothing is right or wrong. Okay? There is no right way to trade the market. There is no wrong way to trade the market. There is no one guy who is right and another guy who is wrong. There is no, this is how the market moves and this is not how the market moves. The market just is what it is. It is driven by invisible forces of supply and demand. And we as traders, we can only have different interpretations of the price, whether it's high or low. That's it. Okay. And trading is a zero-sum game. Now, what does that mean is that for every winner, for every person who actually wins money from the market, another person must lose. Now, it's not the best, okay? But what really matters is who wins over the long term, because myself, I can lose 10 trades in a row, okay, but then if I win the next 10 trades, and I make more than I lost, I'm gonna be profitable. So I'm fine with giving my money to somebody else if I then later take it from somebody else. So what matters in trading is who survives in the long term. That's it, okay? And of course, there are a million ways to determine, as I said, the price of an asset. You have, of course, technical analysis, which are what we're going to talk a lot about, but we're also going to touch on fundamental analysis. Again, as I said, I'm going to teach you everything. And then we have 1,000 ways to interpret a chart using technical analysis. We have market structure, imbalances, Elliott wave theory, moving averages, smart money concepts. We have RSI and MACD indicators. We have flags, triangles, pennants, these type of formations. We have Fibonacci. We have extensions. We have 1,000 different things. Okay, and within all of these things, there is a myriad of different types of setups that you can take. Because if I say market structure, which we're going to cover, it is not like, okay, this is market structure. There are also 1,000 ways to interpret market structure. There are 1,000 ways to interpret imbalances. There are 1,000 ways to trade moving averages. There are 1,000 moving averages that you can trade. Do you see? Like, and this is why trading is so interesting, is because like you really have to find your niche within all of these things. And then of course you have fundamental analysis. Now, what is fundamental analysis? Is basically looking at the macroeconomics, looking at economic data, looking at geopolitics, and really looking at the very big macro picture. Many traders believe that this is actually what moves the market. Okay, we have, just to give you a few example of what fundamental analysis is looking at GDP growth, the interest rates, CPI, inflation reports, commitment of traders reports, the political economy, and like really analyzing in economy here. Really analyzing what is happening and what could that mean for the financial assets that you're trading. We have non-farm payrolls, PMI, PPI, unemployment rates, productivity rates, retail sales, and 1,000 other things. And this can go way deeper. Okay, so that is fundamental analysis. It's not that much on the chart, analyzing the technicals, but it's really like reading behind the assets that you're trading. Okay, and different types of fundamental analysis is actually the fundamental reason of why, for example, an asset could move. So for the Forex market, it is said that the main reason that these currency pairs and one is stronger than the other is the interest rate differential. Okay, so if one country has a 5% interest rate, this means that if you hold the US dollar, you're going to get 5% return. And then the euro, you're going to get, let's say, 2% return. Well, where are you going to put your money? Are you going to hold US dollars and get paid 5%, or are you going to hold euros and pay 2%? Well, of course, you're going to hold dollars. And what does that mean is that the dollar is going to increase in value. Okay, that is like the simplest thing that I can give you, but it goes so much more in depth. We're actually going to have a look at it later on. Now, what the beauty of trading is that you can make a lot with little. And this is why trading is becoming so famous and so popular, is because it has really low entry barriers. Okay, so now let's have a look at what that actually means. You now understand what pips are. Okay, this is the fourth decimal piece. Usually the fourth, if you have a Japanese yen instrument, because they have like 3 numbers at the start, their pip is going to be a little bit different. But again, trust me, it doesn't matter that much. We know what spread is. Okay, the spread is the difference between the price that you can buy an asset for and the price that you can sell it for. Okay, and we know how making money basically works. We bet whether an instrument is going to go up or whether it's going to go down. But because again, we capitalize on extremely small price changes. Okay, we capitalize on those pips. And what are pips? There are a fraction of a cent. Okay, and to make lots of profit, you need to buy a lot of the currency. So just to give you an example, if you buy €1 for 1.2880 and you sell it for 1.29, okay, so what you made is you made 100 pips. Now, that is a lot in the trading world. Okay, that is pretty good. However, what you made is you just made 1 cent. Okay, in fact, it's even, basically 1 cent. Yes, it's probably even less than that. So in order for you to make, let's say, $100 from that trade, okay, you need to buy 10,000 euros, okay, and to earn 10,000 USD cents, okay. Now, hey, you don't want to be spending tens of thousands of dollars to make $100, right? You don't want to go right now to the exchange bureau and think, okay, The euro is gonna appreciate against the dollar. I want 10,000 euros. Give it to me right now. Okay, and then after some time you go back to that exchange bureau and then you exchange and then you make like the difference. Doesn't sound great. That's a lot of money. Okay, so right now enter the beauty of trading, which is what we call margin trading or leverage trading. So brokers nowadays are offering what is called a margin account. And this margin account comes with a leverage. Now we're gonna understand what these things are. So what leverage is what allows you to have a small deposit. Now, let's say you deposit into your broker. We're also gonna have a look at brokers later on, $1,000, but you're able to buy $100,000 worth of the currency that you want to trade. So you can actually make a good profit, okay? But how is that I have $1,000 and I can buy 100,000? I'm gonna show you right now. So let's look at it into more depth. So let us first understand margin and leverage, okay? Now, what is margin? Now, again, this stuff, by the way, so before I get into it, if you kind of get confused, just don't worry, because really understanding these things is not 100% necessary. You won't like really need it. But what you really understand is like what these things are, why they are like a thing, okay? And later on, when you kind of go into risk management, you have to understand how it actually works, because before I always ask why. Okay, so why is this leverage working? How is it working? Because if you don't understand the foundation of something, you don't really get the real knowledge. Because I can tell you this is okay, do this, but if you don't understand it, it's not gonna click. So what is margin? I want you to think about margin as a collateral or a deposit that's needed for you to open a position in the market. Then when you open a position, this margin is locked from your account balance. So that is the money you have in your account, which is cash that you deposited in the broker. Now, it's not taken away as a fee, okay, but it's just locked and it will be returned to you once you close the trade. Okay, so it's like a collateral. And different currency pairs have a different percentage margin requirement, okay? For example, Euro USD, if you research it, like again, this really depends on your broker, by the way. Euro USD, let's say, has a 2% margin requirement. So in order for you to purchase 100,000 euros, okay, 2% of that, you're gonna need $2,000 of margin. So you need $2,000 in your account as a collateral in order for you to purchase these 100,000 euros. Okay, so you need that as a deposit. That is basically margin, because you cannot open a $100,000 position without having anything, right? The broker still needs to have some sort of money to take as a collateral, right? You cannot buy a property without collateral. You cannot buy anything without having some sort of a collateral, okay? So this is basically your margin. And if you do not have that margin requirement, you're not going to be able to open the position. Or what you might get is you might get a margin call, because if the position size exceeds the margin that you have, the broker will just violate your position. They'll just close it because you do not meet their margin requirements. Okay, so that is basically margin. And when you actually open up your broker, you're going to see free margin. So that is the margin that you still have available to open positions. And you're going to have your occupied margin, which is already allocated to a position that you have opened. Okay, now let us talk leverage, which is also the second very important thing. Leverage is what actually allows, let me remove my camera real quick here so you see. Leverage is what actually allows you to buy, for example, $100,000 worth of euros with a small balance, okay? And leverage is expressed always as a ratio. So for example, you can have a leverage of 1 to 100. So what does that mean immediately is that for every $1 that you have in your broker, you have 100 USD in buying power. Okay, so that is the beauty of trading, is that you get these margin accounts, okay? And then these margin accounts also gives you leverage. So regulated brokers that are actually regulated by financial authority, which I'm definitely going to recommend you to go for, they usually offer a leverage of 1 to 30. So if for every dollar you deposit, you can buy $30, okay? While, for example, certain offshore brokers that are also regulated, but they're offshore, they're a little bit kind of riskier, they can offer up to 1 to 500. So for every dollar you deposit, you can buy $500, which is absolutely crazy. Okay, so basically this is margin and leverage. Leverage you have to understand, because you're always going to be asked what leverage do you want. If you go for a regulated broker, you're usually going to be getting 1 to 30, which by the way is more than enough. As for your margin, as I'm going to be teaching you risk management later on, you really don't need to understand margin, because you're never going to get a margin call. If you want to go crazy and like turn $100 into $1,000, that is really when you're going to hit your margin call. Okay, but if you want to be a professional, which you should be, you never have to worry about margin. Okay, now we're starting to get a little bit nitty gritty here. We are right now going to talk about lot sizes in contracts for difference in Forex, because the Forex market is mainly traded through contracts for difference. It's called CFDs. Okay, so when you open an account within a broker, you're going to be opening a CFD account. Contract for difference. This is basically like the derivative that you're using in order to capitalize on these price changes. Okay, that is how you're also being given leverage and how you're also given margin. Now, there are different types of contracts you can be trading. Okay, in the financial world, for example, you can be trading futures. Okay, you can be trading options. But for now, we're going to be focusing on CFDs. They are the simplest really to start with. So the standardized unit of measurement for your position size in Forex, it's called a lot. All right, it's called a lot. And then we have different types of lots. We have one standard lot, which is basically 1.00 lots. That is 100,000 currency units with a pip value of, for example, $10 per pip on EU. The pip value is determined by your lot size. Okay, so that is for one standard lot. Now, can you open 10 standard lots? Yes. Then what is going to be the value per pip? It's going to be 100. Okay, why? Well, because if one lot has 10 pips, 10 lots is going to have 100 pips. Okay, some little maths here. Now, we also have one mini lot, which is 0.10 lots. That is 10,000 currency units with a pip value of $1 per pip. You see how we're stepping down right now? So basically here you're buying $10,000 worth of that currency. Okay, now if you have 0.15 lots, what's that gonna make? $1.5 per pip. If you have 0.20 lots, that's gonna mean $2 per pip. That is how it's calculated. And then you have the smallest lot, which is one micro lot, which is 0.01 lots. Okay, and you're basically buying 1,000 currency units with a pip value of 0.10. So basically 10 cents per pip. Okay, if you once again buy 0.02 lots, that's going to be 0.20 cents per pip. If you buy 0.03, the same thing. Okay, so let's have a very quick example here for you to kind of really think about it. Let's say that we deposit $1,000 in your trading account. Let's go, we got a trade right now. Then you have a leverage of 1 to 100. Now here's a math questions for you. How many lots can you buy? Let me remove my camera here. Think about it, right? So how many lots can you buy? Okay, so let's do the maths and how it actually works. So we have $1,000 of capital with a leverage of 1 to 100. So that is $1,000 times 100 leverage. We can buy, we have $100,000, okay, in buying power. So we can open what? We can open a maximum one lot. Okay, because for $1,000 and leverage of 1 to 100, that is the buying power that we have. However, this is where also the margin requirement that we talked about steps in. Okay, different brokers will have a different margin requirements. So if we insert the margin requirement into the equation, let's say that we have a 2% margin requirement, then in order to open this position, we're going to need $2,000 in margin. Okay, so basically, if we put the margin requirements into the equation, with $1,000 of capital, you can open max 0.50 lot. Okay, so that is, what is that? 5 mini lots. Okay, with 1 to 100 leverage and 2% margin requirements. Okay, now why 0.50? Because with $1,000, we do not meet the minimum margin required to open $100,000. Okay, so hopefully that makes sense. Okay, now that is kind of an extreme example to really get you to think about it. I promise you, if you stick to proper risk management, you're never gonna need all of these leverage and all of these margin stuff, but I want you to really understand how it works behind the scenes. Okay, All right, everybody, time to recap what we learned so far. Now you know the different types of financial markets. Okay, there are many. We broke down the Forex market, which is the biggest financial market. We learned about the different currency pairs, the major pairs, the cross pairs, and the exotic pairs. We learned what is a base currency and a quote currency. The base is the first, the quote is the second. We learned what are the major pairs, the pairs that are ending with USD or that have USD in their ticker. And we learned cross pairs that are a combination between two major pairs. We also understood that the Forex market is a decentralized market and it's open 24/5. We know what bulls and bears are. We know what going long and going short means. We know what being a bullish bias and bearish bias means as well. We also learned what are pips. We also learned what is spread. Pips, again, the fourth decimal of a price. Spread is the difference between buy and sell. That is how brokers make their money, by the way. And we understood margin and leverage, which is again not that important, but you have to understand it. And we also learned about lot sizes. Okay, so what are the different lot sizes? So we are getting very close to the good stuff. So right now, with all of these bases, this is basically all you need to know in terms of like the really foundational part, like the boring stuff. Okay, so right now, we're gonna start making it a little bit interesting. What does it take to succeed in trading? So to succeed in trading, I believe we need three things, which is what I call the trifecta of trading success. We need a solid psychology, we need a solid trading strategy, and we need a solid risk management plan. Now, why do we need all these three things? Well, because if you have a very solid psychology, you're great. If you have a working strategy, you're great, but your risk management is not dialed in, you're over risking, you're getting margin calls, you're constantly blowing your account, you're not going to be profitable, okay? If your strategy is extremely solid and your risk management is absolutely top notch, okay, but your psychology sucks, you are very emotional, you're very fearful to execute trades, or you're very greedy, you overtrade and you do all these sort of emotional mistakes, you're not going to be profitable as well. And of course, if your psychology is top notch, you're a monk, you never go emotional. And if your risk management is great, you know exactly what to risk, when to cut your risk, you know everything, but your strategy doesn't work, it's not a profitable strategy, well, guess what? You're also not going to be profitable. So we need to achieve the balance between these three things. And this is what, of course, this big course is designed to do. I have a coaching program, by the way, and I always make my members start with one thing, which is their why. So if I might ask you right now to think about it, like, why do you trade? What do you actually want out of trading? Why are you doing it? And your immediate response might be money. So why are you trading? Well, I trade for money. I want to make money. I want to make 10K a month. Sure, but what you're going to understand very soon is that money is not enough of a motivation to really push you forward. Money is not your purpose. Okay? There is always a deeper purpose behind money. So how do you find that? Is you ask, okay, so why do I want to make money? What are you going to do with the money? Okay, I'm gonna buy the cars and this and this. Okay, so why do you want to do that as well? What is the purpose? And you can get really deep with that. I make my members do an exercise with the 7 levels of why. So you ask the why question 7 times to go really deeper. So why are you trading? I want to make money. Why do you want to make money? Because I want to buy a car. So why do you want to buy that car? Like, I don't know, to impress other people, to feel good about myself. Why do you want to feel good about yourself? Why do you want to impress other people? And then suddenly you're getting like, okay, like, do I really need that car? Okay, like, remember, there is always a deeper purpose. Is it your family? Is it your self-worth? Is it your future? Is it financial, time, location, freedom, like financial freedom, freedom from your boss, quitting your 9-to-5 job? But why do you want to do all of these things? Okay, so very important right here, by the way. A lot of people are going to skip on this part, but trust me, it's very important. Just ensure that your why is not fluff. All right. I saw a guy on YouTube making 10K per month. They're driving a Lambo. They seem like they're living their dream lifestyle. I want to do the same. That's somebody else's lifestyle. You don't even know if it's true. There's a lot of gurus out there that are really not living the life that they show to be living. You never know what is behind the cover of the book. Okay. So the lifestyle YouTubers are only going to give you FOMO. okay? Because that is how they also capitalize on you. They're going to give you false realities, they're going to give you unrealistic expectations, and they're going to try to lure you to teach you like, okay, that's how you can do the same, but it's not going to work, trust me. So you have to look into your current towards your desired situation. So what is your current situation? Sit down right now, get a blank piece of paper or get a journal, okay? Like I have, for example, this piece of journal, and I talk about these things every single day to just keep grounded and to know what I'm working towards, okay? Where are you in life right now? And then think about what do you want to really accomplish for yourself? Like, who do you want to become as a person? What do you want to do? What do you want to own? Okay, be a bit materialistic as well. It's fine. Okay, where do you want to travel to? How do you imagine your life? Okay, but don't copy somebody else. Really write what you feel deep inside for you is really what you want. Okay, now do that. But before you do it, like, why is this really important? Because your why and your desired situation where you want to go is your fuel in the market. Because trust me, there will be tough times. There will be ugly moments in trading. Where you like to cry, you will cry. Where you like to break your phone and throw it in the wall, okay? And the only thing to keep you going during these times is literally gonna be your why, all right? And if your why is superficial, you'll just give up because you really don't have that inner purpose, that motivation to keep going. You're just like, oh, I saw that guy, I want to try. Well, but when you get hit by the market, you're gonna give up because you just saw somebody do it and you really don't have it deep inside why you actually want to do that. Okay, so make sure it's your own why, not somebody else's. And don't give yourself deadlines. The worst thing that you can do, I did that for too many years myself. Okay, I gave myself deadlines. I want to make 10K by the end of this year. I want to turn profitable in the next 3 months. I have to make it right now. No, unfortunately, going fast is gonna make you slow down in trading. It will give you a lot of pressure, and then at the end of that period for your deadline, you're gonna get disappointed, and they're gonna keep repeat. I repeated that thing for too many years. First year, I want to be profitable by the end. The end, I'm not profitable at all. Okay, next year, this is the year I'm gonna do it. Next year, I'm gonna be profitable. Next 3 months, I'm gonna be profitable. I'm not profitable, and all of these things actually gave me pressure. They kept disappointing me to the point at which I just became numb to it, and I was like, screw it, like I don't care anymore. And guess what, when I dropped all the deadlines, when I just stopped caring about it, it just happened. Why? Because I dropped all of the pressure. I really released all of that importance from me, and something unlocked, right? And you just start trading properly at that time. So again, don't give yourself deadlines and really figure out your own why. Okay. The next step that we have to take, again, we're not yet to trading. We have a lot of time to go towards trading. So this is really the exercises, the first exercises that you have to do. Let us talk about money, and let us have a little bit of an experiment to show you that you might have a little bit of unrealistic expectations. Because again, before I coach somebody, this is the first thing that I make them do, really to level up their expectations. Okay, so I want to ask you right now, how much do you want to make? You can think about monthly numbers or yearly numbers. Like, how much do you think you need? Think of a number that you feel like it's gonna make you financially free. Is it gonna be like $1 million a year or 10,000 per month, which is like the most common thing I hear? So I want you to write it down right now. Just write it down on a piece of paper. Did you write it down? Come on, man, write it down. I promise it's gonna be good. So next question is, how much do you need to make per month or per year? Okay, so that's where we get a little bit financial literacy here. So what are your monthly living expenses, LE? Think about everything: home, your mortgage, rent, utilities for home, food, transport, insurance, entertainment. Okay, how much is that? Okay, and then how much do you currently earn from your job business? So basically, what is your income? Okay, write these things down. And then how much do you need to cover for your living expenses? Write that down. And then how much do you need to replace your job income or add 20% of top of it so you're actually happy about it? So if you're making $1,000 per month, let's say, and you want to add 20% to that, let's just make it 1,200, for example. So write down these numbers, okay? And you're gonna see that there is very likely gonna be a difference between your want number, which is this one right here, and your need number, which is this one. Okay, so very likely your want number was higher. Why is that? Is due to unrealistic expectations and excessive desires. You're literally following somebody else and you want to make all these amazing money, but do you actually need it? But now you see for yourself, okay, I don't actually need all of this crazy money in order to live my dream life, or just to make a better life for now. Now, it's definitely not bad to think big, but first you have to start small and take smaller steps. So let me give you an example, and if you didn't do that until now, let's do it together right now. How much do you want to make? Okay, I want to make $10,000 a month. I feel that this will give me a lot of freedom. I can do anything I want. Like everybody says, make 10K a month. That seems like the right thing to do. Okay, sure. How much do I need to make? Well, my rent is $700. Every month I spend $300 on groceries. I do 2 times my car fuel, 150. I dine outside sometimes with my wife and my girlfriend, boyfriend, whatever, $200 for that. Shopping, some random shopping, 150. Subscriptions for Netflix or this 50. Okay, good. My living expenses are 1,600 rounded. Okay. Okay, so I earn $2,000 from my job right now. So basically I save $400 per month, which is amazing. Okay. And if I like to, for example, replace my job income and add 20% on top of my salary, then that would be 2,400. So this is actually the number we're looking for, and that is our first big milestone. Okay, you don't want to go and make 10K from trading. You don't want to go make 100K. You don't want to get $1 million in funding and go do crazy stuff. That's your number. That's what you need to make. Do you know how easy that is? But too many people are like, I want to make 10K, which makes everything extremely hard. Okay, so that will be your first milestone. And what you see, that there is 7.6K difference between the need number and my want. My want was 10K. My actual thing that I need to make to be very good is 2.4. And the difference is pretty big. Okay. And so basically you have to really start looking into financial literacy, because the first thing that you must do in order to become financially free is to know your expenses. All right. If you get the financial literacy class or like a financial independence class, the first thing that they're going to do is take your phone, get on an Excel sheet or something and type down all of your expenses so that you actually know what you're spending. And what you're going to see is that maybe you're spending more than you should. Okay. But once you know your living expenses, then from there, you actually have a number in your mind. Can you reduce that, or can you cover that with your trading? That is what you first need. Okay. But you see, for example, to obtain location and employer freedom. Okay. So to quit your office, to quit your 9-to-5 job and to stop relying on a boss, all you have to do is just cover your living expenses and maybe put a little bit on top. Okay, and you're oftentimes gonna see you won't need that much. Now, of course, this depends on where you live and what your living expenses are. Maybe your living expenses are crazy. If you live in the US or Canada, I hear it's pretty expensive. Then, of course, you're gonna need to make a lot more money. But for a lot of traders, actually, it's not that much. Okay, now this really depends on your situation, so you really have to figure out these things. Okay, so now, everybody, what the good thing about what we just did right now is you have a monetary goal in your mind, okay? And you have a new perspective of what a sustainable and realistic trader is, okay? So if you watch traders that are sharing like crazy money and some $1 million of profits and like massive, maybe they're making it, but very likely not. Look for traders that are just consistent. Look for traders that are just having a good life, okay? And they're just trading, not showing off, okay? Okay, so you realize that you do not need a lot to literally help yourself and even change your mind. And of course, one little last point, start small to build big. The biggest tip that I can give a beginner trader, what I really wish that I told myself, first of all, just start small and do not rush. For 3 years, I was failing because I was rushing to make it very big and very fast. I was trading a $500 account and I was doing good. And then I told my father like that, look, I turned this $500 into like, I don't know, 700 or 800. I'm really profitable. So, but if I do that on a $10,000 account, that would be so much big. And he gave me that money and I lost 3,000 at that time. So I was in debt to my father. It was extremely bad and shameful. Okay. So rushing to become profitable, overstudying, over trading, really trying to force it. No, you have to go small first and you have to just relax. Master the basics, take things slowly, okay, and trust the process, because the right trading experience is built slowly with time. Okay, and what I always tell my members, because sometimes I see, again, people want to make a lot of big money, become financially free and live their dream life. Okay, but have you made $100 from the market? No? Well, make your first $100 from the market. Like, make it real. Make something, withdraw it, get it in your bank, withdraw it from the bank, see the bill, right? See this, right? Make something and get it out so you know that it's actually real, that this is from trading, for example. Okay, make your first $100 first. Okay, so yes, when coaching traders, I always ask them for their financial goals, and many give crazy numbers without having made any profit at all. And then they want to, because they want to make crazy numbers, then they're gonna have to trade very big accounts, okay? But they've never even made their first $100. So again, it's a marathon, not a sprint. All right, so what really matters in trading? And first of all, is trading really worth it? How much money can you actually make? So let's get into that. Now, the money you can make is directly linked to two things. First is your skill set as a trader, and second, your capital. And the number one priority in trading right now is to build your skill set. Why? Well, because nowadays capital is very easily obtainable if you only have the right skill set. There are companies that are going to give you money. There are investors that are going to give you money. It's never been easy to have big capital, but what you need right now is the skill. Because the skill set, or your edge, your strategy, it doesn't change if you trade $1,000, and it's the same if you trade $500,000 or millions. You're going to be doing the same thing. You're going to be executing the same trades. What really changes is the number behind, okay? So, and also, of course, as the numbers grow, what also is going to change is your emotional control and your relationship to money and risk. But that is right now we're talking about psychology already. And this is why also you have to start small, okay? You can't trade an $100,000 account without mastering first trading $1,000, okay? But that is what many traders do, okay? I want to make very big money, as we spoke about previously, and they get the biggest account, but they're not used to trading these big numbers. So again, start small and build your skill set. So what can you actually make? So here is like a little graph of potentials, okay? This is your account size here, okay? And here is your return in percentage, all right? If you're trading $1,000 and you make 5% a month, you make $50. If you make 10% that month, you make $100. If you make 20% that month, which is absolutely crazy, you make $200. So do you see, like, if you trade $1,000, it is, I wouldn't say it's life-changing. Sure, it can pay for something, but not life-changing. But suddenly, we ramp up our account size to $10,000 right now. Okay, and if you make 5% this month, $500. Okay, not bad. I mean, I can almost pay my rent with that. But if you make 10%, or right now I'm making $1,000 from trading. Not bad. Okay, 20%, of course, 2K. But then as you start hiking the capital, you can see, and you make the same percentages with a 50K account. Right now you're making on a 5% 2,500. But if you make 10, you're making 5K. All right, now we're really starting to talk. Now 20% return. Now, of course, that is we can speak about returns later on. That is a pretty big return, of course, depends on the time frame. But for example, 5% a month is very realistic. This is what I personally go for, right? Not aiming for very big things, because I'm going to show you just in a bit why. And then, of course, 100K accounts. Now you're making 5K on a 5%, and you're making 10K on a 10%. And then, of course, the more the account grows, the more your return in dollar is going to grow without, of course, increasing the risk. So the catch is not to increase your risk too much. So, for example, have $1,000 and risk $1,000 in order to make 2K. No, the goal is to have $100,000, and then you just risk 1% of that. So you're never going to be able to blow your account this way. Okay. My ideal thing, my live account is around 20K. I want to get it to 25K, because then if I do 5% on 25K, that for me personally is a really good return for me. Okay, so I have my number and I have my goal, and you have to have yours as well. Now, let's talk about the compound effect, so which is what Einstein calls it's the seventh wonder, the eighth wonder of the world. Yeah. Now, in your PDF, if you download the link, I'm going to be sharing with you the PowerPoint as well. You can click on this side, and on this side, you can do some compound interest calculations. So let us say, for example, here, our initial investment in our trading account is $10,000, and we're targeting a 6% monthly return. So we want to make 6% a month. For a year, our investment value, which is the account size that we started with, it's going to be 20K. What is that? It's 100% return. Okay. So why am I showing you this? Is to show you that with just 6% profit per month, if you stick with that for a year, your account is doubled. And if you do that one more year, you're going crazy here. Okay. So that is the long-term game. This is why this 6% number is really key. 5 to 6% per month is all you need, guys. You don't need to make crazy like returns. And these prop companies that want you to make like 10% for 30 days, it used to be like that. It's just unsustainable. Okay, take your time. All you need is this number. Okay, and you're gonna flip your account within a year. And if you cannot wait for a year to do that, well, maybe trading is not for you. It needs patience and it needs long-term thinking. Now, the compound effect is also pretty good because as your account grows, you're risking the same risk, okay, per trade in terms of percentage. But as your balance grows, the profit also grows. So for example, you start with a $10,000 balance and you make 6% on that. Good, you made $600. Right now, your account balance is $10,600. But then what you're going to be risking on is this account balance. So 1% of this account balance is going to be 636. Okay, I mean, it's going to be 106. I'm sorry. So first it was 100. Right now it's 106. Oh, so you see, you risk the same 1% of your account, but right now the monetary value is higher. And you can see how your monthly profit keeps growing and growing and growing and growing and growing, but you're always making that same 6% profit. Okay, that is compounded profit. That is the beauty of like just sticking to an account and just compounding it. Okay, we started with 600 profit, and right now our profit per month, it started with 600, but right now we're making 1,200 in profit. Okay, same risk, we still do 1% risk. Okay, that is the beauty of it, and if you go to that website, you can play with that. However, let's just take a step back, because is this real? Is it going to be perfect like this? I'm immediately going to tell you no. Okay. Again, we're still installing your trading mindset, because trading is a business and businesses have fluctuating profits. Now, if you look at the graph, for example, that I showed you, it's looking like this. We'd start from 10K, profit, 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 and you see how the profits are growing and growing and growing, and suddenly we're 20K. Sure, but it's a straight line growth, 6% per month precisely. Is this possible? No, it's not. Okay, it's not. Here's how a real performance looks like. So these are actually my own stats. Okay, live accounts. This one is investing. This one is trading. Okay, this is my 2025 equity curve, right? You see, it doesn't go 6. No, it actually had a losing period here at first. Then it went winning. Then it lost here. Then it went winning. Then consolidation. Then lost here. Then win here. Then lost here. Doesn't go in a straight line. It goes in cycles. You're going to win some, you're going to lose some, you're going to be flat some months, you're going to be losing some months, you're going to be on zero some months you're going to make amazing profit, and then the next month you might be a little bit flat. Okay, same with investing. It's going to go up, it's going to go down, it's going to all go up, it's going to be flat, then it's going to grow very nicely, then it's going to crash, and then it's going to grow very nicely again, and then it's also going to crash as well. Okay, that is the reality. It's never going to be a straight line. Okay. So the mindset and preparation for reality. So first things first, trading is not a 9-to-5 job. In 9-to-5, we are used to be paid for the hour and for the work that we put in. But in trading, you're not going to be earning a fixed salary every month. It's not like making $1,000 a month or 10% per month. That is a fantasy. If somebody tells you, okay, join my strategy and make $500 a day or make 10% per month, it's a lie, because it cannot happen that precisely you're going to be making 10% every month. One month you're going to lose 2%, another month you're going to win 20%, another month you're going to win 1%, another month you're going to be on zero. It's always fluctuating because trading is a business. It's not a job, okay? And businesses have profit and losses every month and every quarter, okay? So if you see the quarterly earnings of every big corporations, they're never the same. Some miss, some hit, some month they made this, some month they made that, this month they grew, this month they went down. That's how trading also works as well. Your monthly performance is always going to be different, okay? As I said, some months you're going to win 4%, some months you're going to lose 2%, other you're not going to win anything, and then there is going to be one big month where you, for example, make 12%, and that really puts you ahead on your equity curve, okay? That's the reality. The focus is over the course of a year. Did you make money? Okay, that's what matters long term. If you made money this month, okay, cool, but next month if you lose it, it doesn't matter. If you made money for 3 months, great, it seems like you're profitable, but when the market changes in the next 3 months and if you lose it all, doesn't matter. Okay, did you make money at the end of the year? That is the benchmark. Okay, so stop focusing on daily returns, stop focusing on weekly returns, focus on the long term. And I want you to really break your fantasies before you start trading, because it's not a get-rich-quick scheme. Trading is one of the hardest things that you can actually embark on. It's pretty tough. It's pretty hard. You're going to cry, okay? It's not going to be making you $1,000 per week or per day. It's not going to be quit your job in 3 months, okay? It's not easy, and it will very likely take you minimum 1 year to learn. If you get the proper mentorship and the proper guidance, it could be faster, but still you have to really go through the ups and downs of the market. It's not also a hobby, it's a professional performance business. It's like sports. You cannot be an Olympic champion if you just take it as a hobby. No, you really, if you want to really make money, you have to take it seriously and commit to it. Okay? So with that being said, let's talk about the holy grail of trading. Now, right guys, you are getting the strategy, because this is what it's gonna keep you in the game for the long term. And unfortunately, we're not at the strategy part yet. I really want to get there, but we have to talk about risk management first, because the holy grail of trading is risk management. If you ever listen to any successful trading veterans, any successful traders, they're always going to say risk management is the reason for their success, because it's what keeps you in the game for the long run, so you can actually make money. Because with correct risk management, it is literally impossible to blow an account or to lose a very big chunk of your account to the point that it's really hard to recover. Okay? And essentially, risk management is what makes you a business owner, not a gambler. It's what makes you the house of the casino. It's what makes you the casino and not the gambler. Okay? So before we get into the foundations of risk management and like how to calculate risk and how much to risk and when to increase risk and when to cut risk, we have to understand 2 more aspects of trading. The first aspect to understand is risk to reward ratio, okay? Also known as RR or just R, okay? Now, risk to reward ratio is how much you gain based on a unit of risk. So if you risk $1 to win 3, you've got a risk to reward ratio of 1 to 3. Easy, right? If you risk 1% of your account balance and you win 2% when you close your trade, well, you've got a risk to reward of 1 to 2. That is great. And if you risk, for example, in terms of money, if you risk $5,000 and you win $5,000, well, you got a risk to reward of 1 to 1. Okay, so you risk 1 to win 1. You risk 5K to win 5K. If you risk 5K and win 2.5K, that would be a negative risk to reward of 1 to 0.5. Okay, because you risk 1 unit, which is 5K, and you want 2.5K, which is half of that unit. So your risk to reward is 1 to 0.5. So basically kind of negative, okay? The standard is 1 to 1. Okay, that is kind of a positive risk to reward. Well, it's not positive, but it's like the threshold. Anything below that is negative and anything above that is positive. And basically why is that extremely important is because the risk to reward is what is actually going to keep you in the game long enough, and it is what's going to make you profitable at the end. Because let's say you take 10 trades and risk $100 per trade to gain $200. Okay, so what we're doing here is we're trading with a risk to reward of 1 to 2. Let's say you win 5 and you lose 5. Okay, so then if you count really, your losses are going to be 5 trades with $100 risk. You're going to get $500 of a loss. But your winners, You had 5 winners with $200 of profit. You're winning from your winners $1,000, okay? And then $1,000 of win minus $500 of loss, it gives you $500 of profit. So do you see right now? You won 5 and you lost 5, so you should be at 0, right? No, you're not, because your winners were bigger with a risk to reward of 1 to 2. Okay, that is the beauty. So even though you lost half and won half, your positive risk to reward ratio is what made you profitable at the end. Okay, so that is risk to reward, RR. Now let us discuss the other variable, which is also pretty important, and that is win rate. Okay, win rate is the percentage of trades you win out of a sample size of trade executions. And the formula to calculate your win rate is winning trades divided by trades taken. If you took 100 trades and you won 50 and you lost 50, you have a 50% win rate, okay? Because you won 50 trades out of 100, 0.5. If you took 20 trades and you won 5 and lost 15, that is a 25% win rate, okay? Because 5 divided by 20 is going to give you 0.25. Make that into a percentage, it's 25%, okay? If you took 50 trades and you won 17 and lost 33, okay, then 17 wins divided by 50 trades, 0.34, that is a 34% win rate. That is how you calculate your win rate. Now, a common kind of misconception or a common thing that many new traders ask is, do I need a high win rate to be profitable? So you probably think to yourself, in order to be profitable, I must have I must be winning more than I lose. Okay, well, sure. It's always better to be taking more wins than losses. It's easier on your emotions. You actually feel better when you're winning more. However, it is not essential, and that is the beauty of it, okay? Because your win rate is not the determining factor of your profitability, okay? Can you also have a low win rate and still be profitable? So can you lose 70% of your trades and still be profitable? Do you think so? Well, let's have a look at it. Now we're going to look at the very important relationship between risk to reward and win rate, okay? Because these two things, they go hand in hand, okay? One is not valuable without the other. So you cannot say, all right, I have a risk to reward ratio of 1 to 3, so I'm very profitable. But if you're losing a lot, well, you're still not going to be profitable. You cannot say, I'm trading with a 90% win rate, but your risk to reward is just absolutely terrific. You're still not going to be profitable, okay? So the combination of a good risk to reward ratio and a good win rate is what essentially makes you the casino and gives you statistical edge. And if I show you this amazing graph right here by Binance, what you see here is the win rate on top and then the risk to reward ratio here to the left in this axis. And then basically, let's say we have a 50% win rate with a 1-to-1 risk to reward, and we match them up, and you can see you're going to be a break-even trader, which means you're not going to be winning and you're not going to be losing if you have this combination of a 50% win rate and a 1-to-1 risk to reward. In order to be profitable with a 1-to-1 risk to reward, we need to have a 60% win rate. They're going to be profitable. But if you're trading with a 1-to-1 and you have a 20, 30, or a 40% win rate, sorry, but you're not profitable. Okay? Same thing. Let's say that you're winning only 30% of your trades. So out of 10 trades you take, you're just winning 3. Oh my God, that's sad, right? Well, it's not, because if your risk to reward ratio is 1 to 3, you're profitable with a 30% win rate. But in order to be profitable with such a low win rate, you need to have 1 to 3 trades. Okay? And if you go to the very extreme, if you take 10 trades and you lose 8 of them, are you going to be profitable? Well, if the 2 trades that you win have a win rate of 1 to 5, have a risk to reward ratio of 1 to 5, you're going to be profitable. So look at this graph, copy it, and then of course, as you start developing your strategy, it's going to be important to really keep notes of your win rate and your risk to reward ratio, and to literally know if you're profitable or not. This is also going to determine some more advanced trading statistics like trading expectancy and also profit factor, but you can very easily figure that out without complex calculations. Okay, so the benefit of knowing your win rate actually is, first things first, let me tell you, you're going to be taking losses, and you're going to be taking lots of them. You're going to be having losing streaks that are actually going to cause you to panic. But if you know your win rate, okay, you can become more objective and more data driven. So if you know what to expect, you're always well prepared. So here there is a graph by FTMO that I really like. And here, similar to the previous graph that I shared you, what you're seeing here is the probability of seeing at least X consecutive losing trades within a sample of 50 trades, which is really good. So this is how knowing your win rate is going to help you. Because let's say we have a 50% win rate, which is pretty good, by the way. We have a 97% chance to take 6 consecutive losing trades in a row. Okay? Consecutive losing trades. So if you know that, if you take 1 loss, good. If you take 2 loss, good. 3 loss, 4 losses, 5 losses, 6 losses, oh shit. Okay, I must be doing something bad. No, you're still staying within the statistical norm. Okay, if your win rate is, let's say, a little bit higher, 65%, then with a 65% win rate, you have like an 87% chance to take 3 consecutive losses in a row. That's nice, but let's say you're trading with a lower win rate of 30%. Well, I'm sorry, but you have kind of 97% chance to take 7 losses in a row, and you have 92% chance to take 8, and you also have an 82% chance to take 9 losses in a row. That's a lot. So knowing this, you can also structure your risk management. So if you know that, for example, your win rate is let's say 50%, and you have an 100% chance basically to take 6 losses in a row, you should always have this accounted for so that you don't blow your account if you take 6 losses in a row. Okay? So screenshot that, screenshot the previous one. But this is basically kind of the foundation of win rate and risk to reward. And then from there, we have to find the balance, because there are a million ways to trade and hundreds of win rate and risk to reward ratio combinations. So you might ask me right now, okay, Ilya, so what's the best win rate? What's the best risk to reward? Well, unfortunately, it's hard for me to say, because you really have to find your own niche in the market and your own edge, and what you also like and what you feel comfortable with, because there are some traders who really hate taking losses. So for them, a low win rate, losing like, for example, 7 trades out of 10 is not really going to feel good. But some traders can stomach that. So what kind of traders are you? Majority of traders, they cannot take a lot of losses. So usually you would prefer a higher win rate. But in general, if you ask me, okay, there is kind of the balance between these two things. A higher win rate is going to mean a lower risk to reward ratio. So you're going to hit smaller risk to reward trades, okay, which is easier, which will in then turn help you to take more winners, which in turn increases your win rate. But if you have a higher risk to reward ratio, so you're going for those big trades like 1 to 3, 1 to 4, 1 to 5, okay, the probability of hitting these big trades is lower. So you're going to be having a lower win rate, okay, because hitting higher risk to reward trades is harder. So you will be taking more losses, more break-evens, which is going to decrease your win rate. My tip for you will be to not target the extremes, okay? The best thing that you can start with is a 50% win rate with a risk to reward ratio of 1 to 2. That is literally the best combo you can start with. It is literally all you need, okay? Now, later on, you can drop your risk to reward to, let's say, 1 to 1.5, and that is going to increase your risk, your win rate to 65%, let's say, or increase your risk to reward ratio to 1 to 3, and that can drop your win rate to 40%. You then really have to find what works for you. What is extremely important, however, is not to target the extremes. So don't go for like 90% win rates, because very likely there must be something kind of maybe wrong there. Your risk to reward is very slow, very small probably. Don't trust people telling you have a 90% win rate, okay? And don't go for 5 or 10 hour trades that are extremely unrealistic, okay? Because then your win rate is going to be minuscule low, and you're not going to be very well emotionally prepared to really go with this type of trading style, okay? So with that being said, we conclude. We know what win rate is, we know what risk to reward ratio is, we know why they're important, and we know how to find the balance. So right now, we finally gotta get into some risk management, shall we? All right, it's time for a risk management workshop right now. I promise this is the final theory, and then we're gonna jump onto the charts, but that is extremely important to figure out before we start trading. So Risk management, there are different risk parameters. The most important one is your risk per trade. How much are you going to risk on every single trade? That can be determined in monetary values, like I'm going to risk, for example, $500 per trade, or it can be determined, which is what I would recommend you do, of a percentage value from your account balance. So if you have, for example, $1,000 and you risk 1% of your account, then you're going to be risking $10. Okay? The second thing that we have to determine is your max loss per day. So how much risk will you allocate on a daily basis before you stop trading? That is what professionals do. Then you're going to have a max loss per week. How much risk will you allocate on a weekly basis before you stop trading? Okay. Then there are some advanced trading criteria that I personally use on my live accounts. That is flatlining the drawdown criteria. So when will you decrease risk in order to prevent deep drawdown? And scaling the profit criteria. When will you increase risk in order to increase profit? Okay. So let's have a look at these things, and I want you to also start taking note of them and really thinking about them right now. Here are your main risk parameters. Risk per trade, 1% of account balance. This is what I recommend. If you have a $1,000 account, you'll be risking $10 per trade. How do you calculate that when you enter into a position? I'm going to show you later on as we're going to do some demo trading. So 1% risk basically is the ideal balance. If you want to go maybe a little bit smaller, you can do 0.50% risk. If you want to go a little bit bigger, you can do 1.5% risk of your account. But really 1% is the golden risk. It's not too much. It's not too little. Okay. And it's going to be very hard to really blow your account if you just stick to that 1% risk. So for starters, 1% risk of your account, great. Max loss per day. Now, this depends on quite a couple of things, but let's say that you say, okay, I'm going to be losing maximum 2% per day. So if you risk 1% per trade, basically you have 2 losses in a row and you have to stop for the day. But this a little bit depends on your trading strategy. Let's say you are a trader that takes a lot of trades and you take, for example, 4 to 5 trades a day. Then you might want to reduce your risk to 0.50%. Why? Because you can have space to take 4 trades times 0.50 and lose them all and still maintain within that 2% max loss for the day. Okay, that is really personal. So for example, in my trading, when I trade futures, let's say I am risking, let's say $150 a day, and when I lose 450, I stop. So what is that? That is 3 losses in a row. Okay. It's very easy. You really have to just determine it for yourself and be disciplined to sticking to that. Now, if you take a winning trade, however, that gives you a new bullet. So if you take a loss and then you take a win, well, you don't stop. You took 2 trades, okay, but you still not met your max loss for the day. Okay, so of course, don't overtrade. But if you start with a loss and then you take a win, well, you still haven't met your daily loss. So if you can take another trade, okay. And then, of course, until you get into profits, then you will also have to decide when to stop. But more important is to decide when to stop when you're in drawdown. Because if you say, okay, if I make 1% a day, I stop. Well, what if there is another amazing trade so you can make 5% a day? Okay. If you recognize a good day, you have to push it. But you also want to set a daily trade limit so you don't take like 100 trades a day. That really, again, depends on your strategy. Okay. So those things you're going to figure out with time. Next is max loss per week. I would say 6% per week is in fact quite a lot. So if you risk 1% per trade and if you take 6 losses in a row this week, so if you lose 6% this week, you just got to stop because that means you had 3 full losing days, which is not good. Then something is wrong because sometimes it's just not your week. Okay. And you must have a limit to know when to stop pushing your luck, take a step aside, and come back next week so you actually protect your capital. Okay, so these are the main 3 things that you need. How much are you going to risk per trade? What is your max loss per day? And then what is your max loss per week when you're just going to stop trading for the week? So right now, pause the video and think about these things. Okay? Did you pause? Probably not, but you're going to figure that out. So let's talk about the advanced risk parameters. These are parameters, by the way, that I have not invented, but that I have created for myself, but I haven't really seen anybody teach this, okay? your advanced optional, which are optional risk parameters. Now, the first advanced parameter that you can add is flatlining the drawdown criteria. So basically, you can cut your risk in half when you reach a certain drawdown threshold of your initial balance. Okay, that is great also if you're doing funded account challenges. So this is how it looks like. Okay, this is where we start. So we start with a fresh account, let's say $1,000 fresh account, and we start losing. We lose, and we lose 4% of that account. Okay, so we have lost 40 bucks. Okay, so we have on our $1,000 account, we have lost 40 bucks. So if we cross that minus 4%, which is what is called drawdown. So drawdown is when you lose money on your account. Okay, it could be balance drawdown. Balance drawdown is basically from the starting balance. It could be equity drawdown, which is when the market is up here and then you take, for example, a little bit of a pullback. Okay, so if you cross this line, you cut your risk in half. So if you're risking 1%, so you took 4 losses, 1, 2, 3, 4 losses, you lost minus 4. Then anything below this minus 4 is right now with 0.50% risk. So you cut your risk in half. Why do you do this? Is to decrease the losses and to avoid going into deep drawdown. So let's say, for example, you take let me try to draw 1, 2, 3, 4 losses. Okay, boom, minus 1, minus 1, minus 1, minus 1. But then if you cut it to 0.50%, your losses are gonna start flattening out like this. Okay, so it's not gonna like continue dropping like that, but they're gonna flatten out a little bit. Okay, but then the next key moment is that when you emerge above that minus 4% threshold, you can go back to 1% risk. So anytime you go below 4%, you cut the risk. But then if you take a win and you go above that 4%, you resume back to your normal risk. What this helps you with is not to dig a deeper hole below your drawdown threshold. Now this threshold can be 5%, it can be 6%. You can determine that. Okay. But that is really good for funded account challenges because you can blow your account if you reach 10% drawdown. So if you reach, for example, half of that, I cut my risk because I don't want to blow my account. Okay, so that is flatlining the drawdown criteria. And then the next one is the scaling the profits criteria, which is increasing your risk by 0.25% or 0.20%. Again, you decide what you're comfortable with when above 10% profit from initial balance. Now that could be 5% profit, it could be 20% profit, really you decide. I'm just giving you ideas on like how to tackle these different risk management situations. So for example, we start again with 0% profit, fresh account, and we trade well, and we make 10% profit on our account. Amazing. Okay, so anything above that 10% line, we can increase our risk. So if we were risking 1% from the start, and if we make 10% and anything above this line, we can do 1.25%. Why? Because this is really gonna help us scale and like really make everything vertical, of course, if you trade well. Okay. But if you dip below that line, you have to cut back to normal risk. It's like the same with the flatlining because you don't want to say, okay, I made 10% and I go to 1.25% risk and then you start taking loss with 1.25. You're going to very quickly blow all of your earnings a lot faster because right now your risk is bigger. Okay, so only if you are above 10%, you can increase the risk. If you take a loss and you go below the 10%, you go back to the normal risk. Okay, you can screenshot this. And then of course you can do that in levels. If you go from 10% to plus 20%, you can add more risk. Okay, but if you go like above 20 and then you dip and you go like plus 19% profit in your account, you have to go in your scaled risk 1, which is between 10 and 20. It's like boxes. Okay. And if you continue growing, of course, you can continue increasing. Now, again, I would just recommend you for a beginner, just stick to 1%. You don't need all of these. These are good things if you want to like scale a live account aggressively, but with compound interest, as your capital grows, if you just do 1% risk, as your capital grows, your monetary risk is also going to increase. So you don't really need to increase your risk as well. But this is just an idea. I do this only with live accounts. Okay. And of course, you can do a combo between both, which is definitely advanced and complex. Okay, so you can have, for example, starting from 0, you have your flatlining the curve at -4. Let's say you travel from 0 to 10. All right, we travel, then we reach 10. Okay, but then if I fall from 10 to 5, I'm gonna cut. Okay, and then if I travel from 10 to 2, and then if I fall at 15 profit, I'm gonna cut again. Like, why do we cut? Is again to flatline and to avoid from losing a lot, to go back to break even or to go to the previous scaled risk. Okay, so you can do it basically in 2 ways, right? The previous way that I explained to you is like if we let's say emerge above the 10%, we increase the risk, but the moment we dip below the 10%, so we take a loss, immediately go back to normal risk. Okay, or you can say, okay, I reached 10%, good, that is a milestone. So if I go from that 10% and if I lose 5% and I go back to here, then I'm gonna cut my risk, not immediately when I dip below the 10. And you can do the same here. Okay, I reached 20% profit, time to increase my risk. But then if you take a couple of losses and you go at 15% profit, then you cut the risk again to ensure that you don't start losing and go down. And then as soon as you climb back up, you can resume it again. Now you can definitely, these are just ideas, by the way. Now personally, I don't do this, but I just wanted to show you like what is possible. And I would only really recommend this for a live account. So if you deposit your own money and you really look to scale that and make some big percentages, that is how you can potentially do that. Okay, but the key is, once again, risk per trade, max daily loss and max weekly loss. That is all you need. And the flatlining criteria is good because when you go on a losing streak, it's going to help you to lose less and like really not go into very big drawdown. Because if you go into big drawdown, like let's say 8 to 10%, then it gets a little bit hard to recover, because right now you're in drawdown 10%, you have lost 10% of your account balance is lower. Okay, so then risking 1% of a lower account balance, you know, it's gonna take more time to recover. Okay, whew. Let's recap what we learned so far. The trifecta of trading success: risk, strategy, psychology. We discussed your why, which is very important. We talked about your monetary situation and your goals and your why. We talked about the compound effect, and we talked about the trading reality, that it's not going to be like make 10% every month. No. Okay. We talked about risk to reward ratio and win rate, which is extremely important. And we also built the first foundational risk management plan. Okay. Risk per trade, max daily loss, max weekly loss, and then the advanced risk management criteria. Right now, it's time to get fun. It's actually time to get into the charts. So I hope you're ready. Let's get your browsers running because it's fun time and we're gonna set up your chart platform. Hey, just real quick, if you are loving the video so far and you're finding it insightful, please go just down a little bit, hit that like button and subscribe to the channel. It really helps to bring more awareness to this video because you're gonna be getting a lot more values. With that being said, come on, hit that subscribe and let's get back to the video. All right, here we are about to open up your charting platform. For this, we're going to use TradingView.com. So open Google and go to TradingView.com. You're going to be taken to this page. Now, what is TradingView? This is a charting platform. What does charting mean? It's literally like drawing things on your charts and making your technical analysis. You can also trade on TradingView, which is great. There are a lot of tutorials about it, but for now, we're mainly going to focus on the drawing part. So first things first, of course, you have to create an account if you don't have one. Get started for free. They have different plans. I will totally recommend that you get a plan if you're serious about trading. I would recommend that you wait for a sale. They do sales on every big holiday. For example, Easter, they might do one. Black Friday, they always do. Cyber Monday and different types of holidays. They do some amazing sales. Sign up for free, however, email, password, make an account. So let me log in and I'm going to show you then how it looks like. So there we go. I am in right now. You can see I'm on the premium plan here. But basically, if you go, how do we then access the charts? Well, we go to products right here and we click on super charts, the one terminal to rule them all. God damn. So when you open the super charts, it's probably going to be very random. Now, I did make a new chart right here to show you how it's going to look like. You're probably going to be maybe on a white theme. I'm on a dark theme. I don't even remember how to change this. It must be from settings somewhere here. but I'm not gonna look into it right now. I don't really remember where did it change to dark theme. But anyway, right now we are on TradingView, and you're very likely gonna be like on Apple or something, but it doesn't matter. Right now, let's just make your charts look a little bit pretty. Now, what you're gonna do is you're going to right click on the chart like that, and you're gonna go to settings, okay? Now, the preference for your charts is really personal, okay? It's really personal. You can play with any colors, but I'm just gonna give you a very nice and kind of basic one that is going to be very easy for the type of technical analysis that we're going to be doing. Okay, I have it saved as a template. It should be, let me see, is it this one? No, it should be this one. Best. Okay, so first things first, you go to symbol, okay, and then you go to body. So when you go to body, and if you click plus here, you can copy this C5, 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 add it right here, and it's gonna be here. So this is gonna be one of your body, and then you go to the other one. You can actually do the opacity to 100, and then you add this number here, 43, 46, 51. Okay, click add. It's gonna be here. Boom. Okay, borders. You go black, pitch black here, 100% opacity. Same here, wick, same here, same here. Okay. Time zone, what I would prefer for your time zone, it doesn't matter where you are in the world and what time zone you are. Later on, as we start talking about sessions, we're going to talk about them in New York time. So time zone here, find New York and click on New York. Precision needs to be default. Okay. Now status line here, this is all the things that appear right here. Now, do we need them? Yes. Title, this gives you the instrument, the time frame, and the broker. Open market status, that is going to show you if the market is open. Chart values, you also need this sometimes. Volume, you don't need that. Last day's change, you don't need that. Indicators, titles, you probably don't need the inputs to show, and the values you also don't need to show. Background, what is this? I don't even know. You don't need it. Scales and lines here, you in general don't really have to touch anything here. But then you can go to canvas, and this is where you determine the overall background. Now I have my background as this color, E7, E7, E7. Now you can make it fully white like this, or you can make it just slightly bit like this, which is kind of what I like. Not to be black, very white, because it can burn your eyes. So if you just, for example, type here E7, 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 boom, okay. Now, grid lines here, for grid lines, you want to remove the opacity. Okay, what are grid lines is these vertical and horizontal things. You want to click on both and you want to remove them. Crosshair, it's this thing. Okay, you want to make this, you can make it black fully. That's great. Watermark, you don't need it. Remove it, because that is going to give you like the pair. You really don't need it. Text, these are your scales here. Now, if you don't have good eyes, you can increase them a little bit. Mines are on 11. Lines, it's fine. Just leave it as it is. Okay. Trading, you really don't need that for now. Alerts, you also don't need. Events, you also don't need. You might have these volumes down there. So you just right click, remove. Ta-da! You have really nice charts right now. Okay. And these are the charts we're going to be using. See, it's very nice. It's kind of nude. It's very balanced. It's very nice. So right now you are looking at the charts. But what are these things? What are these? These are called candlesticks, but what they are, how to understand them, and how to start doing analysis. Because if you're a complete beginner, maybe you don't know what you're looking for. So right now you have an overall chart. Okay. So let us actually go and explain. So maybe right here as well, maybe your chart can look like this. I really don't know how it's going to look like if you make a brand new registration, but you can go here, bar style, and you have to choose candles. Okay, choose candles, and this should appear. If your charts looks something completely different, I have a full tutorial on TradingView as well. I'm going to leave it in the guidance. That is going to be the first thing in the description that you can download, so you can also set up your charts in a different way. But right now that we have our charts, but we don't know what to do with them still, let us go back to the theory right now and talk about candlesticks. All right, so right now let's understand what candlesticks are. A candlestick contains 4 parts. It has an open, it has a close, and it has a high and a low. These are called the OHLC values, the open, high, low, and close values, okay? And then it pretty much has a body, which is the painted part, that's the body, and then it also has wicks. We have an upper wick, okay, and you have a lower wick. Now, what you have to understand is that, of course, candlesticks are going to have colors. And what is going to determine the color is where it opens and where it closed. So because this is a bullish candle, that is a green candle, it went up, it opened right here, okay? It made a low, but then it pushed all the way up to make a high, and then it actually closed right here. So a candlestick tracks the movement of the price action, okay, within a certain given time frame. In this bearish candle, the market, because it's a bearish candle, it opened right here. It first pushed up at a point in time, then it pushed down, pushed down, pushed down, pushed down to make the low of the candle, and then it retraced back to make the closure. And then this is what gives us our values, okay? Now, candlesticks are what create what is called price action. So if you put multiple candlesticks together, you get price action, which is how this looks like, okay? And then if you track every single candle, you can read the candle anatomy of every single candle. So for example, this candle, it opened here, okay? It first went down to this low, then it pushed all the way up to make a high, and then it pulled back to close right here. So that is how this candle developed. And when this candle closes, now when does a candle close? It depends on the time frame that we're looking at, and we're just gonna talk about time frames. But let's now focus on the candles. The next candle opens exactly where the previous candle closed. It opens, okay, and it opens here. It first pushed up, then it pushed all the way down to make the wick, and then it closed right here. So you can see the open is here, but the close is here. So the close is lower than the open, so this is gonna print as a bearish candle, okay? And where this candle closes is where the next candle is opening. Right here, this candle pushes down to create the lower wick, and then massively pushes up, makes a high, and then it retraces back. And usually candles always leave a wick. Most of the times they're gonna leave some sort of a wick, and then we close here. So we opened here and we closed here, so that is a bullish candle. The next candle opens, makes a little high, massively travels all the way down to here, and then it pulls back and it closes here, okay? So the closure is lower than the open, so that is gonna print as a bearish candle. Next opens, pushes up, pushes down, closes here, another bearish candle. Next opens here, pushes down, closes here, another bearish candle, but you can see they're starting to become smaller and smaller. And then where this candle closed, the next one opens right here, pushes down, but then whoop, pushes up to create the high, and then it closes right here and it turns into a bullish candle, okay? And then the next candle opens, it goes up, it goes down, and then it closes, but this is what we call an indecisive candle. Do you see? It's like it has a very small body and it didn't really go anywhere, okay? So we're going to be talking a lot more about price action, of course, but this is how price action forms. It's a combination of multiple candlesticks, okay? So we have to start leveling it up, all right? So we're going to have a look at the candle anatomy, level up. So what you have to understand is that every individual candle tells a story. And how to understand the story is by reading carefully every single candle's body and its wicks. Because trust me, it's all logical. Now, what does the body mean? The body is the meat of the candle. It tells who was actually in control and how strong the volume was. If we see like a really big body, a lot of buyers or a lot of sellers. If we see a small body like we saw, there wasn't really that much volume, okay? So if you have a very big body, so if you have a really big candle, that means there is a lot of momentum in the market. There is a lot of strength. There is a lot of control from one side of the participants, either the buyers or the sellers. And if you have a small body, then that means there is a lack of volume. There is weakness. There is indecision. The big financial institutions are not willing to participate right now and really push price in a certain direction. And then we have the wick, okay? Now, the wick is a little bit tricky because the wick signifies a rejection. It signifies a reversal. It signifies opposing aggression, okay? A small wick means that there is no rejection. again, as I said, it's normal for every candle to have some sort of a wick, but if the wick is small, it's pretty normal. But if the wick is big, okay, that means that the opposing side is entering very aggressively. Now, to really understand the wicks, you really have to first imagine how does a candle open and how does it close. So you actually have to watch candles play out live. Because let's say a candle opens right here, okay, and it first pushes down, but then it massively pushes up, and then it closes right here. So that is actually what is called a bar chart. You actually have these kind of patterns, okay? And what we see here is that actually this is going to be the body where the market closed, and we're going to have two wicks on top. That is how a candlestick is created. And watching it live, what you're going to see first, it pushed down, but then we had a massive rejection to push all the way up. So this wick right here, which is relatively big wick, tells us that there were so many buyers here that they really managed to push price up. And here on the upper wick, we say that there were some sellers here that managed to push price down. And then of course the meat of the candle is the body. What we see is that there were buyers in control because the candlestick closed bullish. Okay, now we're gonna of course look at these details, but you can only see this if the market is of course playing out live. Now, you probably know that there are a lot of candlesticks. There are a lot of candlestick patterns. If you type in Google like candlestick patterns, you're gonna get all of these things, and there are tons of them. When I started trading, I really wanted to learn all of these candlestick patterns because I thought that if I understand them all, I'm going to be very profitable and I'm going to be doing very good. But it's a problem because you really memorize all of these candlesticks and there are too many. And are they really useful? Well, sure, but what really matters is that you understand the logic and the dynamic behind every single candlestick and how it actually played out. Okay, so let me teach you right now how to logically think about what I call candle anatomy, and then we're going to look at some of the most common patterns that are actually good. So we have the body. Okay, so what is a strong body? A strong body is being a relatively big body, for example, maybe compared to the previous candle, or just the overall body here being bigger than the wicks. So if you see this candle, is this a strong candle? Well, it is. Okay, we have a very big bullish body. We have a wick on the downside, we have a wick on the upside, but the body is relatively bigger than the wicks. Okay, that is a strong candle. That is a momentum candle. And then look at this one. Is this a strong candle? Well, you see the body is not as strong compared to this one. We have a very kind of good wick on top and we have a really big wick on the bottom, and if we actually combine both of the wicks, they're probably going to be bigger than the body. So what that tells you is that there was not a lot of strength and there is a lot of rejection on both sides. So is this a strong candle? No, I would say it's more like of an indecisive candle. Sure, it is bullish, but it's not as strong. Okay, so that is the body. Okay, we look at the body to determine the length of the body and how big it is according to the wicks. Okay, and also putting it into context with the previous, because if I just show you this candle here, is it strong, is it small compared to what? Okay, like if the previous candle was maybe, I don't know, if the previous candle was looking something like this, all right, then maybe this one is gonna turn to be small. Okay, so it really depends on context, but what you have to look for is the body, okay, and how big it is in accordance to the wick. And then let's study the wick. Okay, now look at this here. This is a relatively kind of weak body. It's a strong bearish momentum. The market opened, it made a wick on top, massively pushed, it stopped right here and it retraced to close. Okay, what does this candle tell us? Well, there was a little rejection on top and there is a little rejection on the bottom. Okay, nothing very important, an overall bearish body. Look at this one. So again, in order to understand what really happens, I'm gonna draw. You might not see my cursor right now, by the way, because I'm drawing, but I want you to just so we're starting from here because that is where the market opened. The market really, this market was looking bullish at a time. It was pushing up very strongly, but then some sellers came in and they pushed the price all the way down to here, and then they closed right here. Okay, so what this kind of price development tell you about this candle? We were really bullish at a point of time, but then the market massively rejected and went all the way down and actually closed bearish. With a bearish body. Now, if you only look at the body right here, you would say, okay, well, this is a relatively weak candle. Let's say it's a very small body. Sure, but I want you to look at the wick. Okay, what the wick in this case signifies is that there was a lot of rejection. There was somebody really pushing from the top. Like there were a lot of sellers from this level really pushing the market lower. This is what essentially created that wick. Okay, and then the market actually closed bearish. So that is a very weak candle. That is a really bearish candle. Okay, the next candle is the same but flipped around. Okay, and this in this case, reading this next candle is gonna actually give us a little bit more of a bullish sentiment. Why? Because the market opened right here. Okay, and it pushed down and down and down and down. It was really bearish up until this point, and then from here it flipped all the way up, and it reached here, and then it closed right there at the closure. Okay, so what does this candle anatomy tell us about this candle? It opened and it went really massively bearish down, but then it went really massively bullish up. And sure, it's still, I'm actually wrong on that one. Oopsie, the market opened here. I'm sorry. The market opened here because it's a bearish candle and it closed here. Okay, so let me do that again in order to not confuse you. We opened right here. Okay, we massively pushed down and we close right here, and we probably at the opening we made a little bit of a move up and then we started moving down to create the wick. Okay, but again, what is more important in this case is that within this wick there were so many buyers to really push the price higher and reject these prices. Okay, so that is relatively showing us that there is a lot of rejection on the bottom, while this shows us that there is a lot of rejection on the top. So there is like an invisible force pushing. So imagine here there is a hand that just push, like the market tries to go down, but there is like somebody lifting it up. Well, this one, imagine that there is somebody shutting it from the top. Okay, and then this one is an indecision candle. You can see it opened, it pushed up, it pushed down, and it closed exactly where it opened. This is what we also call a doji candle if you watch online, but it's an indecision candle. It didn't really decide what it wanted to do. It went up, it went down, rejected on both sides, and it closed perfectly with a neutral body. So it's not weak, it's not strong, it is indecisive. Okay, so do you see right now that you don't really have to understand, like, is that a pin bar? Is that a shooting star? Is that this candle? Is that a doji? Is it a gravestone doji? Is it this type of doji? You don't need all that stuff. You really need to understand like what is behind the candle and how did the candle actually play out. And then when you understand these things, you can potentially start looking at some combination of candles. So for example, the most common combination that I really love using is the engulfing combination. Because if you watch here, we had a bearish candle, relatively okay. We had a rejection on top, but we also had a rejection on the bottom. So relatively indecisive candle. But then the next candle opens, and what does the next candle do? It opens right here. It pushes down first, but then it massively pushes up and it pulls back to close right here. So this candle fully engulfed the previous candle's body. Fully closed above everything. It closed above the previous candle's high and it closed above the previous candle's body and just fully ate it. This is what we call a bullish engulfing candle. Okay, what does that signify? A lot of bullishness is coming after this bearishness. And then we have this candle here, which was bullish. It opened here, but look, you can already see it within the candle anatomy. It pushed all the way up, but there was an invisible hand here that really shut price from the top to create this very nice wick on the top. Okay, what does that mean? Again, what is the wick? It means a rejection. It means opposing force is pushing price in the opposite direction. And then the new candle opens. It pushes up a little bit to create the upper wick and then massively went lower to create the candle low. Okay, and then it pulls back to create the candle closure. And that is a bearish engulfing because it fully engulfed the previous candle's low and the previous candle's body. Okay, that is what defines a bearish and a bullish engulfing candle. Okay, and right now let's actually put it into practice. Let me go right now on the charts immediately and give you an example of how you would read, for example, candlestick formations. All right, here we are on the chart. So let me just walk through some candlestick formations. For example, I'm going to zoom in and start, for example, from the most recent ones right here. Now you can see, for example, this candle is still running. Okay, it is still printing. It's gone up, it's gone down right now. You can see the body, it's constantly changing. Right now it turns from bullish. Right now it's starting to turn into bearish, and it has a wick on top. What does that wick on top signify? It signifies that there was some sort of a bearish pressure pushing it from the top. Let me change to demonstration here. How did I do that? Okay, good. Let's cover, for example, this candle right here, but can I stop my cross here? No, I cannot stop my cross here because I don't want it to show, but it keeps showing. Okay, so I'm just going to keep the cross here. How would you read this candle right here? Okay, look, it opened exactly here. Okay, it pushed very nicely down, and then it pushed very nicely up, and then it closed. So that is a relatively bullish candle. We have a lot of rejection on the bottom, which gives us a lot of bullishness. Look at the previous candle. Now, when you look at this candle right here, what do you see? Okay, read, for example, the candle anatomy. The market opened right here. It pushed down, and then it pushed all the way up, and then it closed right here. Okay, so there was an invisible force on top here that really caused the market to very massively push down to create this very big wick. So I would call this is a very strong bearish rejection candle. Okay, look at this previous candle. What would you say in this candle compared to the previous candle? Look at the previous candle. It opened up, really nicely pushed up, and then it just left a little bit of a wick here, a rejection on top. The next candle opens exactly where the previous candle closed. It pushed down. Is it very weak? Like, is it really strong to the downside? No, because if you compare it to the previous candle, it is actually staying inside the previous candle's range. So if I take two lines and I draw, this is the previous candle's low and the previous candle's high, okay, you can see the market is actually staying in this candle, it's staying inside this candle's range. And you can see the next candle kind of comes and engages with both of these highs and lows. So that one here I would call an indecision candle. This candle here, that is a really nice upside rejection. The market opened, it really nicely pushed up, and then it was just shut down to the downside to close here. So there's a really strong rejection from the upside. That is a really clear bullish candle, very strong. It opened, very big bullish body. What is this right now here? This is an engulfing candle. Why is it an engulfing candle? Because look at the previous candle. It was a bearish candle with a little bit of a rejection on the bottom here. That signifies that there were some sort of buyers coming in. And then if you take the previous candle's high, okay, this candle here closed with the body closed above the previous candle's high. That is an engulfing candle. You can see the next candle, boom, it goes up. Okay, same right here. That is a bearish engulfing candle. Why? Look at this candle right here. Okay, that is a relatively good bullish candle with a little bit of rejection on both sides. Okay, however, look at the previous candle. The previous candle is really strong bearish candle with some rejection on the bottom. That means that there were some buyers entering from the downside here. But then look at this candle, massive engulfing candle, breaking the previous candle's low. The candle's lower the high is always going to be a wick. Okay, massive engulfing to the downside. Now this is what I would call is an extremely bearish candle. Look at the body of this candle, extremely big. And then the next candle also continues to go down. Okay, so that is how you basically read candles. Okay, and there are different types of candlestick formations like evening stars, morning stars, but I would just really want you to look at the psychology behind the candles. Like, what do you see on this candle, for example, here? This one. The market opened here. It pushed to reach this point. At some point in time, the market was up here, but it got really shut down to the downside to make that very big wick. What do wicks signify? They signify rejections. They signify the market is not accepting this price. It just wants to push it lower. Okay, there is an invisible force here that really pushed the market lower to make it close with this very big wick. Okay, this is what we call a rejection candle, and that is in this case a bearish sign because there is somebody really pushing it from the top. And you can see indecision candle, here we see a really strong bearish candle. Why is this a really strong bearish candle, by the way? Because it opened here, it first pushed up it was looking like a bullish candle at first, but then it really, by the bearish forces, it got shut down to the downside to close with a really strong bearish body to the downside. So we start seeing that, okay, sellers are really starting to get aggressive, okay? And if you kind of use the replay tool, no, you actually cannot see the candle play out. Okay, I thought you can see the candle play out, but you can, for example, go on the 1 minute time frame, which we're going to talk about time frames right now, and you can just watch how candles are developing. So do you see, for example, this candle opened right here. It really strongly pushed. It was up here at a time, and right now it's pulling back. Now, what does that mean? That there are some sellers. Look, the sellers showed us the rejection. Right now, this candle is opening, and it's opening with a lot of weakness. You see, it's so far just a pure, very nice bearish body. Okay, so let's just spend 1 minute watching this candle. Really strong bearish. It's so far an engulfing candle because it's breaking below the previous candle's low. It leaves a little bit of a wick to the downside, but it continues to push. It continues to push. You see the body's getting bigger. Okay, now look. Now it's starting to leave a rejection. Okay, so it came into this price point, which is what we're going to discuss just in a bit. It came into a level of support, and the buyers started kicking in. And you see right now, like, buyers are starting to kick, and this is what we call a rejection. You see how it's rejecting from this price level? Okay, so this candle looked extremely bearish at first. You probably saw it, but right now it's not looking that bearish anymore. Why? Because it has a very big wick. It's signifying a lot of rejection. Okay, so let's see how it's gonna close. Boom, look, right, this closed with a massive rejection. Now, is this a bearish signal or a bullish signal? I would say it's more of a bullish signal. Why? Because there were so many buyers within the wick. It first was extremely bearish, but then a lot of buyers entered to close this as a wick, which signifies a very big rejection. The next candle opens, it pushed down a little bit. Okay, it pushed up a little bit, then it pushed down again. So right now it's again trying to go down, rejecting. Okay, trying to go down again, massively going down right now, looking pretty bearish. Okay, and you can see how it's constantly moving, and the movement of this is basically forming the candles open, high, low, and close. This is a 1 minute candle. So every candlestick here is 1 minute worth of price action. Look, okay, this candle, look, this candle was extremely bearish at a time, but right now, look, okay, based on the previous candle where we saw that very massive bullish rejection here, this candle again tried to go bearish, and then it turned bullish. Okay, and right now, what do you think of this price action so far? It is more bullish than bearish. The next candle opens. Look, this candle just went very fast red, and boom, it just expanded massively bullish. And it all started from this candle here that showed us the rejection. That shows us that there were a lot of buyers participating here. The next candle tried to push down, but failed, okay, and it became bullish. It is actually an engulfing candle, closing with the body above the previous candle's high, and then this candle is really what gave us the push. Okay, look, it opened, it went bearish for a moment, and right now it just pumped bullish, creating a very big bullish body. It reached the top, it tried rejecting a little bit, right now it's trying to fight for a new top. And you see, right, this is how you can also train yourself to understand the candlesticks, because it's extremely important. Instead of going online and doing trading candlesticks patterns, and for example, entering this and say, okay, hammer candle, bullish engulfing, morning star, bullish pin bar. Okay, so what we saw right here is a bullish pin bar. There is, that is a pin bar. Okay, so you can definitely go and study them, but what I just showed you, the psychology behind these candles, is what really matters at the end. So hope that little exercise was insightful to show you how to read candles and really to read the psychology behind and the movement behind, instead of memorizing the actual candlestick patterns. Alright, fanatics, I really hope you're excited and you're finding a lot of value from the video so far. So right now we're going to talk about time frames, because you saw me there. I was first on the hard time frame, then I went to the 1 minute time frame. So what do those time frames actually mean? What are trading time frames? So what you really have to understand here is that price is price. Okay, it prints every second, every little movement is documented within the charts. Okay, and it's the same price across all time frames, because some beginners might think that when you go between the different time frames, price changes. No, price is always the same. It has been what it has been, because we kind of always see the past price action. However, The time frames are different representation of price. It's different data visualization with less or with more detail. Okay, so why are time frames useful? Well, we can see price action between kind of different from different angles, and we can form opinions whether price is cheap or expensive based on these different time frames. So for example, the higher time frames, okay, where we look, for example, at 4-hour time frame, daily time frame, weekly time frame, these are hard time frames because one candlestick, it takes 4 hours to create, or one candlestick, it takes a day to create, right? So that is a lot of time, but it's gonna show us the bigger picture because we're gonna be seeing more data, okay, from a lot of time in the past, okay? And they're gonna be very helpful to determine the overall trend, okay? While the lower time frames, these are gonna be the noisier time frames. They're gonna show us granular price and are better to refine zones and find entries. So, you know, price just doesn't just move, goes in a straight line. It's gonna do like up and down and up and down and up and down and up and down, right? And this is all locked in on the lower time frames. But on a higher time frame candle, you're just gonna see one candle. And all of that information from all of this madness is just locked into one candle. That is why time frames are helpful, because it can add noise or remove noise based on what you really want to see, okay? And as a trader, you have to use a combination of different time frames. So you're gonna be having time frames for identifying the trend. We're gonna call them the higher time frames, HTF. You're gonna see them shortly. And time frames for zones, okay, to trade from, which is what we're gonna be calling points of interest. We call them middle time frames, or MTF. And then we're gonna have time frames for entries, which we're gonna call the lower time frames, the LTFs. Okay, so just a little introduction about the time frames, but we're gonna touch a lot more on that as we go with this course. Okay, now the fractal nature of the markets. Again, as I told you, like the market is fractal, so what happens on one time frame happens on the rest of the time frames. Like these little ticks, okay, they're patterns within patterns. So what happens on the daily time frame, how the candles is printing on the daily, it's the same way that a candle would print on a 1 second time frame. Okay, so basically what I just told you right here, now here you see a daily candlestick that has closed. It opened here, we made a low here, we massively pushed up to make a high, and then we pull back to make a close. Okay, but if you look at this candle only, you cannot fully visualize what exactly did this candle do. Okay, like did it, like for example, did it open here? It went up first, then went down first, then went up first, then maybe went down first, then massively went up, then down, then up, then down, then here to reach the high, and then it pulled back to the closure, right? We don't know how exactly it played out if we look at only the daily candle. But this is a 15-minute time frame. So every single candlestick here is 15 minutes worth of data. Okay? Oh, my battery got exhausted. No way. It's 15 minutes, 15 minutes worth of data. Okay? So what you actually see right here is I have marked the exact same lines, okay, and transferred them onto that 15-minute chart. So we can see this is where the market opened. And what did it do? It first went down a little bit, then it went up a little bit, then it went down a little bit, then it went up again, then it went down a little bit. And then from here, it really started going up, pull back, going up, down a little bit sideways. Then it massively went up, a little bit down, then it went up once more, then it pulls back a little bit, then it pushes for one final time, and then it retraces back, then it pushes up a little bit, then it retraces back again, pushes up, and this is exactly where it closes. Okay, and all of this information, which is gonna be like 24 hours worth of 15-minute candles, is what actually prints this candle on the daily time frame. Okay, so price action is the same. It opened here, this is the low, this is the high, and this is the close, period. That is the data. Okay, however, that is how it actually played out on the lower time frames. Okay, and if I go into every single individual candle on the 15-minute, and I do that the same thing, for example, on the 1-minute time frame, if I, for example, take, let's say, this candle right here, and I take this candle and I go to break it down on the 1-minute time frame, it probably did something like this. It opened, it massively went down, then it went up, and it closed where it opened. Okay, It opened here, went down, pushed up, and closed. Okay, but we cannot see that on the 50-minute time frame. We probably have to drop on the 1-minute time frame to really visualize the granular details of this singular candle. Okay, so with this right now, you understand the fractal nature of the market and what the time frames mean, but right now, which time frames to actually use. So the time frames that I would recommend you to follow are the following: the weekly time frame, the daily time frame, the 4-hourly time frame, the 1-hourly time frame, the 15-minute, the 5-minute, and the 1-minute time frames. Those are the most widely used time frames, and they literally do all the job done. Okay, they're gonna give you all the patterns that you need, and later on we're gonna build all of these time frames into a system that you can actually apply. And then as you level up, you can, of course, based on your experience or based on what you like, you can add different or custom time frames, like for example, a 3-minute time frame or a 2-minute time frame or a 10-minute time frame or a 30-minute time frame. But again, remember, price is always going to be the same. All of these custom time frames are just going to give you a different representation of price. So for example, if you're not very comfortable trading on the 1-minute time frame, you might do like a 2-minute time frame or a 3-minute time frame. That is going to make price action a little bit less granular. Or if the 1-minute time frame is way too high for you, you want to see even deeper, you can go to a 15-second time frame to really look at what is happening within that 1-minute candle. Okay? Now, separation between these time frames, let's separate them. We have the hard time frames. These are going to be the weekly time frame, the daily time frame, and the 4-hourly time frame. Okay, in brackets, because it can be used as a hard time frame, but it is also at the same time a middle time frame where we're going to be picking our zones from. So we have middle time frames, 4-hourly, 1-hourly, and also 15-minute, because on the 15-minute we can also enter. And for the lower time frames, we have 15-minute, 5-minute, and 1-minute. Okay, and the time frames you use will depend on the strategy and the type of trading you do. Okay, strategies, types of trading. We gotta go on a side quest here. What does that even mean? But before we go on a side quest, okay, and we build more knowledge, let me first show you how to set up your time frames in TradingView. So let's go do that right now. Okay, we're in TradingView right now. So basically your time frames are going to be up right here. So you have to find this very little arrow saying chart interval, and you have to click on it. Okay, now depending on the plan that you're using, whether it's free or paid, you're gonna have a lot of different time frames, but within the free plan, you should have anything that you need. So you're not gonna have any stars here. Okay, so everything is gonna be like that. Okay, so you might just have, for example, I don't know, some random time frames here. So what we're gonna be doing is we're gonna be adding all the time frames that we just spoke about. So we're gonna add the 1-minute, we're gonna add the 5-minute, then we're gonna add the 1 hour, then we're gonna add the 4-hour, and then we're gonna add the daily, the weekly, monthly. You can add that, okay? And personally, I like using the 2 minutes and the 10 minutes, okay? So you can see right now, I have all of these custom time frames right here. So if I want to go from the 1-minute to the 1 hour, click on the 1 hour, boom. Now I'm looking at 1 hour charts. If I want to go from the 1 hour to the 1 minute, go back. If I want to go from the 1 minute to the 10 minute, go that. And price action always changes, and it shows you the time frame that you want to see. So for example, again, as I told you, if you're in the weekly time frame, like every single candle is a week worth of data. So if you go back 1 week, 1 week, 1 week, 1 week, 1 week, 1 week, you're looking at a lot of data. You can see here at the bottom, you can see 2026. So literally within just a few candles here, you're seeing the whole 2026. Okay, but if you want to grow a little bit more granular and you go to the 4-hourly time frame, and I zoom out a little bit again, you can see all of this 2026 price action that started from here, because 2026 is here, went up, down, boom, 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 right? And then you see all of this kind of consolidation here, okay? And yeah, so this is basically, we just added the time frames. And right now we have all the different time frames. You can flick through them. You can practice the exercise that I showed you. You can practice that on a lower time frame, like a 1-minute time frame, to really see how the candles are playing out, to really analyze like where it opens. So for example, this one opened here, where it pushes, how it rejects, what are the different types of candlesticks, what do they actually mean, what does it show you, how the market goes from indecisive to really aggressive, for example, to the upside, then indecisive, then aggressive again, and reading all the wicks. And then, of course, another exercise that I would really recommend you do if you really want to get used to, this is what I actually have made my members do for a very long time, is to read a higher time frame candle, but transition it on the lower time frames. So for example, if I take, let's say, I'm gonna do a replay mode, which if you're a free version, you won't have. But take this candle, for example. Now, what did this candle do? How do you imagine it printed? Okay, so what you can do to practice is you can take a line. I'm gonna teach you later how to draw lines, but you go here and take a trend line, okay? And you draw it from the open. You take another line here to draw it from the low. You take another line, and then you take another 2 lines, and you take the one at the closure and one at the high, okay? And then you can, for example, imagine, so how did this one play out? It opened right here. So it first pushed down a little bit, and then it pushed up, it reached the top, and then it pulls back to close, okay? And then you can go, for example, as I did. Oh, I didn't add the 15-minute. No, let's add it. That's my favorite time frame of all. And then we go to the 15-minute time frame, and you see exactly the exercise that I also showed. Now, this one doesn't really look very, very clear how I did it, but now you see like what actually happened. Okay, we opened here. All right, move up. Oopsie. How do I draw with that thing? Okay, there it is. We moved up, moved down, move up, move down. Solid move up, move down, massive move up, pull back, massive pull back, boom, boom, boom. And you basically see the lower time frame development of that higher time frame candle. And again, as I showed you, okay, you can go really a step further. You can be like, okay, I really want to see what, I don't know, what this candle did here. How did this candle look like on the 1-minute time frame? Well, it must look like it opened here, maybe made a little push up, then it massively pushed down, and then it massively retraced to close like that very big wick. And then you can, for example, go on the 1-minute time frame. Okay, but first you have to show where the market started. So I'm gonna drop, for example, a line here, which is where the market opened. And then if I go to the 1-minute, like look what the market actually did. It opened here, it massively push down, pull back first, massive push down, then a lot of buyers kicked in, and we actually made the high here and we closed exactly here. So that shows you, what does it show? It shows that there were a lot of sellers at first, but then the buyers really stepped in to create this rejection that on the 50-minute is looking like a very big wick. Is that a bullish signal? Yes, it is. And you can see the next candles start going higher, okay? So now we have the time frames. Now we understand the candlesticks. So let us get back to the slide and throw a little bit of a recap. So what we learned so far, we set up your charting software in TradingView. We learned about candlesticks and the dynamics behind them, and we had a look at quite a few examples. We talked about wicks, we talked about bodies, we touched on candlestick formations, and actually reading what the candle tells us. I really hope if you get something from this, it will be to not memorize all of these candlestick formations, but actually make sense of what they actually are. Okay, we touched on the fractal nature of the market, we discussed timeframes, we set them up on your charts. And right now, you kind of have a very strong foundation, okay? We talked about risk management, we talked about all the foundations of the market, we talked about candlestick, which is again the building block, it's like the cells of the body, okay? Because the body is built from different cells, the market is built from different candlesticks. We talked about the different time frames we're gonna be using, we discussed the candle anatomy. So right now it's slowly time to start using all of these stuff that we have together. But what we have together so far, apart from a very strong foundation, is candlestick patterns, understanding price action overall, how the candles are building different price action, and the different time frames, okay? So right now, combining these two things together, we're gonna get to what we actually need to start trading, okay? That is having a bias and direction. So how do we determine whether the market's gonna go up or whether it's gonna go down? That is step number 1. Step number 2 is to determine how are we actually gonna go up and down, from what area? Because we cannot say just, okay, it's gonna go up and just enter into a position. No, we need to have a zone from which we're either gonna buy low to go up or we're gonna sell high to go down. And then the third thing what we need is an entry model and an exit. So how are we actually gonna enter that trade and how you're gonna confirm it, okay? So But before we get kind of even more technical on the markets, I want to first talk about what actually moves the market. And really, because what I always want to give you here is the fundamentals of the market, because I could probably teach you like a strategy very fast, but if you don't understand the whole dynamics behind, right? So what actually makes you appreciate a mechanical watch, okay? It's a watch, it shows the time, sure, but all the little intricacies inside, so all the little springs and boards and how it actually ticks and how it charges, like this is what really makes it valuable. So if you understand all the back end of the market, it's really valuable to know. Okay, so right now, let's touch on some more foundations, but it's gonna be better than what we covered so far. So trust me, let's go. So to really understand the fundamentals of a market, we have to ask, what's a market? What actually moves a market? What determines the stock of the instrument that you're trading? Like what determines the price of a stock, a commodity, or Forex pair? Like what actually drives that thing behind the scenes? So a marketplace is where traders, investors, and all the different market participants come to agree on a certain price and bet on their opinion, of course, whether an asset is underpriced or overpriced. So cheap or expensive, low or high. Okay, so basically a marketplace is a constant battle of buyers and sellers and nothing else, honestly. And the bigger group is always gonna win. If there are more buyers, price is gonna get pushed up. Okay, if there are more sellers, price is gonna get pushed down. It is there is a really good theory about the market, which is called auction market theory. And this is basically if you imagine yourself going on an auction, okay, and you want to sell this phone and you say, okay, this phone is $1,000. And somebody says, okay, I'm gonna give you 1,100. Oh, I'm gonna give you 1,200. Oh, I'm gonna give you 1,300, 1,500. Okay, what that makes immediately is the price of a phone goes up. Okay, but if I say, okay, I'm gonna sell this phone for $2,000 right now, and nobody wants to buy it, what do I have to do? I have to give a discount. Okay. 1,900, nobody. 1,800, nobody. 1,007, 6, 5, okay, I want to buy, right? So price went from 2K to 1.5K because nobody wanted to buy it, okay? Now, of course, there is an additional thing to that is because in the markets, you can actually go short. You can sell, okay? And when you sell, that pushes actually price lower. But that is what drives the market. It is driven by the law of supply and demand. The more demand there is for an asset, the more people want to buy it rather than sell it, the higher the prices will go. And the more supply for an asset there is, people want to sell it, okay, or refrain from buying it, okay, the lower the price will also go, okay? That's it, supply and demand, and it's also driven by the auction market theory. So who drives the market? What is really important to understand is that the BFIs, banks, financial institutions, very big hedge funds, people with a lot of money. Now, of course, as I told you in the beginning, different institutions trade for different reasons. Some are trading, for example, for pension funds to protect people's pensions and to make a return on their pensions. So they're going to be very conservative. Some institutions are hedging. Okay, so they want to protect their wealth or they want to protect the value of the currency. So for example, if they think the euro is going to go up, but the dollar is going to go down, they're going to buy euros to hedge, okay, to protect themselves. And there are participants, okay, like non-commercials that actually want to make money from price changes. These are the traders, okay. But what you have to understand is that, again, different participants have different reasons to trade, which is amazing because they're still going to move the markets, okay? And us retail traders, we have no saying of price because our size, our bets on the market is just small. It's minuscule. It's like nothing compared to what those big guys are doing, okay? So our goal is basically to follow these BFIs and their footprints because they are gonna leave footprints. They cannot execute all of these crazy orders and not move price. They are essentially what moves price. So if we know where they're moving price towards, okay, we just join them. It's as easy as that. But if I show you a very funny graphic that I made, basically what is the law of supply and demand? This is the price of a gold bar, okay? And gold bar starts from here with an imaginary price, let's say of $1,000 once again. It goes up a little bit, and right now people, the masses, everybody thinks, no, gold is expensive right now, so nobody buys it. And maybe some people like traders think it's too high, I'm gonna sell it, I'm gonna go short. Starts going down, it's too expensive, keeps going down. No, it's not that cheap yet. Okay, keeps going down. So let's say, I don't know, $500, okay, per gold bar. Okay, now the masses think, okay, now it's cheap. So we start buying it and refrain from selling it. Okay, so people who sold maybe take their profit there, and people that want to buy, they start buying from here. And now it goes up. I think it's gonna go higher. It keeps going up. It's too cheap. I'm gonna keep buying. It keeps going higher a little bit more, and then it reaches a high. Okay, now it's got a little bit expensive. I'll sell right now my buy. I'll sell it here, take my profit, or I'm just gonna refrain from buying more because it's too high. Okay, and when it's too high, when the market think it's too high and the participant think it's too high, like the auction again, you go gold bar everybody for 2K. It's expensive. So what price does? It's too expensive. 1.8K, 1.5K, a little bit more and I'll buy it. Okay, 1.2K. Okay, that's fair. It's underpriced. It's time to buy. Price goes up. It's too cheap. Still a good price. Still a good bargain. It's too fair. Okay, now it's time to sell because it got overpriced again. And the loop just keeps going and going and going and going. That is the market. That is the market now. Some markets are designed to go only up. Now, if I very quickly go to the charts, because I really want to teach you a lot of stuff. If you go, for example, to a Forex pair, now Forex pairs are not designed to just constantly grow up in value because they're not like growth assets. They're used more towards hedges, of course, really depends on the economy. Like if I, for example, really zoomed out for this overall kind of price action on Aussie dollar, okay, so since 2020, so since the 2000, you can see it went up for a little bit of time and then it went down for a little bit of time. And if I really zoom in, like for example, to see what has happened since 2020, let's say, okay, so since I've traded, let's say since 2018 right here, what has price done? Nothing. Went down, went up, went down, went up. Nothing. Okay, so here a lot of people thought that it's very cheap. Here the market thought it's expensive. Here the market thought it's cheap, expensive. Here they agreed on the price because it didn't go up. Here it was cheap. And right now, is it going to be expensive? We don't know. That's the thing to determine. Can it continue to go higher, or is this going to be expensive and the market's going to go down? So in general, currencies like the dollar, for example, you can see since it was created, went up, went down, went up a little bit, went down a little bit, went up, and right now it's just in balance. So again, if you see, since I have traded, for example, from 2018, it went up a little bit, it went down. This is where low prices are. You can see the market always buys. Massive run up here. Here it was expensive. Here it found balance. It was cheap, push, expensive here. And right now we're in a little bit of balance again. So this is what usually you're going to get with currencies and with assets that are not designed to go up. Now I want you to take a look at gold. Now, do you see, everybody, a difference from the different charts that I just showed you? Like, look at gold, look at that. Right? What is that doing? Let me just stretch it out a little bit. Okay, let's start from 2000 again, year 2000 here. We started here. Oopsie. Started here. We go up in waves. We go. Okay, then here it got a little bit expensive already. Let's start buying. Like gold here at that time was 1.8K. Okay, let's stop buying. So buy, boom, 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 boom. It reached 1.2K. Okay, that's a fair price to start buying. Okay, buy again. Okay, 2K. No, too high. Pull back to 1.6K here. You see the prices to the left. Okay, now it's time to buy. Push. Like, look at that. Massive run. It went from 1.6K to 5 to almost 6K to 5.6K. Okay, now this is what we call a growth asset. This asset is designed to go up in value. So right now, are we too high? Is the market gonna pull back a little bit? Probably. Okay, and then of course you have US indices, US stocks. Okay, if you zoom out, this thing has been going up forever. Since 1998, it's been going up. If you zoom in a little bit here, since 2020, push, expensive, cheap, push, expensive, cheap, buy, push, expensive. Right now we expect the pullback to get cheap and then to potentially go up. Now you see like different markets are built with different kind of fundamentals behind them. That is really important to understand. But all in all, price action is the market's language. Again, multiple candlesticks are what builds what is called price action. However, price action is just raw data. It's just like price. Like, it's unbiased. And that's the beauty of price action, is that it's just, you see the price, you see the facts. Okay, it's unbiased. And the market is also unbiased. Price is price. The market doesn't care about you. It doesn't care about your opinion. It doesn't care whether you think it's going to go up or down. The market is the market. But then we as traders, we apply again what is called our analysis. So let's say we're going to focus on technical analysis right now by analyzing patterns, by analyzing footprints of the BFIs, structure indicators, fundamentals, and all types of analysis. And then we become biased, okay? Biased towards price, because then we form an opinion whether the instrument that we're trading is cheap or expensive, if it's high or if it's low, and whether we want to buy it or we want to sell it. And then we have what we call, again, I'm bullish bias, or I'm bearish bias. So I'm biased towards something that is kind of unbiased, but in order to make money, we have to make bets, whether something's gonna go up or it's gonna go down, okay? So let me illustrate my point by putting some lipstick on a chart. Now, here is everybody the price of Euro USD. So pretty much since December, let's say. Now, if 1 million traders are watching right now, 1 million traders will perceive this naked price action differently. Some traders will think it's this, some traders will think it's that, some traders right now it's gonna think it's expensive, some traders are gonna think it's cheap. 1 million traders are gonna draw 1 million things on this chart, but that is price. Okay, now, this price you can perceive through the eyes of market structure. The market making breaks of structure, making higher high, higher low, higher high, higher low, bullish market, highs, lows, higher high, higher low, making a high, then going down a little bit, up again, then we go on a downtrend, we make lower highs and lower lows. So a trader will perceive the market through this lens of simply market structure, which we're about to cover right now. Another trader will say, all right, I want to add Fibonacci to this. So he not only uses structure, but right now he draws Fibonacci, which personally I don't use a lot. From low to high, pull back into the Fib, go long. From low to high, pull back into the Fib, go long. From long to high, pull back into the Fibonacci, here goes long. All right, so he draws all of these Fibonacci levels, and that is how potentially he can determine when a price is cheap or expensive. So when the price, for example, pulls back into the Fibonacci, this means it's expensive, okay? Or when the market pulls back in a bearish Fibonacci here, it's cheap. It's expensive, let's sell it. Expensive, let's sell it. Here, cheap, let's buy it. Cheap, let's buy it. Cheap right here into the Fibonacci, let's buy it. Now, you might have no idea what a Fibonacci is, but just bear with me here. Somebody decides to use very simple support and resistance levels, okay? Now, what is that? Here we see the market bouncing from here, but then it broke and it retested it from the other side. I'm gonna buy. Then it pushes up again and retests the same level. I'm gonna buy because that is my support level, okay? But you see right here, there are no Fibs. Here, the market had resistance, turn into support, break and retest, go long. Test again, try to go long, fail. Now, when this resistance got broken, it's retested from the other side to go short. There was a lot of support. You see the market bounced twice from this level, but then it got broken, retested from the other side, short. Another level here, break and retest, short. Now, this trader is looking at support and resistance. Another trader is looking at blocks. Okay, so you can look at mitigation blocks, you can look at order blocks if there are some ICT guys right here, right? It's simply like a break and retest once again, but you draw the most recent ranges. So there is the break, retest of the last range. There is a break, retest of the last range. There is a break, retest. There is a break, retest. There is a very massive range, broke, retested here. There is a little block here, retested. And you get the point, right? And then there is the other guy who might who might be an indicator trader. So he's gonna look at he's gonna look at the RSI, the MACD, and this. He's gonna have different types of analysis, different types of tools, lines, parabolic SAR, smart money concepts, indicators, 1,000 EMAs, super channels, super trends, and he might overcomplicate it. When this line is green, it's bullish. When the line is red, it's bearish. When it's blue, again, bullish. Oh, you get the point, right? We went from a naked price action to this. Okay, so just wanted to prove my point that there are a million ways to look at the market. But what I believe is the backbone of the market is market structure. That is the breathing pattern of the market, because if you saw from many examples that we have, the market just doesn't move in a straight line. It doesn't open here and just do this. No, the market's gonna do this. It's gonna move in waves up and waves down, okay? And that is what essentially creates actually market structure. And I believe market structure is the most kind of important foundation of every trader. Even if you don't trade market structure, for example, I used to be a very big market structure trader, but I don't do market structure anymore. And I'm gonna show you, if you stick, of course, how I trade market structure. It's a very key tip, but I understand what it is, okay? Because market structure is gonna show you who is in overall control, buyers and sellers, and what the overall trend is, okay? So to understand the market, we have to understand the type of markets that we might have. And the market might be in one of two states. It can be trending. Trending market can be in an uptrend going up or a downtrend going down, or it can be what is called consolidation. It can be consolidating, which is a range, consolidation. The market is directionless, like it just goes up and down without really picking a certain direction. And our job as traders, the first job for us is to identify the trend and the state of the market, and to ask a very simple question. Is the market going up, or is it going down, or is the market consolidating? And what am I gonna do about that? Okay, so let's see right now how this is done by transitioning to the market structure masterclass. So how to understand market structure? Well, market structure manifests in the form of structural patterns. For a bullish trend, for an uptrend, we have higher highs and higher lows. And for a bearish trend, downtrend, we have lower lows and lower highs. And the golden rule, why knowing what a trend is so important, is the golden rule says an established trend is more likely to continue than reverse. Because again, if the market is going up, it will find a lot of power. It will be very hard for the market to suddenly start going down in a downtrend, okay? Think about it as a very big ship that is going, for example, to park at the port, okay? It doesn't just go and crash the port, right? It slows down first. So it first has been traveling fast. It's very likely to continue. But then as it comes towards the end, it starts slowing down. And this is why, like if I use this analogy, right, we go in an uptrend, like the ship is traveling, but then there always comes a point at which price becomes expensive in this case, okay? And it starts slowing down, we slow down, right? And then we enter into a consolidation, we slow down. And then the ship, like, you know how the ship slows down and it just starts turning, right? So we turn, and then when it's ready for the other direction, right, then it starts going down, okay? So if you're in an uptrend, the market is very likely just going to continue that uptrend. Okay, if we're in a downtrend, it's very likely going to continue in that downtrend. So this is why, again, the saying goes, the trend is your friend, because if you just stick with what is currently happening, you're going to have a lot more likelihood to succeed. Okay, and a trend doesn't just go from an uptrend to a downtrend. Very rarely it happens because it needs time. Okay, so always think about the ship analogy. Uptrend dynamics. An uptrend is defined as market structure that is breaking the highs and maintaining the lows. Okay, so the last high, which is the last higher high, should always break, while the previous low, which is going to be the higher low, should not be broken. It should maintain. And the higher low is only confirmed when the previous higher high is broken. Let me show you how that looks like. We start with a low, the market pushes and makes a high. Then it pulls back, but as it pulls back, it does not break under this low here. Okay, and then when this higher low breaks structure, breaks the last high, okay, so the previous last high should always break, and the previous higher low should not be broken, and a higher low is only confirmed when the previous higher high is broken. There is the previous high, we broke, so now we confirm the higher low, okay? Then we push, we make a higher high, and then the market starts pulling back. What should the market not do? It should not break below the previous higher low, okay? So it reaches here, price thinks that it's right now cheap. We start buying and we break the previous higher high. That in turn confirms the previous higher low. We push up again. Higher high created, we pull back. We should not break the previous higher low. We form a new higher low by breaking for a new higher high. Okay, now right now we made a new higher high. The market is pulling back. What we should do? to resume the uptrend, we should not violate the previous higher low, so we should not break it, okay? And we should break for a new higher high. And when we break for a new higher high, okay, like this, we're gonna have a break of structure, and then this is going to be confirmed our higher low formation, okay? As easy as that, okay? As easy as that. Of course, it's not in reality, it's not that simple as the schematic we just drew, because real price action is gonna look something like this, okay? You already know that. In an uptrend, we're gonna go like push, pull back, push, pull back. We're gonna make a high, then we're gonna start like oscillating a little bit. Then we're gonna break structure, then we're gonna pull back again. But what we should always track is the most recent higher highs and higher lows. This is what we call the major higher lows and higher highs, okay? Because these are the most important things. It doesn't matter if the market is right now here doing all this nonsense, as long as we don't break below this low and we break above this high, we're gonna be in an uptrend, okay? And this is what is called internal structure, okay? The structure that is, for example, in between the major higher high and the major higher low, okay? A lot of traders can get confused drawing internal structure, but I'm very soon gonna show you how to do both major and also internal. We're gonna really simplify it. So here is how a real chart looks like. We're having the market pulling down, pushing up, pulling down again, and then we break, okay? We break that last high. What caused the break? So take note of this. In order to always recognize your major higher lows and higher highs, when a break of structure occurs, immediately ask what caused that break. And we're gonna have rules about that very soon as well. In this case, it is this low. So we mark this as our major higher low. The market pushes, it creates a new higher high, pulls back, okay? This pullback should not violate this low. We push up, we make a new higher high. Great. What caused the higher high? It is this low. And then we can see the internal structure. We pull back, push down again. You can see like push, pull back, push. Kind of looks like a downtrend, but no. As long as we haven't broken this major higher low, we remain in an uptrend. We resume to push up. We make a break of structure. What caused the break? The higher low formation here. Again, I'm going to give you rules. What is a higher low and what is not? Continue, pull back, higher low, break of structure, new higher low, higher high form. Then look at this, right? Chop, 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 up and down, up and down, up and down. You might think, okay, what is going on? Are we going in a downtrend? Well, no. This is the low. This is the high. That is the higher low. This is the higher high. Until we break below this low or break above that high, we're still bullish. And then eventually the market, whoop, breaks structure. What caused the break of structure? The low. Higher high, higher low. When is the higher low legit? When we go for a new higher high. Okay? It's easy as that. The downtrend is the exact opposite. The downtrend is defined as market structure that is breaking the lows and maintaining the highs. So the previous or the last low, which is going to be your lower low, should always break down, while the previous high, which is going to be the lower high, should not be broken. And similarly to the uptrend, the lower high is only confirmed when the previous lower low is broken. Okay, so we make a high, we make a low. Okay, the market must not break the previous high. So it makes a lower high by breaking the previous lower low. That is what essentially really puts into stone that lower high. Because again, when the market is, for example, push down and push up, you don't know if that is the lower high because it can make this. Then you don't know if that is the lower high because it can make this. Okay. Then you don't know if that is the lower high because it can make this. Okay. If that is your previous lower high and this is your low, when the market breaks structure here, then the highest point, in this case, this one, that is going to be your lower high. Okay, so this is why this rule is very important, this one. Okay, so we confirm this lower high by breaking this low, then the market pulls back. This lower high is not confirmed until we break structure. We broke structure, lower high, lower low, lower high again, not breaking above that guy, and then continuing to break lower. We keep making lower highs and lower lows. Right now we are potentially making a new lower high. Okay, so when is that lower high going to get confirmed? You tell me. When we break the most recent lower low. All right, easy. Again, goes without saying, it's never going to look perfect. It's going to look more like that. Push, 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 push. Now we get this kind of complex pullback. But again, what really matters to us is the main high and the main low. Okay, then we break lower After the break of structure, again, what caused the break? There is the highest point. Okay, then pull back again. Then here again, we break lower. What caused the break? The highest. This is the lower high, but it's the highest high that pretty much broke the structure lower. Then we pull back, and here I have written the lower highs. These are the highs that must maintain. They must not be broken. They should be lower than the previous high. Okay, so why is the lower high? Is because this high, all right, then the next high, this high is lower than the previous one. So this is a lower high than the previous high. Then this high is a lower high than the previous high. This high is a lower high than the previous. And the lower lows, there is the low, and then the new low is a lower low than the previous low. Okay, it constantly keeps moving in cycles like this. And there is a real downtrend example. Now, pause the video. Okay, so just try it out. Pause the video, take a screenshot, and draw the market structure. So that is your first test. Okay, if you want to get it interactive, pause the video, and I want you to draw the break of structures, and I want you to draw also the major lower highs and lower lows to just see how much you understand it. Let's do it. Are you pausing? Okay, I hope you paused. I think you did not, but I hope you did. Cool. Did you pause? I'm joking. There it is. Okay, so I hope you paused and you actually have an example to compare to that one. We have a break of structure. What caused the break? The high. We push lower, we make a low. We pull back, okay, then we break structure again. What caused the break? The highest high before the break. There it is. Lower high. Push lower, pull back, break. Okay, we break the structure. What caused the break? A little bit unclear, you see. However, the market is not perfect. I'm not going to give you cherry-picked examples. That is how a real market looks like. Okay, lower high, lower low. Pull back. There is the point of the break. What caused the break? Track it back. Lower high. Here a little bit funky. Here we make a clear pullback and then we break structure right here. What caused the break? You track it back. There it is. Okay. Here again, break a structure. What caused it? A little bit here. Now here a little bit messy, but it is what it is. We push lower. We make a low. We pull back. Okay, cool. We should not be breaking above this high, however, in order to maintain. And then the market breaks. Now here again, just before the break, it can be this high or it can be this high or lower high. That is where the subjectivity comes in. And I'm going to give you some rules so you can make it a bit more mechanical. And my head is in the way. And there we go. We continue going lower, reaching a low. And right now there is the last break. Okay. That is the last lower high. Okay. So you have a downtrend. Okay. So these are the trending examples. Right now, it's time to talk about consolidations. So, what is a consolidation? A consolidation is a market structure that is failing to break both the highs and the lows, or is just wicking them. Okay, what is a wick? It's a rejection. So it's a failure to accept above or below a certain price. It tries, but then it gets shut down, right? You remember, we had a look at these examples already. So a consolidation is a balanced price action. It's equilibrium and fair value. The market usually enters into a consolidation when the BFIs are stacking orders and they're preparing for the next big move. It's like an accumulation of power. We accumulate, and just it goes. Okay. So if you see a consolidation in the market, here's a little tip from me. A lot of traders are going to say, oh, the market is choppy and this and that. No, the market is cooking. It's cooking for something big. So then you have to really look at market structure. They really have to look at the higher time frame trend in order to potentially determine for what direction they're cooking for. Okay. So if you study the charts before and after every big move, there is always a consolidation. You don't trust me? We're going to have a look at it. But here's how a consolidation looks like. Okay. The market goes up, goes down, goes up, goes down, goes up, goes down, goes up. And usually it stops somewhere. Okay, now here above these levels and below these levels, there's going to be a lot of orders. We're going to talk about buy stops and stop losses and sell stops and limits and all this stuff in our liquidity part of this tutorial. Okay, but what you should know right now is that above and below the consolidations, there are tons of orders. Okay, so let me show you how a consolidation actually looks like, because a higher time frame consolidation can have multiple short-term trends. Now here, guys, we're getting a little bit more advanced, okay? Remember, the market is fractal and there can be trends within trends. That is how it can look like, okay? On the short term, the market may be making higher highs and higher lows. You see an uptrend, 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 but then again, it stops and the ship starts turning, okay? We reach a higher time frame area of resistance. The ship turns. We enter into a consolidation, right? The market goes up and down and up and down and up and down and up and down, but then it goes into a downtrend. Lower high, lower low, lower high, lower low, lower high, lower low, lower high, lower low, lower high, lower low. It reaches the point and then the ship starts turning, turns into an uptrend. There we have a consolidation here. Then we have a little uptrend again. We reach the top and then we have a downtrend and we reach the bottom. But what you see is that there is a very big consolidation and the market always seems to stop at this red line here and find resistance, and it always seems to stop at the green line here and find support. Okay, and within these two areas, depending on how big that consolidation area is, you might have trends within that very big consolidation. Okay, so if I very quickly show you, for example, this chart. Now, what do you see? Again, a million traders right now watching this video are gonna see a million different things. You can draw 1,000 things you can see right here, but I just want to illustrate my point of trends within consolidations and how the market keeps going from one cycle to another. What do we see here? We started with an initial consolidation. We kind of went up, we went down, we went back up, and you can see this level is really failed to be broken. We went down, we bounced again, but then from here, we're actually starting to build a massive downtrend. Lower high, lower low, lower high, lower low, lower high, lower low, lower high here, lower low, lower high, boom, 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 and we reach a bottom here. We reach a bottom, you can see. From here, the market stops making new lower lows, all right? It made a low. It made a lower high. It tried to make a lower low, failed. It tried to make a lower low, failed. So what is it starting to do? It's starting to make higher lows. Wow, there's your first very big insight. Okay, look at that. Look at that shift. Okay, this was the lower low that was supposed to be broken. It got broken here at the lower low. It got broken here at the lower low. Okay, but here didn't want to break. Here didn't want to break. Here didn't want to break. And suddenly, oh, uptrend. Okay, do you see how nicely you can read market structure? And then we go to an uptrend, 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 uptrend. But then here we enter into a macro consolidation. But within this very big consolidation, we had a little uptrend, then a little downtrend, then a little uptrend, but we stop on the top. Then we turn from an uptrend to a downtrend, but we stop at the bottom. But then we turn from a downtrend to an uptrend, but we stop here. And then you can see a consolidation will always have a middle line. This is what we call like the equilibrium line. And the market is always gonna kind of bounce between that line. Okay, so look at that line here. It's exactly the middle of this consolidation. Like here broke, retested, here plays with it, plays with it, goes below, goes above, goes below, goes above. Again, a little consolidation here within the big consolidation. You can see it made a top, it made a bottom, it failed to break the top, failed to break the bottom. Consolidation. We went on a little uptrend, but as soon as we reached that level on the top, we failed to break it. And then we launch a downtrend, and it seems like we're breaking the consolidation. But again, here at the bottom, we create another consolidation. We failed to break the lows, we failed to break the highs, we failed to break the lows, we failed to break the highs, but then the market impulses very strongly and turns into a macro uptrend. And then here, what we end up with a consolidation again. Tries to break the high, tries to break the low, fails the high, fails the low, plays in the middle line, fails the high, comes back into the middle line. Do you see like higher lows and lower highs here? No. If you really zoom in, which is what we're going to be doing, you can probably spot within here like a little downtrend, and then you can spot like a little uptrend as well. But on the macro side of things, I wanted to show you how you have like macro trends and then they turn into macro consolidations, but within the macro consolidations, you can have shorter term trends. But here is like a textbook example of a consolidation. We push up, push down, middle line. Try to go the high, try to go the low, but you can see here, immediately repelled. It came in, indecision candle, engulfing candle, boom. We didn't really want to stay below that line. Okay, we come into the middle line and look at how the market always oscillates around the midline. So the midline is literally the halfway from the top to the bottom. Okay, chop, 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 chop. This is what we call a choppy market. Like really, it's not clear. Then we go up a little bit. Okay, we go above here and then just look. Same thing that happened here. We went above, boom, push down. So what do you see here is like somebody hitting from the top and pushing price again back into the range. And guess what happens? We go on a little downtrend. Downtrend, downtrend, downtrend. Where do we reach? We reach the bottom portion of the range. Goes to the middle, tries to break lower, fails. Goes a little uptrend, tries to take the top, fails, goes to the middle. So do you see here, okay, like a clear uptrend, price going up? No. We went up, we went down, we went up, we went down, we went up, we went down. And right now we're going to go up, probably we're going to go down. There is no commitment, okay? There is no trend in this case. There is another example again, okay? Market seems like it was on an uptrend, consolidates, tries to push down good, pushes up, pushes down, but as it pushes up, it doesn't make a new high. So then it starts pushing down and you can see like towards the middle line again, kind of from bullishness, right now looking bearishness, but then it taps here, immediate repel into the highs, immediate repel into the lows, immediate repel into the highs, immediately back down again. Like, what's happening? Consolidation. We're not making higher highs and maintaining the lows, and we're not making lower lows and maintaining the highs. We're just bouncing between usually two levels. And once you kind of get to identify these two levels, okay, which in this case is this high and this low, okay, the middle line, you're then gonna see it always kind of responds. Here you can see responded here, responded here, responded here, kind of responded here. We came up again, reacted, okay? So when is the market going to exit the consolidation? Well, when it just exits and really stays above or below it. This is what we call like accepting outside of the balance, which means we're going into imbalance. Okay, but we're going to talk about that, so don't worry. And here is an example of a choppy market. Now, what is a choppy market? Like, look at that. It's like some crazy wicks, big bodies, but crazy wicks, like no direction whatsoever. It reaches a high, immediately repels, looks like a downtrend, but then chops again, reaches the bottom, immediately repels, reaches the top, immediately repels, and then we enter into this chop, 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 chop. We came into the high, immediately repel, right? This is just not tradable price action, okay? That is a choppy market. It's not trending. It's having like a macro consolidation, but even within the consolidation, you get this type of price action here. Do you see this as a clear? I don't. We are not going to be able to trade that, and that is okay, because when the market is in the consolidation, we got to take a break as well, okay? All right, uptrend, downtrend, and choppy markets. We just covered the foundations of market structure and trends. Again, a bullish market and uptrend consists of bullish market structure, which is making higher highs and higher lows. A bearish market structure or a downtrend consists of bearish market structure, okay, and lower lows and lower highs, okay? And a consolidating market is literally a directionless market. It's struggling to break the highs, it's struggling to break the lows, and it's not going in a very clear direction, okay? And of course, you might have like big macro consolidations with big levels, but within that, you might have uptrend, downtrend, okay? Now, it's time to get a little bit more advanced and answer some key questions that you might be having right now. When does the trend change? So when do we go from an uptrend to a downtrend, and how do we spot that? When is a trend fully confirmed? When can we say that, okay, this is an uptrend, or okay, this is a downtrend? How to objectively draw market structure. So what is exactly the higher low? What is exactly the higher high? Well, gotta do some more work. So hope you're excited for that, because we keep going more detailed. So right now we're gonna have a look at break of structure versus trend change. So structure break, known as BOS or SB, so break of structure, structure break, doesn't really matter, and trend change, which I call TC. Now you can hear the TC being described as a change of character or some other kind of fancy terms. No, it's just like a trend change. And here is how it looks like, okay? Now, breaks of structure is when we are in an already established trend, so we're making higher highs, higher lows, breaking the higher high, higher low, breaking the higher high, higher low, breaking the higher high. But then basically the trend change occurs when we break in an uptrend, when we break the last higher low, okay? So when we break the last higher low, because again, remember the definition of an uptrend is the higher lows maintaining and the higher highs breaking. But if the higher low does not maintain and it gets broken, that is when we get a trend change. And this is the first sign that the trend is shifting, okay? And then we go low, lower high, lower low, lower high, lower low, lower high, lower low. So what's that? It's a downtrend, okay? A downtrend, the lower highs should maintain and not get broken. But when the last lower high gets broken, we get a trend change. We get a bullish trend change. And then we go from a downtrend to high, higher low, higher high, higher low, higher high. We go on an uptrend, and then the last higher low is broken. That is a bearish trend change, and that is pretty much how we change the trend. So you can see the trend changes are always going to be when the last higher low is broken in a bullish trend, or the last lower high is broken in the bearish trend. That's what it is, and that is the difference. But the trend change is pretty significant because it can definitely show you, okay, the buyers are probably running out of steam, so maybe we're gonna start turning into a downtrend. Okay, now the trend change pattern, again, it signifies the first sign. I want you to pay attention, the first sign of a change in trend. It doesn't mean, okay, trend change, let me short the hell out of this market and just go very big short. Not necessarily. Okay, so in an uptrend, it is the break of the last major higher low. There's how it looks like. And in a downtrend, it is the break of the last major lower high. Here is how that looks like. Okay, very nice and very simple, but enough schematics. Let me give you some example here. Again, lower high breaks for a new lower low right here. This is the high that broke it. We travel down, then we start making a real pullback. Okay, this is a potential lower high. And then here we break. Okay, we track. That is the last lower high that broke the low. Okay, and then the market makes a trend change. Okay, why? Because it violated the last lower high. Goes high, higher low, higher high here, breaks. Okay, here we make another higher high. And then what do? We break the most recent higher low here. That is a trend change. And then we go to bearish market structure. Okay, until we break the last, in this case, lower high, which is right here. Let me give you one more example. Again, don't stress too much about the markups and the higher lows and the lower highs. We're going to go into a lot of detail about that. I just want you to understand for now the difference. There is, again, push, pullback. We break for a new break of structure. We track the low here. Okay. Like, why did I draw the TC line here in this case? Because yeah, this is going to be based on the rules. This is actually going to be, the one that is the higher low formation. Here, let's say we break, we make a trend change. Now, what caused this trend change? You track it back the highest high. Okay. Pullback, lower high, lower low, lower high here, lower low broken again. Now, what is the last high that broke this low? It is this one. Okay, and then you can see the market pulls back. It tries to push lower to break the lowest low, but it cannot. So what you see here is a little bit of a shift of structure, and then we break the latest lower high. That is a trend change. Okay, and then we go higher low, higher high, higher low. You can see here maintaining above the previous one, pushing, pulling back, maintaining the previous one, and then returning to an uptrend. So you can see the trend changes are just at very specific places in time, where we are just breaking the last lower high or the last higher low, which signifies the change of a trend. And actually in these two examples, it was exactly the change. So here we changed, we went bullish. Here we changed, we went bearish. Here we changed down, we went bearish for a while. Here we changed up, and we maintained bullish for quite a while. Okay. Now, why I told you the trend change is the first sign of a reversal is because it is not a full trend confirmation. Okay, it's just the first indication of a trend shift. A true trend shift is confirmed after the creation of a new higher high or a new lower low. Okay, so simply said, after a TC, you need a boss. Okay, so you get a TC and the boss, which is exactly how it looks like here. We had a higher high, a higher low, a higher high. Hey, the last higher low got broken, trend change. But does that mean we're just gonna go down immediately? No. Okay, then we're gonna need a pullback to make a potential lower high, and then when the new lower low forms, okay, that lower low confirms that the previous thing is a lower high, and that is what confirms the downtrend. Okay, lower low, lower high, lower low. We break the last lower high. That is our trend change. Exactly right here. Does that mean right now we're just gonna go bullish 100%? No. Okay, we first need to see the market pull back to create a higher low, and then to break the last high to create a higher high. And right now we're having a higher low, because if you think about it, when we have the trend change, okay, right here, the trend change right here, okay? This is not a higher low. This is still a low, okay? It's not like, it's not an uptrend. There is no uptrend yet. But when we pull back and then we break, now what do we have? Now we have a higher low formation. And a higher low formation is what actually says, okay, now we're bullish because we maintained above that previous low. So we're making a higher low, okay? This is what truly confirms the shift of structure. And why is that very important is because there is a thing that I used to trade a lot. It's the fake trend change. And this is how a fake trend change will look like when you don't have a new higher high or a lower low to be created. It's going to look exactly like this. You're going to have a higher high, a higher low, then push for a new higher high, and then a trend change. And if you really rush and say, all right, trend change, let me go short, and then the market does this, goes to take out that previous high, and then basically this is a trend change back up. You see, we just trend change down, and then suddenly we're trend changing back up. Okay, so then as we trend change up, okay, will it here make a higher low, maintain above this low, and make a new higher high to confirm that, okay, right now we're resuming the bullish trend? We gotta wait for that, because this right here could be another TC, and then the market might want to break this to the downside, and you're like, okay, TC down, TC up, and then TC down. What the hell is happening? It's usually a consolidation when it does this, okay? This is why you really need to wait to confirm. There it is again. Lower low, lower high, lower low, trend change bullish. Okay, but what I need to see right now is for the market to pull back, not break this low, and to make a new higher high. But does it happen? No. The market immediately resumes the downtrend and makes a new trend change lower. Okay, so basically right now we just have a high and a low. Is this going to be a lower high? How do we know if it's going to be a lower high? Well, when it breaks the low. Okay, and then when it breaks the low, we can say, okay, now we're in a downtrend. Okay, so very key, and I don't see a lot of people teaching this, and it's a very big trap. Look here. Lower low, lower high, lower low, lower high, lower low. There is a massive lower low. What's the last structural point? It's right here, the lower high. The market comes for a trend change. Good. Okay. Now, what caused the trend change? For example, we've taken this low. I'm very soon going to teach you how to take these highs and lows. But that is our first indication that, okay, we're going to go up right now. The market pulls back. But you see, did it make a new higher high? No. It came very close, but it did not. It's a failure to make a new higher high. And what is an uptrend? It's making new highs and maintaining the lows. And what does the market do? Up, flips bearish, and makes a trend change, and suddenly we went from bullish to being bearish. And then you can see the market pulls back, and confirms a break of structure lower, and that right now confirms the downtrend. Because we made the trend change, we pulled back, we didn't go to break back the highs here, okay? And we continued to go down, okay? So that is how fake TC looks like. There is another example. Balls down, break of structure down, break of structure down. Okay, trend change up, massive push up. Great, we're gonna go up. But the market just flushes down, and what does it do? It makes a trend change back down. So what it should have looked like in order to confirm, it should have pulled back, make a higher low, and push to make a higher high. And then when this break of structure happens, then I can say, okay, that is my higher low formation. Now we're gonna go back up. Okay, but it breaks lower, and then it pulls back. Okay, it pulls back, but this is the high and this is the low. Then it consolidates, and then it makes a bearish boss. So what are we at right now? We're in a downtrend because it makes a bearish trend change, pulls back, it confirms the boss. Okay, cool. This break of structure, what caused it? It's this high. The market pulls back here to potentially make a new lower high, but it does not push lower to make a new lower low. Okay, and it pushes to make a trend change. Now, like, okay, man, what is happening? We got it up and down, and then right now up. Again, then what do we need to confirm the uptrend is to wait for a pullback and then a potential continuation higher. But it doesn't happen if I remove my camera here. Trend change up, and then it turns all the way back down to make a trend change back down. Like, come on. But then it pulls back and it makes a break of structure lower. Now this confirms right now, okay, we are in a downtrend because we made a trend change, we pull back, and then we made a lower low. So that then here confirms the lower high, so we're bearish. Here, we pushed up, we make a trend change, good, but did we pull back to make a higher low and push to make a higher high to confirm that? No. We just went from a trend change up to a trend change down. So that trend change up was fake. That trend change up was also fake because it didn't continue. This trend change down was not fake because it pulled back and continued, okay? But it still ended up reversing, which happens. And do you spot something about this price action? It's a consolidation, okay? Reach the bottom, reach the top, reach the same bottom, didn't take the top, reach the bottom here by a little bit, reach the top again, didn't take it, reach the bottom, failed a little bit, and then we finally went outside of the consolidation. Okay, so you see how we're starting to merge right now, the different concepts together. So I truly hope you understand the trend change, the structure break, and why is it so important to really confirm the trend change with a new higher high or a new lower low. Now, enough schematics, let's get a little bit actionable. So we're really right now actually about to go on the charts. However, the $1 million question is how to draw market structure. Every beginner and intermediate trader overthinks on this topic, which at the end is not that important. And I'm going to give you a very big hack on how to just stop drawing market structure and have something that is extremely powerful. What is a valid higher high? What is a valid lower low? What is a valid lower high or higher low? Like, where do I actually put my marking? What is the last lower high or the higher low that caused the break? Where is my valid higher low, lower high? So I released a video 2 years ago on this topic, so you can actually add it to your watch list. I'm going to include it in the downloadable resources. So again, it should be the first thing in the description. If you click it, and you should give me your email so I can actually send you these things. It's going to be probably a Google folder or something with a lot of resources and a lot of things that you can have a look at. But this is going to be one of the videos where I explain precise rules if you really want to go super mechanical on market structure. But now I'm going to simplify it even more. So now let's talk about the rules of market structure. All right, so let's have a look at the rules. If you want to, of course, use mechanical market structure, I'm going to give you some very simple market structure mapping rules, and we're going to be using what is called fractal highs and fractal lows. Now, what is a fractal? It is a candlestick pattern where we observe the candle anatomy, and it is a combination of 3 candlesticks. So again, going back to the candlesticks chapter that we had, you really must nail down those candlesticks and really understand the anatomy of them. A fractal can be customizable. It could be a 3-bar fractal or a 5-bar fractal. Those are the most common, and this is pretty much one of the 2 that we're going to be using. Here is how a 3-bar fractal looks like. So this is a bullish fractal here. This is a fractal high. Now, it is literally going to be the highest high, okay, in between other 2 candles. So you have one candle here that is a bullish candle, you can see, and it leaves a high. Then the next candle opens, it pushes, it makes the high, and it closes here. Okay, so we have the high of the candle, which is again almost always going to be a wick. And then we have the next candle that the high of this candle, the wick, does not cross above the previous candle's high. Okay, so basically you have a higher high here at the highest high, and then you have a lower high to the left and a lower high to the right. And then this makes a fractal high. Okay, and here is a fractal low where you have the market pushing down, leaving a low. Then again, it opens, it pushes down, it leaves a low. Okay, and then the next candle opens and it pushes up, but you can see the low here does not cross below the lowest low of this one, and then this low is also not crossing below the lowest low of that one. So what we have here is we have the lowest low, and we have a higher low to the right and a higher low to the left, right? So that is a fractal. That is a 3-bar fractal high and a 3-bar fractal low. And here are, for example, how a 5-bar is going to look like. That is a little bit more complicated to really watch in the live markets, but we have an indicator for that, so it's going to be really easy. You can see, for example, we have this lowest low, and to the left of it we have a higher low and a higher low. All right, then the lowest one, and then to the right of it we have a higher low and then another higher low, then the lowest one. So we have basically 2 candles to the right and 2 candles to the left that do not have a low that is lower than this low. Okay, and then we have here the same. We have a highest high here, and then to the left of it we have a lower high and a lower high. Now, can this high cross above this high? Yes. What we just do not need to have is for this high to be crossed by anything else. 2 candles to the left and 2 candles to the right. That's as simple as it could be. So if I just very quickly get my pen here, if this wick looked like this, okay, it's fine. As long as it does not cross above this high, okay, it's fine. If this wick looked like this, so it crosses this candle's high, but not the highest high, it's still okay. Same for here. If this wick looks something like that, or if this wick looks something like this, as long as they're not crossing the lowest low, okay, that becomes kind of a major low, and that becomes a major high, okay. So again, there is going to be an indicator that is going to make everything automatic, so don't worry about this, but again, it matters that you actually understand what the fractal is all about. So let me give you the steps. We go through the following sequence. Where is the last structure break or of a structural level? So that structural level can of course be a higher high, lower high, or a higher low. So we're going to have to determine whether it's a break of structure or a trend change, which is where the tricky part is going to come in. And then the break can be a wick or a body. You choose. Now, in my opinion, body breaks are better. However, they might make it a little bit more confusing because sometimes we're going to get a wick break, return, wick break, return, wick break, return, and then it might be reversed. And you're like, okay, like where is my structure break? I have a video on wicks versus breaks. If you download your resources, I'm also going to leave a link to that. Okay, so you can expand on this knowledge. The next step is to determine where is our major lower high or our major higher low. Okay, so higher low in a bullish trend, lower high in a bearish trend. The one that caused the break of structure that we just identified. And then the third step is we mark our major structure and then we wait for either a new break of structure or a trend change. Okay, so there are two ways to go about it. We can find the real major higher low or lower high, which can be a little bit hard because you really have to zoom out to identify, okay, like where did everything really start and what is the major structure, because right now we might be trading into an internal one. And if I very quickly visualize this, it can be looking something like this. We have, for example, a massive push lower, and then suddenly the market starts making like a bullish trend and then a bearish trend and then a bullish trend, but your major lower high is here and your major lower low is here. Okay, so but if you're zoomed in, you might start seeing, okay, break of structure, break of structure, break of structure, trend change, break of structure, then another trend change and another break of structure. But at the same time, all of this is right now internal. So this is one of the ways to go about it, by really trying to identify the major structure. But the second way, which is a little bit easier, okay, so that one is to avoid the internal structure. But the second way is to just zoom in and focus on the most recent breaks, which is a lot easier, but that is going to include internal structure. So let me right now go and show you. So first of all, let me give you a quick example of how that is going to look like. So I am going to give you quickly those two ways that you can go about it. And I'm going to very quickly also in the next thing that we're going to do, I'm going to also show you the indicator. So for example, here we have a lower low. Then we have a lower high, and then the market breaks the lower low. So there is the first step. Where is the latest structure break? There it is. What caused the structure break? Step number 2, you track it back, the last lower high. Great. Major lower high, break of the lower low. Now, of course, you have to wait for a new lower low to form. Here we didn't form, we pull back for a new lower high. We dropped, and that is where we actually formed the lower low. Okay, so right now you actually would ignore that one, and you're going to trade from this major lower high that actually caused the break of structure to the lower low that formed. So in general, now we're trading from this low to this high, and anything inside is going to be internal. Until we break above this high to make a trend change, we're still bearish. And until we break below this lower low, that is going to be the real break of structure. And you can see here, this is where this is actually a gap down, which makes things a little bit tricky. But if we take it as a break of structure immediately, okay, so what caused the break? The last lower high. We take the last lower high, and then basically right now we're looking for a new lower low to then define the range from the lower high to the lower low, and we're gonna still be bearish. Okay, but do you see, like, if you jump on the charts right here and you see all of these structural patterns, you're gonna be like, okay, where is my major structure? So that it's gonna take a little bit of experience, and it might be a little bit confusing at times because you might get lost. So what the other way to do it is to literally take every single structural pattern that the indicator I'm going to show you is going to give you, and then if anything is broken, you mark it, right? Lower low broken, great. Lower high. There is a lower high here, but we haven't really broken any lower low because we haven't had the indicator to ping that we have a lower low. We push lower, lower low. We pull back, then we try to break lower, but we do not. And you can see the indicator actually marks it as a higher low, which can be a first sign of a shift. But then the market breaks this most recent lower high. So that is, what is that? That is a trend change, because we're changing the trend. We're breaking the last lower high. What caused this break? You track it back. There it is, the last higher low. Then the market makes a higher high, pulls back for a higher low. That is where you could potentially start looking for longs. Unfortunately, consolidates. Now here we have a lower low because it wicked this higher low formation. So slightly bit choppy price action I have picked right here, but again, I'm not gonna cherry pick. Here we have a wick break. I mean, these are wick breaks. That's a sweep. We're gonna talk about liquidity. There is swept here as well. But here we finally get a body break of really this higher high and also this higher high. So then what is the higher low that broke it? There it is, okay? And then we push up, we make a new higher high. But then the market breaks the last higher low. What is that? That's a trend change, okay? What caused that trend change? It is the last high, which is this higher high. Lower low created, lower high created. We break the lower low, great. What broke it? The lower high. We pull back, lower high created. We break the latest lower low, great. What broke it? The lower high. So I would actually even tell you to prefer this kind of way because it's a little bit easier. So right now, let me go and show you how to install this indicator and have a look at some real examples. All right, so here we are on the charts. Now, what you're going to do is you're going to look into indicators right here, and you're going to type fractals. It's going to be this fractals by nephew Sam. You're going to click on this, and it is immediately going to populate your fractals. So this is the default settings are for 3-bar fractals, and you're gonna have a lot of them. So what you're going to do is usually your indicator is going to appear right here to the left. You're going to click on the settings here. You're going to remove this show fractal points, and you're going to click show pivot points. So when you show pivot points, you're going to do left bars 2 and right bars 2. What this is going to make is it's going to make our 5-bar fractals, the one that we discussed just a few slides earlier. And yeah, because 5 bars are a little bit high probability, because if you do 3-bar fractal, you're gonna just get way too much. Like, you're constantly gonna be up and down and up and down and up and down. But if you do 2, it's gonna be perfect. Okay. So let me, for example, show you how you would tackle this by going, so here we are gonna be, so this is the indicator, fractals by nephew Sam. It is immediately going to populate the most recent structural patterns. So the first way that you can go about it, which is the more complex way, is you really have to kind of start a little bit from the left here and really track what is happening. So for example, what I immediately see is there has been a major break of structure here, okay? But then above that, we had a trend change. Okay, good. What caused the trend change? It is this lower low. Then we push, pull back, higher low, lower high. Okay, so basically we're still trading inside this overall range. Here, not by this one. Let me mark it like this, from here to here. And then the market kind of goes down, but you can see like here, we didn't really get a body break above, and then we didn't really get any higher low formation. Here we had a higher low formation, but this higher low formation failed to push higher. And then basically it went all the way lower to break this lower low. And what is this? This is a trend change. What caused the trend change is this lower high. Then we pull back for a lower low, we pull back, we break for another lower low, okay, but we still have this only lower high. And then basically you see the major structure that we're currently at, which I like to mark with this highlighter tool, which you can find here within the brush. Highlighter is I'm going to do lower high with red. You can change the colors here. And then basically the lowest low is here. So currently we're trading inside this overall structure. We're still bearish, because that is the major lower high that must be broken before we say we have a trend change. So that is the first way to go about it. You can see I had to really start from a little bit to the left to really kind of see, okay, this is the break, there is the breakup, there is the breakdown, there is the major one. So basically currently we're trading within this market structure. Okay, but what I would recommend you to potentially do is to focus, so to really zoom in based on the time frame that we're right now on the 4-hour time frame, to zoom in and to identify, okay, so what is the last break that we've had? And I zoom in immediately without paying attention too much to the left. I really zoom in, and what I see is that right here, we're having, I also have templates for this. I have a TradingView tutorial that I'm also gonna attach where I show you how to do these things. What I see is we have this lower high that is broken. What broke it? This higher low. And then what do we have? A higher high. So what is the current structure? If I get my, where did it go? If I get my highlighter tool, let me actually put it in favorites. We have a higher low formation that I'm gonna mark with blue, and then I have a higher high. So there's my structure. I'm bullish right now because we made a push. This is a higher high that is potentially going to be our liquidity, which just got taken. So right now we can be pulling back to potentially maybe make a new higher low and then to attack for a new higher high and to maintain this bullish structure. Because you can see in this case, I don't really have to wait for this lower high to get broken. We had a break of the lower low here. We had a higher low, but then we pushed. In this case, I would still say we are bearish because we haven't broken any structure, but here we created a higher low and then a higher high. So then basically that can signify a trend change. But here you're really more into the flow of the market, which is sometimes can be internal structure, but I do like it a little bit better because it's also very easy to mark. So I can give you a immediate example, just going on a random place. Let's just hit replay just randomly right here. And I am immediately, so I can give you again the two examples here. So one of the examples, the first one where we have to find the real major structure, which in this case, this is a very big major structure I can already see, is to really start from a little bit to the left and build a little bit of a story. Okay, so we start from here. We have a break. Okay, we have a break. Sure. And then basically here, let's say we have a break. Okay. And then here is where we have the trend change. And that trend change happened. What caused it? This low. And then we push all the way to make a higher high. And here we kind of failed to really body break above. We push lower and then we consolidate. So basically what is the price action here is from this low to this high. Push, and right now we're still bullish. Do you see it's a little bit complicated? And this is why I also stopped using market structure too much, because I like stuff that is objective. And I will share the video where I made market structure extremely objective. I even have an indicator for it, but I want to make it easy. Okay, so in this case, the easiest thing is going to be where we are right now. So this is where the price is right now. I zoom out a little bit. Where is my latest break of structure? There is a lower low that got broken. What caused the break of this lower low? This lower high. Bingo. There is my lower high. Market in red. The market pushes. There is our lower low. We're bearish. That's it. We are bearish until we either break above this lower high, that is going to be our trend change, or until we make, let's say, a lower high here and we break it to make a more recent trend change. So let's actually see what happens. Lower high created. Okay, so if we break above this one, we're going to mark it as a trend change, but so far we're still bearish, trading from this high to this low. And we continue to make a new lower low. Do you see? So then as we make a new lower low, what do we have? We have a break of structure. Break of structure. What caused this break of structure? The most recent lower high, which is here. And then all of this stuff becomes irrelevant. So right now, what do we wait for? We wait for a new lower low to form. Lower low formed. You can already be looking for shorts right now because we're bearish bias, and we're going to be looking for what? For a downtrend to maintain, we need to be maintaining the lower highs and breaking the lower lows. New lower low broken. What caused the break of the lower low? So let's type it down again. Break of structure. There it is. The most recent lower high. You see? It's nice and easy. What do we wait for right now? We wait for a new lower low to form potentially. There it is. It forms when we have the 5-bar fractal, which is automatically calculated for you. Now, again, if you want to understand it, there is our lowest low. We have 1, 2 highs that are not breaking this one. And then we have 1, 2 lows and 1, 2 lows to the right and 1, 2 lows to the left. And basically this is our lowest low. That is how the algo actually calculates it. So what do we wait for right now? We're bearish. We're looking for a break of structure once again under this lower low or a trend change above this lower high. Let's see. Okay, we failed to make a break of structure. We consolidate a little bit and you can see we might be getting a trend change right here. Bingo. You can see the indicator actually gave you an indication that, hey, this lower low failed to get broken. This is actually another pattern that is called market structure shift. I haven't included it because it's a bit complicated, but it looks like this. We make lower low, lower high, and then we fail to make a new lower low. So it's kind of a shift. You see it's starting to get a little bit more into an incline higher. And this is another sign that the market is shifting, but it's a lot weaker sign than the trend change. What do we have right here, everybody? We have a trend change. What caused this trend change, if I may ask you right now? You track it back down, the higher low formation. There it is. I like marking them with like this. So in this case, this is my major higher low. What do we wait for right now? Well, we are right now in the first sign of a trend change. Remember, what do we need? We need for the market to pull back, higher low, and then break to really confirm that we're going bullish. So let's see if that is going to happen. Higher high created. What do we want to see? We want to see this higher high to be broken. Higher low created. Now here we're really bullish, but we really need to see this higher high to get broken in order to really say, okay, we're in an uptrend right now. Okay, we're starting to try to break this, and you can see what is happening here. A little bit of a consolidation, but where is our last break? Well, it is here. Now this is where this second approach becomes a little bit tricky, because right now you're like, okay, well, I was suddenly trading here, and now suddenly there is a trend change here. Well, yes, that's unfortunately how it works. Structure cannot be extremely well defined. And right now what is basically happening is we're breaking this higher low with a trend change. What caused the break? It's this. So right now we're actually bearish from this high all the way to this lower low. And we really want to see the market to right now continue lower. Let's see, lower lows keep forming. Lower high, come on, give me a confirmation. So here, everybody, we're starting to get a consolidation because we're not breaking the lower lows, okay? And we're also not breaking the highs. What is this? Consolidation, and you already know about this. So let's see what happens. Reaches the top, repels. Reaches the bottom right now, repels. Reaches the top, repels. We have a gap down. Okay, so now you can see now we got the trend. So if I delete everything and I start from scratch again, where is the last break? Step number one, where is the last break? There. This is the last break. The latest structure that was broken is this higher low. What caused the break? This lower high. Bingo. That is my lower high. This is my trend change. And right now I am bearish. What am I looking for? I'm looking for a pullback. So I'm looking for a lower low to print first. Let's see when it does that. Lower low. I am bearish right now, and I would expect this lower low to get broken. Let's see. Broken. Continue. Now, in this case, you can see we did not form a new lower high. So basically, we're still making this our main lower high because we didn't have a new one. But we're making new lower lows, which is still a bearish trend. Let's see. New lower low created. Now we have a new lower high. So we want to see this lower low to continue to break. Let's see, or if we get a trend change. Okay. First sign of a trend change. In this case, the latest structure break is the break of this lower high. So are we gonna right now continue to go higher? Let's see, or is it gonna be a fake trend change? Higher high created. Now I want to see a break of this higher high. No. Okay, so what do we have right now? Again, is a little bit of a consolidation. Still, the last break that really happened of a valid structural point is this lower high. So we're still trading from this low to this high. So we're still a little bit bullish. Higher low. Okay, so we really entered into yet another consolidation here. And right now what is up with all these gaps that we're having? But hopefully you get the point. Now, how you can do this is, again, either just going back in time, but if you have a paid TradingView version, you can just go at a really random point, like let's just go, I don't know, 28th of August last year. And again, you just zoom in and you start. Where is my last structural break? There it is. Okay, what caused this break? This low. So what kind of structure I am right now? Bullish. We have a bullish break. Okay, cool. Now you wait. Higher low created, higher high created. Great. What am I looking for? I'm looking for the higher high to break and the higher low to maintain. Let's see. Higher high breaks, higher low maintains. What do I have right now is a higher low, a higher high, and a higher low. What do I want to see right now? A new higher high to form and to get broken. Let's see. Higher high forms, gets broken. Beautiful. there is my new break of structure. You can actually keep all these breaks of structures, and I keep marking new higher high. Okay, great. What do I want to see right now? A new higher high to form and the higher low to maintain. Let's see. New higher high forms. We can take our break of structure line. Oops. What happened right here? We formed a higher low formation and the market broke it. What caused the break? The lower high. What is this? Trend change. Now we shift to bearish. Okay, now we're bearish. What am I looking for right now? For the lower low to form. There is our lower low. What do I want to see? The lower low to happen in order to maintain the downtrend. I want to see the lower low to be broken and the lower high to be protected. Let's see if that happens. Okay, we didn't really break this with a body close, so I wouldn't say that this is a break. And we are starting to make some fancy schmancy pullback here. Let's see if this lower high is going to form or is it going to break. Okay. We had a lower low here, which is a sweep, which we're going to cover in a bit. We tried to create a lower high. We tried to push down, but here is everybody where we have this market structure shift pattern, where the market makes a lower high, but it fails to break the lower lows. Now, once again, what is the definition of a downtrend? It is lower lows being broken and lower highs being maintained. What did we have here? Lower lows were not broken. This lower low was not broken. And the lower high did not get maintained. It got broken. So what is this? It's a trend change. TC in short. What caused this trend change? This higher low. So we went from a bearish market, which is lower high, lower low. We even had one lower low. This was also still bearish because we're still looking for shorts. Quick trend change. What we're looking for right now, again, just to give you some final examples for you to really kind of master market structure and to know how to practice it. There we go. New higher high. So we can mark it. That's our new high. So right now we are bullish. What do we want to see right now? We want to see the higher highs to break and for the higher lows to maintain if you want to see an uptrend. Higher low created. We want to see this maintain and not break. And we want to see the higher high to break if we're going to be bullish. We're bullish, breaking. This is our new higher low formation. That is confirmed because we have broken the higher high and that confirms the higher low based on the rules. Higher high created. What do we want to see is we want to see the higher low to maintain and not get broken and for the higher high to break in order to continue with the bullish trend. Oopsie, what do we get? We get a trend change. All right, TC down. Great. So what we want to see right now is for the market to pull back and then break again to really confirm that this is not going to be a fake trend change. Let's see. Lower low created. What we want to see is we want to see this lower low to be broken to really confirm that, hey, right now we're going bearish. So let's see if we're actually going to break this. Lower high created. Now we want to see this lower high maintained, not broken. Okay. We have a wick break here and then the market breaks this lower high. So basically we are right now in a trend change up. So starting to get a little bit choppy. Higher high, what do we want to see is we want to see this higher high to be broken to maintain a bullish trend. There we go. Broken, bullish trend. What caused the last break? It's this. So now we want to see just to continue a new higher high to be created. There it is. We want to see this one get broken. It got broken. Okay. What caused the break? It is this higher low. What do we want to see next? A new higher high. Okay, we're really bullish. There is a new higher high. There is a higher low. Oopsie here. Okay, this one is valid because it disappeared. So basically here we are still a little bit bullish, I would say. Because that is not a body break. We're still trading from this low to this high. So then you have to wait for some new structural patterns to form. Okay, that is a tricky example here. But if you kind of get lost, always go back immediately. So where is the last break? The last body break, if you will. Because if you're taking wicks, that would be a break for a higher high. But then where is my higher low? Really, it's still down there. So we're still a little bit bullish. Now this lower high, it didn't really break anything. And this is a higher low that is not broken. So currently this is a little bit tricky situation here. You see, it's not always going to be extremely amazing. But now here what I see is I see this low is being broken. And what caused the break of this low, it is this high. So I am right now a little bit more bearish. Okay, so if I now see this lower low to be broken, which again, it did not really break clearly. Man, this price action here got pretty confusing. Are we in a consolidation here? What's happening? Kind of looks like a consolidation to me. Okay, now, and you can see like when it gets cleaner, you start seeing lower highs, lower low, lower highs, lower lows. Then here we shift. and so on and so forth. Okay, now of course there are certain indicators that can do all of this market structure for you, but they're not really good. Now I have my Fanatic indicator. This is part of my coaching program, but again, we do not use market structure anymore. Why? Because I'm just about to show you something that is a lot more powerful. But if I show you how it looks like, this is taking into account the valid ranges, which you can watch in the video that I'm going to attach, the video with the valid with the objective market structure rules. And you can see it's taking, in this case, pullback candles and opposite candles. So it's a system where you have an opposing candle, which in the bearish trend is going to be a bullish candle, and also an inside candle that is not breaking below the previous low here. That makes it this a valid range, pullback, break, trend change, pullback, break a structure here, and it's actually going to mark it all automatically for you. Yeah, it's kind of nice and easy, but actually the way that I also explained to you is, I would say, a little bit better, because this way that I defined, it does a lot of trend changes. It's constant, like trend change up, trend change back down, trend change up, trend change back down, and a lot of times it's not as good. Okay, so now you know how to mark market structure. We have our fractals indicator to show us the most recent swing points. You just find the most recent that was broken, you find what caused the break, and then basically you have your current market structure. So if market structure seems a little bit complex for you, maybe you're not really clicking with it, I want to just give you an easy market structure hack, and I'm immediately telling you this is what I am using right now. After years of trading market structure, I have transitioned to trade two other concepts that I'm just about to share with you. So market structure was left a little bit kind of on the back seat, but as I told you, market structure is really the foundation of everything. However, what if there is an easy way to really define market structure? And there is a much easier way to define overall market structure and overall bias, and that is by adding a 50 period exponential moving average to your chart. Okay, that's an indicator. Well, yes, indicators can actually be really good if you really know how to use it and if you really put it into context. Because what many traders think is that you're gonna put 10 indicators and they're always gonna show you when to buy, when to sell. No, the indicator needs to be part of a system. It needs to guide you somehow, and it needs to just give you context for your overall trades. I do not trade based on that EMA. I do not say, okay, EMA is bullish, I'm gonna go long immediately. No, it's just part of our system. So if you don't want to trade mechanical market structure like I showed you, which I don't recommend, because the two tools that I'm about to show you right now in this tutorial, they're gonna be 10 times better than market structure. The 50 EMA is the best trend tool. And I will later show you again what I trade currently, which is a lot better than market structure, but I still use the overall structure as guidance for the trend. And I just zoom out a little bit and I ask, okay, who is in control? Where is the EMA pointing towards? And of course, I consult the EMA. So let me show you how that looks like. There. So we have a naked chart. However, look how we plot this EMA. Now, what is the 50 EMA? A moving average is the average of the last bars. So for example, a 50 moving average is going to take the last 50 bars and it's going to calculate the average price of that. And as every new candle prints, it constantly keeps calculating for 50 bars before. Now, it is a little bit of a lagging indicator, but it's not, because it gives you the overall, for the latest 50 candles, the overall strength and the overall structure. So what you see is happening right here. Let's just have a look at it. What do you see? EMA pointing down, price action is above the EMA, then it goes below, retest, bearish, bearish, bearish. We test the EMA for a potential lower high, no, but we shift above the EMA, we're bullish. Test, higher low, higher low, higher low, higher high. We pull back potentially to test the EMA, but we break it from the other side, retest from the other side, bearish. We break the EMA, retest bullish, higher high, higher low, higher high, higher low, higher high, higher low, precisely into the EMA, higher high, higher low, higher high, higher low into the EMA, pushing, higher low into the EMA, pushing. You can see, like, as long as the EMA is bullish and price action is above it, I'm bullish, because that is the overall trend. We push for a new higher high. Now here we come to test the EMA, react and break. Hey, trend change bearish. lower high, lower high, lower high, lower low, lower high, lower lows here, lower lows here. Here we break above it, push, trend change, retest from the in DMA from the other side, higher low formation, we push for the new higher high. And if I even include, for example, here a little bit of markups here, you can literally see when we're bullish and when we're bearish. Consolidation here a little bit, but above the EMA, 50-50. Trend change, clear bearish bias, bearish bias, bearish bias. Trend change above the EMA, break and retest of the EMA, higher lows, higher lows. Break and retest of the EMA, bearish. Break and retest, trend change, bullish, 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 bullish. Here we also have a trend change in terms of the EMA. Bearish, 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 bearish. Trend change of the EMA, bullish. See how easy? Let's go do it on your charts right now. All right, let's put it all on your charts. We go once again to indicators and we type exponential, moving average exponential. You click on that. Great. That is immediately going to give you an EMA. However, you have to once again go to your indicators and you have to go to the settings. So there is the EMA, you go to settings. And what you do is you go to the length and you make it 50. Bingo. You can style it. Now smoothing here. Yeah, it can be EMA. No. You don't really need all this stuff. Length 50. Source as it is. Leave everything as it is. The only thing you can do is go to style and maybe make it whatever you like. You can make it yellow, you can make it blue, you can make it a little bit bolder like this. This is definitely not bad actually. And you're set with your market structure. What are we currently doing, by the way? Lower high from the EMA, lower low. Right now we're just at the EMA. This is a current price action, by the way. This is not replay. Look what we're doing from the EMA. We're going down. So are we bullish right now or are we bearish? We're bearish in terms of the EMA. Now, if you do both things, now if I click, for example, the indicator is going to give you, hey, we have broken here. We're still bullish in terms of market structure. But why I started using the EMA, because I stopped using the mechanical market structure, but I just wanted to implement what I call like overall structure. So what kind of overall structure means is you just zoom out like this and say, okay, what is the market really doing? Well, we kind of made a high here, a low, lower high, lower low, lower high. This is what a lot of the people on YouTube are going to teach you. They never really objectify market structure, so you're always confused. So in this tutorial, I actually gave you objective rules for market structure, but I also give you a choice to either be a little bit more relaxed with it and use the EMA. I want to really go into it, but know how to do it. Because many traders are going to tell you, all right, high, low, lower high, there, right, we're moving lower. Right now, this can be a lower high. So this is kind of, you can see the overall structure. We're not zooming it into the market. We're just looking at it. Like a lot of people are going to tell you, hey, higher low, higher high, higher low, higher high, we're bullish. And right now we broke down, we're bearish. And like, where is your lower high? Is this your lower high and this is your lower low? Or is this little things here? Or is it this? Like, what is it? You don't know. But once I started trading what I'm actually about to show you right now, I still wanted to have some sort of structure, some sort of market structure, but without drawing it. So after a lot of testing and looking, it was very simple, 50 EMA. There it is. Bullish, bullish, bullish. Here we consolidate, we break it. Now here we're bearish. We look for shorts. We break above it, we're bullish. We look for longs. We consolidate at the EMA. Now also the EMA can tell you the strength of a trend. If the EMA is flat, consolidation. If the EMA is inclined up, bullish, inclined down, bearish. I want you to look, for example, right here. The EMA is starting to get flat, but we hold above, hold above, hold above, hold. Look at the candle anatomy. Look at all the wick rejections coming from the EMA. When did we close for the first time clearly below the EMA? Exactly right here. Exactly right there with these two bearish candles. We closed clearly below the EMA for 2 candles. That can be your trend change. And you can see then the market pulls away from the EMA. Lower high, lower low, lower high, lower low. We just go down. Test the EMA, but you can see we don't really get 2 clear candles above. And to really push away from the EMA, goes lower again. Now here what we're getting is we're getting a market structure shift, potentially. So we look a little bit bullish, tries to overtake the EMA, breaks back below, tries to overtake the EMA, breaks back below. Okay, and then we literally see, all right, we were actually bearish. So if you can get market structure to also, like the recent market structure, to also agree with the EMA, it's always great. So for example, here you can see like they are going to be a lot of times in disapproval, because in this case we had this lower high that was broken, so we're bullish, but we're tapping into the EMA. Not a great thing. And a lot of times, even with my strategy right now, I can get, for example, a long trade, but if the EMA is bearish, I don't trade it, especially if the EMA is on the 4 hour or on the 1 hour, which are going to be, for example, our bias time frames. So you can see in this case, we pushed up, we made this trend change, and we made this higher high. What do we want to see right now? We want to see the higher high to get broken and the higher low to maintain. The market pulls back, makes a higher low, tries to push, fails. It tries to push lower, body breaks. So now I'm looking a little bit more bearish because this higher low was broken. What caused the break of this higher low? It's this. So basically right now we're a little bit more bearish. But then nothing is being broken. We formed lower low, wick, higher low. Then we push up. This higher high never got broken. This is a lower high. Then we have a higher low that didn't broke the previous structure. Then we have a lower high that didn't break any structure. So everybody, what is this? Hey, consolidation, beautiful. And then basically you can see in this case, we were, because the last break was the break of this higher low, nothing else was really broken. So we were still bearish, and that bearishness aligned with the EMA. So at the end, we went bearish. Okay, but this is not always going to align. So for example, here, as we see, there is a break of this high, we're bullish, but we tap into the EMA, not good. Higher high, but look at the candle anatomy from the EMA. Tries to break it, reject. Try to break it, reject. Try with the body to break it, but then the next candle opens, it tries to push up and is immediately shut down from the top. Bearish engulfing candle. Okay, below the EMA. Comes back, retests the EMA beautifully, bearish engulfing candle again. And at this point right here is where you also get your trend change. The latest break of structure of a valid structural pattern right here. And precisely at this moment is where the recent market structure aligns with the EMA. And then look what happens next. You have a beautiful rundown. So what would be, for example, a great example right now would be to really see a bearish market structure shift in this case, because the latest structure that was broken is this, and currently the higher low that can maintain is this. So currently we're trading in this bullish push. So if we, for example, make a higher low and we break it right here, and the EMA is going to be bearish, then very likely we're going to get a nice move lower. So that would be, for example, a good bearish scenario. The EMA can be used on any time frame. You go to the daily time frame. Price action above the EMA, and if the EMA is sloping up, we go up. Price action below, bearish. Break above, bullish. Break below, bearish. Break above, bullish. Consolidation here, holding, the last resort holding. Right now we're bearish. 1 hourly time frame, same thing. What time frame was I at right now? I think it was, yeah, it was on the 4 hour. 1 hour time frame. Price action was bullish here, broke below the EMA right here, also broke structure. Look at the bearish trend. Bearish, 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 up until here. We have a market structure shift and we have a trend change and we break above the EMA. Beautiful. Long bias. Longs, longs, longs here. We got a little bit of a break below, but then we immediately came back above it. And currently we're bullish in terms of the EMA. So if the market right now comes and tests the EMA on the 1 hour, we can very likely also be looking for longs as well. So that is how I use the EMA, and it works on every single time frame. Like, just go and switch the time frames and see how well it is respected, especially in trending conditions, which is what we're looking for. You can immediately spot what a consolidation is when the EMA is flat and it kind of keeps breaking above, keeps breaking below, keeps breaking above, below, above, a little bit, below a little bit, above a little bit, below. There you know, okay, we're just consolidating. When it's trending, it's clearly trending, and I mainly use the EMA for, again, for my trend. So that is the 1 hour, the 4 hour, and the daily time frame. And I want to have these time frames to be aligned with the EMA, and then on the lower time frames, I'm going to be looking for trades that are aligned with that EMA direction. So that is how we define the overall direction using the EMA, or of course, market structure. You've been watching for 4 hours and I bet you're loving it so far, but you still haven't hit the like button and the subscribe one. So come on, let's take a pause a little bit, take a break, scroll down a little bit, hit that like, hit that subscribe so you don't miss all my future videos and really help this video to get a little bit more traction because I really put a lot of work. It would mean a lot to me. Let's do it. And of course, let's get back into it. All right, Fanatics, we are moving. Now you know the most important aspect of market structure, okay? So what we learned so far, we dove deep into market structure. We had the trend foundations, trending and consolidating market. That is the first thing that you have to look at. Is the market trending or is it consolidating? How do you know? By using market structure or by using the EMA. Bullish market structure, bullish trend. Bearish market structure, bearish trend. These are our trending conditions. Consolidating, really going up and down, really getting confused. If you spot it within some of the charts that we looked at, I kind of got confused at times. Okay, like it's not breaking, it's not like what is happening. When you get these type of conditions, just don't trade because it's not clear and it's not your fault. Sometimes the market goes a little bit crazy and you cannot really recognize the structure. Well, that means it's a consolidation or a choppy market, so don't push it. We had a look at the trend mechanics, trend changes, structure breaks, and trend confirmations. We learned how to draw market structure in a mechanical way, and I also gave you the easy market structure hack, which is the 50 exponential moving average. Now, market structure is really a strong foundation, and this is why I started with it. You can go into a really deep rabbit hole about it, and I have a lot of videos on it on my channel. Now you can check out my educational playlist. I have a lot on market structure if you really want to understand it. But now, going forward, we're going to look at two extremely powerful tools that are better than market structure, but actually complement it, and they are ingrained within market structure, all right? So we just learned how to identify overall bias and overall direction by using market structure, but we have two more tools to talk about. And the first tool that we're going to talk about right now is the concept of liquidity. All right, so what is liquidity? Let's start again with the foundations. Liquidity is the ability of an asset to be bought or sold on demand. Okay, so we say a market is liquid when there is a constant participation of buyers and sellers, and anyone can come in at any time and buy or sell his commodity, his asset, his cryptocurrency, currency, whatever. So why we're starting also with the Forex market is because the Forex market is the most liquid market out there. You can always go anywhere and sell your euros for USDs, or like always, you can always exchange your currencies. You can always open a trade. You can always go and open any type of trade. That is what we call a liquid market. It's very easy to exchange stuff. But if you, for example, compare this to real estate, I mean, not the best example because yeah, it does make sense. Well, we would call real estate an illiquid market. Why? Because I cannot just click a button and buy a house or sell a house, right? There needs to be a buyer for every seller. Could be a lot of sellers. There might not be a lot of buyers, okay? You have to go to view the house. You have to do documents. You have to do this, and then it takes so much time. It's not liquid. It's not flowing. So anyway, hopefully you understand what a liquid and an illiquid market is. The more orders there are, the more participation there are, the faster stuff is happening, the more liquid a market is. Now, liquidity is essentially orders. For every buy order, there must be a matching sell order. And for every sell order, there must be a matching buy order. It is always an exchange. So the concept of liquidity is pretty crucial. This is why we're starting with it right now, is because this is what essentially drives the market. This is what kind of moves price. And for us retail traders, liquidity is not really a problem because we can open our platform at any time and we can execute because, again, we're not trading with billions or millions. No, we can always open a trade. You're never going to get a moment, of course, if your account is not very small, to get a margin call or to get like a margin not sufficient to open your trade. Like you're always going to be able to open a trade. However, imagine a financial institution that wants to buy 500 million worth of Euro USD. So that is, for example, 5,000 standard lots. What are we going to trade? Us. One lot, 10 lots maybe. Like if you are extremely crazy, you can do 100 lots. But 5,000 lots and 500 million worth of Euro USD. Okay. Now, if this institution wants to buy $500 million of Euro USD, there must be 500 million sellers of Euro USD. So they cannot just go and click and immediately, let's go. There were 500 million people that are selling euro. No, they need the liquidity in order to execute that order. And usually, again, they're not just gonna press a button for it to happen, because that is gonna cause the market to massively collapse. And I'm gonna tell you why when we're looking at the actual auction market theory. So what this BFI is gonna need is they're gonna need liquidity. And then the question is, where do they find this liquidity? Well, this is our goal right now, to understand where. And to actually understand liquidity, we must first understand orders in the market. If you are a complete beginner and you don't know what these orders are, let's check them out. There are three types of orders. We have a market order, we have a limit order, and we have a stop order. The stop and the limit orders are also called pending orders, because you are setting these orders and you're waiting for price to engage with the price that you have set those orders at. While a market order is you just click and you execute, right? Now we have also another type of order, which is a buy stop limit or a sell stop limit. You won't really need those. But for example, this is a MetaTrader platform. And when you go to execute a trade, you can choose between all these type of stuff. You can do an immediate market execution, and this is where you determine your lot size. You can set a stop loss and a take profit. Or you can do a sell limit, a buy stop, or a sell stop. Yeah, buy limit, sell limit, buy stop, sell stop, and these two things you're really not gonna need. So what do all of these mean? Let's explore them one by one. First, we're gonna look at the market order. So imagine this is again the price axis, and then we have the time, and the market is moving up, it's moving up and then moving up, and then precisely at this moment in time, and at this moment of price at 1.2880, you decide to go long on Euro USD. So you execute a market order. How do you do that? Is you go again, let's say this is GBP USD. Our lot size is going to be 0.01, so 1 micro. And then we just click buy markets. Do you see what your spread is right here? The sell is 36.46.2 and the buy is 36.46.5. So the spread on this broker is very low. It's very low. It's like literally 3 pipettes. It's not even a pip, which is usually the brokers that you should be looking for. Very low spread, but usually in these brokers, you're going to pay commission. Okay, but of course, these brokers have to make money for us to engage in the markets. I'm grateful that there are brokers to give us leverage and help us engage in the market. So if you enter a long trade exactly right here, if the market goes down, you're going to have a floating loss. Until you close the trade, you're going to see minus on your profit and loss pretty much account. And then if the market goes up, since you market longed here, and if it goes up, you're going to have a floating profit. So the market order executes immediately at current price, which you can always see right here. That is the price that you're going to get if you just click buy markets. That is a market order. And this is also called an aggressive order. These are the aggressive participants who want to get filled right now at the current price. And usually, like, because these price, they change like every nanosecond. Until you click, this can be 36.48. And then you click and it's like suddenly you're executed at 48. So you're not always going to get the exact price that you want to get executed on. But that usually happens when the market is going extremely volatile and extremely crazy. So you're not going to get this very often. So that's market order. Let's talk about limit orders, which are a little bit more complex, but of course you're absolutely going to figure it out. Let's say that the current price once again is 28.80 and the market is right here. If you want to sell above the current price, you can set a sell limit price. So let's say you set a sell limit at 28.90. Why would you set a sell limit? Is because you think the market will go to 28.90 and reverse from there. So when the market comes and taps your sell limit, which is 28.90, you're gonna then get executed at exactly the price that you outlined. That is the benefit of limit orders, is they're gonna execute it precisely on the price that you indicate. So in a sell limit, if the market goes down from here, you're gonna be in profit. And if the market goes up from here, you're gonna be at a loss. So you're executing a sell above current price. A sell limit can only be placed above current price because you want to sell high, potentially expecting for the market to go down. Let's say you think that the market is actually going to go up and we're currently at 28.80. So you set a buy limit at 28.70. And then the market travels down, and taps into your price of 28.70, and your buy limit gets triggered, and then you execute a buy. So you literally, the broker is gonna execute you for a long trade, for a buy trade. However, if the market then continues to go down, you're gonna suffer a floating loss. However, if the market taps your price level and starts reversing, you're gonna be having a floating profit. So that is the limit order. There is, for example, sell limit, and you set the price at 28.90. You click place, and you're literally going to get filled exactly at this price when the actual price action reaches this price point. And for a limit, so how I usually remember them, for a limit, you expect a reversal. You expect a bounce. But for a stop order, okay, current price once again, 28.80. You think that the market is going to cross 28.90 and just continue to go up. So it's like a breakout. So a buy stop can only be set above current price, and a sell stop can only be set below current price. But this is a continuation. The limit is a reversal. The buy stop, the stop is a continuation. So if the market travels and taps your buy stop price, it is going to trigger you in a buy position. So you enter into a buy at exactly this price, and if the market continues to push higher, you're going to have a profit, but if the market reverses from here, you're going to have a loss. Same is true from the other way. Let's say you decide that the market is going to continue to crash lower, but you don't want to enter right now. You really want to see the price to show you that it wants to push lower, and then you want to enter. So you set your sell stop at 1.2870. The market travels down, taps 1.2870, and it triggers you into a sell order, and then you get triggered into a sell. So if the market then goes up, you suffer some loss, but if the market continues to go down, you have a profit. There we go. You set the sell stop 1.3640. The current price is 36.50, so you can only set a sell stop below current price, and you can always set a buy stop above current price. For limit is the opposite. You can set a sell limit above current price because you want to sell high, and a buy limit because you want to buy low. But the stop order is like a continuation. You want for the price to continue going in that direction. Okay, so these are the types of orders. I hope it makes sense. We're going to recap them just in a bit. But on most platforms, as you're going to be opening up a broker right now and starting to trade, after, of course, this tutorial, you're going to have an option to set a take profit level and a stop loss. So TP and SL. A take profit level is where you wish to exit your trade and realize your gain. So you made profit. That is, once again, you can set a take profit at a specific price point where the market is going to close your position and realize your profit. But a stop loss is the opposite. It's where you wish to exit your trade and cut your loss. So if you take a trade, you can predetermine a level at which you can exit for a specific amount of loss. Okay? And of course, depending on your position, whether you're long or short, whether you're in a buy or a sell, the take profit and the stop loss orders are going to be different. So this is why we just explained the 3 types of different orders. Now, you don't really need to care too much about this because everything is going to get calculated automatically when you set a TP or an SL. So you will just be asked about your price point. So for example, you enter at 28.80, take profit at 28.90, stop loss at 28.60. You're going to get executed at these price points either for a loss or for a win. So what you have to understand, however, which is where, again, why I'm showing you this, why I'm teaching this, is because it's important for liquidity. If you take a buy or you go long, you're going to exit your position by selling. Okay, so if you bought, you have to sell back. You're either going to sell back for a profit or you're going to sell back for a loss. Okay, so you will either need to use a market sell order, okay, or in the case of setting orders, your stop loss on a buy order will be a sell stop below current price, and your take profit on a buy order, oops, little typo here, will be a sell limit above current price, because we already know how these work. So if I very quickly want to draw it, let's say that Let's say we execute exactly right here. And we set a take profit here and a stop loss here. So a take profit, what is the take profit gonna be? It's gonna be a sell limit. Why? Because we can set sell limits above current price. So when the market reaches this one, ping, we get out of the trade for a profit. So our buy position gets sold here. But our stop loss in this case, it's gonna be a sell stop. Okay, why? Because we can only set sell stops below current price. So if the market from here goes down, it taps this level, you exit, you again sell your buy position, unfortunately, for a stop loss, okay, for a loss. So that is how these orders work, but they're going to be automatically made by your broker. You just set TP and stop loss, and it's going to know what kind of order to execute. And the same thing is true for the opposing side. If you go short, so if you take a sell, you're going to exit your position by buying. So you either need a market order, so just decide, okay, I'm going to exit here and click buy, or you're going to use a stop loss, which on a sell order is going to be a buy stop, and a take profit is going to be a buy limit. Okay, so these are just like really the dynamics of it. If you're kind of really confused about this, it doesn't matter as much, but it's really important to understand like what kind of, where orders are located and what kind of order gets triggered when people's stop losses or take profits get hit. Okay, because that is where really that liquidity surge is going to happen. So there's actually, I had an example prepared for you. We execute exactly at this price point, which is 1.18668. We execute right here and we set our stop loss under this low. So our stop loss is going to be a sell stop order. And then we set a take profit here. And that take profit is going to be a sell limit order. So if the market goes up, we get triggered here for a sell limit. And if it goes down, we get triggered here with a sell stop and we close our positions. If we, however, decide that at this precise point, we're going to be entering into a sell. So we market order with a sell short at 1.17203. We set our stop loss here at 1.17299 and our take profit at 1.17015. So this is going to trigger us with a buy stop. If it goes above, we get exit for a loss. And if you go down, we get triggered with a buy limit to realize our profit. That's how it works. Now, let me give you a quick example of what the limit order is. So currently the price is right here at 1.17020. However, you think that this precise level right here is going to be a very strong level and the price action is going to reverse from there. Exactly. So what you can do is you can set a buy limit. You can set a buy limit below current price. What you're going to be expecting is a bounce. So, and then you can set your stop loss, your sell stop, and then your take profit, which is going to be a sell limit. So if the market precisely comes into this price point, your broker is going to trigger you into the trade and it's going to set your stop loss here and it's going to set your take profit here. And then if the market reverses and goes and goes and goes, you realize your take profit by exiting with a sell limit. And there are going to be a lot of people to sell here. And you can see, whoop, price goes back down. Here is how trading with a stop order looks like. You're thinking that the market is going to go down. The current price is right here, 1.16551. However, you want to see a little bit more confirmation. You see, okay, I want to see a break of this low. And if this low gets broken, I want to immediately get triggered into a sell. So what you can set here is a sell stop. So you set the sell stop at 1.16492. So if the market starts going down and just touches this level, you get triggered into a sell. And then your stop loss is going to be a buy stop above and a buy limit below, because for a sell, you need to exit with a buy. And then you can see the market crashes through this level, but immediately when the market crosses this point, you get triggered into your sell. Okay, and then the market goes lower into your take profit, then you get triggered, your buy limit gets triggered for a take profit. Okay, woo. So now you know all the orders. Now, at first, it might be a little bit confusing to memorize them. You don't have to, but how I kind of memorize them is a stop order is a breakout. It's a continuation, okay? And a limit order is a reversal or a bounce. This is a really good one that you can screenshot, or of course, you're going to have the PowerPoint so you can revisit it. Again, a buy stop is above market price. We just follow the breakout, while a buy limit is placed below current market price. So then we expect if the market taps this price, it's gonna rebound. And a sell stop is the same. We expect for the market to crash under that sell stop. And for the sell limit, we expect the market to tap the sell limit and reverse, right? So every order that we just discussed is liquidity for the market, because the market operates within the mechanism of going for liquidity. So taking all of these orders and then going back to seek fair value, and then back to liquidity, back to fair value or balance. Liquidity, balance. So right now you might ask, where is the liquidity? Okay, so how do I recognize where all of these people are going to set their orders? Where are their stop loss? Where are their take profits? Where are all of these things? And why is this really relevant? Where is the liquidity? Is where there are tons of orders, where there are tons of buy stops, buy limits, or sell stops and sell limits. And where are these tons of orders? We're going to explore this right now. So where is the liquidity? Now, if you go online, you're going to see 1,000 types of liquidity. Double top, double bottom, trendline liquidity, head and shoulders liquidity, false breakouts, false flag formations, momentum divergences. You're going to see equal highs. You're going to see equal lows. You're going to see trendline liquidity. You're going to see, I don't know even that one that is. What is that? IDM? No idea. Probably inducement low, inducement high, inducement low, inducement here. And I mean, so complicated. It is true, but it's so complicated. So if you go to study online, you're going to see like 1,000 different liquidity points. You're going to be like, what the hell is that? The real liquidity pools are found at a very simple place: above highs and below lows. That's it. That is where really the liquidity is. Now, for centralized markets like futures or options, there are more liquidity levels than just highs and lows, like volume weighted average price, VWAP, gamma exposure levels, high and low volume nodes and levels, all right? But that is the levels that everybody knows. So everybody knows where the volume weighted average price is. So if institution wants to buy 1,000,000 shares, they're always going to buy it at VWAP. This is why there is going to be, for example, a lot of liquidity there. The gamma exposure levels, you can look at these and you're going to see exact levels where there is that exposure. So you can expect bounces from there because there is a lot of liquidity. However, for the Forex market, because it's decentralized, we don't really get these things. And if we do get them, they're not going to be very legit, because every broker or every data provider is going to give you different volume weighted average price, or it's going to give you different volume profile levels, and their volumes are not going to be amazing, because imagine there are 1,000,000 traders and these 1,000,000 traders are not trading at the same place. Some is trading on IC markets, some is trading on fusion markets, some is trading on Oanda, some is trading on FXCM. So they're not combined together. And if they try to get combined, it's not going to be the real thing. So for Forex and also for futures and for every market, if you just learn to spot liquidity above highs and below lows, it's great. Now, why is that? Well, because that is where the most orders are located. Because where would you place your stop loss? You're usually going to place your stop loss above highs and below lows. And a lot of people are going to place limit orders and stop orders also above highs and below lows, either expecting a breakout with a stop order or expecting a bounce with a limit order. Okay. And at these precise points, there is always a lot of liquidity. So how does that look like? Let me just give you like a schematic scenario here. Let's say that a BFI wants to buy an asset. They start, then there is a low, and then the market pushes and there are a lot of buyers. Okay, good. But if that BFI wants to buy right now and they have so many orders, where are they going to get their orders from? Well, look, the market pulls back. It potentially makes a higher low. Us retail traders are going to think, okay, higher low, we're going to go for a new higher high. We enter a long trade, stop loss. So their long trade goes in a stop loss, which is a sell order. If the BFI wants to buy, what do they need? They need sell orders. So what they need to do is they need to trick people into buying and then stop them out. Or they need to trick people into selling to literally get that sell volume so they can buy it from them. So see what happens here. Buyers get stopped, they turn into a sell. And then sellers really see, all right, we're going down. So they start sell. But then under this low, that is what we call a liquidity pool. So buyers So if there were any buyers in this move up, their stop loss is below here. If there are any people that want to sell below these levels, they're going to set a sell stop. That is also a sell. Okay, so not only buyers are getting stopped out, but sellers are also being induced into the market, and sellers are looking for a breakout below this level. So precisely at this point right here, there are just so many sell orders. Okay, and a sell order can be the stop loss of the buyers or new sellers thinking, okay, now we're gonna go down. And then when the BFIs get all of these sell orders to match their buys, they launch the real move. They launch the real move. And then guess what? The sellers from here, they set their stop loss here, and then people want to buy above this level. Then what is that? That is another liquidity pool. And what exactly the institutions are going to do is they're going to offload their longs. If institutions close longs, what does that turn into? It turns into shorts. And this is why everybody, you're going to see that usually after a high is made or after a liquidity point is taken, the market pulls back. Why? Because everybody right now wants to buy. Everybody that is sold is stopped out, and institutions have made their move, so they want to take some profit. But a take profit on a buy order is a sell order. So the market starts going down. Pulls back a little bit once again. Here everybody thinks, okay, we're going to go up. They go long. The market stops them out, and under this low, there are sell stops. The market thinks, okay, now we're in a trend change. We're going to go down. And then boom, the BFIs launch another order. After taking some stop losses from here, after tricking people into sells, they get all the buys that they need to launch a new move, and then they just repeat the process. This is also one of the reasons I stopped trading market structure too much, because it is really hard to understand these things in the lens of market structure. You're constantly gonna be like, is this liquidity grab? Is this not a liquidity grab? Where is the major string? Where is this? Where is that? So I'm going to show you a much easier way to go about these things, and actually a lot more profitable. So I hope you understand this. That is a hypothetical liquidity scenario, how there are multiple participants in the market, and how the big guys, the institutions, again, do they really do this? Probably not. But they still need to generate some sort of orders, and they're going to get those orders from these liquidity pools or by tricking people into executing the opposing position that they actually want to execute. Okay. So how do we draw these liquidity levels? We're going to be using what I call swing points. So swing highs and swing lows. We will make them very objective in the form of a 3-bar fractal. We know what a fractal already is. We used 5-bar fractals for our market structure, but I would recommend that you probably don't use that much market structure and just focus on the 3-bar fractals for our liquidity. You already know how that looks like. We have a high and a lower high to the left and a lower high to the right. That is going to get marked on the indicator, the fractals indicator, as a fractal high. That is a swing high. Swing low, we have a lowest low and a higher low to the left and a higher low to the right. That is going to be a swing low. Okay. So keep tracking until you find the swing. So that is, again, it's just the fractal rules. Okay, like you see high, okay, good. But then we have a high, okay, good. But then the next candle breaks the high. Okay, so this is the highest high, highest high, highest high again, highest high again, and then finally we get the pullback. So that is going to get triggered on the indicator as a fractal high, and that is when you have a swing high. And why is that important? Is because you can see here, there is no liquidity pools. So the market breaks this high, it breaks this high, it breaks this high, it breaks this high. It just keeps going higher. But once we actually make some sort of a pullback, then that means that there are a lot of sellers coming. So that immediately means that above this swing point, there could be a liquidity pool. Now, we don't know that. Now, there are certain, but again, this is more for futures where you can actually see the tape and you can see how many orders there are above and below these type of levels. But for Forex, we don't really have that. But that is what is going to be a swing high. So right now, let's go draw some liquidity levels right now. All right, on the charts again. Like, I'm always so excited when we get to the charts. What we're going to do is, again, we're going to use a fractal. Fractals, if you want, of course, you just click on it and it's automatically going to be a 3-bar fractal. So if we go to the indicator once again, settings, we can do, there we go. So show fractal points, click on that. 3, now I use 3. You can use 5 if you want to like really refine your liquidity levels. It's actually probably going to be very good. However, I only pick, for example, very relevant liquidity points, like not everything. But anyway, let us keep these fractals for now. So for example, here, where are our most recent liquidity levels? It's under this low and it's above this high. As easy as that. Under this low, there was a liquidity level. Look, the market taps, goes up, right? That's a sweep. We're just going to cover about that. Going a little bit here. That was a nice liquidity point here, but look at what the market did. It just broke it. So here the sellers really won. This liquidity point was not engaged. This liquidity point here, first it came in, whoop, swept it, but then it broke it. That confirms, okay. So that was not very sensitive, and it seems like that sellers are taking control. Liquidity point here, you can see that is a sweep. We're just going to cover sweeps and breaks as well. Now we just draw liquidity points. They kind of resemble market structure as well. There is this liquidity point was broken. There is another liquidity point here. Liquidity point that was broken as well. Liquidity point here as well. Liquidity point, beautiful sweep here. Two liquidity points stacked. They got swept here, but then the market still prevailed. This is the same thing that you're gonna do literally on the quality time frame. Look, that is by the way good liquidity here. That swing high got created. The market took it and boop, immediately repelled away. This is a swing high that actually got broken. Swing low here. Swing high. Okay, like you get the point. This is really not, it's nothing complicated. It's nothing complicated to draw them. Now, I usually do draw them without the indicator, and actually without the indicator, it really helps me to find like the major swing points. So in this case, I won't really mark like all these. I would say, okay, like what looks major to me right now, it's for example, this low. That low looks pretty major. This low here down is very major as well. And I'm going to look to the left. This low here is a very major liquidity. And then all the way, for example, up here, and potentially this one is also pretty good. So this is how, if you watch my weekly outlooks that I publish every single Saturday, and after this video, if you watch this whole tutorial, I would totally recommend you follow them, because there you're really going to see how I actually analyze. And yeah, these are going to be, for example, my relevant liquidity points. If I go to, let's go to some other pair. Let's go to, I don't know, gold, maybe pick something different, because gold is extremely chopped up right now. Like there. So a very important liquidity here under this swing low. There was, for example, liquidity here that got swept, and then basically that's it. We have important liquidity here. If I zoom out a little bit to the left, again, here is where the market is having a very big liquidity pool, but it's really becoming comfortable inside. And then under that, we have this liquidity swing point here, and then under this, we have this swing point here. And these are all, by the way, guys, 3-bar fractals. If you plot the indicator, they're going to show up. All right. So that is how you draw liquidity. It's as easy as that. Swing points, if you struggle to identify them, just put your fractals, the 3-bar fractals real quick if you're having some doubts, and it's gonna guide you. All right, now you know how to draw liquidity, but let's actually look a lot deeper into it and to understand why some liquidity points get absolutely smashed and why some liquidity points actually get absorbed and rejected. And to really understand that liquidity dynamic, we have to look a little bit into the auction market theory, which is what kind of also essentially drives the market. Now here I have in front of you the DOM. So what it's called the DOM, this is the order book. This is where on centralized instruments, you can actually see how many orders are there above the current price and how many orders are there below the current price. So imagine this is the price of a gold bar. And the current price is right here. The best, the best buy is 100. The best sell is 99. Again, this is the spread. But what really matters here is that you can see the resting orders below current price and the resting orders above current price. Above current price, we're gonna have sell limits because you can sell above current price with a sell limit. And below current price, you can buy with a buy limit. So we can see at the price of 99, we have 5 lots of gold, for example. So 5 lots, 98, 7 lots. 97 has a lot of interest for 20 lots. 16, 12, 28 at different prices. Now you can see the price of 94. There are so many people that have placed a total of 28 lots. Now, this is the total. There are some softwares like Bookmap, for example, but again, for centralized exchanges and instruments, that can show you what is the percentage of these 28 buy orders, for example, that are held by one person. Okay, but usually don't know. And then above current price, 7 orders at 100, 10 orders at 101, 5 orders at 102, 18 orders at 103, and 21 orders at 104. These things can constantly change because these are what is called passive orders. They're passive and they're not triggered yet. So I can come in right here and I can place 1,000 lots at 104, but I can immediately remove them. So this one is suddenly gonna look like 1,021 and then I remove them. Okay, back to 21. Right? So they're passive, they're not executed, but it kind of can show you the overall interest of a specific price point. So I immediately want to ask you, so if you listen to the liquidity that we just explained, where are there going to be the most orders available? At above highs and below lows, right? So for example, if 104 is a high, it's gonna have a lot of orders, and if 94 is also a low, an important low, it's also gonna have a lot of orders. Now, how does this auction market thing work? We have passive orders, that are the liquidity providers, and we have aggressive orders, those are the liquidity takers. Now, the aggressive orders are actually people executing right now with market orders. They're paying on the spot. So let's say, for example, here a bank wants to buy, and they enter a market buy order for 10 lots on gold. How are they gonna get filled? So they want to enter 10 lots and the current price is here. Okay, so what they do is they get 7 from the 100. So at price 100 there were 7 passive liquidity providers. So they're gonna fill 7 here, and then they're gonna fill the rest 3 from the upper one. And so they're gonna get an average price, or they're gonna get a price of 101 if they do a market order, because you can see this is immediately gonna drive the auction higher because they really ate all of these orders here, the 7, and they pushed even into the upper order at 101. So they're gonna get filled a little bit higher because this is where their complete order was fulfilled. And that is gonna move the auction a little bit higher. That is like, for example, hey, I'm selling this gold bar for $100, and they say, okay, I want to buy it for 101. Then boom, price moves to 101. Somebody else want to buy it? Yes, I want. Okay, 102. All right. So price can just keep moving higher. And so what actually happens after this is, so basically those aggressive or those market orders are what moves price and the bid and the ask. So what actually happens after that bank executed 10 lots? Well, price moved up. Right now you can see there it has moved up, right? So you can buy it right now at 100, or you can sell it at 101. Price has moved. Before you could have bought it at 99 and sell it at 100. Right now it's different. Right now it's a little bit more expensive to buy it because this bank moved price higher, okay? Price moved up and the best bid and the best offer are changed right now. So now at 101 you have 3, at 102 you have 5, and so on and so forth, and the price of the gold bar has moved up, and then this bank is now holding 10 lots of gold at price 101. Now let's say another bank comes in. Bank 2 wants to sell 20 lots of gold bars. So what is gonna happen if they want to sell 20 at the market? So they want to just come in and boom, sell 20. Well, they're gonna start taking all of the passive orders. So people that have set their limits, these are the liquidity providers. These are usually what are also called market makers. They usually provide liquidity for everybody to get in, and that is how they make money within very small differences, which is basically the spread. But I'm getting way too detailed here. So what is gonna happen is you have to count. For example, they want to enter 20. So we're gonna take 7 from here, 5 from here, 7 from here, and then a little bit from here. Now I have to calculate it, right? Here we have 12, and then we have 7 more, 19, and then we're just gonna take 1 from here. All right. So what is that gonna do? Is it gonna push price to 100, to 99, to 98, to 97? Because they sold 20 lots and they ate all of these orders, and they kind of probably get filled somewhere down there. Okay. And now you can see the auction changed down. The previous auction was up here at 101 and 100, and right now the current auction is at 98 and 97. Okay, and now bank 1 holds again 10 lots at 101, so they're suffering a loss, but bank 2 sold and they got filled a little bit lower because they ate all of these orders right there, and they originally got filled when all of their orders were completed. And this is why, again, going with a market can sometimes give you a bad price because you really eat everything that is below you. So this is why, again, a lot of these market makers and really the big institutions, they're splitting their orders in small pieces. And this is why also you're getting constantly pushes and pullbacks, because if you come in and want to really buy everything, you're just gonna eat all of these orders above you and you're gonna get filled up there because you destroyed all of these orders. Okay, so do you see how the auction market works? This comes in, pushes price higher. This comes down, pushes price lower. They get different fills. Liquidity keeps changing, and the overall price of the asset is determined by, again, the interest of the big players. So that is auction market theory 101. This is how the auction works, and the market is actually an auction because you have different things that are selling for a price, but what is the objective price? Well, that is determined by the market participants. All right, so understanding the why. So online, again, as I told you, you're going to see plenty of interpretations of liquidity. You're going to see liquidity grab, liquidity sweep, liquidity purge, inducement, manipulation, change of character, absorption, exhaustion, and 1,000 different things. However, once you truly kind of level up as a trader, you will understand the why behind these concepts. This is why I'm always teaching you the backbone of these things. I'm not telling you, okay, this is what market structure is, this is how it works, use the EMA, use this. I want to tell you like what is behind, because I believe this is how you really level up as a trader once you understand the foundations of things. So in essence, once you understand how this auction theory works and how you have passive orders resting on both sides, and when somebody comes to execute, they're eating these passive orders. Okay, once a liquidity point is taken, two things can happen. You can have a break. So this is when the aggressive participants are more than the passive ones, and they keep sending price higher or lower aggressively. So if that bank comes in and buys and push price higher, but then another buys and push price and another buys and push price, there are just not enough passive sellers to really then push the market down. And there is just no interest from the sellers, so the market is going to keep going up, and it's literally going to destroy or break our swing point. In simple price action, we're going to see a body break of a swing point and a continuation in the same direction, and acceptance above the swing high or acceptance below the swing point. All right, so price needs to be comfortable above or below the swing point. It doesn't immediately need to return back, because if it pushes up, so for example, bank bought and pushed price higher, and then another sold and immediately pushed price lower, well, that was not a break. We saw absorption at the top. All right, and of course, a sweep or an absorption is when the passive participants are more than the aggressive ones. All right, so the aggressive orders get absorbed by the passive ones. So bank really wants to go long and really wants to push price higher, but they try to push but immediately get pushed down. Try to push, immediately get pushed down, right? So this is when you get the wicks, and that is when you get the sweeps. All right. And yeah, so basically I'm currently using also some order flow software, and you can see, for example, there are, let's say, 500 orders executed right now, but they immediately push price lower. Why? Well, because there were just so many passive sellers. They're also executing passively, also putting limit. So for example, if there is like 1,000 sells, all right, and banks comes in here with 500 buys, all right, they're not going to be able to push through this price level because the sellers are still big. They're not going to be able to push, okay? However, if they come in with 2K buys, they're going to break through that wall, because right now the passive sellers are not that much. And this is basically kind of the foundation of it, okay? And in price action, you're either going to see, again, a body, or for the sweep, you're going to see a wick, a rejection, or a failure to stay above or below a level, as I told you. There is going to be like an attempt to break through the level, but there is going to be like a hidden wall or a hidden hand that just pushes it back lower or lifts it back up. Okay, so right now, as you understand kind of the foundation of it and why these things are happening, we can look more into the price action terms and we can study the anatomy of sweep versus break. Now I want you to look at this price action. What do you see right here? We see this very big major high. All right, we see a high, the market fails to break it, the market fails to break it, and then it pushes away. Now, above this high, because it's a pretty major high, that is a liquidity pool of potentially passive sellers because it's above price. How many? We don't know. All right, so when the market gets to that level, what should we watch out for? We should watch out for if the market is clearly breaking it and staying above it and really continuing to push above it, or if it gets absorbed and immediately pushes back down below that major liquidity point. Let's see what happens. There it is. We come in, you can see we come in with it extremely, so there was a big bang that came in and said, okay, I really want to buy, and they ate all of the orders that were, for example, resting here, but now they come here. Slow down, slow down, slow down, rejection, price broke above the swing point, but then buyers, you can see, started exhausted. They ran out of steam, and then sellers prevailed, and you can see they returned exactly below the swing point. And what happens? There were so many sellers at that level that the buyers cannot really continue to push price. They get absorbed, and look at the downtrend. Where do we then go? We go into the opposing major liquidity pool. It's this low. All right, it can also be this low here, but this low is more major. Why? Because it's like the more you get very big separation between different swing points, we're going to talk about that. We're going to talk about low hanging fruits and also separations. But the more major, like the more isolated a swing point is, the more liquidity it holds. And you can see here, again, under this low, there is a liquidity pool of passive buyers. Okay, so are the sellers that are pushing price lower right now going to be able to maintain below this level? Well, look, they came in immediately, like you see so many buyers were resting here, just push price higher, but then the sellers come again, we try again, but then this candle again, read the candle anatomy. All right, massive buyer kicks in, the seller attempts, but it's not an engulfing candle, it's still reject on the bottom. Then we have an indecision candle. What does that indecision candle tells you? Well, the sellers are starting to exhaust, they're not as strong. And then look at this, boom, bullish engulfing candle. We failed to accept below that major liquidity point. The buyers here, the passive buyers, really prevailed, and right now the market is reversing. Read the candle anatomy. Where can we go next? In my opinion, we can start looking for these short-term swing points. There is swing point number 1, there is swing point number 2, but the major swing point is gonna be up here. So let's see what happens. Oh, okay, we have a lot more of a development here. Now the market comes in a little bit here, creates a swing point, pulls back, it takes that swing point, but you can see there is still a wall here, and then the market immediately gets pushed down lower. Pulls back, we turn into a bearish market structure, and then where do we go? We go again into this isolated liquidity pools of passive buyers. We break it extremely massively, okay? But look at the next candle. Reverses, okay. Tries to go down, fails. Exhaust, it tries to go up right here. Okay, so I see kind of this one is more like a sweep so far. We didn't really accept and start trending below this level. And then the market had a gap down, but then immediately came accepted back inside above the major liquidity point. And then we start going higher. Where do we go? Liquidity. Liquidity number 1 right here. That is a swing point again. Tried, immediately failed. Then where do we go next? Liquidity. Where is the most recent liquidity? Here. We tried, immediately repelled away. Where do we go next? Liquidity pool above this major high. And also there is a major high here. The market comes in, stays inside, it tries to break down, but again, read the candle anatomy. We're seeing here wicks on the bottom. What does a wick on the bottom say? It means that there are buyers lifting price higher and pushing it higher. Indecision candle, and then after this candle here, now we see, okay, the aggressive buyers were strong enough to absorb all of the sellers from here, and they finally pushed price higher and broke above this liquidity point. Now in this point, I can say buyers are definitely in control. And then you can see here that we have another major liquidity point, but look at this candle. Massively, it just didn't react from here. There could have been so many sellers, but they just got absorbed, because if there are 1,000 sells, but the market comes with 5,000 buys, it's gonna break. All right, it's gonna break. But do you see how before that very big move, We took liquidity down, we took liquidity down, we took up, we took down, like we accumulated, we consolidated. And then here there was the first decision point. Are we going to reverse from here? Are the sellers going to prevail? We broke the sellers and then we just expanded massively. So this is how you read the market logically. It's not like this and that and this trend line and this like break of structure and this or that. No, you just read liquidity and you understand, are we breaking liquidity or are we sweeping it? And then usually the market is going to go towards the next liquidity level. All right. So the anatomy, once again, the very important thing is to observe the candle anatomy. This is why first we started with learning about the candlestick patterns and the psychology behind it. And it's very important to not just read one candle, because so many online videos or even mentors are going to teach you, all right, if it's a body, it's a break. If it's a wick, it's a sweep. Not necessarily, because you have to read the story. There could be a couple of candles that break, but then if there is a candle that breaks back below, it is still a sweep. Let me show you an example. Swing point. The market comes in, sweeps with a wick, doesn't stay above it, bearish candle. Now that is a sweep because I read the story, right? We have a wick on top, and then we have a bearish engulfing candle. That means we rejected that. That is a sweep. We pull back lower, okay. We try, we consolidate here, right? We didn't take out the swing point here, pull back, boom. This candle is a very clear body break above the swing point. The next candle retests from the other side, and what does it leave us? It leaves us a wick from the bottom. What is a wick on the bottom? It signifies rejection from the bottom. Buyers lifting price back up. And then what the market does? Goes back up. Okay, so that was a break. Then, of course, the market decides to just suddenly reverse. And where does it go? It goes into the liquidity points. Liquidity 1, liquidity 2. But where is the most isolated liquidity in this case? It is that low. And then eventually this low. And you can see when it gets to the most isolated liquidity, massive candle, a wick. What is a wick? Once again, it's a rejection. It's an absorption. So there were so many buyers under that low that it got absorbed. And then you can see, whoop, bullish candle. Then the market consolidates. It shows us rejection on top. Bearish engulfing candle, bearish signal. Pullback in terms of this wick. What is that wick? The market tried to push up, but immediately got repelled back down. And then look at here. Very strong bearish candle, breaking this low with a body and also breaking this low with a body. But at that time, we just have to wait a little bit to see if it's going to stay comfortable below that low. Look, next candle, bingo, bearish. Now I can say, okay, the market has broken outside of this range because we have two candles that are really staying below the swing points. So there was a pool of liquidity here, but the market, the aggressive sellers really ate all of that pool. And then the market goes down. There we have a swing point. That is a very recent swing point. The market first rejects it very nicely. Now, a lot of you would say, all right, that's a sweep. But look at what the next candle does. The next candle immediately accepts above that swing point. That to me is a break. But not a lot of people are going to teach you that. So that was first a sweep and then it's a break. Because why? The market became comfortable above that swing point. So there were passive sellers here that pushed price lower, but then the buyers again said no. And again came in and pushed price higher. We push higher, we again find some sort of resistance. I'm going to teach you why this move happened very soon. Bearish candle, again rejection on top, and then we rush. Where do we rush to? We rush to the liquidity. The market doesn't stop just randomly here. It took this liquidity under this isolated low, and look, sweep. Okay, cool. What is going to happen in the next candle? Immediately bullish reversal. All right. So there really seems to be a lot of passive buyers down there that these very big sellers that started from here got absorbed and really could not continue to push price under this low. Okay. And in terms of structure here, we would say, all right, maybe a lower low, but in terms of liquidity, it was a sweep. Where does the market go next? Reverses, shows us that MSS pattern here, failure to take out the low, and it goes for that high. Now analyze this high. Where first things first, we're having a body break on the first candle. That is always a very good sign because the buyers didn't get repelled immediately. The next candle is an indecision candle, however, with the wick on the bottom. What does that signify? Once again, everybody, we're lifting price up. The market went bearish, but then whoop, got lifted back up. So there were a lot of buyers. And then the market becomes comfortable above this high. Now we have a break and we can target the next liquidity points. There is liquidity number 1 and liquidity number 2. The market came into liquidity number 1, swept it, Second candle also sweeping it, so that is definitely a sweep. And then the third candle opened, massively pushed up. That was looking like a very big bullish body at the time, but then it just massively got shut down to the downside. So there were so many aggressive buyers trying to push, but the wall of liquidity here, there were so many passive sell orders that absorbed all of these buyers and pushed the market lower. So where does the market go next? Next, liquidity comes, sweeps, and then it broke it, and then it stayed comfortably below it. So this, I would say, it's more like a break, but then you can see eventually it starts pulling back. So it didn't really become comfortable under this low. Another short-term liquidity gets created here. First, it sweeps it. The second candle breaks it, break. Another short-term liquidity, the market broke it, but then look, it broke it, bearish candle to test it, indecision, and then immediately got just snapped back inside. It tried here for 2 candles, but then it got shut down. Where do we go? Opposing liquidity. Here, pulls back, new short-term liquidity got formed. The market took both of these liquidity points and perfectly rejected and closed the body above these swing points. The next candle immediately showing us the bullish sign. We attack the high. The first candle that attacked that high is a body break. Great, with a small wick on top. That is okay. And then the next candle breaks above. Okay. And then we go into the next major sweep. What do? The market tries to push, immediately gets shut down. Tries to push, immediately gets shut down. And now we go lower. So where can we go? Liquidity on the bottom, or we might want to attack the liquidity on the top. All right. So that is how you read liquidity. It's so amazing because once you understand it and you really look into the price action and you like detach from market structure and all these things, and you actually understand the why of the market, I'm so excited about this because that is really what made a change to my trading. I went from being like mechanical and really looking for that step-by-step system to really understanding what is happening, why is the market moving, and then this really gives you that inner confidence to just go and execute. All right. Where is the relevance liquidity? Because you can have a lot of liquidity levels. Now, every liquidity point is important, but when you're trading, you want to draw only the relevant ones. So in this tutorial, we're going to separate them into 3 types of liquidity levels that you need. Based on the current price action, what is the low-hanging fruit? What is the closest liquidity above or below the current price? So if current price is here, what is the closest liquidity that the market can go for? Like 1 above and 1 below. And this is what is usually going to be our short-term target. And then we're going to observe that for a sweep or a potential break. Then also we're going to look to the left a little bit for old and major liquidity points. We're going to be looking for those isolated. We're going to look for those prominent swing points because oftentimes the market is not just going to stop and reverse from random places. These massive old liquidity points can be the point at which a trend actually reverses. Okay, so we're going to look at low-hanging fruits, recent liquidity. We're going to look at old major liquidity points, isolated ones. And the third liquidity points is what I call reaction areas. Those are not as major as the major ones, and they're also not recent liquidity. So they're a little bit to the left. They're usually old structural highs and lows. When the market makes a trend change, and it goes from making lower highs to making higher highs, then all of these old lower highs are going to become reaction areas. And the market will tend to kind of react from them until it gets to the major liquidity point. So let me show you how that looks like right now. Time for practice. Are you gonna pause this video right now and identify all the liquidity points that you see and try to differentiate them between short-term and these big liquidity points? And you can even take it a step further to identify the reaction areas, but that might be a little bit too much. Now pause and do the liquidity. I'm waiting. Are you doing it? Okay, I hope you did it. If not, let me show you. But first, do it. Do it because it's really going to be good for you. All right. Jokes aside, I hope you spent some time trying to do it, but there it is. Let's have a look. Now, it is in hindsight, so it might be a little bit hard, but I want you to imagine I'm going to walk you forward through it. It's like we're working with current price action. Imagine that price was here. The low hanging fruit is the high. We take the low hanging fruit and then we accept above it. Push, 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 push. Then we start pulling back. This becomes a high, but then we pull away from that high. We pull away from that high. We pull away from that high. Then the market pushes up. It fails to take out this high. Okay. What does it take? It takes short-term liquidity, low-hanging fruit. Low-hanging fruit 1, low-hanging fruit 2. I didn't mark these. And then the market goes bearish and it takes the most recent liquidity. So if price was here, what is the most recent liquidity that it can take? This. And then it pushes into an old structural low. Like that was an old higher low, but right now we have shifted price to bearish. So these old structural patterns are going to become reactionary. As you can see, the market breaks it, consolidates, and then immediately gets pushed above it. Now that's a sweep. The market pulls back, pushes up, pulls back. That is a potential higher low. So if we're here, what is the most recent liquidity that we can take? The higher high. Okay, so this is why higher highs and higher lows are so powerful, because they're also liquidity points. We take low-hanging fruits, we pull back. We take opposing low-hanging fruit, we push. We take closest liquidity, we push down. We take close liquidity here, do you see? But look at the EMA, it's pointing bullish. I didn't mark this one here as well. Push, pull back, push, taking the most recent liquidity, closing above it, pull back, higher low, most recent liquidity here. And then we come to take a prominent swing point. Now look at the swing point. That swing point didn't get tapped for quite a lot of time and it really just maintained isolated. Look at the market. Massive breakdown, massive breakup, sorry. Okay, is it a break? Is it a sweep? The next candle tries to continue, immediately gets shut down below the swing point. Closed below. Accepts below. Ah, that was a sweep. Where can we go next? Look at all of these old higher low formations. All of these are old structural reaction areas. That is the perfect example of a reaction area because the market reversed from a major liquidity point and then it just started going. Reaction area number 1, react. At the same time, we were building the low-hanging fruits. Lower high, lower low. Why did we make the lower low here? Because we reacted from the reaction area. Pullback, short-term liquidity, which is the most recent lower low. We break the short-term liquidity here, but why did we stop there? Because the market took these two reaction areas. Reacted, tried to break, reacted again, pulls back for a lower high. This here right now is also liquidity that I didn't mark. The market pulls back. Now we're below the EMA, you see? We trend changed. Bearish, lower high, push, lower high from the EMA. Low hanging fruit is the most recent liquidity. And then we take this lower reactionary, which is this oldest lower high. We take this reactionary, we actually close below it. So in this case, I would have definitely expected for us to go to this prominent swing point, but we did not. What the market did is make a very big pullback. Okay, we're still bearish. We try to short from here. It goes down, but it doesn't take this liquidity. Strange. What is this, everybody? That is a market structure shift. And this is the first sign that, hey, a trend is failing potentially. We're not breaking the lower low. And then what the market ends up doing, it breaks this most recent lower high. That is a trend change, and that is the low-hanging fruit. Pullback, low-hanging fruit, the most recent swing point. But then now look, all of these old ones, old lower high, old lower high, old lower high, and even an old lower high here, they're all going to become reaction areas. Reaction area taken, reacted. Reaction area taken to the left, reacted, higher low formation, pushing for a new higher high. But look, we swept it. We just pinged it and then immediately reversed. Not good. Where do we go? Opposing side of liquidity, actually making a trend change. Okay, reacting from the EMA, pulling back a little bit, low-hanging fruit got created here, lower low. Pushing lower, where do we go? Reaction area. This caused the market to pull back. Low-hanging fruit, do you see the video? Yes, you see it. Pull back, low-hanging fruit gets attacked, reverse, low-hanging fruit, and then these old lower highs become liquidity, reaction areas. Take the reaction area, react, create a low-hanging fruit, which is a 3-bar fractal, once again, a swing point. And then we massively launch. Where do we launch? Above this very prominent swing point. Now, why is this a prominent swing point? Well, because this is the last place where the market reversed and we just didn't touch the swing point for quite a lot of time. All right. So in this case, we have this, and this as prominent swing points. And eventually this can become one because we haven't really touched this one for a long time. And look what happens. Same thing that happened here, by the way, guys. Like, why do we make these huge reversals? Is because there is a very big wall of liquidity. The market massively broke it, immediately got shut down. It actually stayed above it for 2 candles. So for a time, this looked convincing that it's actually a break, but then this candle right here, it shut down price lower, push, lower low, low here, low hanging fruit. The market pulls back for a lower high, drops, takes the low hanging fruit. What are our reaction areas? This most recent higher low, this higher low, and then of course all of these are going to be potential reaction areas. So do you see how it works? Okay, and that is going to take time to read. That is going to take time to read. Now, of course, let's go to the charts for a quick example, and then we're going to move on to the next chapter. So if you want to improve in trading, you have to be obsessed about it. How I like to improve in my own trading is I'm going to teach you later how to improve, but it's just simply going to the charts and studying. So I'm going to give you right now an example of how, if I was learning how to identify liquidity, what I would do, which is a very simple, open-minded, just going onto the charts and seeing and asking questions. So I would say, okay, look at this massive swing high. Look, isn't this the exact example that I guys gave you? Oh my God, this is the exact example that I gave you. Yes, okay, so this is GBP USD, so I'm gonna move to another one. But look what is happening recently here. So the example literally stopped right here by taking this low hanging fruit. And then check out the slide. Like, I promise, this is not intentional. When I was doing the presentation, GBP USD was here, just taking this low hanging fruit. What did I tell you just before actually I saw this price action? This is gonna get taken reaction area, reaction area, reaction area. Now let's go back to the charts. All right, we were here. The market pushes lower, pulls back. Low hanging fruit liquidity gets taken, accepts below it, pulls back. Low hanging fruit liquidity gets taken. And now we start collecting this reaction area, and this reaction area. Oh, this one is not taken yet. Okay, so we took this reaction area. So these are old structural higher lows and higher highs. They're not major, because in this case I would say the major is down there, the most isolated one. But all of these swing points, even this little guy right here, are going to become liquidity. So the market ended up taking these reaction areas, and it kept taking the low hanging fruit. So there is another low hanging fruit. The market pulls back, lower high, low hanging fruit. Right now we're sweeping it. Where is the most recent liquidity right now? Above this high and below this low. These are the swing points. So we're either going to take the low to continue for a lower low, or we're going to make a trend change, or we're going to make, again, new structure and then maybe take it and continue. So I have to go to another pair right now. No, I'm not supposed, no, what I'm going to do is I'm just going to hit replay. I'm going to close my eyes and I'm just going to hit replay here. All right. And what I would do is I would just again study. So first I would start by maybe seeing, okay, where are the very big reversal points? So let's first train these major liquidity points, because to identify this, you have to be a little bit zoomed out. So what I immediately see is this massive high. Okay. Then I say this massive low. These things are not being taken. Okay. Then I see this is a very prominent low. And that's pretty much it. So in this case, I go to study. This high here, when it got broken, what happens? The market broke it, stayed above, stayed above, stayed above, stayed above. We're clearly accepting above that high. Okay, so I would say in this case, we're definitely bullish. The EMA is also bullish. Okay, what other liquidity points can I spot that started forming after this? Okay, so we had a little bit of a liquidity here, a very short-term one. That is a swing point. Taken, immediately repelled. Great, where do we go? We're actually going to go to an imbalance, but we're going to talk that in a bit. Pushes lower. There is a low hanging fruit. What happened? Swept, accepted. Pulls back. This is a low hanging fruit. Takes it, close below. Great. Then the next liquidity was here. What the market did, reverses. First swept it and then accepted above. Let me stop the crosshair so you can actually see it a little bit better. Crosshair. No. Okay, good. And I'm going to do this demonstration. Okay, good. What the market did is it first rejected and then accepted above, and then it just started accepting above until it reached the high. Now you can ask, like, why did the market stop there? And you can zoom out and you can see, okay, did we have something here? Well, we had, for example, liquidity point here and liquidity point here. And you can drag these into the future. All right, and you can see that literally the market stopped at this old daily swing point. It's not major, it's more like a reaction area, and very likely there is like a big imbalance here, but I'm not gonna go there yet. However, the market stopped. Okay, let's continue reading. So it stopped right here. Where is the liquidity? Well, there was liquidity under this low. Is there? No, these seem equal, so let me trigger the EMA. No, this is not liquidity. Okay, so the next liquidity is here. What happens? Low hanging fruit, the market takes it, reacts, tries to do something here, and then accepts below it. And as we start accepting, what do we start targeting? We start targeting the old reaction areas. Reaction area here, reaction area here, reaction area here. Let me just ensure that these are swing points. No, this one is not, because I cannot see if they're equal. There we go. Okay, if you're ever doubting, you just put on quickly the fractals indicator, and then you can see we're pushing and pushing and pushing down, and right now we're below the EMA. We're below the EMA. Here we make a low hanging fruit. The market pulls back for a lower high, breaks the low hanging fruit, and breaks it, but then starts accepting above, not great. But then this candle here, this candle really showed us, okay, I want to potentially push lower, and it continues to go lower. Where to? Low hanging fruit. Takes low hanging fruit, accepts below it, great, that's a clean break, pulls back. Now we're in a very clear bearish market. Low hanging fruit gets taken. Now this one is a sweep. It tried, repelled, tried again. Now it becomes comfortable above. Where does the market go again? Low hanging fruit. Does it break it or sweep it? Touched it, and then next candle just slashes down. Where does it go? Low hanging fruit. Low hanging fruit gets swept. Massive bullish candle. In this case, I would have said it could have gone for this low hanging fruit, but it did not. And then it just started breaking lower. And then I can zoom out. And what do I see here? I see a major swing point, and I see a major swing point, and I see a major swing point. Oopsie. Is that a swing point? Let me ensure. Yep. And then the next one is here. So do you see, you can actually kind of forecast where the market can stop. Here, for example, when we're pushing down, where can the market potentially stop? Well, this is a significant point, and this is a significant point. You can see the market takes the first one, but then it goes into the next one, and it gives you the pullback. So you can also, with this way, you can expect when can the pullbacks start. Then what do we target? Low-hanging fruit. Low-hanging fruit broken very clearly, but then we reach into a pretty major here swing point, a very old one. The market sweeps, goes above, stays above, so it kind of didn't really accept below this low. And then what does the market do? It goes to take the opposing side of liquidity in the form of this high here. Takes it, repels, pulls back into an imbalance, then breaks again, low-hanging fruit, breaks above. And then the market stops here for a while. It's below the EMA though, so we're bearish. Below the EMA, there is very likely a daily zone here that we're going to look at. Oh no, that is a daily time frame, so there is very likely a weekly zone, but we're not going to look into that right now. Where do we start forming liquidity? Well, the market forms a swing high, doesn't get taken, and then we have here a swing low that first gets swept, and then it gets broken. And this immediately tells me, okay, we're starting to accept below the swing points, and then I start looking at the reaction areas. So this very recent uptrend here, this very recent uptrend right now, all of these structural patterns that we formed, they're going to become liquidity. Now watch. Structural pattern number one, taps, reacts, creates a low-hanging fruit liquidity here, and it takes it, and it closes below. Then, structural low. Why does the market stop here in reverse? Well, because these are the old structural lows. We pull back. What do we create? We create a low-hanging fruit, which is, again, the most recent liquidity. The low-hanging fruits are usually going to be your higher highs or your lower lows, because when the market moves up, it keeps taking them. We take the low-hanging fruit. Great. So now I can zoom out a little bit once again. Okay, we're coming into this low, but we really strongly broke below this low. All right. And then we pull back, we create a lower high, we maintain the previous lower high, we make a new one. If you again put on the structure indicator, we're still bearish. Massive, massive, massive flush lower, and we stop here. Now, why do we stop here? Again, there's probably some sort of a swing point. There is a swing point here that we stopped again to the left. And then the next one is precisely here. This one just got missed by a little bit, okay? Now we tap into the swing point. Now, should you always expect reversals? No, but you should always watch what happens. So after this one gets taken, repel, 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 we formed a swing high. That should also be a market structure high. You see how we start? merging things together. Now it's starting to get excited. And we break this low-hanging fruit liquidity. And that is also our trend change. And we accept above it. Like, look at the candle anatomy once again. We broke with a body. The body stayed above. And then the next candle, we tried to push down, but it repelled and got lifted back up and it closed bullish. That to me is a very clear break. So this is our first sign of a market structure shift. So what can we start doing right now? All of this downtrend, right? All of this downtrend right now, I can just start dropping all the liquidity points. Liquidity point, liquidity point, liquidity point here, liquidity point here, and then ultimately liquidity point here. And then of course we are looking already at these higher highs here. Okay, so then these are your reaction areas. Okay, these are the most recent lower highs. They're not like prominent swing highs, because the prominent swing high in this case is going to be this high here. Okay, but these are the most recent reaction areas. And then we just go and flow. The market creates here, but we're still below the EMA. It pulls back. Okay, do we have any sort of liquidity? There is liquidity. What happened? The market took it. We immediately repelled away from it. Good. Where do we go? The next low hanging fruit. There is that high. Do we break and close above that high? No. We tried, right? We tried, rejected, bearish candle. All right, then we go potentially down. I would have said we could have gone for this liquidity, but then the market generated this little one, low hanging fruit, swept it, reversed. Where do we go next again? Low hanging fruit, the most recent high, breaking for a higher high. And this is where really we started engaging with these previous lower highs. But look at the price action. The market first rejected. So this candle here took both of these swing points and rejected. Okay, let's see. Second candle breaks them. So the second candle actually broke with a body above the swing point. Rejection from the downside. This one is kind of looking a little bit bearish, but it's not really weak. We didn't really come below the swing point to really say, okay, we're going to go down right now. And then this candle here kind of gives me a lot of good indication. We're starting to move higher and we're starting to close above this swing point. A little bit of a consolidation, and usually we're going to talk about consolidations. When you get consolidation, you start sweeping liquidity on top and sweeping liquidity on bottom. But do you see that the market doesn't just randomly stop here or randomly stop here? It stops when it takes liquidity. And when that liquidity gets absorbed, that is when the market continues. And where does it go? Next liquidity. Now here, the market stacked, it stacked, it stacked, it stacked, it stacked. Massive move up. This liquidity point here, destroyed. This liquidity point, destroyed. Really, really bullish market. Okay. And then right now here we start consolidating a little bit. There is a liquidity, kind of got taken, but really failed to stay above. Then we went into the opposing side. We took this liquidity, we pulled back a little bit, and right now it's starting to look a little bit bearish. So let's do this a little bit. Now this tutorial is gonna get really long, but I hope you're enjoying it. Let's do right now. Okay, so what can be happening in terms of market structure right now? We're probably shifting down a little bit. The last higher low is starting to get broken. Okay, cool. Where can we go next? I see liquidity here, which is a reaction area, and I see liquidity here. So what I want to see right now is if the market is going to accept under these liquidity points and maybe get me into the EMA. Or if it goes higher, I will target low hanging fruit here. Okay, then this liquidity, and then to the left, I start dropping the other ones. Here. And here. Let's see. Let's play price action. Boom. We reverse and we sweep that most recent liquidity. Let's see if it's going to accept above. So far sweeping. Definitely looking like a sweep. Definitely looking like a sweep and a consolidation. Accepted above. Whoa. Okay. EMA was bullish. Overall structure was bullish. We swept this one. We went down, but we didn't come to take out the lows. This candle here broke above this liquidity point. It even broke above this one. And right now we're just massively expanded and we collected these two liquidity points that I just showed you. So right now we have to wait for fresh liquidity because old liquidity, we only have this major low right here, this major high. Sorry. So let's see what happens. Holy shit. All right. Look, this is how also reversals happen. The market. So there was a big guy that wanted to sell here. So it stacked, it stacked, it stacked, it stacked, and it tricked a lot of buyers into, you see, I thought the market's gonna go up. So I got tricked. Buyers enter here, buyers enter here, buyers enter above. this high. Buyers enter above these highs. Buyers enter everywhere. And now they take their sell orders and they launch their sell orders. Okay. And the market literally stopped, for example, from this swing point, and very likely there is also an imbalance here that we're just about to cover in a bit. This is how you study liquidity. And then you just continue. You delete all of this. You see, I'm just enjoying it right now. I'm just on the charts and I'm just reading. We're pushing down. We're shifting the trend to the downside. Market structure is very likely breaking. Where is our last structure break? It's here. We're breaking the market lower. Okay, good. EMA, it's starting to get broken. Let's see if it's going to maintain. If we maintain, where do we go? Old structural liquidity. That's an old higher low. This one got taken. That's an old higher low. And this is an old higher low. Oopsie. This is by the way, I draw the straight lines by holding shift on my keyboard. So when you hold shift, you don't have to make a line. You just hold shift and it's either going to do perfectly diagonal, perfectly vertical, or just perfectly horizontal. Okay. And then ultimately here. So I drew all my liquidity points. Now, however, I have to watch what is going to happen recently and watch for market structure and for these low-hanging fruits. Low-hanging fruit here. If we're going to go bearish, if we're going to go bullish, we're going to go to the high. Let's see. And EMA, look at the EMA. I told you, let's see if the EMA is going to accept below. It broke, it tried, accepted above, accepted above. That is not an acceptance below the EMA. So we maintained bullish. And where does the market going to go right now? We drew the liquidity before it happened. Look, boom. Liquidity taken. Short-term liquidity taken. Short-term liquidity generated. There is one to the downside. Let's see if the market is going to take liquidity and then go. Long-term liquidity collected. Long-term liquidity. That is a prominent swing point. Let's see what happens. Do we reverse from here or we accept above it? Consolidate, consolidate, consolidate. Accepted above it. Okay, so we came to sweep this old swing point. We started going up, accepted above. And right now we're pretty much bullish. Pretty much bullish until, of course, the trend shifts. All right, sweeps here, then it reverses, takes sweep from here, take sweep from here. Here just before the push, it swept this low. Now we're breaking this major high. We're staying above and we're just making higher highs and higher lows and we just keep going. Okay, it moves from liquidity to liquidity. But right now we're just lacking one very important concept that pretty much we're about to cover right now. But I really hope you see how I personally study everything. I just get lost in the charts and I ask question, why did this one react from here? Why did this one go from here? How does it look like? And then I start combining it with all the concepts that I already know, and we already know them together. Okay, so that is liquidity. You draw the liquidity, 3 types of liquidity: low hanging fruit, old reaction areas. So your old reaction areas are literally this. We went in an uptrend for a while. Right now we're in a downtrend. You mark all of these. And the market usually tends to react from all of them. And the prominent highs are like prominent, very big highs and lows. And the low-hanging fruits are literally your higher highs and higher lows almost always. Okay. Whew. So now you know. So if we get back immediately to the slides, you just mastered liquidity. There is, of course, a lot more that goes into it and a lot of training, but we covered the fundamentals. The types of orders in the markets, understanding where liquidity is located and why is it located there. We also looked at the markets, the auction market theory. We observed the candle anatomy for a sweep versus break. We know that just a single wick or a single body doesn't mean, all right, it's broken or swept. We have to wait and watch. We know how to draw liquidity in a systematic way. We have 3 different types of liquidity types. And now you know how to identify basic market structure, basic trend, how to identify liquidity, and where exactly can the market potentially seek it. So now we have covered overall the second concept that we're going to be using. Market structure was first. Overall market structure, either going to use the EMA or just an overall understanding of market structure. Great. Liquidity, amazing. And right now we're about to jump into, I would say probably it's not the most important, but these concepts that we're about to cover right now and the liquidity, they just go hand in hand so well together. So hope you're excited. Let's go. And the final piece of the puzzle is the concept of imbalances. So it's about to get good as we're about to put everything together. I call imbalances the Swiss knife concept because it serves so many purposes. You can identify momentum or the lack of momentum in the market. You can build directional buys with it. You can follow the current market flow and where is the market currently going and who is currently in control. This is why it's so much better than market structure. You can pick points of interest, zone to enter from. It can serve you also as an entry model. All right, so it's all of these things. And when you combine this with liquidity and the EMA, that's what I trade. And that's what I use to trade profitably. It's extremely good. Now, there is, of course, some more details about entry models, but we're also going to touch on a foundational entry model here as well. Now, what is an imbalance? The definition of an imbalance, Investopedia defines it as a situation resulting from an excess of buy or sell orders for a specific security on a trading exchange, making it impossible to match the orders of buyers and sellers. So this gets us back to the auction market theory. Okay, when is there gonna be a very big imbalance and a very big push price higher? When there is, for example, 5K buyers and only 200 sellers on the passive orders. So these 5K are just gonna massively push price higher. All right, and then of course, when they don't match, because if there are 5,000 buyers and there is only 200 sellers, they cannot match. So that is going to create a very big imbalance. Okay, and that is going to live on what is called an inefficiency gap, what is also called a low volume node, or what ICT, a very famous YouTuber, coined as a fair value gap. Okay, in a price leg, where only one side of the market participated, or there was a minimal participation from one side. Now, why did I implement imbalances in my trading? Is because they have been in the market forever. And in terms of the auction market theory and order flow, they're just simply low volume nodes. Okay, this is exactly areas of price where there were only buys transacted. All right, and you can see this in the tape. There were only buys, and usually what we're going to learn right now, the market mechanism, let me just focus. The market does not like one-sided participation because, again, for every buyer, there must be a seller. For every seller, there must be a buyer. So if there is a period where there are only buyers, the market doesn't like that. The market makers don't like that because they make money from every single buy and sell. So if there is only buy, they don't make money. Okay. And this will result in a rebalance of those inefficiencies. Maybe you're aware of gaps in the markets, how they always get filled. It's the same with these fair value gaps that I just call imbalances because fair value gap is a tongue twister and it sounds way too fancy than it is. It's just an imbalance in price. Now, what I would give credit to ICT is how he actually drew it in terms of price action, because you can see it on the volume profile, but the price action helps you to see where the imbalances are without having, for example, order flow. And this rebalancing mechanism offers fair value to balance the market. Imbalances also create the trend. They show us the intentions of the BFIs because the BFIs cannot hide. If they're there, they're going to print an imbalance. All right, so that is the footprint they also leave us. And this is how I make momentum objective. Because if there is an imbalance, that means there is a momentum. When there are no imbalances, that means there is a lack of momentum, there is a consolidation, and that also means that there is no institutional involvement yet, or they're very likely stacking orders. Okay, so that is an imbalance. It's an excess to match the buy and the sell orders. That creates a very big push, a very big imbalance in price, because there were so many aggressive buyers and there were so many little passive sellers to offer the sells to these buyers and to absorb them. So then the market goes into an imbalance. Okay, and this is how it kind of looks like. So you can see there's like a bullish candle, a bearish candle, and just suddenly, oh, massive bullish candle. All right, and you can see that within the candlestick. It is a pretty big bullish body, but this is a distribution. So that is the order flow. I'm going to make a separate video on order flow because this video is probably going to get 20 hours if I speak about order flow as well. But we started really offering fair value on top. Here you can see like these are all orders. So you can see here we have 38, 38, 38, 38, 38, 38 buy orders. But 0, 0, 0, 0, 0, 0, 0, 0 sell. Here we balance out a little bit. So there are some buys, some sells, some buys, some sell, buy, sell, buy, sell, buy, sell. But here we also get 50 buys and 0 sells. Okay, and then the market gets, again, you see sellers start to get a little bit more, 33, 33, 33 versus 100, 100, 100. And then at the top, we start like really distributing and starting to close the candle, and we get a little bit of a wick. Where does the market going to retrace to right now? Where is the higher low going to form? Aha, so now we're going to learn where do the higher lows are actually forming. The first place where the market stops, it's exactly where there were 50 buys and 0 sells. Look, the reaction, bing, react. But where the next place it goes is to really come and offer fair value here to all of these zeros. And that is where it stops, when it offers to some of these zeros, and then it resumes in the overall direction. Here is a bearish example. Okay, we start from here. Okay, cool, balance, 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 balance. But then suddenly within this candle, and precisely within this price range right here. So when the market, so if you were watching this live, the market opened probably, chopped, and it just massively went down. Okay, and then at the bottom here, you can see we're starting to build a distribution. There are a lot of buyers, a lot of sellers, a lot of buyers, a lot of sellers. It's perfectly balanced. And here you can see within the wick, there were also a lot of sells and not many buys. So the market ended up going there eventually. But when we make this lower low and we retrace, where are we going to go to? Well, look, we're going to go to give an opportunity for these buyers to also participate. We're going to come to balance this imbalance. Pulls back, fills all of these orders, creates the lower high, and then it continues. Where does it continue to, everybody? Liquidity. Okay, so that is how you can really see behind the imbalance. It's these zeros. You're not always gonna get those zeros, but that is what essentially it is. So how to draw it in terms of price action? An imbalance is a 3-candle pattern. You have candle 1, which can do anything. It can expand, it can consolidate, it doesn't matter. Candle 2 is the most important candle, and that candle must be an expansion candle. That is the candle that actually creates the imbalance. This is where those zeros are going to be. And then candle 3 can do anything except touch candle 1's higher low. It can keep expanding to create a new imbalance, or it can consolidate, but it must not pull back. Because if candle 3 pulls back to balance the zeros of this candle 2, that is what is also called an immediate rebalance, but that gets a little bit too complicated. Okay, so candle 3, let me show you, candle 3 must not cross the lower the high of candle 1. So there is candle 1, pushes down, nice. There is candle 2, opens, pushes up, pushes down, leaves a wick, great. And then candle 3 overlaps with candle 1's low. So if there was any imbalance here within the body of candle 2, this wick right here fulfilled it. So this is what we call an immediate rebalance, but personally I don't trade this, because if I started trading this, everything will look like an imbalance and a rebalance. Okay, so there is a match. This is a balanced price delivery. It's matched. But take a look at here. Candle 1 pushes down. Candle 2 is what creates the imbalance with this very big bearish body. And then you pretty much take the candle 1's low in a bearish scenario and candle 3's high. And if they do not overlap, this is where you draw your imbalance, your fair value gap, if you like to call it that. Okay. And then basically here within the body in the middle, because this candle 1 is not matching with this candle 3, this means that this candle 3 did not really pull back to match all of these orders here. Okay, so there is still a gap inside, and this gives us a high probability area for a potential pullback from which we can also definitely trade, because the market tends to respond from these low volume nodes. Okay, this is what essentially is. It's a low volume node. This is where there was very little volume, but there was a very big price movement because there was an imbalance between between buyers and sellers. Here is the bullish scenario. Candle 1 pushes up. Candle 2 relatively, again, candle 2 must be an expansion candle. It must be a big momentous candle. This one is like, meh, it's actually slower than this one. Okay, pushes up, and then the next candle opens and it crosses. It overlaps with candle 1's high and candle 3's low. They overlap, so there is no gap. This candle looks a little bit more stronger. Good. Candle 1's high doesn't overlap with candle 3's low, and there is a gap. So that is your fair value gap, your imbalance. I call them imbalance. I don't call them FVG or fair value gaps. It's too fancy, and yeah, it's just an imbalance. Now, let's go and draw some imbalances, just to draw them, because there is a lot more that goes with imbalances. And there is also an indicator that you can use. So let me go to our charts. There we are. What are we doing? GBP USD. I keep going on GBP USD. Maybe I go to EU just to diversify a little bit. Now, how do you mark imbalances? Again, you go and practice exactly how I taught you to practice. You go and just find imbalances. There is an imbalance here. I hold control. Control on your keyboard or command if you're on Mac is going to trigger this magnet mode. Okay, and if you hold control, so if you select the rectangle you can find here in the geometric shapes, you can start it. Okay, and if you hold control, that is going to put a magnet, and it's gonna drop. It's gonna pinpoint exactly to the high, to the body or the low of the candle. So that is how I draw perfect imbalances. So I click the rectangle, I hit control on my keyboard, okay, and you can see this thing actually goes live, and there is my candle 1's low, and there is my candle 3's high. Imbalance. And then I drag it forward with this little box here. Drop it forward, and then usually I have templates. I just make it bearish because it's a bearish imbalance. There is another imbalance here. You can see candle 2 expands lower, candle 3 doesn't match candle 1's low here. Okay, so you can see here we have a mismatch. They're not matching. So we can draw another imbalance. Great. We have 2 imbalances right now. Up a little bit, you can see here pretty balance, 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 balance. Hey, there it is. Look where the market went. Candle 1's low, candle 3's high, they're not overlapping. So there is a gap in price here. The market comes to fill it and it goes down. There is another one here, a massive imbalance as well. Candle 1's low, massive candle 2, and then candle 3 continues to push lower, an imbalance. There is a balance, so there is a perfect example of when an imbalance doesn't form. You see here? Candle 1's low, candle 2 looks pretty good, but then this candle opens and it matches candle 1's low. So there is no gap here. I cannot draw an imbalance here because it doesn't exist. All right? There is an imbalance here as well. Make it bullish. If you want to make it, just double click, go to style, and then here for the background, you can change your colors. You can make it green if you want. Okay? Taps in here, this one fails, goes down. There is another imbalance here. Make it red. There is another imbalance here. Beautiful pullback, and goes. Where does it go? To take the liquidity. Okay. There is a gap here. A real gap in price is when the body opens way above the previous body. Now this is not normal, okay, but this happens usually over the weekend sometimes, but that is also an imbalance. That's where the market came back. So this is how we draw imbalances. Now you can train to do this, okay, but what you can also do is you can do FVG and good guy Nephew Sam. You click on this Nephew Sam indicator. Let me just remove everything. And this is going to draw the imbalances for you. If you struggle sometimes to identify them, you can draw them. Now you can go play with the settings a little bit. And I want to show everything, however. So let me see. Show filled, max bars, show labels, delete boxes after fill. I can remove this. And now you're going to see all the imbalances. So if you want to practice, but if you're finding it a little bit hard to identify, you can use this indicator and you can show every imbalance, and that is going to print them out for you. Bullish, bearish, everything, and you can see how they also respond always, like reactionaries and liquidity. Not always, but we're gonna have a look when and when not. So yeah, this is the indicator. There are probably some other indicators again, but again, I am not a fan of indicators that help you do something, because you're just gonna have this on your charts and you're gonna be like, all right, I'm bearish. Do it yourself. This is why I always teach my students, like, do it yourself. Learn how to spot it yourself, because when you do it yourself, you're more mindful about it. You drew it. What I also like doing is I go to text and I'm gonna say this is, for example, a daily imbalance. I would mark it daily imbalance, and now I know what I'm looking for. So then if I go to the Volatility time frame next and I start drawing imbalances here, okay, let's see, there is one here. And it's going to become second nature for you. There is a Volatility imbalance, Beautiful reaction here. Now here again, you see, do we have an imbalance within this push? How can you check? Is by checking, for example, here. Okay, you see candle 1's high, candle 2 is the expansion candle, and then candle 3 tries to cross, but it could not match. So this is a very little imbalance here because there is a gap and we can draw it. Here we have the similar thing. There is this expansion candle and I take from candle 1's high. Okay, and you can see candle 3 didn't match the candle fully. So there is a very small gap. But I mean, look at the precision. Like, look. Comes in, bingo. Perfect response. Like, why did it respond from here? Well, because we had a little gap and response. And this is where currently we are in price. Now, if you also have, for example, volume profile, you can test out to see. So if I drop like a little volume profile range, you can see, like, look. So this is where exactly, so you can see, for example, here we have a distribution here. There were balance, but then very briefly for this exact price point, you can see this, there are only, so I don't have the numbers right now. Let me see if I can add the numbers. I don't have the numbers. Come on, give me a second. Okay, so how do I add the numbers? Values. Let's see if it's gonna show. No? Okay, there. Look. 0, 20 buys, 30, 40, 40, 0, 0, 0, 0, 0, 0, 0, right? There is your imbalance. So if you really want to pinpoint it where it is, there is your imbalance. However, the beauty of these fair value gaps, like how we draw it in terms of price action, is you can actually see it. All right, if there is a mismatch here, or you can draw your volume profile and you can just see this is a low volume node. This is where there was no volume, but price moved fast. So there is an imbalance. We can probably do again the same here, for example. Volume profile, look at your low volume node. Look, there was volume right here. These are orders. There is a lots of volume right here. These are orders. But here within this overall box, right here, okay, there is nothing. There is a little bit of buyers and sellers here, but you can see for a lot of plays here, for a lot of time, there were only buy. There was a little bit of sell, then buy. Okay, and look, if you want to be more precise, you can draw the box like that. Now the market does not fully come and fill it. This is why I actually don't like drawing the low volume nodes, but I like drawing the imbalance because it gives you a bigger zone. And then we tap into the imbalance and we go. Okay, there is another imbalance here. Beautiful. Massive push, pulls back. There is a gap, taps in, goes lower. Do we have imbalance here? No. Do we have imbalance here? No, because you can see this low matched with this high. There is no gap. And then the market reverses. Okay. Now you know how to draw the imbalances as well. Now, if you have any questions, let me know. But if you have struggles and if you are just doubting whether your imbalance is right, just put up the Nephew Sam FVG indicator and it's going to tell you. So right now, let's start looking into actually how these imbalances work and what do we do with them. Let's go. But before we get into it, I just want to show you something interesting about imbalances, and why they're so good is also because they actually determine the overall market structure. So what you're looking at right now is an empty chart. There is nothing, and I'm on the 1 hour time frame. So what I'm going to do right now is I'm going to click on the fair value gap indicator to populate. So what do you suddenly see? You see market structure and you see how the market moves. All right. What we see is the market made a high. Come on. Why doesn't it work? Made a high, low, lower high, lower low, lower high, lower low. Then it reversed, high, pullback, massive high, massive pullback, consolidate, push, goes down, lower high, goes down, pullback, goes down, pulls back, goes down. And right now it's pulling back up and it's right here. Right? And I don't have any price. Same thing going on to the Volatility time frame. Same thing is going to happen. All right. We went down, we went up, pullback, we went up. Here you see a lot of mixture of imbalances. That is a consolidation. Here, pullback, push. And right now we're bearish. All right. You see, same thing happens on the daily time frame. Here we went for a massive bearish run, pullback here. Now here we're seeing we're in a pretty big consolidation. We made a move down, then we went back up. And right now we're making very small bullish kind of structure, but a little bit compressed. Okay. So you actually see that through imbalances, even though we don't have any bodies, we don't have any candlesticks, we still manage to read what did the market actually do. And this is a really nice kind of example that I like showing because it really helps us to determine the overall direction and even the overall trend. So if you can only read imbalances, they're actually telling you where is the market going. So you wouldn't really necessarily need market structure. So just wanted to show that because it's pretty fun. All right, so now we know how to draw the imbalances, but how do they actually work? How we're gonna trade them? How do they hold? How do they fail? Let's talk about successful versus unsuccessful imbalance zones. So to differentiate this, we're gonna utilize the good old candle anatomy inside an imbalance zone on the same time frame. In this tutorial, because it's more suited for beginners to intermediate traders, I am not gonna give you extremely everything. This is why I have like probably a 40 hours course on teaching all of this stuff. So because you can read an imbalance zone on one time frame lower or on 2 time frames lower, there are different types of entries on 1 time frame lower and 2 time frames lower. Like you can really become a master of these 2 things. But right now I'm really giving you the foundation, okay? And you can definitely make a lot of amazing progress with that. So we're going to read the candle anatomy on the same time frame inside the imbalance zone. And we're going to be using the double rejection rule, the DR. After an imbalance zone is tapped, we're going to be reading the candle anatomy, mainly of the first 2 candles. Now, it can definitely be more than 2 candles, but the first 2 candles are really going to tell you the story, whether that imbalance is going to hold or not. So the first candle, C1, candle 1, will most likely show you initial signs of rejection, wicks. The zone gets tapped, maybe you get a little bit of a lift off. That is a good thing. If the first candle just absolutely blasts through the imbalance, it will very likely not hold. However, we should always look at the candle 2 as well, because candle 2 is what will essentially confirm the imbalance holding or invalidate the imbalance and make it a failed imbalance. So if C2, if candle 2 respects candle 1's higher low, it doesn't break it and it shows confirmation of momentum, then the imbalance is basically holding. However, if C2 invalidates candle 1's higher low with a body closure, all right, then the imbalance has failed. This we also mean double rejection failure, aka DRF. I teach this also in my bootcamp. Now, in case of a consolidation where we get like 2 candles and like the first candle is okay, but the second candle doesn't do much, and then the third candle also doesn't do much, and maybe then the fourth candle doesn't do much, you can just keep tracking them candle by candle and just think logically. All right, just keep tracking them. If you see like a confirmation and a lift off, then it should be good. But if you see like an engulfing candle under the previous candle's low, for example, in a bullish imbalance, it's probably not going to work. So observing the previous candle's high or low is crucial when reading the interactions with an imbalance zone. And we're going to have a look, of course, at examples, but that is the foundation. Candle 1 and candle 2, what is the candle anatomy doing? How is it looking like? Is it holding? Is it breaking? Is it respecting or is it disrespecting? So another very foundational thing to really touch on right now before it's too late is that when an imbalance zone is tapped, it's taken, it's gone. Now, this is my own interpretation because I have seen like there are so many imbalance traders out there, right? It's crazy, but some traders think that they draw their imbalance zone all the way into the future. In my opinion, because I look at it through the eyes of order flow and I see where those zeros are, I really see where the imbalance truly is. When that imbalance is filled, when these orders are balanced out, that imbalance kind of doesn't really exist anymore. And then it's really up to supply and demand, whether it's going to lift price or potentially reverse it back down. Okay, so when the zone is tapped, when the opening of the zone is tapped, it is taken, it is gone. Okay, and we do not use that imbalance for future uses because once it's tapped, it's gone. Why? Because again, the low volume node is now filled. Fair value is offered, so it's not relevant anymore. So again, we only use unretested imbalances. Always ensure when you're trading that your imbalance is not retested, because if your imbalance is tested and then the market comes to test it again and you try again, you're not trading from an imbalance. You're trading from liquidity, which we're also gonna have a look at, but the imbalance doesn't exist anymore once it's tapped. There is an example that's you can make that mistake. There is this imbalance. when this candle crosses, it's gone, that's it. The imbalance doesn't exist anymore. All right, and then you can see the market gets a lift off, which is great. We see candle 1 rejects, candle 2 doesn't break candle 1's low, candle 3 also doesn't break candle 1's low, so we're still kind of inside, and then this candle gives us the lift off. Great, then we attack the liquidity. But then what a lot of traders can do is they can draw this imbalance all the way into the future and try to take a long here. No, that is no longer the case because the imbalance was taken on this candle. Or here, actually, that's the first example. There it is. Imbalance, candle 1, candle 2, candle 3. You can see all of them are giving wicks. None of these candles are closing below the previous candle's low. And then we get the lift off. Good. But the imbalance was retested right here. As soon as the market crossed the zone, that's it. Then we just leave it to supply and demand. But what people would do is they would draw that imbalance all the way into the future and try to go long from there. Okay. Same here. You can see imbalance. The market pushes into it, goes away. The orders are filled. That's it. But then some people are going to drag it all the way into the future and try to trade. No. Same here. Imbalance. As soon as this candle touches the high line, now, of course, the imbalance itself can be all the way down here. And a lot of people will say, for me, imbalance is failed when the low is broken. For me, imbalance is failed when the 50% is broken. I only trade from the 50% of the imbalance. It's all kind of subjective, of course. Do what you want. I'm here to tell you what I personally do. When the zone is crossed, the imbalance is taken, and then I just read the candle anatomy. There's another one, like bullish imbalance. This is where it gets tapped. You cannot use it for the future or like do a break and retest of it. No. There's another one. There is this imbalance here. This is the candle where it got taken. Exactly here, and then we observe the candle anatomy. In this case, it went in the upper one. But then you cannot really draw this imbalance into the future and take a short from here. No, you're no longer trading from that imbalance. Now, somehow in this case, magically it held, but this thing doesn't exist anymore. All right, the market is stopping from something else. Maybe within here there is a lower time frame imbalance because that is the daily time frame. Same here, there is the daily imbalance. It gets taken exactly right here. Right, and then it goes lower, but then you cannot draw this imbalance and try to short from here in the future. No, because it got taken exactly here, and now the market is making new imbalances, so you cannot drag it into the future. Okay, once it gets taken. So keep that in mind. But let's have a look at some double rejection rules. These are some textbook. I have cherry picked these. Imbalance 1 and imbalance 2. Now, what do you do when you have 2 imbalances? What do you do when you have 3 imbalances? These are all details, but if I talk about these details, we're going to talk for 50 hours in this video. In general, you look at all of them. Usually the first one is going to respond. If they're very close to each other like that, both of them can respond, but just read the candle anatomy. Be logical. Candle 1 comes in, rejects, and then candle 2 sweeps. Candle 1's low. It doesn't break it with a body to make an engulfing candle. It sweeps it. Price gets a lift off. Candle 3 respects and goes to take the liquidity. Okay. Imbalance here. The market comes in with a very strong candle 1. So candle 1 taps inside the imbalance. You're like, oh shit, we're really bullish. All right. But again, the rule is for 2 candles. Double rejection. Because the next candle flips, respects the previous candle's high, pushes lower, and attacks the liquidity. Another imbalance gets created. Candle 1 taps. Very nice rejection. Very nice indecision. Candle 2 bearish candle, and it's also respecting the previous candle's high. It doesn't engulf the previous candle's high because that would be a failure. Okay, and then we very nicely move where? Towards the liquidity. There is another bullish imbalance, and here also another thing that a lot of traders do is they do these inverse fair value gaps, where if you have a body closure below the imbalance low, they go short. Okay. I personally, my rules are the double rejection rules. So I need to see 2 candles to really confirm that the imbalance is failing. In this case, we have this candle, which looks pretty bearish. It's pretty scary. But look at the second candle. The second candle breaks below the previous candle's low. It went bearish, but then suddenly flips bullish. Once again, the auction market theory. The market is being pushed by the buyers below. And it makes this very beautiful pin bar, this very beautiful bullish candle. Okay, that to me is a successful double rejection. Okay, so for me right now, for the double rejection to fail, I would really need to see a bearish engulfing candle to close below this low. All right, and then C3 goes towards the liquidity. So usually it's gonna take you 2 to 3 candles, right? So here, for example, 1, 2, 3, 4, and then we went here, it's 1, 2, and 3 goes. Here's like 1, 2, and 3 goes. Here is 1 and 2, okay? You also have the single rejections, which is what I call tap and go. This is SR, it's not DR, this is SR, where the market just taps and just immediately goes without really staying inside the imbalance at all. Look, imbalance, taps, immediately goes to take the liquidity. No double rejection, it just taps and goes. Usually you're gonna see like a nice wick into the imbalance and then an immediate run away. Another imbalance here, just taps and goes. Doesn't stay inside, no double rejection, and immediately goes from imbalance to liquidity. Another imbalance here, taps and goes, right? Doesn't stay inside, doesn't linger inside, it just, this market was bullish, 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 bullish. It taps into the imbalance open. I don't need 50%, I don't need 75%. I just need to see the open to be tapped. Massive repel to the downside. Here again, bullish imbalance, touches and goes. Imbalance, touches, immediately goes, right? This is why you have to look at details and into the wicks, into the candle anatomy, because you can miss that one. If you don't draw your imbalance zone properly, if you are a little bit sloppy with the drawings, you might miss that this was actually a retest of the imbalance, so you miss a long trade, okay? And of course, another situation is where you can have a lot more candles to consolidate in the imbalance. Here we have an imbalance, there you can see candle 1 taps in, massive rejection, looks pretty good. Candle 2 sweeps candle 1's high, okay, and leaves a very massive rejection as well, tapping into the EMA. Okay, so still double rejection is successful. Candle 3 tries to push up and massively rejects lower. Another wick, we haven't broken above candle 2's high. Now we have candle 3. Candle 4 tries to push, rejects, doesn't break the highs. Candle 5 tries to push and fails, but doesn't break the highs. And then candle 6, 7, 8, 9, eventually it went down, but in a very choppy fashion. However, a previous candle's high, candle 1, candle 2, 3, 4, 5, a previous candle's high was never broken with a body closure. That is my rules. This is what I have kind of thought about. Body closure above the previous candle, that signifies the reversal. Here, candle 1, all right, candle 1 taps, beautiful rejection, and then candle 2, look, candle 2 tries to push, comes into the EMA once again. The EMA in imbalance is just an extremely powerful confluence, and pushes down, but again, it doesn't body break above the previous candle's high. That's a sweep. The next candle opens, it tries to tackle candle 2's high, but it sweeps it. It doesn't stay above. And then candle 4 gives you the bearishes, and then candle 5 takes the liquidity. All right, you see, there never was a body break above the previous candle's high. So let's see how that would look like, actually. This is what I call a double rejection failure. There it is. You're in balance. Candle 1 taps and rejects, beautiful, but then candle 2 is a very heavy bearish engulfing candle. And again, what is a bearish engulfing candle? It's a body that breaks below the previous candle's low. In this case, this bearish body broke below the previous candle's low, and even though the imbalance in this case, it's not engulfed yet, it's not fully broken, I consider this to be a double rejection failure, and then the market goes to seek the opposing side of liquidity, and I see it also tapped into the EMA here. Now here is a very choppy scenario here. Imbalance bullish, candle 1 taps, rejects, but then candle 2 just absolutely destroys candle 1 and the imbalance. I mean, it's pretty clear that this imbalance has failed right now. There is another imbalance. There is candle 1, beautiful rejection. Candle 2, it didn't break it fully, so you can wait, but then candle 3 broke it. So you can see candle 3 here broke above candle 2's high. We had an engulfing candle. So according to me in this case, this bearish imbalance, I'm no longer going to try to short it because it's failed. Candle 1 was good, candle 2 was okay, but you can already see within candle 2 there is a lot of bullish pressure here coming from the downside, and then candle 3 broke above candle 2's high, invalidation. We make a new bearish imbalance, okay, we maybe try again. Candle 1 comes in very bearish, gives a rejection, okay, let's wait for candle 2 because you cannot say if this candle 1 is going to blow it, but then candle 2, engulfing candle above candle 1's high. This bearish imbalance has failed. Bullish imbalance created. Candle 1, beautiful rejection. Candle 2, beautiful consolidation. In this case, we can expect that the next one can potentially rip off. However, candle 3, bam, bearish engulfing candle, breaking below candle 2's low and even candle 1's low. Bullish imbalance fails. We're very likely going to go to the liquidity. Okay, so that is how the double rejection failure works. And really the key to it is to just understand candle anatomy and just think very logically. All right. Do you see that the candles are being swept? Do you see wicks on top? Do you really see rejections, or do you see the bodies closing below the previous candle's lows and really signifying, for example, seller control or buyer control? All right. And of course, sometimes it's just extremely clear that an imbalance is failing. So that is an immediate failure of an imbalance. So like there is an imbalance, but then C1 is just the candle one is just like, I mean, absolutely obliterated everything, and it took the opposing liquidity. So would I wait for the second candle? I mean, guys, again, just let's be logical. It's pretty clear that it has failed. Here again, the bullish imbalance, let's try to long. It just destroyed it. So I wouldn't wait for the second candle because we're right now very far away from that imbalance, and we have taken the opposing liquidity. Again here, imbalance 1, imbalance 2, but then the first candle that starts tapping into these imbalances, it just absolutely destroyed them. Okay, and it took the opposing liquidity, and it's making a bullish imbalance. So in this case, not gonna short. All right. As always, practice time. Let's go immediately. No time wasted. What pair is this? Euro USD. I'm boring you with Euro USD, but we gotta do what we gotta do. Again, the strategy works the best. DXY, EU, GU, USD JPY, and gold. It works on every single market. However, on these kind of more balanced, more liquid markets, it works amazing. The first imbalance that I see is this one. That's a daily imbalance. What type of rejection that is? Well, yeah, this is basically kind of looking like a very nice single rejection, but it's also double rejection. Candle 1 comes in, immediately repels away from the imbalance. Candle 2 respects. Candle 1's high, bearish engulfing below. We go for the liquidity. Beautiful. Right now we're tackling live this daily bearish imbalance, but again, candle 1 taps in, leave a little rejection, and right now candle 2 is printing, so we don't know what's gonna happen yet. If this candle 2 closes above right now, so if it does something like, yeah, I cannot do it properly, but if it does something like this, all right, and it closes above this candle's high, then where it's gonna go? It's gonna go to the next imbalance, because this one could not stop price, but then we would say this imbalance has failed. Okay, but we don't know that yet. Let's look for some other one. No imbalance here. Okay, beautiful. Here. Daily bullish imbalance. Candle 1, beautiful rejection. Candle 2, candle 3, candle 4, candle 5. You can see like this candle 5. Like this is a really interesting situation because every single candle swept the previous candle's low. Like look at this. Every single candle is a sweep. However, in this case, I mean, let's just be logical. It spent 1, 2, 3, 4, 5 days inside this daily imbalance, really. And then it finally offloaded. And where did it go? I'm going to teach you where it goes next. It goes to the weak liquidity. So this one is a very choppy example of a very slow kind of double rejection failure. Again, everybody, nothing is perfect in the market. It's never going to be amazing. Okay. Daily bearish imbalance here. That's a beautiful example. Candle 1 comes in, beautiful rejection. Bearish candle again. Candle anatomy is really bearish here. We go for the low hanging fruit. Candle 2 takes the liquidity. We do not make a new imbalance. We reverse back up. Where do we reverse to? Into this imbalance. Now look, this is interesting. Okay. We tap into this imbalance here. All right. Candle 1 really bullish. But look at candle 2. Candle 2 swept. Candle 1's high. All right. And then candle 3 respected candle 2's high, and it printed a bearish engulfing candle. So in this case, this imbalance is actually holding. But at the same time, we had a bullish imbalance. And as I'm going to teach you very soon, we would like to prioritize the most recent imbalances. But in this case, this imbalance actually had a successful double rejection, and it ended up pushing price lower. What happened with this one is a beautiful tap and go. Beautiful tap and go. Taps, and it goes. Let me go on another instrument. Let me go, guys, to, I don't know, Aussie dollar. I haven't really looked at this in an eternity. It's FXCM. Holy shit, that is choppy. Okay. Beautiful double rejection failure. Daily imbalance. All right. Candle 1 very bearish. Candle 2 failed. I would have said in this case we would go for the liquidity, but it did not. Whoa. This one is choppy. There is the late. So this is also how you practice imbalances. Again, you just get lost in the charts. You just get lost in the charts, because in order to succeed in trading, you just gotta love the charts. If you don't want to spend the time doing that, or if you're demotivated to do it, or if it's like boring, and if you want somebody to tell you like a plug and play strategy, never gonna work. Sorry. Look, this is an extremely crazy, like this pair is extremely choppy. This is why I don't trade it. But look, candle 1 comes in, rejects. Okay, good. Candle 2 tries to push up, leaves a wick on top. Okay, it's fine. But then candle 3 was really good. Candle 3 tried to push down and rejected really nicely. At this point, I can see, all right, we're probably gonna go up. But then candle 4 bearish, but it didn't really break the previous candle's low. Then candle 5, like, oh my god. So again, like in this case, guys, let's just be logical. We have spent 1, 2, 3, 4, 5 days inside this imbalance. I would probably stop looking into it. It's not doing anything. It's just sweeping the lows and it's just sweeping the highs, and it doesn't go anywhere. So again, not perfect. Let's find another one here. This is a failure. Why? Candle 1 taps. So this is actually a tap and go, because if you go to a lower time frame, it tapped, it pushed up, and then basically fulfilled the objective. But then candle 2, you can see, broke below with a body below candle 1's low. Failure. That's a double rejection failure. Okay. And then we don't do. Is this an imbalance here? Let me check if that is an imbalance. How do we check? We just drop a line. Okay, there is an extremely small, very, very, very small imbalance here. Candle 1 looks like it absolutely blasted it, but then candle 2 immediately flipped. Swept the previous candle's low, didn't break it, and it flipped, and it actually went bullish, right? So never give up. Wait for the two rejections. Imbalance here, tap and go. Oh my god, this one is choppy as hell. There is the next imbalance that I see, daily bearish imbalance. Candle 1, nice rejection. Candle 2, beautiful double rejection, by the way. Swept the previous candle's high, and a very nice bearish push. It ended up collecting some liquidity, and then it chopped up because Aussie dollar is an extremely choppy pair. Another liquidity zone here. Like, these imbalances are so tricky. Taps in and maybe fulfills the liquidity, but candle 1, candle 2, very big indecision, and then there is the failure. Candle 3 fails. It breaks below these two bodies and it fails. In this case, I would have said that we can potentially go to this low, but we did not. And we went and attacked the liquidity. You can try this on gold, but gold, really bad time to pick gold right now because it has been extremely choppy recently. But look, fresh price action. What is this? That's a daily bearish imbalance. Let's make it red. Daily bearish imbalance. What did it do? Candle 1 comes in, rejected, and right now candle 2 is succeeding the imbalance and attacking the liquidity. Beautiful. Before that, bearish imbalance. What happens? The market chop, comes in. Candle 1 rejects from the daily imbalance. Candle 2 respects the high. It doesn't engulf it. It's an indecision candle. Candle 3, candle 4, candle 5 take us lower into the liquidity. Successful imbalance, successful imbalance. Daily bullish imbalance here. Candle 1 comes very bearish, rejects. Candle 2 respects. Candle 3, and then candle 4 takes us home. Imbalance holding. Let's see where is the next imbalance. There is a very small imbalance here. Candle 1 looks like it just absolutely destroyed it, but then candle 2 flipped, so there was still hope. But then candle 1, candle 2, and then candle 3 kind of were bearish, and then this one actually really invalidated the imbalance. So in this case, I wouldn't really look for longs anymore. But then the market showed us where it wants to go, and we took our long. So that one is a failure. It really looked like it's gonna hold, but it didn't follow through. And then this candle here, which is 1, 2, 3, 4, the fourth candle, broke below the previous candle's low. That kind of really invalidated it, but it actually just wanted to come and take some liquidity and reverse, which is pretty funny. Another imbalance here. Okay, candle 1, great. Candle 2 sweeps. Candle 1's highs, double rejection so far, good. And then candle 3 pushes us lower. You can very likely take your take profit within this bearish candle. But then the next candle really fails to go and starts going higher. And then basically here at this moment in time, when this bullish candle printed and then this candle broke above the previous candle's high, you can say, all right, this imbalance is gone. So I'm looking for longs right now. Beautiful imbalance here. Like, guys, I'm getting lost again. You see, I just love, this is how I learned all this thing. I just go and just check it out. Beautiful rejection, beautiful single rejection. It comes in, beautiful response from the imbalance. Then the big move happens. Another beautiful one right here. This is a beautiful double rejection. Candle 1 comes in, rejects, great. Then we watch candle 1's low, which in this case is the previous daily low, which is a really important liquidity level, by the way. The market comes in and massively gets lifted higher. It tries to close below, fails, double rejection successful. We go attack low hanging fruit liquidity and this little old liquidity here. Okay, here that is a good example of a failed imbalance as well. There, bearish imbalance. Candle 1 comes in, really bullish. Candle 2 invalidated. Bingo. Failure. Okay, candle 1 and then candle 2 broke, engulfed the previous candle's high. This bearish imbalance has failed. And now a bullish formed. We're shifting the trend. There is an imbalance here that didn't get retested. So if an imbalance is not getting retested, then you can then you can drag it into the future. Here is a really nice choppy example. Candle 1, massive rejection. Candle 2, nothing. Candle 3, sweeps. Candle 4, sweeps the highs but doesn't break the lows. Then this one kind of right here gave us a little bit of a sign that it wants to fail, but then it still kept sweeping the lows and then eventually it went. But this is like, again, 1, 2, 3, 4, 5, 6 days inside this imbalance. Usually when I see more than 3, because I love trading the double rejection, and if I see like that it's not going after the double rejection, I just kind of, okay, I probably take a step aside. Everybody, go to the 1 hour time frame. Same things. Where are we right now? Small imbalance here. This is the first one that I saw. Candle 1 rejected. Candle 2 sweeps. Candle 1's high. Candle 3 gives us the confirmation. Attacks the liquidity. Successful trade. There is the daily imbalance that we tapped. Outside of the daily, we're getting a 1 hourly bearish imbalance. That is our entry model. I'm going to teach you soon. Candle 1 comes in, rejects. Candle 2 sweeps. Beautiful double rejection. Candle 3 takes it home. And candle 4 continues. There is a bullish imbalance here. But as the bullish gets tapped, we're having a bearish one. So this would override this bullish. This bullish is going to become a reaction area. There is a bullish one here. All right, let's see. That is a failure. That is a failure. However, it ended up going. There is candle 1 tapping in. Pretty bearish candle. And then candle 2, you can see candle 2 engulfed candle 1's low. Body closure below. Imbalance failed. The next candle tried to push up, but then the next candle was brought back down. Not a great imbalance to be trading from. Here we also have a bearish one. Yeah, this one was pretty stuck between a bearish one, this bearish one, candle 1, candle 2, candle 3, candle 4, candle 5, candle 6. Again, it never broke. There is candle 1, swept. There is candle 3, swept candle 2. So kind of a consolidation. There is a big imbalance that didn't get tapped. There is a failed imbalance here. Candle 1 rejected. Candle 2 also looking really, really good because candle 2 swept. Candle 1's high, swept, but then candle 3 engulfed, bullish. Where? Liquidity. Low hanging fruit. Then this one is a pretty clear failure, by the way. Candle 1 looking good, and then candle 3 just absolutely blasted. There is another failure here as well. Candle 1 looking good, but then candle 2 breaks, engulfs. Candle 1's low. We go seek lower prices. Okay. Now, of course, this is just half. This is not even half of the picture. I'm just drawing random imbalances right now and just showing you how they work. And they work even without any sort of context behind them. But right now, pretty much, you know how to draw imbalances. You know how to practice. Just go and find all of these imbalances, draw them, train the double rejection failure. Look at the candle anatomy. Look at what the candles are telling you. Look, is it failing? Is it holding? And then you can ask a question. Okay, so why did the market suddenly stop here and made this very massive move down? All right. I have studied thousands of my stop losses and I would be like, okay, so I want it long here, but why did it go down? And then I go to forward and then I go to the daily and I see, oh, but there is a daily bearish zone against me. So this is why my long failed. And then I ask, okay, so how can I then align with this bearishness? And I find these 1 hourly zones and then I go find the 4 hourly zones. All right, there, fall zone. We tapped into that daily that was above. Now we're making a fall, right? Candle 1 comes in, great. Candle 2 creating a double rejection, successful, because candle 2 swept, bearish candle. We go lower, right? Did this one get tapped? No, this one is still not tapped. So you see, this is how you learn and this is how you practice, but I truly hope it's making sense. The double rejection successful and the double rejection failure, and kind of some of them are not perfect. Like there are some situations where it just starts to consolidate and it does nothing. That is normal. In this case, I would recommend you drop it for now, drop the imbalance and just wait for a new one to form. So right now, let's continue with the theory. Alright, so you now overall know the basic mechanics of an imbalance, and I mean basic, they can go a lot deep. And right now, of course, we know the basics, we know how the imbalances work, we know how they fail, we know how they are successful, and we know what we're looking for. Now it's time to kind of start putting them to work and give them a little bit more context. So firstly, why is the market moving as it is? From market structure, you have seen, or you know how the market kind of moves in general. We have the push, pullback, push, pullback. It's also called impulse, correction, impulse. I used to trade a strategy that was called an ICI strategy, impulse, correction, impulse. We're making higher highs and higher lows, or lower highs and lower lows. But have you asked why? Why is this happening? All right. Now, first of all, we looked at the supply and demand mechanics, how when something gets expensive, people stop buying it, then it goes cheaper. Like this is auction market theory, of course, but we can look at this through the sense of imbalances as well, because do you remember what the definition is of an imbalance? It is excessive one-sided orders, either buys only or sells only, leaving an inefficiency gap in price. Okay, sure. But the market doesn't like these inefficiencies, so it triggers a rebalancing mechanism to offer fair value. And actually, this can also be done with algos, because probably a very big percentage of the markets nowadays are operated by algos and market makers just providing liquidity. And anytime that we have a very big imbalance, which is when a big player has ended, then there is a mechanism that just goes ping, 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 goes back to rebalance these orders. Okay, and then when imbalances are filled, which is what we call the fair value is offered, then the battle between supply and demand continues. Then once again, are the institutions going to perceive that this is cheap to lift it higher? Or are they going to perceive, no, that's it, and then just break the imbalance? This is when we just don't know. How would we confirm it with an entry model? And we are pretty far away from an entry model, so you better be patient. So, and pretty much when that zone is retested, that is when we can have a potential higher low or a potential lower high. And then the market will seek liquidity to go out of balance again, to create a new imbalance. And then the market heads for a new higher high and a higher low. So do you see what happens? We push with an imbalance. The market triggers a mechanism to come back to rebalance. Then supply and demand is going to decide, all right, are we going to push and go? If supply and demand decides we push, we go up. Okay, and then we take liquidity, it's expensive again, then we pull back into an imbalance, and the same thing repeats until it does not, because imbalances are going to fail and they're going to attack the opposing liquidity. So what if there are no imbalances at all? Well, guess what? The market is in balance. There is not a big player that has decided, all right, we're going to push up. The big traders and the big investors are waiting for a catalyst, which is usually news. We're going to talk about news as well. And when there are no imbalances, this has been a game changer to my trading, everybody, because if you trade market structure, you're always going to get structure. But if you don't get imbalances, that means we are in a consolidation. This means that the market is choppy. This means that the market, the big market participants are not into the market. So why would I trade? So right now, I only trade when there are imbalances in the market. I only trade from imbalances. That's it. All right. So if there are no imbalances, the market will just go up and down in a consolidation seeking liquidity. That's it. And now, of course, you can have different market lenses. Now, what I'm teaching you here is just one of the million ways to perceive the markets. And I have my own way of perceiving it. Somebody say, okay, you learned from ICT, you learned from this guy, you learned from that guy. I've learned from everybody. Again, I've been trading for many years. I know everything about trading. I know, like, I've watched everything. I've bought every course. I've gone through everything. And then as you do this, you kind of determine your own market lens. So it could be like some sort of a market structure that's not even based on our rules. You can say, like, this is what you're usually going to see in tutorials about market structure. They're just going to give you like a chart and hey, this is a bullish market. Push, pullback, push, pullback, push. But then you go in your chart and like, okay, so where is the higher low? Like what is really is? What about all of these? What about this push, pullback, push this down? Then we shift to up, then here, up, then we shift to down, then we shift down again, then we shift up, right? There are so many ways to perceive this market structure. You can perceive it like that. You can perceive it like this. You can say internal and external, whatever. It's a market lens. You can perceive it like this, like there it is, internal, external. Okay, something that we also kind of covered. You can look at market structure like this. I've just taken some random pictures because there's so much information out there. You see double bottom, bull flag, bullish pennant, ascending wedge. But then we turn into a descending wedge. Then we make a triple top and we go down in a bear flag, pennant, inverted head and shoulders, inverted cup and handle, expanding wedge, cup and handle, rising channel. Like, come on. And you see, like, you can perceive it, price action in this way. You can look for inverted cup and handles, right? I don't know, I just found this really funny. Then there is this market structure, right? Short-term highs and then intermediate highs and then long-term highs. And then you have like 3 types of market structure across 3 different types of time frames, and you actually get messed up. You have Wyckoff theory, accumulation with a spring, then the markup going higher, then distributing at the top with a manipulation with a spring, and then the markdown lower. I do like this. It kind of resembles what I also do. You have Elliott wave. Elliott wave I also learned back in the days because I wanted to do structure and I wanted to do objective market structure. So I thought, okay, Elliott wave theory, it's a theory, but it's absolutely crazy. You again have these 5 waves to the upside on the lower time frame, then you have ABC to the downside. But then this builds your major structural waves. So you have waves within waves, but then what are the waves? You have like granular price action. What exactly are you going to take as the wave? And then you have people trading full moons and new moons. On full moon they buy, on new moon they exit. On full moon they buy, on new moon they exit. I mean, there are millions ways to trade. What matters is what works for you and what makes sense for you. Again, my model is nothing new. It's absolutely nothing new. It's all out there, but I have done the work to really familiarize it, to really digest it, to really see the patterns, and to really make it make sense for myself. Okay, the model is nothing new. There is nothing new in the market because the market has been there for a very long time. And of course, at first there have been some discoveries and this and that, great, but nothing is really new nowadays, especially. Okay, so what you have to do is you have to find out what makes sense and master it. And right now I'm going to show you what makes sense for me. This is what I have thought as the market mechanism. Again, it's nothing new. It's nothing new, but this is how I, through my eyes, through my market lenses, how I perceive the market. And based on this market mechanism theory, the market will do one of 2 things. It will look to rebalance an imbalance, which is offer fair value or make a pullback, in other words, or it will seek liquidity above or below a liquidity point, a swing point, simply break a high low. And do you see with this sort of mechanism, I'm using imbalances in liquidity, but the imbalance is going to be the pullback to create a higher low. So there is structure, and the liquidity is going to be the higher high to break structure. So structure and imbalances go hand in hand. This is why I dropped structure from the equation. I no longer draw market structure, but I still covered it in this video because you have to understand it to train your eyes to see it, because I can see it like subconsciously whether the structure is up or bullish or bearish. Okay, but we're either going to rebalance to fill an imbalance, or we're going to seek liquidity to take out a higher low. That's it. That's what the market is going to be doing at any point in time. And our focus should always be on the current market positioning. So what is the market doing exactly right now? Is it offering fair value? So is it pulling back into an imbalance? Has it already offered fair value? So has it already retested the imbalance and right now it's starting to push towards liquidity? Or is it taking liquidity? So has it already broken a high, or it just broke a liquidity, or is it already breaking it? And these 3 situations will help us know what we can do always. So screenshot this slide. I mean, you're going to get the PowerPoint, but print this because these are the 3 things that the market can be doing. It's either currently pulling back into an imbalance. It is either already pulled back into an imbalance, and currently it's potentially giving you entry towards liquidity. Now, is it going to be in your direction or in the opposing direction? That is going to depend if the imbalance is holding. And then, has it already taken liquidity? So did it take liquidity? So then it resets. If it has taken liquidity, it's going to look to rebalance. If it has rebalanced, it's going to look to take liquidity. It's one or the two. And this is how it looks like. Oh shit, this is market structure. Well, yes. We push up, make a higher high. We pull back to rebalance. We attack the liquidity, which is our higher high. We push up, we've taken liquidity. What do we do now? We pull back to rebalance. We rebalance. Okay, what do we do next? We take liquidity for a higher high. We've taken liquidity, great. What do? We pull back to rebalance. And then from here, what do we expect to do? To take liquidity on the upside, or maybe to take liquidity on the downside. Because we do not forecast. This is something very key we're going to talk towards the end when we get more to our psychology and trading principles. And this is how, for example, it can look into a more complicated kind of framework. Which is where, for example, this Elliott wave theory comes in. This is where major and minor structure comes in. This is where like short-term, intermediate, and long-term structure comes in. But it's also complicated because you can see, for example, here you have lower time frame imbalances and lower time frame liquidity. We're having this push phase, but then it reaches the top, and then it starts building lower time frame imbalances and taking lower time frame liquidity. But then it taps into a hard time frame imbalance. Imagine this is the 1 hour time frame, 1 hour going up, and then 1 hour going down. But then we tap into a daily bullish imbalance, and then this is gonna prevail because it's a hard time frame. We're gonna talk about time frames in a bit. Market pushes up, pulls back, starts building bullish structure. Then it takes a prominent swing point, and it starts reversing, bearish. But then it pulls back into a daily bullish imbalance. Hard time frame imbalance retests again. The lower time frame shifts to bullish. We have the structure shift, and we have the imbalances shift. And then we go again for the hard time frame liquidity. But until we go to the hard time frame, we can be taking these short-term liquidity points. All right, so that is kind of how it works. And it's all logical. It all works on every single time frame. And if you build it together into a system, you don't need Elliott wave, you don't need intermediate, short-term, advanced market structure, you don't need internal, external, you don't need blah, 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 blah. No. All you need to just think logically and follow the process, and also learn how to use it on different time frames, which of course we're gonna get into very soon. So there is, for example, a chart here. We already looked at similar charts. We have a daily imbalance, candle 1 rejected, candle 2 beautiful, successful rejection with a bullish candle. We attack the hard time from liquidity, we push away from it. In the meantime, we create a daily bullish imbalance. The market pulls back, beautiful candle 1 with a beautiful rejection, candle 2 attacks the liquidity, and then we continue, we make a new imbalance, and this just repeats. We go from imbalance to liquidity, from imbalance to liquidity. However, this is the daily time frame, and as I told you, this is the exact same price action here. This is the exact same price action, but on the 1 hourly time frame. Like, look, you suddenly see, wow, it's so granular. Like, you see so many details, and you see on the way towards that daily time frame imbalance, short, 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 short. On the 1 hourly time frame, it's making that bearish market structure that you might say it's internal or short-term structure. No, if you know that the market, for example, here has taken liquidity and you have a daily imbalance and you see that the market is pulling back into that daily imbalance by looking on the 1 hour, you can even trade short. It's all logical. But then we tap into that daily imbalance and we no longer want to trade short. Okay? The market breaks above with a 1 hour imbalance. We start looking for longs. However, it starts to consolidate. There is a 1 hour imbalance down, but then whoop, 1 hour imbalance up, and we very nicely emerge above the 1 hour EMA. Right now, that short-term trend is in our direction, and we're also in the long-term trend with the daily. High, 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 low. 1 hour imbalance retest. 1 hour imbalance bullish. 1 hour imbalance bullish. 1 hour bullish. Here, there is no 1 hour bullish until we reach the top. And why do we stop right here? Because we reached the hard time from liquidity and we have created the daily bullish imbalance here as well. Okay, and there are no imbalances here. No imbalance, no imbalance. There is a little bearish here, but we are above the EMA. Okay, and then we drop massively. But where do we drop to? We drop into this daily. But so then you can say, all right, 1 hour is bearish, I'm gonna go short. No, because the daily time frame is bullish. We're tapping into a hard time frame imbalance. The 1 hour time frame immediately starts giving you the shift to bullish imbalances, goes, attacks the liquidity, and then it just continues to go higher. But you can get, for example, see, you can get very granular with this. It just looked like that, very nice and simple, but then suddenly it looks like this. Okay. So let's talk a little bit more. What to do when there are no imbalances? Well, when there are no imbalances, price will take liquidity and consolidate until momentum is introduced in the markets. That's how it looks like when you just don't have imbalances. That is what I call a choppy market. Okay. I just do not recommend you to trade markets like that. Like, why would you? There is no liquidity, there is no trend, there is no momentum, there is nothing. All you're gonna take here is stop losses. You're gonna get stop loss after stop loss. And again, just realizing that if you just wait for imbalances to form, it gives you a huge edge, because so many traders are gonna take stop losses here, but there is not a single imbalance. There is one here, but it just immediately got smashed, so you wouldn't be able even to trade anyway from it. Liquidity down, liquidity up, liquidity up, liquidity down, liquidity up taken, liquidity down taken, until we find that right now we see it starts introducing some sort of a move. All right, so keep this in mind. Oh, there's another example here. No, it's hidden behind. No, let me check it out. All right, there, fixed it. So there, this is another example right here. Again, no imbalances whatsoever. Sweeps liquidity on the bottom, goes down, but no imbalances, then goes up, sweeps liquidity on top, then goes down, no imbalances, sweeps liquidity on the bottom, and that is just a very big nonsense. There's another example here. That's the one I showed you already. No imbalances, absolutely crazy. And there should be the final one there. All right, we kind of go up. There is a little imbalance here that actually tapped and fulfilled. Great. Then here we have liquidity taken, nothing, no imbalance, no imbalance, no imbalance. Liquidity taken, no imbalance, liquidity taken, nothing, down, nothing. Then we take major sweep, then we take major down sweep. Like, what do you do even in such cases? You cannot do anything because you don't really have any sort of zones. So again, at all costs, avoid these. If you are patient to avoid periods that don't make any imbalances, long term, you're gonna have your win rate immediately after this video. If you just implement all these things, it's gonna rocket, I promise. If you just implement imbalances, if you implement liquidity, and what I'm about to teach you, it's gonna go really good, I promise. So let's see the consolidation rule. So there is another rule apart from this. What we just had a look at is all the choppy market, where it's just not making any imbalances at all. There are markets which are gonna make imbalances, but they're just gonna fail. So when 2 consecutive imbalances fail, this is a sign of a consolidation. Then what you like to see is like the market structure. You want to see a confirmation of 2 imbalances actually holding. Okay, there it is. So for example, we have a bullish imbalance, fails, but it makes a bearish imbalance, fails. Consolidation, like bullish doesn't hold, bearish doesn't hold, then you have bullish fails, bearish fails, like come on. But then it makes a bullish imbalance, and then in these situations, what you really want to see is similar to, again, the market structure confirmation that we want, which is again a trend change, pull back higher low, and a break for a higher high. You see how they overlap again. Pull back into the bullish imbalance, and really to make a new imbalance and a new higher high to really confirm, okay, we are outside of that range. So that is what we would do in these sort of situations. Here is an example of that. Bearish imbalance, failed. Bullish imbalance, failed. Consolidation. Bearish imbalance, failed. Bullish imbalance, failed. I mean, then we have we have an absolute chop for an eternity. Like, again, we just don't touch this, because why would we? First imbalance in a while, bearish. Okay, we pull back into it, we're holding. So double rejection is successful. We hold. And then from here, if I quickly remove my camera, from here we created that bearish imbalance. Now we can say, okay, sellers are in control. The market is below the EMA. The EMA is starting to point lower. We are probably going bearish. So that is the consolidation rule. When you see a bullish imbalance fail and then a bearish imbalance fail, be very careful and wait truly to see some real order flow and some real trend to kick in. Now, let me give you some level up knowledge here, because there is going to be times at which the market is going to retest your imbalance, and then it's going to struggle to make a new higher high and attack the liquidity. This is what we also discussed in terms of market structure as a market structure shift. Because again, in order for the bullish trend to continue, we must continue making new higher highs. But if the higher high does not get broken, we basically have this market structure shift, a creation of a lower high. Here, this is a high, and then we have lower high to the left. All right. So if this, so again, in this case, because it has rebalanced, it will seek liquidity. But if we fail to take liquidity on top, it's gonna take liquidity on the bottom, and it's gonna go to the origin of the imbalance. Now, in my private program, I teach order flow ranges, which is like a 10 times more powerful thing than market structure. And we use imbalances for that to define the ranges in terms of market structure, but with imbalances. And all of these ranges have an origin. So for example, if that is an order flow range bullish and the market fails to make a new high, it's gonna go and attack the origin of that bullish push. If I immediately give you an example, there we have a bullish push, what I would call a bullish order flow range. Candle 1 taps in, reacts, candle 2 fails. Okay, this is basically a double rejection failure, but I have said it's rebalanced, so probably I just wanted to give an example here. And then the market tries to push up, it fails. It tries to push up, it fails. So it has kind of rebalanced, but it's failing to take liquidity on top. Where is the origin of this imbalance? It's right here. It's liquidity, always. It's a liquidity. Look at where the market goes. Bing, goes down, takes the origin. Because we pushed up, we pulled back, and we failed to take the liquidity on top. So if you're failing to take the liquidity on the bottom, and the market has rebalanced, then it's going to seek liquidity, because we know it's going to do one of two things. It's either going to seek liquidity, or it's either going to rebalance. All right? The market seeks liquidity on the bottom. Massive sweep here. At the same time, it's printing a bearish imbalance. However, candle 1, beautiful rejection. However, candle 2 breaks above candle 1's high, engulfing candle, goes higher, bullish imbalance gets introduced, taps in, and then we go to attack the bullish liquidity. Okay? That is a failure to take liquidity. After rebalance on one side, it's gonna look for the other side, the opposing order flow range. All right? All right. These are the foundational price patterns, everybody, that you must know. They go a lot more in depth as well. So what I have kind of made for myself and for my team is deep mastery over those two things. Deep mastery over imbalances and deep mastery over liquidity. We have the EMA to serve as guidance. We have an advanced EMA strategy as well. We call it the EMA band. So all of these things, right, you have to know. So right now, because we covered already pretty much a lot of things, we have market structure, we have liquidity in imbalances. I want to do one final practice on the chart right now, just merging them all together for one final practice, and then we're gonna start putting everything into a process. Let's do it. All right, once again, exciting times. We are on the chart. So what do we have here? We have gold. Let's do gold, okay, but I want to keep it random. So again, I'm not prepared for this. I'm just gonna go replay, and I'm gonna hit a random point in time, blah, 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 here, okay. And we immediately get lost in the charts. If you want to learn, you have to get lost in the charts. I would recommend that you, for now, just practice on one time frame. All right, practice on one time frame to make things a little bit easy. You can do it again with a replay mode going forward, or what I like doing is actually going backward and just studying. Okay, it's hindsight, but that is how you study. We're gonna talk about that a little bit later. Okay, what moment did I pick? I picked a pretty choppy moment. So what do I immediately see? I see a major significant liquidity here that massively got swept. Do we have any imbalances? No. The last imbalance that we have is a very small imbalance right here. Very small. Currently, we don't really have anything. So what do? Let me go forward maybe. Yeah, okay, let me do like a backtest. So for example, what I would do in this case, but I'm gonna stay on one time frame. And that is really half of the picture. It's even less than half of the picture. So what I'm gonna do right now is I'm waiting for imbalances. Okay, this price action is just absolutely choppy. We don't have anything, so I'm looking for an imbalance to form. Is that an imbalance? No, that was not an imbalance. All right, so right now we're getting a very big pump, and what are we doing is we're breaking structure and we're breaking liquidity. Where is my EMA? Let me plop the EMA to know. Okay, bullish structure, great. Now, imbalance first. That is a breakaway gap. But do I teach you breakaway gaps? No, this is way too advanced. So there is an imbalance, all right? So we're massively imposing, we're going up, good. There is another imbalance, great. So what am I doing right now? I'm bullish. What did the market take? Liquidity. What am I looking for right now? A rebalance. I want to see a rebalance of these two imbalances and then to potentially go for a new higher high. Let's see. Did this one get tapped? It missed for the tick, or maybe it did. You can check here the low, by the way. So the low of this candle is 406.27, 406.26. So it actually tapped it by one tick. Okay, cool. We continue right now where we keep taking liquidity, although we don't really have any liquidity levels. So we're massively expanding, massively expanding. There is no imbalance here. Okay. Okay, we're massively expanding. Finally, an imbalance. So the market has right now traveled and traveled and traveled and taken a lot of liquidity. I can zoom out. But what we have done on gold recently is we have taken this very, very major swing point, and right now we're just going and making massive all-time highs. But I clicked on this moment here. I think it's just gonna go up from here. Anyway, forward imbalance. What do I want to say? I also want to see a tap. Let's see. Tap. Okay, beautiful. Candle 1, extremely bearish. Now I want to see what candle 2 is going to do. Let's see. Candle 2, respect. Where can we potentially go? We rebalance the imbalance. Now I expect for it to go towards liquidity. We're bullish market structure. Let's see. And if it fails to go for liquidity, which it just did, I would have expected the lower one. Okay, we took liquidity. Now, do we have a new imbalance? We do not. So we cannot trade. So now we can look for liquidity. There is a recent liquidity point here. Let's see what happens in the market. Okay, still so far bullish, but no zones. So we cannot trade right now. We cannot say, hey, I'm going to trade again. No, this one got taken right here. And I usually draw my imbalance zone to the point at which they're tapped. So I'm not going to do this. Never. Okay, invalidated the bearish imbalance. So still bullish, but you can see right now we're not doing anything. There was a short-term liquidity here that is currently being swept. And on top, we have this liquidity available right now. Just drew it. The market just attacked it. Let's see if we make a new imbalance. Beautiful. We made a new imbalance. So right now what we have done, everybody, we have taken liquidity. Right now I would expect for us to rebalance, potentially. Let's see if it does that. Okay, just keeps running away and keeps collecting liquidity. Keeps collecting liquidity, but it's very slow and it's not making any imbalances. So still, again, we do not trade. We're taking liquidity, but we're not rebalancing. So I need to see a rebalance. Guys, this is all random. I didn't pick this thing. We're doing it live. Rebalance happened. Now, all this liquidity is not relevant. Let me just keep what is relevant for now. This liquidity low is relevant. Why is this liquidity low relevant, everybody? Did you pay attention? Because that is the origin of this bullish push. If this bullish imbalance fails, we go for this low. If this bullish imbalance holds, we go for that high. Let's see. Looking like a failure. However, it hasn't broken below the candle 1's low. Very shitty situation. I would say subjectively that this one is gonna be a failure, but let's see. There. Failed. Where did we go? This is the failure this is a double rejection failure, which if a double rejection fails, the market is still going to attack the opposing liquidity. Okay, so now we start applying liquidity. There is an old liquidity here. So can we go towards that? Let's see. Do we have a bearish imbalance? We do not. Is there one here? No, they're matching up. Okay, let's see. All right. So this is a massive drop. Now, why is this happening, by the way? You can immediately ask, so why is this happening? I'm on the Volatility time frame. Go to the weekly. Go to the weekly. Where is the market going? Weekly imbalance. Go to the daily. Why is the market making that drop? I'm immediately asking, why is this happening? Daily. The daily was taking liquidity, and right now it's coming back to rebalance. Okay, but I'm going outside of what we plan to do because I plan to do one time frame. All right, massive Volatility zone, and right now we're below the EMA. We're below the EMA, and it looks like we're shifting bearish. So I immediately zoom out. Where can we potentially stop? Old structural points. Structural point. Structural point. Old unretested imbalance is also a reaction area. And then ultimately, structural point. Let's see. We just took liquidity. We can expect a potential rebalance. Let's see if it happens. And the new imbalance gets created here. Let's see if it gets tapped and then to attack the new liquidity that just formed. this low. Retest of the two imbalances. This is candle 1. Let's see what candle 2 is going to do. Is it gonna make a double rejection failure? Not yet. Not yet, but we have a bullish flower imbalance. So here we're getting into 50-50 territory, all right? This approach that I'm teaching is very logical. So right now you just have to be logical, all right? We're below the EMA. Good, we're bearish. We're making a bullish imbalance. Okay, but we're still pretty bearish. So let's see what is gonna hold right now. Because the bearish imbalance is still holding because we haven't broken above this previous candle's high, and a bullish is printing. So is the market gonna pull back into the bullish and go up? Or is it just gonna destroy the bullish and go down towards liquidity? Let's see. We don't know that. We have to react. Let's see what happens. The bullish one pulls back. Beautiful single rejection. Taps and goes. Now let's see if the market is gonna go. Like, I mean, we don't really have any liquidity apart from that one in this case. Okay, so let's see if it's right now gonna fully reverse into a bullish market. What would I like to see? For the market to break above the EMA, for it to break some sort of bullish structure, and to start forming new bullish imbalances. Let's see. It made a little bit of a liquidity here and a little bit of liquidity here. Now I want to see acceptance above these liquidity lines to really determine what is next. What a sweep. Accepting below this liquidity, that is bearish signal. Going back above, so we're probably, oh shit, okay. Now where do we go? We go into this zone and we go very likely towards this liquidity level, but this is a very massive sweep. So here, everybody, it's getting a little bit tricky. You see, it's kind of hard to figure out. There are no imbalances right now. The market swept liquidity. It's not making imbalances, and we just wait. There is a very nice bullish push. Okay, quality bullish imbalance printed. Great. What is very recent right now? All of this is already disappeared. It's already tapped. Liquidity is taken here. This liquidity got taken. This zone got taken. Almost reached this one as well. Right now we're trading against the flower EMA, and you can always also use your structure. There's our structure. The last, basically, the trend change is going to be up here. Okay, and then the market is also going to align with the EMA. So let's see. We have a flowery bullish imbalance. Liquidity has been taken from here and from here. Again, these are low-hanging swing points. Every swing point is important because everything contains liquidity. Let's see if we're going to retest. No, we create another. But we're starting to very slowly break above the EMA. So we can potentially start hitting higher. Let's see. Retest of the imbalance is great, but look at the EMA. It tried to get above, immediately repelled it back down, and structure is still bearish. So in this case, you can see merging everything together, which we haven't done yet. We're just about to do the process. Would you go long right now? Would you think that the market's going to go up? I personally wouldn't. I'm not convinced yet. Let's see how these bullish imbalances are going to hold right now. And they're failing. Beautiful double rejection failure. Look, where do we go? Candle 1 goes bearish, candle 2 fails. These imbalances are destroyed. What is the origin of these imbalances? Right here. That is where they started, and that is liquidity. And then under that liquidity, we have this low. Let's see. Very big percentage of the times, if an imbalance fails, or if an imbalance fails to make a new high, it's going to go and take the origin. Let's see. Okay, forwardly bearish. Come on, man. One time I wanted to see it happen and it did not happen. Okay. We formed a bearish imbalance here. The market didn't come to attack the liquidity, and it just absolutely blasted the roof of the opposing liquidity. Okay. But this is something that I would have absolutely looked to go short from this forward zone, but this forward zone just absolutely got destroyed with, I mean, it's pretty evident that it got destroyed. So, yeah. And right now we are breaking above the EMA. We're finally, if you put the indicator, we're finally breaking a lower high. So we're having a bullish trend change. We're breaking above the flower EMA. We are printing a flowery bullish imbalance. Now things start looking a little bit bullish. Let's see. We've taken liquidity. If we pull back to rebalance and go up, could be a long. Or is, wow. Rebalance to the absolute tick. Let's see if it's going to continue. Continues, consolidates, kind of continues, but in a choppy manner, continues, no imbalances, no imbalances, continues, no imbalances again, and it just keeps continuing without imbalances. Now here, why is it making a pullback, right? Go one time frame higher. Daily imbalance. Now I'm getting a little bit a step ahead, but again, I love the charts. I want to figure this out for myself and what is going to happen. So you can see here, everybody, on the Volatility time frame, we don't have any imbalances whatsoever. So in this case, you kind of don't trade and you can expect that the market is going to go to take liquidity. There is this liquidity point. All right, that just got taken. Then we have the liquidity on top and then we have the liquidity on the bottom, which is where this daily imbalance is resting. So let's see. Taps the daily imbalance right now, but we still don't have anything on the Forex. So I'm cheating a little bit here because I'm using the daily. All right. But I don't like trading with closed eyes like that. I need to know what's happening on the hard time frames. We come again, but still no 4-hour imbalances whatsoever. Nothing. All right, for the first time, we pull back into the 4-hour EMA. Beautiful. How is market structure looking like? Are we still bullish? Well, yeah, basically. There is a break, but it's a sweep. I wouldn't say that this is a break to go short, because if you do body breaks for structure, which I would recommend you do, it wouldn't be. And right now we're building a bullish imbalance. So let's see. Are we going to go take liquidity here? Okay, are we going to retest the imbalance? Consolidates, goes and takes the liquidity. Now we have taken liquidity and we're making a new forward imbalance. So now what I expect to do is we go from liquidity to imbalance potentially. Let's see if it retests. And it just rockets. And where does it go? Towards the ultimate liquidity. Okay, and then again, imbalance created. We took liquidity. Now I would expect some sort of a rebalance, which again just starts to consolidate, and it doesn't do, and we consolidate on top. But you get the point, right? I can do this all day, but I just wanted to show you a couple of these concepts to really kind of figure out what is happening and how you can also practice. Practice imbalances holding and where is it going to go next, and practice imbalances failing and where is it going to go next. See these periods where there are no imbalances whatsoever. Then see when a big move happens. Why did that big move happen? Go to a hard time frame. Go, I wouldn't say lower time frame, because for example, we can probably capitalize on lower time frames here, but for now you want to keep it to the foundations. So I will totally recommend that you practice these things only on the forward time frame and on the daily time frame. On the daily time frame, you can do exactly the same. All right, just pick a random point in time here. All right, and you just go and you start. Okay, what are we doing? There is the last daily bullish imbalance. Great. Candle 1 taps, candle 2 goes. Amazing. What are we doing right now? We made a daily bullish, and right now we made a daily bullish. What is the current state of the market? We have taken liquidity, so I would expect for the market to potentially pull back and rebalance. What can it rebalance? This daily zone. It just tapped it. We created liquidity. I expect it to go here, but then if it invalidates this daily, maybe it's gonna go down there. So let's see. Candle 1, candle 2 successful, candle 3 tries to push up, candle 4 successful. Great. Liquidity taken. What do I need right now? An imbalance. There is my imbalance. Great. Liquidity is taken. What is the next market mechanism step? Potentially offer fair value. Fair value offered. Great. What is the next step? Take liquidity. Where? For a new high, or if this imbalance fails, it's going to go to the origin, which is right here. Let's see what happens. Candle 1 and then candle 2, basically a failure. Basically a failure. Why doesn't gold take the origin? Like Forex does this so well. In this case, this forward bullish imbalance failed. I would have really expected the origin to be taken, but the market just flipped. It happens for the second time on gold, so that is an insight even for me right now. I'm actually studying right now. The market goes up, takes liquidity. Great. We make an imbalance. We make another imbalance. We've taken liquidity. What is next? A potential rebalance. Higher low formation to form. Let's see. There is the rebalance. There is the most recent liquidity, low hanging fruit once again. Okay. If this imbalance fails, I would expect the lows to go, but knowing gold, it doesn't do that very often. Candle 1 rejected. Candle 2 also rejected. So far, a successful double rejection. Successful. Liquidity smashed. Higher high created. Great. Now what do I need to do is to make another imbalance. There is the imbalance. What is the market doing? It's continuing to take liquidity. Now we still need some sort of a rebalance. A new imbalance gets created. We still need that rebalance to make a higher low. Rebalance successful. Great. We target the new liquidity. This is not a liquidity yet because it's not a swing point. You see, it doesn't print as a swing point. Now it's a swing point. See, because it's a 3-bar fractal. Rebalance. Candle 1, beautiful rejection. Candle 2 looking pretty good. Candle 3, smashes the liquidity. And you just keep going on forward, and you draw this and you read, and when it gets tough, you ask questions and you just keep going. And I did this for 20 minutes again. I really wanted to do it 5, but I cannot stop myself. So with this, everybody, we're right now starting to put everything together. I just showed you imbalances, liquidity, market structure and everything, and how you read it on a random piece on the charts. But right now, it's really important to start putting all of these things into a process. But first, I would totally recommend you go in your charts right now and just do this for a while. Do it on EU, GU, and gold, and USD/JPY. All right, because some of the other pairs, the crosses are very choppy, and you might see like this market is shit. Just do on stuff that works. Test it out a little bit, but right now, let's go into the process and start putting everything together. All right, fanatics, we're absolutely packed with knowledge right now. We know a lot. However, there comes a time at which we have to start putting everything together and build it into a system, build it into a process, because you can have all the knowledge about the markets. Like my main mistake in the past was I knew everything around about the market. I'm like a trading encyclopedia. Anything you ask me, any concept you ask me, I know it. However, I couldn't really put it together, so I was never profitable. And I only started becoming profitable once I removed all the noise, all the useless stuff that I know, and I just kept what really works and I put it into a simple system that I'm actually going to transfer onto you right now. So first, we're going to talk about something really important that you're going to hear a lot, and that is bias. So what's that? What's bias? You'll be hearing it out a lot. Daily bias, directional bias, bias, direction, trend, and all these sorts of stuff. So what does that actually mean? Well, let's not overcomplicate it. Are you bullish or are you bearish? Do you think that the market's going to go up? Bullish bias. Do you think that the market's going to go down? Bearish bias. Or you can say long bias or short bias, bullish bias, or up bias. No, you cannot say up bias. No, bullish bias or long bias. Okay. So this is kind of a jargon, you know. So like if somebody asks you, hey man, like what do you think about EU? Well, I think it's bullish. So you think it's going to go up, or I think it's bearish. Or you say I'm bullish bias or I'm long bias. I think longs, right? So that means you think it's going to go up. Anyway, that is this daily bias thing. And there is a little difference between trend and bias, because thinking about our market mechanism, sometimes the trend or the overall market direction can be bullish, but you can have a short-term bearish bias. How can this happen? Well, if the trend is bullish, making higher highs and higher lows, but the market just made a higher high and we have an imbalance below us, then we believe that the market is going to pull back to rebalance this imbalance so we can short into it. All right, so just to quickly make you visualize it, we are bullish. We're going up, the EMA is bullish, so we're bullish. However, the market took liquidity right now and there is an imbalance here. So I can trade towards that imbalance on the lower time frame. So basically in this case, if somebody asks like, are you bullish or are you bearish? This is where, again, you get a little bit lost, because you can be long-term bullish. I really think long-term it's going to go up. However, in the short term, I think it's going to pull back into this imbalance. So I am short-term bearish bias, but sorry, I'm short-term bearish bias, but long-term I'm bullish. So again, like, let's not complicate it. Let us just keep it simple. The very big question that we have to ask is, where is the market going next? That's bias. Up or down? That's it. So how are we going to figure this out? Well, guess what? We already have all the knowledge. We already have all the tools to figure this out. And the most important tool, of course, is imbalances. They are going to help us define bias and direction, because again, as I said, that is a Swiss knife concept. It shows us who is currently in control. And what is really important is who is in control right now. Let me get my highlight. This must be highlighted right now. Who is in control right now? Whoever made the most recent imbalance. So when it comes to the current control of the market, the current trends, and pretty much like whoever's currently in control, we're going to be using the most recent imbalance. Imbalances show us where when there is a trend and when there is a consolidation. If there are no imbalances, it is a consolidation and a chop, and we do not trade this. If there are imbalances, but they're mixed up, so we get a bullish imbalance, a bearish imbalance, a bullish imbalance, a bearish imbalance, there is still a lack of direction, so we also do not trade this. And yeah, it pretty much gives us overall direction. If you remember, I showed you a little example how I removed all the price action and I just kept the imbalance indicator. And you could literally imagine the market structure. And then of course, market structure and the 50 EMA. I mainly look at the EMA. I don't really look at market structure, but when I look at a chart, I can really understand what the structure is. But I mainly look for the EMA. So if price is above the 50 EMA, we're bullish. If price is below the 50 EMA, we're bearish. And if price is kind of in the middle, if price action just keeps oscillating around the EMA, and if the EMA is flat, that is a consolidation. That's it. That is bias, okay? But of course, we're gonna put it all together right now. Something that is really important for you to really understand is the fractal nature of the market. Now, what does that mean that the market is fractal? It means that it moves with similar, if not the same patterns across all the time frames. So what is actually going to happen on the monthly? How a imbalance is going to get retested and follow through and attack liquidity on the monthly, it's going to do exactly the same on the 1 minute. The entry models that we're going to be using, they can develop on the monthly and they can develop on the 1 minute time frame. It is all the same. It is fractal. All right. So a very common question that I get asked a lot on YouTube in the comments is, well, if that's the case, why not just trade a singular time frame? So I get questions like, okay, can I just trade the 5 minute? Can I just trade the 50 minute? Or can I just trade the 1 minute? I mean, you can. All right, you can. However, let me first show you something. Now, firstly, time frames are a different representation visualization of the same price. Now, we already know that. Lower time frames are noisier. They offer us a lot more detail, all right, because they show us more candles. Higher time frames are cleaner because they show less data and compress big information into just one candle, all right? But then again, you think, so okay, so if price is all the same, so if the same thing actually happens on the lower and the higher time frames, then why do I need all of these time frames? All right, so why can't I just trade one? Right now, I'm gonna go to the charts and show you exactly why. All right, here we are on the charts. Let us trade. We are on gold. We are on the 1 minute time frame. So let's trade the 1 minute. I mean, we can trade one time frame. We understand the concepts. What is the market doing right now? Well, it's really nicely bullish. Right above the EMA, market structure is bullish. The market had a 1 minute imbalance here, pulls back, beautiful double rejection. Right now, we are gonna go up because we're bullish. Let's take an entry. We're gonna take a trade like that. We're gonna set our stop loss below and we're gonna go for a profit. So let's do it. The market has taken liquidity. I would expect a rebalance. It actually, oh, okay, it actually made a 1 minute imbalance here. So I was just gonna say I'm gonna take a long from here. Anyway, we took a long either from here or from here and the market just absolutely smashed us. Cool, okay, well, I guess I'm gonna go and trade the 5 minute only. Okay, 5 minute, look. 5 minute time frame, 5 minute imbalance, 5 minute imbalance, and a 5 minute imbalance right here. So the market wanted to test the 5 minutes. So I guess I'm gonna trade the 5 minutes. So let me take a long trade from here. Stop loss I'm gonna place under here. Let's go. 5 minutes. It just absolutely smoked me. All right, okay. So I guess 50 minutes is better. So let me go to the 50 minute time frame. Okay. There is the 50 minutes. So we are pulling back right now into this 50 minute zone and into this 50 minute zone. So now we're gonna get it. So let's say we took a long from here because we're trading the 50 minute right now, and I'm gonna place my stop loss under this swing low, and we're gonna go higher. Let's do it. Let's go. Okay, retested that one. Now we're gonna go. That's it. It's the 15 minute. Let's see. Double rejection successful. We are going. All right, we're going. Let's see if we're going to hit take profit and attack the liquidity. Consolidate. No. Okay, well, we hit stop loss on this one. But we tapped the EMA. Okay, maybe now is the time. But let me first go to the 1 hour time frame. Let me see what's happening on the 1 hour here. What is happening on the 1 hour? The 1 hour is right now pulling back into the imbalances here, and it's taking 1 hour liquidity. Okay, so now it's gonna go up. Now I think it's gonna go up. Let's see if it's gonna retest this imbalance below us here. Let's see. Retested the 1 hour imbalance. Okay, now we're gonna go because it is gonna go from the 1 hour. We failed the 1 minute, failed the 5, failed the 15. That's it. There it is. There. All right. Got smoked again. I guess it's not the 1 hour. Let's go to the 4 hour. Now there it is. This is it, everybody. There it is. The 4 hourly time frame. There it is. The 4 hourly time frame. We took liquidity. on top here, and right now we're pulling back into the floor. I mean, this is it. If it's not this, the volatility time frame, I'm gonna trade the volatility time frame. Let's do it. Entry from here, stop loss right there. This imbalance, that's gonna hold. Okay, it's not the volatility. Well, let me go to the daily then. Let me go to the daily. That's it. It is gonna be the daily. Okay, the daily time frame is taking liquidity right now, but maybe the daily is gonna come here. Maybe there is the daily imbalance here, and then there is the daily imbalance here. So let me see if the market is gonna pull back into the daily, and then maybe the daily is gonna be the time frame that I'm gonna trade. Let's see. Okay, we tap into the daily. Beautiful candle. Let me execute them, because I mean, I failed on the 1 minute, on the 5, the 15, the 1 hour, the 4 hour. Now it's gonna go from the daily, right? It is gonna go from the daily. Beautiful rejection. Great stuff. Smoked again. I mean, I don't know anymore. Maybe I go to the weekly time frame. Now, there it is. There it is. There it is, everybody. The weekly time frame. The weekly time frame is right now tapping, and I think this is really where we're gonna go. This is really where we're gonna go. All right. Take a long trade, reject, and we start going higher. And we went to attack the weekly liquidity. So do you see kind of what I did here? It's kind of a funny example, but I literally intentionally picked this top right here, and I tried to do it on the 1 minute, then the 5, then the 15, then the 1 hour, then the forward, and the daily, and then the weekly. Okay, this is why you cannot trade only the 1 minute time frame, because you just don't know where you are on the macro scheme of things. The market wanted to pull back into the weekly time frame because it has been pushing on the weekly for quite a while. We had weekly imbalances and it wanted to pull back. The daily time frame failed, and it actually guided us here with that bearish imbalance into the daily. The volatility time frame also failed, and it started giving us shorts into this weekly. And of course, the 1 hourly also failed, and it started giving us shorts. But if you don't work with all the time frames, there is no way for you to know that. So I hope this example shows you why you cannot just trade one time frame. So after this funny example, I really hope you understand why we must perform the infamous top-down analysis. You will oftentimes hear in the trading sphere that the hard time frames are the king, or the trend is your best friend, and that is universally true. Yes, for a few reasons. The hard time frames are the time frames that really hold the hard time frame trend, and they're more important than the lower time frames one, because that is what those big institutions follow. They follow the big picture, because the big banks, the big institutions, they're not scalping on the 1 minute time frame. Trust me, they're not. Many of us trade the 1 minute time frame as retail traders, but I really don't think the big guys are staying on the 1 minute time frame and like taking scalps. No, they're looking at the macro picture, they're looking at macroeconomics, macro political economy, and all this type of stuff, and they're forecasting the bigger moves. And this is where they really show us their intentions. And also the hard time frame zones, they hold more weight, and they are the major turning points for an overall trend. A 1 minute imbalance really doesn't hold any importance, because all it takes is just 3 minutes to create. But a weekly zone, now that is where, if you have a weekly imbalance, then that means on a weekly time frame there was that imbalance. So the market comes back to rebalance a very big macro liquidity there. So potentially it's gonna go from there, right? So a lower time frame trend you're gonna spot is most often going to start from a higher time frame zone. So for this, we're going to apply what is called top-down analysis. Simply starting our analysis not from the 1 minute time frame like we did, but from the higher time frames and then down to the lower ones. So first, we're going to determine the higher time frame trend and our higher time frame zones. Then we're going to flow with the lower time frame price action, seeing if they respect those higher time frame zones, all right? And pretty much that's it. So let's right now build the overall process of top-down analysis. Now, first of all, let's talk about time frames. Okay, we already touched on time frames, but now let us very quickly recap it to give a little bit more context once again in our minds. We need hard time frames for the hard time frame trend and the major POIs. Weekly and daily time frames, those are very big major trends and very big major important zones that can cause major moves. Now, a little disclaimer here, I don't use the weekly time frame a lot because I like to take very quick trades. So for me, the weekly time frame, I check it probably once a week, maybe twice, to just remind ourselves where we are, but I really watch the daily. Okay, we also need Middle time frames for POIs. What is a POI? It's a point of interest. That is your zone from where you're going to be looking to take a trade. And for positioning within the higher time frame trend. Now the positioning is going to be extremely important. And for the middle time frames, we're going to use 4-hourly and 1-hourly. Those are going to give us our intraday zones and medium-term trends that are going to give us high probability zones for day trading if day trading is what you want to do. And then we're going to need the lower time frames for entries and confirmation. 50-minute, 5-minute, 3-minute, and 1-minute are the lower time frames that I use to get my entry confirmations, right? And this is basically going to confirm that our middle time frame zones are actually holding. So that's the process. We start from a very big macro trend. We then step it down to really determine, okay, where are we precisely within that very big macro trend? And then we go to the lower time frames to confirm that middle time frame zone. That is how it works, and that is how you build everything into a system. And we're going to talk about all the time frames and what exactly we're going to be looking at those time frames. Okay, so you're going to ask right now, so should I use all these time frames? Well, how to put them all together? Which ones to prioritize? At which time frame to stop? Like if I get this weekly zone, should I stop trading and wait for the weekly to tap? If I get a daily zone, should I trade the 1 hour? If I get a 1 hour, can I wait the daily? And all these type of questions. Now, the timeframes you use are gonna depend on your strategy and your style of trading. So we're gonna go in a little bit of a side quest in a bit to discuss trading styles, because it really matters going forward for you to kind of pick your timeframes. But the model that I will teach you, you can use all the timeframes, because what I'm currently teaching you, by the way, it's kind of a universal language of the market. It's not like a strategy where I tell you, okay, if the 50 EMA is above the 100 EMA, you go long. Sure, that can work, but what I'm really teaching you is a very kind of narrowed down perception of the market. It's not as simple as, hey, if the 100 EMA and the 50 EMA are bullish, we're gonna go long. Sure, but it's not as easy as that. If it was that easy, we're all just gonna be absolutely killing it. If it was as easy as just follow 2 moving averages. No. I give you language that is fractal, which repeats on every single time frame. All the concepts that we have spoken about so far, they happen on the monthly and they happen on the 1 minute, or even if you want to go extreme, on the 15-second time frame. So once you learn the overall market mechanic, then you can use this on every time frame that you want. You have complete freedom. You can choose to just use the weekly, the daily, and the 4-hourly time frame if you want to do a little bit more long-term trading, or you might decide to go lower and use 1 hour, 50-minute, and 1 minute for short-term trading. Okay, so now I'm speaking about long-term and short-term trading, but what actually are those things? So let us go on a little bit of a side quest to talk about the styles of trading. Now, in general, there are 4 styles of trading. We have scalping. That is very short-term, making profit from very small price changes and holding positions for minutes, just quickly, in, out, in, out, in, out. And I can immediately show you, for example, let's see. So just real quick, that is what scalping is. For example, I'm on the 1 minute time frame here, take a short, exit, take a short, exit, take a short, exit. Okay, that's literally what scalping is. I'm not holding for very big moves. I'm just taking, exiting, taking, exiting, taking, exiting. It's literally within minutes. And for this, you're going to be using the lower time frames. You can use, for example, 1 hourly zones, 50-minute zones, and then entering on the 1 minute time frame. Day trading is what I actually do for Forex and for gold. I'm opening positions within the day, usually a few hours. I hadn't held a position overnight for a lot of time. Like, I don't really remember when was the last time that I held a position overnight. I take the trade, and my trade is going to hit stop loss or take profit within the day, usually within minutes, like maybe 15 to 30 minutes, or within an hour, in maximum probably 2 hours max. So that is day trading. You trade within the day, and in general you can probably take like 1 or 2 trades a day, while with scalping you can take 10 trades a day within a very short period of time, right? Swing trading, this is medium term trading, which the aim of which is to capture bigger price swings over a few days to weeks. So for swing trading, you probably want to trade from 4-hourly zones and from daily zones and really hold for those big liquidity targets. And then we have kind of what is called position trading, which is long-term trading. That is holding assets for weeks to months focusing on major macro trends, I would say that this one is kind of going towards investing. So I would say scalping, day trading, and swing trading are really the three main trading styles. This position trading thing, you can see it. This is why I'm mentioning it, so you know what it is. But I would say it's probably better to call it investing. Okay, so you might ask, what's the best one? Well, short answer, there is no best. I'm sorry, but there is no best, because in trading, there is no right or wrong. There is no best or worst. There is no this is the way and this is not the way. Again, as we said, there are a million ways to trade the market. There are a million approaches that you can take. There are a million timeframes that you can use. There is no right or wrong. What really matters at the end of the day is, are you making money? So you have to find out what you like, what you also have time for, which is what is really important, and what your personality is. So for example, there are certain traders that are really afraid to scalp, to drop to the 1 minute time frame. They really panic. It's very fast for me. I don't like it. So these traders are better for day trading or for swing trading. There are traders that, for example, really don't have a lot of time. They're doing 9 to 5. They have kids, they have families, so they don't have a lot of time to spend on the charts. They're great for swing trading or position trading, where you really look at the higher time frames and you have a lot of time to think. Because if you're looking at the Volatility time frame, every candlestick is 4 hours, so you can check your charts once every 4 hours. All right, and this is basically your journey as a beginner, exploring what is out there and finding what truly resonates with you and what you really like doing, and then afterwards you really find your niche in the market. If you want to ask me my take, I would say day trading and swing trading are the most sustainable for most traders if you want to trade the Forex market, commodities, indices, and crypto. Okay, if you want to do position trading, I would just recommend you do investing, because if you're looking like for really long-term swings, then just invest. Focus on learning how to read fundamental analysis for stocks, or maybe invest in gold, or just buy the S&P 500 index when it drops. I mean, it's that easy. For position trading, you don't really have to do that. But if you want to speculate, which is trading, then you got to do one of these three things. And you have to find what. And in my coaching program, for example, I have a call with my mentees. When they finish the whole course and when they're ready to actually start trading, we talk and we figure out a couple of things. Now, this is not in this presentation, but for example, where are you from? What's your time zone? What type of job you're doing? What is your lifestyle? When do you have free time? What is the session that you would like to be trading? And what are your interests? So you want to scalp, day trade, and swing trade. And then based on all of these things, we determine the best time for them to trade. We determine the best pairs based on the time zone that they're at, based on the trading window that they have, that they can allocate to trading. Okay, and so that is how you can also frame your trading approach based on your lifestyle. All right, so styles of trading, a little bit of a side quest here. Now let us get actionable by building our daily analysis process. So the logic and the mechanics. As I said, we already have all the tools and the concepts. Right now it's all about really diving deep and understanding how they actually work and really merging them together. We have market structure, which is the EMA. We have liquidity points, the swing points, swing highs and swing lows, and we have imbalances. Those are the three things that we really need. Then what we have under our disposal is the market mechanism. I believe, that the market goes from liquidity to imbalance, and then from imbalance to liquidity, and then from liquidity to imbalance, or maybe from liquidity to liquidity to liquidity to liquidity until we get an imbalance. So that is what the market does. And I want you to really be logical and try to detach a little bit from these kind of step-by-step system, 5-step checklist, all right? Or this 10-minute strategy is gonna change your life. No, because these things are kind of just mechanical stuff that, again, guys, like, it just cannot be so easy. You have to understand the market, and it takes time to understand the market like I'm explaining it right now. Because I can really give you the strategy kind of, but if you don't really understand the mechanics behind, you're never gonna trust it. So use your logic. Where is the market guiding me right now? Where are we going? Where are the imbalances pointing towards? That's how you figure this out. Where is the market potentially gonna go next then? How do I know where the market is gonna stop? How do I know where it's going to? Well, where is the most recent liquidity point to be taken, or the most recent imbalance to be rebalanced? Logic, right? What is failing? what is holding. A failure of an imbalance would suggest weakness, and then we're going to seek the opposing side of the liquidity. An imbalance holding with a double rejection successful, it's going to mean that it's going to seek the higher high or the lower low. Logic, again. Or is the market not making any sense? Well, oftentimes you're not going to get a very clear read on the market, and that is okay. It is not your fault. You just have to wait. We had a look at a lot of these consolidative conditions where it's just like you just have no idea what's going on. It's confusing. It's not nice. In this case, everybody, it is not your skill as a trader that you cannot read the market. Sometimes you just have to accept that the market is not clear and you're not going to get a clear read, and that is okay. All right, so we're going to use these tools and we're going to just use logic. Where is the market guiding me? Imbalances. Where is it potentially going to? Liquidity or imbalance. Are the imbalances holding? We go up or down. Are they failing? We attack the opposing liquidity. Is it not making sense? We don't trade. All right, easy. Now, the direction and the POI. Now I'm giving you the steps, so watch closely. That is really important. Step number 1, who is currently in control? Where are the most recent imbalances pointing towards? If there are no imbalances, we have choppiness. All right. If there are numerous imbalances but nothing is holding, we have consolidations. Okay, so these are the consolidative conditions. Where are the most recent imbalances pointing towards? If we have a bullish imbalance, we're going up. If we're having bearish imbalance, we're going that. The most recent imbalance is the one that is currently in control. Okay, now the most recent imbalance can be high. We don't know what is too high and what is too low, but let's say, for example, the EMA is down here and then our imbalance is up here. The EMA is another way to determine what is fair value. So if the market is very far from the EMA, it would like to gravitate towards the EMA. Okay, so keep that in mind. If you're very far from the EMA, it's usually not good. But if you have your imbalance here, you have to try. You have to try to go long. Okay, so just a little bit of an extra detail here. Now, there we look. Where is price action in the corners of the 50 EMA? Okay, is it above it? Bullish. Is it below it? Bearish. Great. And where is my most recent imbalance zone? This will serve us as a point of interest where we can potentially look to take a trade from. And then where are the most recent and relevant liquidity targets? Connection lost. Those will serve as potential targets. All right. That's that. So this is basically the step in which we're going to determine the trend and we're going to draw our zones, the imbalances and the liquidity. That's it. So again, read through all of these carefully. Where are the most recent imbalances pointing towards? Overall trend. Are there imbalances? Yes. Then define the trend. If there are no imbalances or the market is just going up and down, consolidation. 50-minute EMA, are we above or below? Okay. My most recent imbalance zone, that is the zone that we want to... Oh my God. That is the zone that we potentially want to trade from. Our point of interest. And then the liquidity is where we can potentially target. So that really gives us like that direction and POI overall. Okay, then the next extremely important thing to think about is the market positioning. So where is price, this shouldn't be where is price positioning in accordance to the market mechanism? So what does that mean? You remember what the market mechanism is. It can do one or two things. It can seek liquidity or it can be offering fair value. But in fact, it's kind of three things that it could be doing. Is the market offering fair value? So is it pulling back into an imbalance? That is the pullback mode. So what you can do, you can trade into the imbalance or you can just wait for the imbalance to tap. Okay, you should then wait for your POI to tap and then prepare for a setup. Or you can trade counter trend towards the POI, but for now, I won't recommend that because it's a little bit advanced. Once you really get used with these concepts, you can definitely look to go what is called counter trend, which is against the trend. The second thing that the market can do in terms of positioning is, has the market offered fair value already? So retested an imbalance and is currently pushing towards liquidity. So that is our expansion mode. If I very quickly try to visualize it, the first scenario is going to be the market has taken liquidity here, and right now there is our imbalance, and right now it is here. So it can be pulling back to offer fair value into an imbalance. The second scenario is we have an imbalance and the market has pulled back into the imbalance. Okay, so fair value was already offered. And right now we're starting to push towards liquidity. So we're somewhere here. All right. That is, by the way, the best place for trades because we already have a confirmation that our higher low is being created. And right now we're starting to move up towards the liquidity. So that is scenario number 2. So if your POI is tapped and the market is starting to go, that is your strike time. That is where you try to go towards the liquidity because in this case, you're basically trying to catch a higher low or a lower high and trade the expansion until a higher high or a lower low is made. You can keep striking because we potentially know that the market is going to take that liquidity. Not 100%, you should never use is or the market is going to do that. It must do that. It will do that. We never know. We never know. Okay, you saw many times I kind of forecasted that a potential liquidity is going to get taken because of a failure of an imbalance, but it did not get taken. So you never know what's going to happen. Nobody knows. All right, I don't know. I've got no idea. All I do is I just show up daily and I play the setups. That's it. Okay. And the third scenario that can happen is, has the market taken liquidity? So has it made a new higher high or has it made a new lower low? Okay, because in this case, what the market could do is it can potentially continue as long as there are middle time frame zones. If there are no zones to potentially continue from, then you wait for the pullback and there should be some sort of an imbalance that then we're going to pull back into. If there is no imbalance, we wait for it to form because then again, we need some sort of a zone. Okay, so let me see. And once you see liquidity is taken and pullback is starting, we are at the offering fair value place, so you can do counter trend. And then if after taking liquidity, again, as I said, there is no rebalance area, expect liquidity to be taken on the opposing side. That is when no new imbalance is created. The market, again, if there is no rebalance, that is just going to go for liquidity because it's always going to do one of two things. It's either going to pull back into an imbalance or it's going to take liquidity. So if there is no imbalance, well, it's going to go for the liquidity. Okay. So basically in this step, you determine the positioning of price. And this gives you pretty much the next step, which is when you're going to decide what you want to do next. So based on the trend and based on the market positioning, you're like, okay, let's take a step back right now. This is where I am. This is the trend. This is the market positioning. This is what I'm going to do next. Then you take the next step, which is the entry potentially, or you just decide what you're going to do. Am I going to wait for the pullback? Am I going to wait for the market to start a pullback? Am I going to take a counter trend trade? And then of course you decide. So let's sum up those steps. Step number 1, who's currently in control? Trend, structured imbalances, POI, most recent imbalance, and liquidity, swing points. Keep in mind, different time frames will have a different trend and positioning. So that is the hard part, by the way, everybody, of this edge, is that you're going to work with different time frames and you really have to master to know where are you in terms of the higher time frames and in terms of the lower time frames, how you are positioned within those. So we're going to try, of course, to explain this. And then step number 2 is, where is price positioned? Is it offering fair value, pulling back into an imbalance? Is it trading towards liquidity, expanding? Or is it taking liquidity, making a new higher high and lower low? And then step number 3 is going to be, what am I going to do? What's the action plan? Based on the trend and the positioning, what are you going to do? In general, the best option for you right now, I would recommend, is to wait for your POI to be tapped and then trade towards liquidity. Just follow the concept, okay? We took liquidity, then wait for the imbalance to tap. Imbalance tap, fair value offered, trade towards liquidity. Liquidity taken, you hit take profit, great. Wait again for the pullback and for the rebalance. So these are the steps summarized. That is basically the process that we're going to be applying. And we're going to do this, okay? But firstly, let us talk about the pairs and the time frames. All right, so our focus pairs, the pairs that I would recommend that you practice, are going to be the following: Euro USD, GBP USD, USD JPY, GOAT, which is XAU USD. And I'm going to tell you why about these pairs a little bit more later when we have a look at time zones and all this sorts of stuff. Now, if you want to trade futures, ES and NQ futures also work great with the concepts that you're about to learn, but they are best for scalping. All right, so if you want to learn a little bit of day trading first, definitely stick to the major pairs. The weekly time frame, we're going to just check for any relevant imbalances and liquidity points. If not, we're just going to read the candle anatomy of the latest candles. So what are the latest candles telling us? Are they really strong or are they weak? And that is going to pretty much determine how the lower time frames are also going to look. If you see a very massive previous weekly candle, that means we're very likely going to have some imbalances on the lower time frames. But if the weekly time frame is pretty choppy and compressed, then very likely we're going to have a macro consolidation, let's say, on the hourly time frame, for example. The daily and the hourly time frame are really the most important time frames because they're going to give us the overall clear direction and the positioning. All right, so there we look for the direction and positioning. We look for imbalances to work with on the daily and on the hourly time frame. And what really increases your win rate is that if you do not have any imbalances to work with on those time frames, just skip the pair. Okay, is there something on the daily? No. Drop to the hourly. Is there something on the hourly? No. Buy. Come back tomorrow, come back next week, because if you don't have anything on the daily, if you don't have anything on the hourly, and you cannot understand these time frames, very likely the market is chopped up and it is not your fault. All right, the market is just currently in compression and you have to wait for it to break out. All right, so after imbalances, you look for liquidity. Where can the market be going next, which is your liquidity? And then on the 1 hourly time frame and the 15-minute time frame, this is where, like, in alignment with the daily and the 4 hourly trend, you can be looking for intraday zones. On the 1 hour and the 15-minute, this is getting slightly bit advanced right now, but we can definitely look into it. And you overall apply the same process here. Again, as I told you, the concepts are fractal. This type of process you can do on every single time frame. But where the edge really is and where the difficulty is really implementing them all together and knowing where you are across all the different time frames. But you literally are gonna do the same thing. It is not very difficult. Okay. So before we go into practice, I want to give you a little heads up, something very important, which is that the market is not always going to give you clear bias. A very big fallacy that a lot of traders have starting out and even a couple of years is social media feeds us a lot of this stuff that there must be a way where you are going to know always what the market's going to do. And in order for you to make money, you need to know where the market's going to go next. And later on, we're going to talk about psychology a little bit. I'm going to give you some books. But one of the key phrases of one of the legends in trading psychology, Mark Douglas, is he said, you do not need to know where the market's going to go next in order to make money. Like, think about it. You do not need to know what is going to happen next in order to make money. But wait a second, like, I have to make bets on where the market's going to go next to make money, right? Isn't that the case? Well, you're going to realize that with time, what he actually means. What he actually means is that you should not be obsessed to say gold is going to go to 5K or gold is going to flush right now to 4K. You do not know and you do not need to know. Because if you just show up in the market and you read the imbalances and you just react to them holding or failing, you literally don't know if it's going to go up or down. But if you just show up and trust those zones, the market is going to show you. This is why you don't need to know, because the market is going to show you. If you only hear it, if you allow it to show you and you don't push your opinion onto the market and try to say it's gonna go here, okay? So trying to always figure out where the market's gonna go next, it is impossible. And just because you cannot figure out your bias right now, that doesn't mean your strategy sucks. That doesn't mean you suck. That doesn't mean the market's gone crazy. No, there are certain periods where the market enters into compression. There is a lot of uncertainty. The big guys and the big investors are waiting for a catalyst, which can be news, which it can be war, it can be too many other things, and the market is just waiting. And it's not your fault that it's not clear. You're not gonna have a clear bias every time. Okay, so that is really important to know. The market is not always gonna make sense, and that is not your fault, so don't blame yourself. It's gonna go through periods of consolidation, choppiness, waiting for a catalyst. Please accept this, because that is a fact. And then what you really have to wait, what I teach my my private members to do, is always wait for the setup that it shouts at you. Hey, take me, I'm here, short me, please. All right. Daily is bearish, hourly is bearish, 1 hour is bearish. You get the entry model, liquidity target is clear. It's like literally boom, 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 boom. It's clear, it's shouting. But if you're like, that one is bullish, but that one is bearish, but it's not making a lot of sense, but I really don't know, then leave it, because it's not shouting. Okay, because that is what essentially makes profitable traders survive, surviving those choppy periods to then later on capitalize on the clear moves when they come. Okay, so this mindset is gonna make you calm, objective, and eventually profitable. So embrace it. And right now, it is time for some chart work. Let us go right now and put the process to the test. All right, everybody, happy times again. We are on the charts. Now, firstly, you can make a watch list by going right here and click on this button right here. And then if you click plus and start typing the different pairs, you're going to add them here. So for example, what I would recommend you do is you type first DXY and add the DXY. All right, so I have it here. It was on top. And then you do the same. You do Euro USD, for example, and I personally use FXCM as a broker because you have different brokers here. Add Euro USD, then type GBP USD, add GBP USD, then you can type gold, which is XAU USD. You can add again FXCM, and then you can add also different pairs that you would like to potentially test. So the weekly outlook that I do every Saturday. So for example, I have this overall watch list. So right now I want to do a little bit of a practice by analyzing all of these major currency pairs. So we're going to start from the weekly time frame. What did I tell you from the weekly? Again, we kind of just observe overall. Let us see what is happening. So what immediately strikes me is that we're taking this very major liquidity to the left. Okay, so I'm going to mark it up. This is a weekly liquidity. Okay, that is taken. What do I expect after liquidity is taken? I expect to rebalance. Do we have a place to rebalance? So where is the most recent imbalance? It is right here. So I can say weekly imbalance. Okay, that is the weekly time frame. We are above the EMA, just slightly breaking it and retesting it from the other side. We have a weekly imbalance, but are we going to pull back all the way to that weekly imbalance? Let us see. Now I'm going to transition on to the daily time frame. Now, what is the daily time frame doing? Once again, first things first. Where is the market pointing me towards? Well, I just look at it. Bullish imbalances, bullish imbalances, bullish. Okay, so we are bullish immediately. You see how fast. I don't need to go and look at market structure and all this sort of stuff. No. Where is my most recent imbalance? There it is. Daily imbalance, and I just have a daily imbalance below this as well. Okay, so in this case, what is going to be my thought process? If the market's going to go higher, it will very likely go higher from these daily imbalances. And then where is it going to go? Liquidity. There is daily liquidity. Okay, and if the market fails the double rejection on these two daily imbalances, then it's going to go to the lower daily liquidity, which is here, and that is where the weekly imbalance is and where the daily EMA is. So that is going to give us a lot of support. Okay, so far I am bullish bias on the DXY. And now I can transition, of course, into the volatility time frame. Okay, and what you see happen here very recently is the market created bearish imbalance here on the volatility time frame, pulled back into it and pushed us into the daily. And as we tapped right now into this daily zone on the volatility time frame, now we know, okay, the volatility time frame is bearish, however, the daily is bullish. So I am going to trust the daily because the daily is a higher time frame. And what I can be looking for right now literally is an entry model. All right. I haven't taught you entry models yet, but the entry model in this case would be exactly right here. If you want to be purely mechanical, where the stop loss below and you would already be hitting take profit. All right. Or what you can be looking for right now is really for, because the volatility time frame EMA is bullish, so the average market structure is bullish. I can be looking right now for a new volatility imbalance right now to get created, which can be, for example, somewhere here. And then I would be looking for the market to continue towards the daily liquidity. So I am bullish on the DXY, and that is my analysis. So what is the action step that I can take right now? There is no imbalance to trade from the volatility time frame. Okay, cool. Can I go to the 1 hour? I can. All right. And then I go to the 1 hourly time frame. And what do I see? Is I see that the average market structure was bearish. You can see the EMA turned bearish here, tried to break, immediately broke back down. Lower highs and lower lows. These are all shorts that you can take. Short here. There is a short here towards the daily imbalance because you know where the market is going. And right now we're exiting very strongly outside of that daily imbalance. We're tapping into this 1 hour zone. So you can even attempt a long trade from this 1 hour zone. What you can target: low hanging fruit liquidity, reactionary liquidity, and then all the way up here. I haven't taught you yet reaction areas in terms of imbalances. So if there isn't any imbalance that is not retested, it is a reaction area as well. Okay, so that is the DXY currently, but I wouldn't really go to the 1 hour time frame. So I'm gonna stop here. I am bullish bias, and I expect the market to take this liquidity and then to potentially go for the daily liquidity as well. If we come a little bit later and the market prints a daily bearish candle to break below this low, I'm gonna be bearish and I'm gonna be looking to target the next daily imbalance and then eventually the daily liquidity. There we go. First outlook done. Let's go to the second one. Delete everything, go to the weekly time frame. This is Euro USD. What is happening with Euro USD right now? Well, I just read a little bit. So here we had the weekly bullish imbalance. The market tapped into that weekly. It tried to push, it failed. It tried to push, and then it failed. Okay, so we had a weekly bullish imbalance here. Let's mark it up. Always build a little bit of a story of the market. We had a weekly imbalance. It tried to go, it failed. It tried to go, it failed. Now, when I saw this candle, for example, here, that is really where the double rejection failed. And then we target the origin of the imbalance, which is here. And then we target the next liquidity target, which is here. And then I zoom out a little bit and I see there is a major liquidity point here. That is going to be our weekly liquidity potentially. But what did the market do very recently is it took weekly liquidity. So what can we expect? We can expect a rebalance. Do we have somewhere to rebalance to? Yes. Okay. So what bias I am on the weekly time frame on EU? I'm bearish bias. We have a weekly bearish imbalance. We're below the EMA. We're taking liquidity. So right now I would expect a potential rebalance. But this weekly imbalance is very far away. Is there something to potentially push price lower on the daily time frame? We drop to the daily. Okay. Same as the DXY overall. The daily time frame is tapping into this daily bearish imbalance. It has a daily bearish imbalance above us as well. So we have two areas to potentially stop price and push it lower. Where is our liquidity? Well, we have this weekly liquidity and then we also have this daily liquidity here. And if you want to go for the opposing liquidity, then it's going to be this within the weekly imbalance. So what is my bias? I'm bearish bias. It's below the EMA. Market structure is bearish. I'm bearish. Weekly is bearish and daily is bearish. Great. And then, of course, you can go to the 4-hourly time frame. There is the daily being tapped. The 4-hourly time frame is reacting from the EMA and it's trying to push down. So right now I can say, well, I want to trade the 1-hour time frame, but I will need to see a 4-hourly bearish imbalance to form here. And then what I'm going to start targeting everybody is the old liquidity levels. That is an old structural point. And then we are literally going to go all the way to the lows. So let's see. I am bearish bias on EU. That's it. Now, can you go to the 1 hour? Yes. Okay. You can be looking for a short from this level. The market just broke structure here. Again, you can use your indicators. See that one? Yeah. There is the last lower low that was broken by this high. So currently we're at a bearish market structure. And also what the imbalance is telling us is that the most recent imbalance is also bearish. And the EMA is being broken and retested from the other side. So this to me right here looks like a pretty good short opportunity. This is the wrong tool though. It should be this one. There we go. Okay. So let's see. And then we would expect this liquidity to get taken, which is the low hanging fruit, the most recent liquidity. And then we have this low, which we took from the 4-hourly time frame. Bearish bias on you. Let's see how it plays out. It's probably going to be the same on GU. Weekly time. So let's do something. Let's do something completely random. Let's do like, I don't know, EuroCat. Let's go to EuroCat. Never looked at this pair, by the way. Weekly time frame, what is it doing? Well, I mean, it was an extreme chop for a very long time, not a single imbalance. Like again, everybody, this is why I don't recommend these cross pairs, because this weekly price action is just ridiculous. We created a weekly bearish imbalance very recently. Now here I would love to see the monthly time frame. What is the monthly doing? Chop, 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 chop. Do we have a monthly imbalance here? It seems... yeah, it seems like there is a very, very, very little monthly imbalance here. Okay, let's ignore it for now. Weekly really nicely pushed. Where is the next potential liquidity? It's here. Okay, that is a swing point. There is a swing point here. Okay, cool. We're right now pulling back. So what did we do? We pushed, we took liquidity. Where did we take liquidity from? Here. And also like very recent liquidity was here. Now we're pulling back into the weekly. So in this case, I can say I really want to see a retest of this weekly and then look for a short from there. Dropping onto the daily time frame. Can I do something on the daily? Let's see. Where is the last imbalance on the daily? It was right here. What did this daily imbalance do? Candle 1 rejected. Great. There is the liquidity that we should have attacked. Rejected. Great. Second candle comes. Candle 2 sweeps candle 1's high. Okay, still good, but then candle 3 breaks above the previous candle's high. So after this candle right here, after this one, this daily imbalance has failed. And what will I target? The origin. So this is the origin, that is the liquidity that created that bearish push. How can we potentially go there? We can go there through the hourly time frame. Now, do we have something on the hourly? Well, we had a little guy right here, a very, very, very small imbalance that ended up playing out. And right now we have this hourly zone that is just being tapped. So I am overall bearish bias in terms of the weekly, but I think on the short term, we can potentially push and come into this weekly. So there is my bias. You see how logical it is. And I don't have 1,000 lies and 1,000 different things. So that is what I would do. Let's check out gold. Let's check out gold. What is it doing? Again, let's even start from the monthly time frame. What is the monthly time frame doing? It is absolutely pushing bullish. Okay. Do we have a monthly imbalance? Let's track it down a little bit. We have a monthly imbalance here. So I would say, for example, here, monthly. Then I would go to the weekly time frame. What is the weekly time frame doing? Okay. Do we have any weekly imbalances? No. All right. What are the last weeks doing then? Down, pushing down, and then this one is pushing down. Where are we then potentially going? So if we don't have imbalances, I would look for some relevant liquidity. And what I immediately see is that just right now, fresh, right now, it took this weekly liquidity. So what I would expect after liquidity is taken, I would expect some sort of a pullback. So I would immediately go to the daily time frame because I don't have anything relevant on the weekly. What do we have on the daily? Where is the last imbalance on the on gold? On the daily, it was here. Okay, it was here. The EMA was bullish against a bearish imbalance, not the best. Okay, but this daily bearish imbalance get tapped, rejected, and just today we crashed where towards weekly liquidity. So right now what I can expect is potentially a daily imbalance that is a little bit advanced, to wait for a whole day to see if a daily imbalance is going to form, retest, and then to potentially go. But what I can also do is I can go to the hourly time frame. We have taken liquidity. Is there a hourly imbalance? Well, a hourly imbalance is going to form in exactly 1 hour and 10 minutes. So this candle is still printing, and very likely we're going to have a hourly bearish imbalance. So I'm overall bearish bias on gold, although what I don't like is that we're just engaging with the EMA that can offer a lot of support and that we have taken liquidity. So I need to see some sort of a rebalance. Where can that rebalance happen? The only potential rebalance we have right now is the 1 hour. So I would wait for this 1 hour to form, get pulled back into, give me double rejection, and then what am I going to do? I'm going to target the liquidity on the bottom. That's it. If this hourly imbalance fails the double rejection, that's going to be my second scenario. If it fails it, then I'm going to go to the opposing side of the liquidity, which is going to be this one. I always give 2 scenarios. And pretty much that's it. Can I give an example on another pair? Can we do indices? Let's see. Weekly time frame on the S&P 500 index. Nothing really important here. In terms of liquidity, this is a very big liquidity point, but very recently, nothing interesting. So I'm going to go to the daily time frame. Do we have something on the daily? Well, on the daily time frame, we have this daily bearish imbalance. But with all of these recent gaps, it is getting a little bit difficult. Like here we have candle 1, and right now we have candle 2. So in general, it is still holding from that daily imbalance, although it looks a little bit funky because we gapped up. Okay, so I am bearish. We are below the EMA. The average market structure is looking like it's going bearish. Like even if I don't draw market structure, I can see that we're making lower highs and lower lows. Okay, so can I go short somehow? Well, I can drop to the 4 hour time frame. Let's see what do we have on the 4 hour. Well, the 4 hour, where is the latest imbalance on the 4 hour?
Connection lost.
We have this here. This was a 4H that did not get retested. Okay. And then the market here had a 4H that is more relevant. And this hourly time frame just absolutely got destroyed. And now we took this liquidity. And the market has right now taken liquidity. And it's potentially rushing towards this liquidity. So I am a little bit more short bias right now on ES, on the S&P. However, I need a bearish zone. Do I have it? No. So can I trade? No, because I don't have the POI. That is a very big step. We need POI. We need bias, POI, and entry. We have a bearish bias. Okay, but can we enter bearish? No, because we don't have a hourly zone. Can I go to the 1 hour? Sure. Although, again, I don't recommend it. There is a 1 hour zone. So maybe if the market pulls back into this 1 hour zone and gives us a short, that can be a potential short. If not, I have to wait for this volatility to form in 1 hour and 10 minutes and then maybe look for a pullback. So that is how I would tackle it. So this is how you build bias. Like that is how you do it. Let's do one final one, USD/JPY, and we're done. Weekly time frame. What is the weekly time frame doing? Well, we just took very major liquidity. So usually liquidity you see is the first thing that I spot. Weekly liquidity taken. The most recent imbalance is bullish. Oh my god, this thing is just keep disconnecting. We have a weekly bullish imbalance. Okay, great. In fact, we even have one below. Okay, great. What has the market done the last? It has taken liquidity. So what would I expect? I would expect to rebalance. Does it necessarily has to come back all the way into this weekly to rebalance? No. So I'm gonna go to the daily time frame. Do we have something on the daily? Where is the most recent daily imbalance? Let's see. I see a very clear daily imbalance here. And I see, is there an imbalance here? Let me double check. Yes, there is a very small one. So let's draw it. There, a daily bullish imbalance. Now what is happening? Candle 1 taps. Okay, candle 2 sweeps candle 1's low, still valid. And then candle 3 sweeps candle 2's low again, still valid. We haven't really failed the double rejection failure. All right, we haven't failed it. And we almost, it's almost tapped into this one. Okay. The market has pulled back to rebalance. What do I expect it to do next? To go for liquidity, which is going to be... Oh, shit. What is that? Which is going to be this weekly daily liquidity. So then what I can do is I can transition into the 4-hourly time frame or even into the 1-hourly time frame and find my way towards this liquidity. Like look at the 4-hour EMA. Beautiful kiss of the EMA. Beautiful response. Right now, the market is taking this liquidity. We can wait for the market to make a 4-hour zone, which is going to make in just 5 minutes, in fact. It's going to close this 4-hour zone. Then I'm going to be looking for a pullback, entry confirmation, and going towards the liquidity. You see, I'm bullish bias. Weekly is bullish, daily is bullish, and the 4-hourly time frame right now is bullish. Could we have taken a long trade so far? Yes. There is a 1-hour zone. You can potentially take it from here after we pulled back into this daily zone here and capitalize on this. Right now, there is this 1-hour zone, okay? But this 1-hour zone is going to fail if the market would like to retest the 4-hour. So we gotta see how it happens tomorrow. So that is how you do bias. Start from the weekly, liquidity, imbalances, trend. Go to the daily, liquidity, imbalances, trend. And by that time, you should have an idea of potentially where you want to trade. And then on the 4-hourly time frame, you really see the positioning of price in terms of the daily time frame. So in this case, I see the daily time frame has rebalanced. Great. And now the market is in a push phase towards the liquidity. So it has offered fair value. Right now, I think it's going to go towards this liquidity. So I can use the 4-hour, the 1-hour, and the 50-minute time frame to really look to trade towards that daily liquidity. That is what I would do. And I would always flow. If the market shows me bearishness, if the market shows me a failure of this volatility zone with a double rejection failure, I will then attack the opposing side of the liquidity. Because again, you don't need to know what is going to happen next. I do not need to tell you right now it's going to go to the daily because I have no idea and nobody has an idea. Nobody knows. All right. But if it pulls back into my zone and gives me an entry confirmation, I would go long. But if it pulls back into my zone and fails to give me an entry confirmation and gives me a volatility double rejection failure, I'm going to go short. All right. And then I'm going to target the liquidity on the bottom. So what you're going to see in my weekly outlooks that I publish every single Saturday is I'm always going to give you 2 scenarios. That is what I would love to see for bullishness. And that is what I would love to see for bearishness. That is how you do proper bias. Right now, let's talk about the next thing that is very important. All right, fanatics. So I intentionally waited a little bit, even less than a day. And right now we're going to have a look at the exact pairs that we analyzed for our daily bias practice and to see how they actually played out and how we would do it again. So we're going to start with the DXY. I have left everything as we last did it. We had weekly bullish, daily bullish imbalances. We pull back into the daily bullish imbalance. We have a successful double rejection right now, but this day hadn't printed at that time. What we then said is, okay, we're starting to react from the daily and we would be looking for longs. Where can we then potentially go? We can attack this liquidity here, and then eventually we found this little reaction area where we said the market can potentially stop. So look, right? The market gave us 1 hourly bullish imbalance here. This is our long trade. We massively push. We attack the low hanging fruit. We attack the reactionary liquidity. We come into an imbalance reaction area that gave us the pullback. So beautiful play out. How we would flow right now, we would again go to the daily. Okay, do we have something new on the daily? No, the daily is beautifully pushing. What stage are we at? What is the market positioning here? Where we are traveling towards liquidity. So what do we want to do? We want to trade towards the liquidity. How do we do that? I delete all of this and I go to the hourly time frame. What did we have? We had a hourly bullish imbalance. Great. What is the low hanging fruit? Hourly liquidity, and then where do we go next? This hourly reaction area, and then ultimately the daily liquidity. And what you can do, of course, is you can even go to the lower time frames to look for confirmations. There is, for example, a 1 hourly bullish zone, so you can potentially even be long from here like that, first targeting this liquidity and then ultimately looking for the upper ones. So you see why it's so important to start with a hard time frames, seeing that the weekly is really nicely bullish, but then is the market gonna pull back all the way down there? We check the daily. The daily has a daily bullish, beautiful double rejection. The hourly is giving us bullish right now, beautifully targeting towards liquidity, and even the 1 hourly time frame is agreeing with us. The AMA is bullish on every single time frame, so we're really looking for nice long bias on the DXY. So what were the other pairs that we analyzed? We had a look at EU. Wow, look at that. We plotted the sell from yesterday. Beautiful take profit. Where? At the liquidity. And if you want to be even more precise, again, as I told you, always look for those unretested imbalance zones that can potentially get tapped. Now this one here, this one actually got tapped here, so this one is retested. Where we can stop next is potentially these two zones, these two very small 1 hourly reaction areas. Just right now we're tapping into this one. But look, beautiful. This is actually the entry model that I'm about to teach you. We were bearish on the weekly, bearish on the daily. We pull back into the daily, bearish, great. On the hourly time frame, we didn't really have anything to work with, but the hourly EMA beautifully held price, beautifully. 1 hourly time frame gave us the bearish imbalance and a break below the EMA. Now, I don't really need to look at market structure right now, because if you broke below the EMA, I mean, that is great. Retested, beautiful push lower. Look what the market does. It continues. What is this here? It's a 1 hourly bearish imbalance. We took liquidity, where? Under here. Then we pull back to rebalance. Great. What are we doing right now? Taking the low-hanging fruit once again. There is even another 1 hourly zone that could have been traded. And most importantly, however, there was a 4 hourly bearish zone. There it is. 4 hourly bearish zone. From the 4 hourly bearish zone, I'm going to give you the entry model very soon, but you can be entering right here on the break of the EMA as well. And you're looking at a really massive risk to reward. Okay. So a really nice play out. So what we would be doing right now is we're just flowing with the imbalances. We can look for a new hourly to form, or right now we can be looking for a new 1 hour to form if this 1 hour forms, because right now, where are we? We're taking liquidity right now. So we need to see a pullback. We're not going to chase price. We need to see once again a pullback into the 1 hour and then to potentially continue. And where are we going to go? Well, probably towards these lows here, because these are really our ultimate liquidity points. There is nothing else. There is nothing else apart from these two lows. So I believe long term, we're going to go here. So Euro USD, beautiful play out. We didn't look at GU and AU. So we looked at gold. Wow, look at gold. All right, beautiful flush. What did we say? Well, we were bearish on the daily. Bearish on the daily, pulls back, beautiful push lower. Where do we go? Weekly liquidity. We marked it up. Hourly time frame, what did we have? We had a hourly bearish imbalance. All right, and then I said if that hourly bearish imbalance fails, we're going to go up. But if it holds, we go lower. Where do we go lower? Low hanging fruit right here. And where are we going to go right now? Zoom out a little bit. There is our most recent major liquidity point. If you go to the 1 hourly time frame, so what happened after we made this analysis? The market actually retested that hourly zone, and from there it gave us this 1 hourly bearish zone. But then what happens? We take liquidity under the low hanging fruit, the most recent liquidity point. We take liquidity and we pull back into that 1 hour imbalance. And what happens from there? Absolutely plummeting, taking the most recent liquidity here. And right now we are literally going for this ultimate low. How could you have traded that 1 hourly zone? I'm going to teach you very soon by dropping onto the 5-minute time frame. And there's your entry, basically. right? I mean, that is a little bit crazy. Now you should definitely wait for the EMA also to get broken. So very likely you can be even looking for an entry like that with a safe stop loss. Let's be a little bit more objective like that, but that is a great trade. That is a really great trade. And if you hold that trade, I mean, just absolutely crazy. That was during Asia though, unfortunately for me. And what else did we have? We had a look at indices as well. We had a look at indices. Now this one again, what we said is that we are overall bearish. Why? Because on the daily time frame, we had this daily bearish imbalance, and this is candle 1 inside the daily bearish imbalance. Then candle 2, you can see at the end of the day, ends up flipping bearish. So I am still bearish towards this daily low and potentially towards this low. Now, how did the market play out? What did we want to see? We wanted to see a 1 hourly pullback. Unfortunately, the market didn't give us that 1 hourly pullback. So did we take a trade? Unfortunately not. And then the market just plummeted. In this case, you can be looking for 15-minute retests, but I don't even see the 50-minute. So how are we going to flow with it today? Okay, do we have something new on the daily? No, but the daily is bearish. Okay, do we have something on the 4-hourly time frame, however? Oh, yes, we do. There it is. We're having a 4-hourly zone here, and then we have a 4-hourly zone all the way up here. Now, in this case, I would prioritize this 4-hourly zone. Where is my most recent liquidity? Here, and then a reaction area here, and then ultimately this low. What is the current market positioning? We pulled back to offer fair value. So what are we going to be doing right now? We're going to be taking liquidity. The market pulls back into that 4-hourly zone. There it is, pulls back into the 4-hourly zone and gives you the entry model with a 15-minute imbalance. Price is below the EMA, and then where do we go? We go towards liquidity. Almost took it for a 2R. Okay, and then we're just going to continue flowing, right? Do we have any 1-hourly imbalances? Are we going to be making new 4-hourly imbalances? And we're just going to flow with price. But you can see all the analysis that we did ended up playing out. Now, I did make another one, but I don't remember which one it was. So I'm doing this freshly right now in the morning on the next day. I should have checked, but anyway, all of these major ones that we had a look at played out. So I hope that was insightful. Now let's go back to the knowledge. 8 hours in. 8. Congratulations to you, but it's time to take a pause, scroll down a little bit and hit subscribe and hit like and leave a comment. What are your thoughts so far? Are you finding it insightful? Are you loving it? Let me know, because it would mean the world to me and all the work that I put into it. Thank you, and let's get back to the video. All right, fanatics, we are back at theory. I'm sad when we go back to theory because I want to get on the charts, but we're also going to do that soon. So let us talk about the concept of time. Really important concept, and there are a couple of aspects of it. So let's talk about it. Have you spotted that price moves at very specific times, right? And also for a big move to occur, price is gonna need some sort of a catalyst. You have spotted that a lot of times the market kind of consolidates, and just goes. Like, have you asked yourself why? It is usually most often due to time. Because no matter how perfect a technical setup is, if you take it at the wrong time or if you take it at a bad time, it will hit your stop loss and it's gonna leave you wondering why. So, what is time? Time is volatility, volume, and bursts of liquidity. All right. So when do we usually have these big moves? When does the market get clear and trending? During specific times when there is volatility, volume, and a burst of liquidity into the market. And there are two types of time categories. We have macro time, which is your economic calendar, your commitment of traders report, your major economic drivers, weeks of the month, day of the week, and all this type of macro timing. And then you have the micro time, which is the time of the day. Okay, so that's a little bit of an intro. Now, why is time important anyway? Should we really need it? Yes. So trading, first of all, is all about capital preservation, how to lose less. And I want you to put yourself in the shoes of an investor who has a lot of money and you want to invest $100,000 into a trader for him to trade with your money. Which trader would you choose? Trader A. He trades every day. He takes 10 trades per day. He loses a lot, but somehow always manages to come out with profit at the end. All right. He trades all the time. You're constantly stressed, like a little bit uptight. And then there is another trader who trades 3 to 4 times per week, produces small but consistent results without very big drawdown swings. Which one would you pick? Well, probably trader number 2. Why? Because he trades smartly and he uses time. He trades for 3 to 4 times per week, knowing exactly when to trade. And the other benefit and why time is also important is because it's going to give you routine and knowing at what time to show up and focus and then when to relax. I think it's a really cool thing. You kind of really can determine, this kind of dream thing that is being sold online. All right, I'm done. I made $1,000 by 10 a.m. So now I can go and enjoy my day. That can actually be true. Because if you focus at exactly the right time and you take exactly the right setup and you get in and you get out, that's it. Why would you continue to push yourself further when time right now is no longer on your side? All right, so that is a really key thing. And you also avoid the low quality times, which protects your mental capital, emotions, and saves you money. If a trader stares at the charts for 10 hours all day, he will eventually force trades and he will never win long term because he's not gonna have an edge. Something that I realized really late in my trading is that actually having precise times at which I would trade is giving you a very big edge over the others. Because a trader who trades all day, he doesn't have an edge because we are human beings. We cannot focus for more than, 2 to 3 hours with high quality focus at a time. So if you start doing 4, 5, 6, 7, 8 hours of trading, you're not going to be able to take the right trades and very likely you're going to make mistakes. So there is edge within time. Certain times of the day and certain days are going to move better than others. And if you know this, it's going to give you an edge. All right. What is an edge? It's putting the odds in your favor to win a trade. That's an edge. And if you're consistent with your routine, it also gives you an edge. Why? Because it's repetitive. If you know that every single day you're going to show at that time, if you know even before the week has started that, for example, Wednesday is not going to be a trading day or that Thursday is going to be the best trading day, you know how to frame your week. That gives you routine and it's going to make you professional. So let us talk about macro time. Now, macro time is the big picture and you can go very big with it. You can go as big as you want. You can think election years. You can think like midterms. You can think crisis, wars. Something at the time of this recording, we have the Israel and Iran war, bombings, and the market is really moving very fast. We have global policies. We have interest rate differentials and we have different macroeconomic things. All right. So this is what we call fundamentals. And many traders believe that this is what essentially moves price, which is kind of true, but it is just part of the equation because different people perceive different things, right? So somebody can say this is that is what the election year is going to do, but some guy says this is what the election year is going to do. So who's right? Nobody's right. At the end of the day, it's supply and demand. The collective of traders really deciding if an asset is expensive or cheap. And what I believe is that price is a direct representation of the fundamentals and the sentiment of investors. And what you're going to see is that price usually moves way before even the fundamentals are a fact, which is when we say, you're going to hear this term, it's been priced in. So what you really like, this is everybody really important. You're going to hear also another thing, buy the rumor, sell the news. So price action, what we see on the chart, is a future anticipation of the value of the asset you trade. So right now I'm opening gold, all right? And for the future, I expect it's gonna go down, okay? But so if, for example, right now we think that the Fed is going to hike the rates and we think that this is going to be bullish for the dollar, even before they hike the rate, I'm going to buy the dollar. And then this causes price to move. And when they actually make the announcement that they're going to hike the interest rate for the dollar, then the market can sell off. This is why. Buy the rumor, sell the news. So different fundamentals are already being priced in, and usually the release of those fundamentals is already too late. So us retail traders, we don't really have a very big edge relying on these type of fundamentals. For example, a stock market crash begins happening, but by the time the news actually announce we are in a crash, the market has already reversed. And by the time the market says we're outside of the crash, the market's already made new all-time highs. This has happened all the time. COVID, I lived it. The recent tariff crash, I lived it. And even the 2022 kind of consolidation, I also lived it, right? It's always late. This is why I'm not very big on the fundamentals, but they can be important because I believe by the time it's in the news, it's too late. You're already late. And there are different, like the big boys, they do have information before us. So we don't really have an edge there. So what I believe personally is that if you can read price, you don't really necessarily need to understand fundamentals that deeply. It's just a good add-on. All right. So if you're a scalper or a day trader, it matters even less to understand macroeconomics and macro drivers because you just want to get in and out for today in the next 15 minutes. How would knowing the interest rate differentials and where the GDP is growing and if there is a deficit or a surplus or this or that is going to help you catch this small move? Not really. If you're an investor or a long-term trader, sure. But still, we would like to learn about the macro time components that are going to be important for us, because knowing these things can still give us an informational advantage. So let's have a look at the most important thing that we should look at constantly as day traders. That is the economic calendar, because news releases are catalysts for price movements. And to track the news releases, we will use the economic calendar. I use the calendar on forexfactory.com. If you have the slides, which you will do if you download the resources, you can click on this link and it should take you to this website. Now, the economic calendar is going to help us frame our week so we can potentially know when to expect a big move. Now, there are a couple of key economic news releases that you should be watching out for any currency that you trade. Now, I mainly trade the USD and I mainly monitor the USD because the USD currently is the world currency, right? The reserve currency. So it is the news releases for the US dollar is what really causes the whole markets to move. And we have pretty much interest rate decisions, monetary policy and central bank press conferences. We have the Federal Reserve, ECB, European Central Bank, Bank of England, Bank of Japan, Royal Bank Australia. These are all the central banks. And when they announce their monetary policy, which is the interest rate, usually price goes very volatile. Actually, at the time of this recording right now, in just 45 minutes, we're going to have the Fed announcing the interest rate and having the press conference. So we're expecting big volatility. Then we have Consumer Price Index, very important, CPI, Producer Price Index, PPI, Manufacturing and Services, PMI, Personal Consumption Expenditures Index, Consumer Confidence. These are more price-related things, right? How much does it cost to produce? How much does it cost to manufacture or service? What is the expenditure of the personal expenditures that people have? How confident they are? And Consumer Price Index is literally inflation. How is a basket of things growing? All right. So these are kind of for inflation. Then we have non-farm payrolls or non-farm employment change. And then we have unemployment rate, unemployment claims, and new job openings. So these are the job market, because essentially kind of an economy is determined with their inflation and the job market. If the job market is really strong, great. But if inflation is really high, not great. If inflation is really low, great. And if the job market is strong, amazing, right? That's the best thing that a country can have. So a combination between these things can give you an overall picture of the economic situation of a country. And then we have retail sales and gross domestic product, GDP. These are the key economic news releases that you should watch out for. Do you need to track all of the stats? Not necessarily. How I personally do it is I just look for these news releases. I know the time at which they're going to get released, and I can trade before that expecting volatility, or I can just wait for them to pass. And now I'm going to tell you when to wait for those news releases to pass, because there are the top 3 dangerous news releases that you do not want to trade before. That is non-farm employment change, also known as NFP, non-farm payrolls. It is released the first Friday of a brand new month, okay? And that is the best evaluation of the US job market. How many new jobs outside of the farming sector, this is why it's non-farm payrolls, were created, all right? Investors and traders really look for that news release, and usually it goes very volatile. Then the next top 3 is the federal funds rate, right? So the interest rate for America, the dollar, all right? And the FOMC statement. The FOMC is Federal Open what was FOMC? Federal Open Meeting Committee, I think. Yeah, something. So they gather the Fed, the FOMC, and they speak and they say what are their expectations for the economy and for the currency and the interest rates and all of this type of stuff, because the interest rate is the main driver of any currency price, and the USD influences all pairs because majority of the pairs are linked to the dollar. Those are the major pairs. And we also hear what the Fed chair at that time is Jerome Powell, but very soon it's gonna be changed. Has to say about the economy, what is their plan, and that also gives investors a hint about what the central bank thinks where the economy is going to go, so then you can position yourself accordingly and then start taking positions based on that. And then we have the US Consumer Price Index, the US CPI. This is the main measure of inflation. So what is the action plan for those news releases? We do not trade on the day of those news releases, because volatility is going to slow down before the news release. And when the news release is actually released, there is like, we call them Star Wars candles. So we wait for those news releases to get released, all right? And then we trade. And in general, the day before these news releases is a little bit tricky, while the day after the news releases, it is really volatile because the news is out there and traders and investors can start positioning themselves accordingly based on those news, okay? Hopefully this makes sense. You can do a little bit more research, of course, on all of these news releases, but right now, let us set up your economic calendar. So I'm gonna open up my browser right now, and we're gonna go to forexfactory.com/calendar. Or if you just go to forexfactory.com and you go right here, calendar, you're gonna be good. I would recommend that you make a registration, okay? Make a registration because that is going to save your calendar settings. And now what we're gonna do is, let me see how it looks like. So we are going to click right here on this funnel, all right? And usually we're gonna have everything selected. It's probably gonna be like that, and it's gonna be a little bit of a madness, all right? So what we're gonna do is we're gonna click on filter. We're going to remove this. That is low impact news. Those are news that are being released, but really they don't drive any volatility in the markets. I personally keep the medium impact, but the high impact, those are really important. Event types, we click O, we want to see everything. Default view, we want to see this week. And then for the currencies, basically, you can select all the currencies that you care about. Now, personally, I have only removed the Chinese yuan here because I don't trade this one. And then you're going to click apply filter, and you're going to get exactly the same calendar that I look at every single week in the weekly outlook. Okay. And then of course you see, so Monday here we have Canadian CPI, very important. On Tuesday we have Australian dollar interest rate decision. So very important if you're trading the Australian dollar, and then their press conference. Then we have today, we had US PPI, very important. Okay. Producer price index. It was positive for the dollar. So what do we see? If I very quickly go, wait a second, I have a chart here. If I very quickly go to the dollar, it went up. All right. So look, the news release got out. Boom. We go very nicely up, which is great. Okay. And just right now, in just 40 minutes, we're going to be having the federal funds rate. So today I'm not trading. Why? Because I'm waiting for this. And then you can see tomorrow we have interest rate for the Japan, interest rate for the pound, interest rate for the Swiss franc, and then interest rate for the euro, the press conference as well. So a very big day tomorrow as well. Now, how I would frame a trading week, so we can click here and you can look the next week. So what I see right here is that Monday there are no news. I have nothing to worry about. I can just focus on price action. On Tuesday we have Euro PMI, and these are red. So these we have to pay attention to. Euro PMI, GBP manufacturing and services PMI, and USD manufacturing and services PMI. Are those news in the top 3 that we just covered? No. So can we trade before them? Yes. All right. And we can expect that this is going to be a catalyst for a very big move. On Wednesday, we have Aussie CPI. So if you're trading the Aussie, watch out for that. And then we have GBP CPI. So if you're trading the pound, also watch out for that. On Thursday, we have unemployment claims. Great. It is not in the top 3. So that is definitely going to bring us some volume. And then on Friday, we have retail sales for the pound. Great, it's not in the top 3. And then this one, consumer sentiment, also not in the top 3. So basically this week, we don't have anything to worry about because we don't have any of the top 3 news releases for the US dollar. Now, if you're trading the Aussie dollar before CPI, you probably want to wait for CPI to pass and then to trade it. All right. And you can do the same for next week. Check it out. Bank holiday is really important. We do not trade on bank holidays, especially for the US dollar. If there is a US bank holiday, we do not trade because the US is the biggest market. The stock market is opening in the US. So if the US is really off, we don't want to trade. But in general, when you have bank holiday, okay, don't trade because literally the banks are closed. And if the bank is closed, if they're not going to be trading, why would you trade? You cannot move the market. All right. There is non-farm payrolls here. This week, we're going to have non-farm employment change. All right. Everybody's on a bank holiday, but the US are going to release NFP. So definitely not a... So you see, from here, I know I'm not going to trade on Friday because it's NFP and it's bank holidays. Not going to push my luck. Okay. I can trade. On Monday, I can trade. There are no news. On Tuesday, I can definitely trade. There is this job openings. It's not in the top 3. I can trade. On Wednesday, manufacturing PMI, I can definitely trade. And on Thursday, employment claims, I can definitely trade because we don't have any of the top 3. And on Friday, it's the top 3. I skip. And this is how I frame my week. Now, you can definitely go more in depth by clicking, for example, here the statistics. And yeah, you can pretty much zoom in. You can see, for example, the job market has been going down. So since pretty much 2020 here went down, and it has been kind of declining, which is really not great for the US. And we have been lingering right here. So then fundamentally, if we see a pop with a lot of jobs being created, that is going to be really bullish for the dollar. But if we see a decline, that is going to be really bearish. That is how, in general, you can kind of really read those news. You can see actually the last news release here was bearish. We had negative, so we actually didn't create any jobs. In fact, we closed a lot of jobs. Not good. This is not good for the economy. All right. And this is why we have been seeing the DXY. If you just zoom out, for example, on the daily time frame, it has been in an overall kind of downtrend. Okay. So that is the economic calendar. Set it up, do it like I did it. And right now you're ready to frame your weeks and you know when to trade and when not to trade. Right now we're going to discuss micro time. All right, so next we're going to talk about the other aspect of time, that is micro time. So what is micro time? Those are your intraday sessions. We have Asia, London, and New York. Those are literally the 3, pretty much the 3 sessions. Now you can spread Asia with like Sydney, Australia, and Tokyo. London, you can spread in Frankfurt and London, and New York is basically New York, but you can spread it at New York Open and then New York Stock Exchange Open, but it is a whole like session, okay? So sessions are what provide us with the intraday volatility. So specific times of the day are set to be market openings. That is when settlement banks, clearing firms, banks are starting to do their work. You can actually research on that. There is a thing called FedWire. There was a thing like with the clearing firms, right? You can research on these things. And if you also have a look at the actual pit openings. So when does really the pit where the traders are actually doing their work opens? It mainly opens at New York and they have different openings. So for Forex, it's like 8:20 Eastern. For gold, it's 8:20 as well. For the DXY, it's 8. So basically the New York session is going to be the best session based on everything. So now sessions are going to help us frame our day based on where you are located. So it's best, for example, if you use sessions, it is best for intraday trading and scalping, anything below the 1 hourly time frame. And I mean, if you're taking trades on the 1 hourly time frame, you are very likely kind of more towards day trading / swing trading. But if you start taking entries or even looking for zones under the 1H, now you're definitely an intraday trader getting towards a scalper. While for a swing trader, you can definitely be more relaxed. You shouldn't be paying that much attention to the sessions because the sessions are mainly important for the intraday traders because we're going to be working with small stop losses. So we want to ensure that we get exactly at the right time so we avoid getting stopped out. So what we have to say, however, is that news are more important than sessions because news and the fundamentals are what basically drives the market and gives the market the direction. And then when you pair this with micro time, you get this really nice pair of the 2 timings. Because if there are no news, then micro time is going to still give you volatility, but you're going to spot that it finds it really hard to actually go somewhere. So for example, if you have London Open, it might make a nice move up, but then it's immediately going to return back into the range and you're going to be like, oh, that was a fake out. Well, yes, because when there are no news, which is basically the thing that the market uses as a catalyst to make the big move, the timing is going to bring some volume, but is it going to commit? that is another thing. Okay, so always make sure to combine news, macro time, with sessions, micro time. So what are the actual timings? Let's talk about the sessions for Forex. The sessions all are in New York local time. All right, so that is New York local time. Depending on when they go in daylight savings time and when not, always these sessions are going to remain at that time. So what I actually recommend you to do right now is, if you go to your charts, I'm on the charts, but I have to remove my face for a little bit. Down right here, you click on the time zone, and doesn't matter where you are. Let's say, for example, you're I don't know, here. Okay, you UTC +3. You go to New York. So it doesn't matter. It can be -4, it can be -5. Okay, you click on New York, and that is going to make your charts with New York time. It might be a little bit confusing, but it is okay. This is going to ensure that you're always like trading at the right time. And I would just recommend you to memorize the New York timing based on your time zone. So for example, I know for myself that London Open for me, for example, is 10 a.m. in the morning. All right. But EST time, New York time, it's 2 a.m. in the morning. Okay. So make sure to do that. London session starts from 2 a.m. again, New York time, until 5 a.m. Frankfurt opens at 2, and then London opens at 3. And basically, you can get initial volatility in Frankfurt, and then London can definitely bring in some more volatility. But basically, the session is from 2 to 5. Okay, it is a 3-hour window. And then from 5 to 6, again, New York time is what we kind of call lunch hours. That is low volume and a little bit of a slow price action, because right now we transition from London into New York, but they're actually going to overlap, because this is what is called online, you're going to see it as a kill zone. So it's like 4 hours or 3 hours, and usually at the beginning of the session. Now, London pretty much opens, let's say, at 8 a.m. London time, and it's going to close at 5 p.m., right? So they are doing like 9 to 5 or 8 to 5, all right? But the actual volatile times are going to come at the beginning. So New York session, now this is, by the way, my Q zone. New York, the true New York Open is at 8. All right, it's at 8 New York time. Then we are going to have news releases at 8:30, and also a lot of the pits of the futures pits are opening at 8:20. So the really good window to start trading in New York is actually from 8. Okay. However, what I have spotted from a lot of experience is that the market wakes up a little bit before that. Hence, I always start like 1 to 2 hours before that 8 o'clock. So I'm going to start checking the charts at 6 o'clock, again, New York time. Always, I will check it out at 7, because sometimes the setup is going to get provided, let's say at 7 o'clock or 7:30, and then when the volatility kicks in at 8, it goes to take profit. So you have to be prepared before that. And it usually goes from 6 to 10, but you can definitely enlarge it to 11 as well. All right, because 10, it is still a really good timing. That is a really good time for futures, especially. So if you're trading instruments like gold, for example, they tend to move a little bit more. So for the US session, you can be a little bit flexible. You can definitely push this 10 a.m. a little bit forward. Okay. And then Asian session is from 18 o'clock until 2. So until 2, which is basically when London starts. The first 4 hours of Asia are the best. So if you're trading like from 18 o'clock, if you can do that, then trade until like, 22, 4 hours. And then after this, it usually slows down because the move is already done. Asia is really good for specific instruments, which we're going to be talking right now. But keep note of these timings, and we're also going to set an indicator for you so you can recognize them on your charts. Now, let's talk about the pairs and their timings. We have the London currencies. So we have Euro, GBP, and Swiss franc. Now, why are they London currencies? Well, because they're based in Europe. Okay. And in London session, you can mainly trade Euro USD and GBP USD. They're really nice pairs. You want to avoid trading them in Asia because they, the majority of the times they're going to consolidate in Asia. So only focus on these 3 currencies. Okay, so that is Euro USD and GBP USD. You can do USD Swiss franc if you want. London session is great for those currencies. Then we have the New York currencies. Which are the New York currencies? Everything Everything in the market moves in New York because New York is the best session. Everything is gonna move at that time. The USD, the euro, the pound, the Australian dollar, the yen, everything is gonna move because that is when really all the markets are kind of operating together. Okay, apart from Asia. So Asian session doesn't really overlap with New York, but then we have London and New York overlap, which are the two most volatile sessions. All right, and then literally all the futures pits are opening. That is when really all the activity happens. So if you have a look at when the biggest moves are happening in the market, which I'm going to show you in a bit with a tool, you're going to see it's New York. So basically you can trade everything in New York. And then we have the Asia currencies, which are the Australian dollar, the New Zealand dollar, the Japanese yen, and gold. Gold recently has been working great during Asia. Why? Because Japanese and Chinese central banks are buying a lot of gold or selling a lot of gold. And we have had amazing, incredible moves in gold. A lot of members from my private program that are trading gold during Asia, they're just absolutely smashing it day after day. They're printing money. Myself, for me, in my time zone, the Asian session starts at 2 a.m. So 2 to 3 a.m. in the evening, and I'm not willing to wake up because I'm not willing to sacrifice my sleep to wake up and trade Asia. No. All right. So what you want to do is avoid trading Asian currencies in London because usually then if those are Asian currencies, they're going to move very nicely in Asia, and then they're kind of stop trading a little bit in London, and they might wake up in New York again. So the main thing to pretty much know is don't trade London currencies in Asia and don't trade Asian currencies in London. That's it. New York, you can trade everything. That is the best session. If you can only trade one session, I would say New York. Now I want to show you something interesting that you can definitely look for yourself. So let's go to the browser. Okay, so here we are in an interesting website, which is marketmilk.babypips.com, and then currency volatility. So what you can do is you can go here, currency volatility, and then you can basically check for all the different currencies and when they are moving the most. So if I click, for example, on the US dollar, this is gonna give you some tutorials right here. And then if we go to, let me see, I don't want this. Let me see what I actually want. Volatility, but on the daily time frame. Okay. There we go. This is exactly what I want. So I got so many things, but I don't want NZUSD. I want a major pair, let's say Euro USD. So what you're going to see right here is that you can sort volatility per hour, let's say in the last 3 months, to really see a bigger sample size. This is all sessions, London, New York, Sydney, and Tokyo, and all hours. What you're going to see here is the percentage move, all right? And you can see, like, when does the big move happen? It happens right here. What is that? That is New York session. So New York session starts here from 15 o'clock. That is GMT +2. That is my time zone. So absolutely yes. 15 o'clock my time should be 8. Should be 8 o'clock in the morning New York time. Look, that is when the majority of the move happens. This is London session. This is Frankfurt, London open, and then pretty much the 3 hours that I gave you. Nice move. Then you can see the 2 hours that it dies, and then it starts picking up from here. This is why I told you start trading New York session a little bit earlier. All right, and then you can see we get the very big moves, and you can explore that for your pairs. You see, you can have volatility per day, so it moves a lot on Monday, and then it dies a little bit on Thursday. Volatility per month. These are all some really nice things that you can check out. And then, of course, you can look for your own pair. Let's say you want to trade GBP USD. You can go and again check it out. I would recommend that you do maybe the last 3 months. I think it's a good amount of data. But in general, you're gonna see the same thing. This is why I told you US session is the best. There is always a move in London here. There is a spike of volatility in London, but then New York is really where the big moves are. Now, if you want to check out, for example, an Asian pair, let's check USD JPY. Now look here. Suddenly we have a very big spike in Asia. Why? Because, as I told you, it's an Asian pair. And then you can see London session, it spikes a little bit, but immediately gets back down. But then again, the bulk of the volume is once again during, this is in the last 7 days. Let me just do 3 months. Yeah, you can see you have a little bit of a spike above the average in Asia. Then we have a little bit in London, but then of course you have a little bit in New York as well. So it's pretty balanced. So you can look for all of these things here. Why isn't there gold? Isn't there gold? Oh, there is gold. Let's check out. Does it have volatility per hour? Then we do, for example, the last 3 months. And yes, you can see gold, for example, really good during Asia. A lot of spike during Asia, and then it's dead during London. Nothing. Nothing. Then it starts picking up here at 15 a.m. at 15 o'clock my time, which is 8 a.m. New York time. And then it goes 8 a.m. New York time, 9 a.m. New York time, 10 a.m., which is basically I gave you the Q zone as 6 to 10. And then usually you can push it a little bit to 11 US time. And then you can see it starts dying again. All right. So really interesting website that you can definitely check out. And now we go back to the presentation. Now, which pairs to trade? Well, the instrument and the markets you trade and you choose to trade are your own choice. However, I can definitely give you some guidance. Focus on the major pairs. I personally trade Euro USD, GBP USD, and USD JPY in terms of Forex and gold. That's it. In fact, I only trade GBP USD and gold. As of this moment of speaking, these are the two instruments that I trade, only two. And I trade them mainly during US session from 6 until 11 American time, New York time. Okay. These work best with the strategy that I'm currently teaching you. They have really good volatility. They're very clean and they're very structured. They're not choppy. They are really good. You can look at some other majors like USD CAD, USD Swiss franc, Aussie dollar, New Zealand dollar, but I find the above ones are just better. Don't trade something that is not good. So why would you want to trade like GBP NZD or GBP AUD or Euro Canadian dollar? Like these are just choppy pairs. Aussie dollar and NZD dollar are also most of the times choppy. Like just go and check out, for example, just go and check out the charts. We go to Aussie USD, all right? And you go to the daily time frame, like why would you trade the pair that does this? And then if you zoom out, why would you trade a pair that has done this for an eternity? Look at this, everybody. So since April 2025 all the way until for 250 days, we were in this consolidation. If I can maybe refine the consolidation a little bit, it will look like this. Chop, 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 chop. Then it moves up and then again starts chopping. Here, check it out. Like, why would you trade an instrument like that? Immediately go to Euro USD. All right. Moves up, moves down, has moved up, has moved down. There is no consolidation. So again, make it easy to succeed. Don't try to do some hard things that don't make sense. If you can only pick two of these instruments that I gave you, it's going to change your trading immediately. For beginners, I would recommend you start with Euro USD. It is a little bit more balanced. It's the most liquid. It's the most traded instrument. So it's very structured. But if you're a little bit more advanced, you can definitely try GBP USD and gold. They work amazing. And what you should also look at is your lifestyle and your location. So where are you based and what kind of lifestyle do you have? So then with that, you can know which currencies move at which timing, and then based on when you're free to do some trading, when you have a trading window, or you want to trade at the end of the day after work, or you want to be scalping in the morning for 1 hour, then you can design your instrument list and you can determine your kill zone as well. All right, so that's that. Now, some of you might want to trade US indices. If you want to do that, that is another market that you can trade, the indices market. The most liquid are the US indices. You have the S&P 500, the Nasdaq, and Dow Jones, and Russell 2000. This is small caps. S&P are the 500s, the biggest 500 companies in the US. That is an extremely amazing instrument, an extremely amazing vehicle to invest in because you're investing in the 500 best companies in the best market in the world, which is in the US. Nasdaq is more tech heavy. It's just 100 companies, so it's a little bit more volatile. Dow is just like 30 companies, industrial companies. I don't like that index too much because it's too little companies and it doesn't perform very well. And Russell is like 2,000 companies, smaller ones. I trade only the S&P, but I also look at Nasdaq a little bit. And you can do other indices like the DAX, the DAX 40. These are the best companies in Germany. You have the Nikkei index that is in Japan. It is good, but I would prefer that you stick to the US indices. They're the best. Now, these can be traded as future contracts or CFD contracts. If you want to trade indices, I would recommend that you learn how to trade futures. And if you want, let me know down in the comments. Do you want a comprehensive tutorial like this on futures? Let me know. And make sure to hit and subscribe. Hit the like button and subscribe so I can make it. All right. The timing. New York Stock Exchange open window. New York Stock Exchange opens from 9:30 and then you get 9:30 to 12. That is your AM session. New York Stock Exchange Open is really volatile, so you don't even need news. Why I love trading indices is because they are going to be volatile almost every single day. Because when that 9:30 opens, the stock market literally opens, a lot of traders rush into the market and you get a lot of volatility, literally every day. So for futures, I'm not that much careful with the macro time. I just focus on macro time and I just show up at 9:30 and I trade until 12. Then I take a break, and if I'm free, I can show up again at 13, and you can trade it all the way until 16. That is the afternoon volatility towards the market closure. Keep in mind also there is a pre-markets development of indices in London and Asia, but the real trading of the stock market starts at 9:30. So do you want to trade the pre-markets? It's not the best. All right, the price action is going to look a little bit drunk. It's not going to be nice. It's not going to be respecting the levels. So I don't recommend it. The most profitable session for futures, it's this one, 9:30 to 12. You are going to catch your move during that time. However, you have to be scalping. If you want to be swing trading or kind of intraday trading indices, it's not the best. I've tried it with, so I have a different strategy for futures than I have for Forex. So I'm just going to say this right now. If you try to use the stuff that I'm teaching you on indices, it's absolutely going to work. But on the lower time frames, it's going to be a little bit messy. Okay, so let us set up your sessions indicator and your pairs watch list. Now, we already did set your pair watch list. It is by going right here and starting to, let me make this full screen, and starting to add all the instruments that you need. You just click on the plus. So first you can make like a, create a new list. All right, I have different lists, for example. I have weekly outlook, my real watch list, crypto, futures, and stocks watch list as well. Create new list and then add all the instruments that you want to look at. So for example, I only have EU, GU, USD, and gold, and I have ES and NQ. That's what I have. As for the sessions indicator, okay, that is where we're starting to get interesting. So let me delete all of this. We're continuing to drop. We're continuing to drop in the market right now. You're going to look to search for sessions. You're going to search for FX market sessions by Boitoki. Okay, so type FX market sessions and this guy should appear. All right, we click on this guy and this is gonna give us a really nice looking indicator. So then what you're gonna have to do is we go to the indicators once again. I already have the correct thing here. Okay, but let's do it from scratch and then I'm gonna double check if everything is right. We go to settings. The first thing that we do is we go to the time zone here and we're gonna make it GMT -4. Why? Because that is the current New York time. So we make it GMT -4. Then for London session, do you remember when London starts? It starts from 2. It starts from 2 a.m. and it goes until 5. So we scroll until 5. All of these should be no. We don't need any of these. Session number 2 is New York. When does New York start? It starts from 6 and it goes, you can put it until 10 or 11, but let's do it 11. Let's give a little bit more of a time. And then Tokyo, do you remember Tokyo? It starts from 18 o'clock until 2 a.m. And then you have a forward session that you can do, but you really don't need that. Now here, box, dots, you can play with it. Like I don't need these dots, includes the latest bar in the session. And yeah, you can do that. Labels, I really like how this already looks like. It's perfect. Fibonacci levels, you don't need Fibonacci levels. Information, this information here is interesting. It tells you the average move of the session, but I don't need it personally. We're going to remove it. And that's it. Then of course you can style it. You can, for example, if you want your London to look something different, you can change the colors and all of this stuff. History is how many sessions to potentially show. So currently it shows 10, but you can do it, for example, let's say 50. I want to really look at a lot of sessions in the past, let's say, and that is going to populate it. Voila, we have the sessions indicator. And what is this going to visualize to you is basically your Killzones, the exact sessions that we currently walked through. Tokyo is going to get visualized like this. Then there is London. And I want you to do a little bit of study. Just go back in time and like look at this day, for example. Tokyo, this is Euro USD. What did I tell you for Euro USD? Don't trade in Asia. It didn't do anything in Asia. London, however, opened up and it made a really nice move down. All right. But then New York, look at New York. So what was the biggest move? It was New York. Look here again. Tokyo, not much. London, massive move up. And then New York, really nice move up. Again, London pair and a New York pair. Here, Asia was actually a little bit big. Then London didn't do much. But then again, we show up right here. And then we start looking for setups. And then you can see New York, boom, really nice move up. And then when our session ends, we stop trading. When this window closes, we stop trading because right now we're getting into low probability. Beautiful London. Then New York was not that great. Very choppy London here, but then New York was good. All right. London great, New York great, Asia choppy, London push, New York choppy. Again, not every day is going to be amazing, but in this way, you actually have a visualization of your sessions. And if you go, for example, right now, this should be installed on all of your charts. All right. And you are going to have the indicator on all of your charts. Now, something else that you can do, just a little bit of a tip, because I'm a little bit of a perfectionist. So right now, if you go, for example, to the daily time frame or to the hourly time frame, you're going to see a little bit of a mess. So what you want to do is you go to sessions and you go to the settings and you go to visibility and you want to remove this, and this. Make it to just one. So what this is going to do is it's not going to show the indicator on anything, daily, weekly, hourly, but it's just going to show on the 1 hour. On the 1 hour and below. That is how I have mine because it's a little bit cleaner. Like I don't like having it on the 4 hour, it's a little bit noisy. But if I want to drop to the 1 hour or to the 50 minute, I want to see it show. Even if the 1 hour for you is a little bit noisy, you can also remove the 1 hour by again going onto the sessions visibility and just remove this. And now it's only going to show on when you go to the 15 minute. So there we go. Now you have your watch list and now you have your session timings indicator. All right. And pretty much right now you are ready to trade, but we have something very important to cover right now because we still haven't learned how to enter the market. So I hope you're excited for that. We have set up your indicator. We have set up your watch list. We have set up your sessions and everything. Let's go back to the knowledge board. All right, we're very slowly starting to go towards the end. And wow, I mean, we learned a lot so far. It's been like 8 hours probably so far. So we learned how imbalances and liquidity work. We put them to practice and now we implemented them into a bias and direction framework. We discussed pairs, we discussed different timings, we had a look at the economic calendar, we discussed the sessions, we discussed a lot of things. We covered the news aspect of trading. And right now it's finally time for the final steps. So we have to introduce the entry model. All right. So the entry model is basically the simplest part of trading because all the hard work is doing the bias, doing the direction, picking your POI, picking your target, and then all you need is just some sort of a confirmation, some sort of a trigger that is gonna make you take the trade. Now, do you necessarily need an entry model? No. Like a lot of times, if you say I'm bullish and we have the hourly bullish imbalance, you can just enter from that imbalance, but your stop loss is gonna be a little bit bigger. All right. So the aim of the entry model is to literally confirm your POI that it's going to hold and also to give you a smaller stop loss and a better risk to reward ratio. And why is the hard work on the bias and direction and really picking the right POI is because if your POI is right and if the bias is right, the trade will go. It doesn't matter how you enter, it doesn't matter where you enter. If your bias is right and you just plot the right buy or sell, the trade is gonna go. So what is really important is that the entry model should be simple. It should be easy to execute, easy to remember, and easy to replicate. Because what a really big problem is most traders mess up their entries, and which is why they fail. The first fallacy that they want to have is they want to have a very tight stop loss, very small stop loss, and target like massive risk to reward trades because it looks good. or they have like a very complex 5-step entry checklist that until you read, okay, 1, 2, 3, 4, 5, 6, until you read all of your rules, the trade is gone without you. Okay, or if one of your steps is not fully correct, you start doubting, but step 3 is not good, and this and that, and you again miss the trade, right? Or you screw up on your trade management. You exit too early, you just see a little bit of profit and you exit, or the market goes into stop loss and you don't know where your stop loss should be, so you keep enlarging it and you end up losing very big, or you go fast to break even really soon. So these are all really bad mistakes. Now, I have a few entry models, in fact 3 or 4, okay, but in this tutorial I'm going to share my most foundational one, so that you can build a foundation, get something that you can actually implement right now, because I could have left you without an entry model, but I'm not going to do that. So I'm going to give you the most foundational one, the simplest one to implement. Is it the best one? Probably not, because there are a lot more details that go behind, but this will really get you up to speed with execution and getting some sort of a confirmation from your points of interest. So what is that foundational entry model? Well, the simplest entry methods that I uses a concept that we already know very well, and that is the imbalance concept. So we know what the overall trends and the potential targets are. We pick our points of interest, we wait for that point of interest to tap, and then we simply wait for an imbalance to form in the direction of the POI, in the direction of the trend. That is it. The stop loss is placed under the most recent swing points, right? Under or above. If you are taking a long, it should be under. If you're taking a short, it should be above of the entry time frame. Your take profits, for now, I would recommend that you keep the take profit fixed. So you only target a risk to reward ratio of 1 to 1.5 R, or you can target a liquidity point to the left. One of the two. Can you go for 2R? Yes, but start small. Start taking some take profits, and then you're going to start seeing patterns when you can let it run and when you can potentially cut it. That's it. That's it. And I call this precise entry model the VSR, the V-shaped recovery. Why the V-shaped recovery? Because that is actually an economic turn. You have U-shapes, right? These are very flat bottoms, and you have V-shapes that are looking like a V. It's a sharp imbalance outside of your POI, signifying aggressive participation outside of that POI, validating your zone, basically. Now, you can have different POIs. You can have a zone on the daily, on the 4 hour, on the 1 hour, on the 15 minutes. So what is your entry time frame? Let's talk about it. You can again pick a POI on any time frame, and it will have a corresponding entry time frame. So the entry time frame for the VSR is always going to be 2 time frames lower than the POI time frame. Okay? So we already know our basic time frames, what they are: weekly, daily, 4 hourly, 1 hourly, 15 minutes, 5 minutes, and 1 minute. Okay. So for a daily POI, 2 time frames lower than that. So we count 2, 4H, 1H. So for a daily POI, we're going to need a 1 hourly VSR. For a 4 hourly POI, we count again 2 down, 4H, 1H, 15 minutes. So we're going to need a 15-minute VSR. 1 hourly POI, we count 2 time frames lower. So what is the lower time frame than the 1 hour? It's the 50-minute, and then the next is the 5-minute. So from a 1 hourly POI, 5-minute VSR, and from a 15-minute POI, I recommend a 3-minute VSR, because the 1-minute VSR is too aggressive. So I tend to wait for a 3-minute one. All right, that's it. And what you can also do is you can mix and match them. So if you get, for example, a 1 hourly VSR from the daily POI, you can use that 1 hour VSR as a POI and then confirm it on the 5-minute. Again, as I told you, it is fractal. So you're getting a daily POI and you're getting a 1 hourly VSR. You can enter immediately. However, you can say, okay, well, this 1 hourly VSR can right now be my POI. So when you go to this here, so a 1 hour POI, you can look for a 5-minute VSR. And that is how you can get even tighter stop loss, and you can exit the trade a lot sooner without expecting a very big daily move. You can mix and match them. If you get a 4 hourly POI and you get a 15-minute VSR, you can wait. You can take this 15-minute VSR as a POI, and then you can confirm that in the 1 minute or in the 3-minute. And I'm going to show you how. So let me first give you some more details. Where to enter from. you can enter on the imbalance creation or set a limit order for a retest of the imbalance. Now, you already know what a limit order is, right? We discussed this in the liquidity chapter, so it's very important that you know. And basically that's it. Immediately as an imbalance gets created, you can immediately enter, or you can set a limit order and wait for the imbalance to get retested, and then you can enter there. There are pros and cons of these two things. If you enter on the imbalance creation, your entry is going to be a little bit higher or lower, so your stop loss is going to be bigger. If you wait for the retest, your stop loss and your risk to reward is going to be better, but sometimes you're risking that the imbalance is not going to get retested, because this definitely does happen. Okay. And then an advanced entry would be to look for an even lower time frame confirmation from the VSR, but I don't recommend that. So for example, that will be, you get your 50-minute VSR and then it taps, and then you go to the 1 minute to confirm that VSR. That is kind of how you can mix match them, but for now I would stick to the main ones. Okay. Where do you put your stop loss? Your number one priority as a trader is to always have a safe stop loss. Again, like, always have a safe stop loss. Please don't be one of these traders that want to have these very big risk to reward, that want to look fancy and like really pinpoint. No, have a safe stop loss. Your stop loss should always be at a place that if crossed, your trade is invalidated, right? If this point is crossed, I'm no longer interested in that trade. That's it. And that is usually going to be under or above the most recent swing point or the lowest point or the highest point of the imbalance tap. So let's say that this is our 4-hourly zone, and the market on the 50-minute comes in, taps in, and then it prints a 50-minute zone. Where is going to be our stop loss? Under the lowest point. We're not going to try to put it here or here. No, it's going to be under the lowest point. If we have this, and there is our 50-minute imbalance, where is going to be our stop loss? Always the safest. Not here, not here. Just put it safe. Put it safe, because if the market comes and takes you out here under these lows and it doesn't take the major low, you're going to survive. Okay, so always place it safe. The lowest or the highest point that you see when the zone was tapped. Where do I take my take profits? There are two ways to do that. You can do a fixed risk to reward ratio. I usually go for 1 to 1.5 R. Or if there is a very clear liquidity to the left that you think that the market is going to take, then you can enlarge your TP and go for that liquidity. Okay. But remember the market mechanism. The market goes from imbalance to liquidity. So your best take profit is always going to be at the most recent liquidity, which is what we call the low-hanging fruit. Because after that low-hanging fruit gets taken, the market does tend to pull back. So you might be getting into a very nice profit, but you want to keep going for more. And then the market might reverse and maybe hit your break even or hit your stop loss. Okay, so always try to exit at liquidity. Now, what is a break even? Break even is putting your stop loss exactly where your entry is. So basically, when the market reverses against you, you're going to get stopped out for zero. So you're not going to be losing any money. That is what going break even means. Now, should you go break even? This is your decision. I only managed to break even once price has taken liquidity, and I feel that this could be the end of the move, but I still want a little bit more risk to reward. So then I would move to break even to protect myself from sharp reversals and potential stop loss. Okay, so that's basically it. Now, let us have a look at some examples, and we're gonna literally go through the whole process. All right, so here is the chart that is Euro USD on the daily time frame. We're having a daily bearish imbalance. What did the market do last? Okay, so what is the trend? It's bearish. We're below the EMA. We're making bearish imbalances. Great. What is the market positioning? Well, what the market just did is it took daily liquidity. So what is it doing right now? It goes from liquidity to rebalance. Okay, so now we're rebalancing the daily imbalance potentially. How can we trade towards there? So in this case, I'm going a little bit counter trend on the daily, but I think that the market has taken liquidity and it's going to go and rebalance this daily bearish imbalance. I dropped to the 4-hourly time frame to find a bullish POI. We have a 4-hourly bullish POI here, guiding us towards the daily bearish imbalance. Now, the 4-hourly POI is tapped. I identify my low-hanging fruit, which is the most recent 4-hourly liquidity. So what entry do I need from a 4-hourly POI? 2 time frames lower, 1H, 15 minute. Okay, I need a 15-minute VSR. The market taps into the hourly POI, exactly right here. We wait. It taps into the 50-minute EMA. So the 50-minute EMA is bullish. That tells you that the average structure is bullish. If you use, for example, the indicator, very likely there is going to be some sort of a break of structure down here, then break of structure up here, then break of structure down here. That's why I kind of don't really recommend market structure, especially like on the lower time frames. Just look at the EMA. The EMA acted as beautiful support, and there is our 15-minute bullish VSR. What is again a VSR? It's just a 15-minute bullish imbalance in this case. That's it. What does that confirm? Is that again, what is an imbalance? It's momentum. So that confirms that there is momentum and that there are big orders with imbalance here launching from this POI. In this case, I'm entering on the imbalance creation. Immediately, as soon as this candle closed, I am entering the trade, market order, and I'm placing my stop loss where? Under the lowest low that is inside the POI. Here, I'm not gonna place it here. I'm not gonna place it here. Okay, right there under the lowest low. What I'm actually targeting here is a low-hanging fruit in the form of a 1-hour liquidity, but the real liquidity is the 4-hour liquidity. Okay, and you can see the market came to give me a 1.5R at the 1-hour liquidity. I'm very happy with that. And you can see immediately the market takes liquidity, initiates a pullback. There was a 50-minute zone. Unfortunately, that did not get retested. We went to the 4-hour liquidity for a 2.3 risk to reward ratio, and then we ultimately went to the daily zone for a 3 risk to reward ratio at the daily. So, beautiful trade. Let's check out another one. There is Euro USD once again on daily time frame. Again, Euro USD, that is the best pair that you can potentially start with. Who is currently in control? It's the sellers. We're making daily bearish imbalances. Structure is, however, bullish. All right, so it's a little bit 50-50. Sellers are in control, but structure is bullish. Not the best. Okay. However, I would like to listen to the imbalances. We have 2 daily bearish imbalances, current control sellers. We can try from the first imbalance. So from a daily POI, we're going to need a 1-hourly VSR. There is my most recent swing point. That is the low hanging fruit. I can go for lows like that, but no, I want to target the low hanging fruit. Here is the 1-hour time frame. The market pulls back, and exactly right here is where we touch the daily POI. Okay, the market taps into our POI. Now we need to see a bearish 1-hour imbalance, a bearish VSR to confirm that this daily imbalance is holding. The EMA is also bearish on the 1-hour. So always ensure, so here is a very big gem, by the way, that I believe I didn't include in the presentation. When you're taking an entry, always ensure that price is either under the EMA if you're bearish or above the EMA if you're bullish. And you're going to see why. Look here, okay? We tap into the EMA, react. Do we make a bearish imbalance? No, in fact, we're still bullish in control. The market pushes above the EMA. Buyers are still in control. We tap into this 1-hour zone. Candle 1, candle 2, candle 3, candle 4 invalidates this 1-hour imbalance, and we break below the 1-hour EMA. I mean, when I say the 1-hour EMA, it's always going to be the 50-period exponential moving average, but it changes as you change the time frames. Okay, so that is the 50 EMA on the 1-hour. So I kind of call it the 1-hour EMA. Okay. There is our 1-hour bearish VSR. Very nice bearish imbalance. We enter on the imbalance creation. Where is our stop loss? It's not somewhere random. It's at the highest high that was created inside the imbalance. Bearish VSR created. You can enter on the imbalance creation, or you can set the limit at the retest right here. Or what you can even do in this case is you can say, okay, I'm going to use this 1-hour VSR as a POI. So if the market pulls back inside that VSR, you can go to look for what? For a 5-minute entry. And I believe I'm going to show you here. But here is how the trade plays out, simply with the 1-hour VSR. Entry, why does the market pull back? Because we took liquidity. So the market made an imbalance, but it took liquidity. It pulls back to rebalance into the 1-hour imbalance. Beautiful tap of the EMA. Pushes, takes liquidity, pulls back, pushes, takes liquidity, pull back, pushes, takes liquidity from this 1-hour reaction area. Gives us a really nasty pullback here. But look at the EMA. The market looked above, but then immediately dipped back below. And then eventually we went into the daily, the ultimate daily liquidity target for a 1.6R. Now let me show you how we can enter, how you can use this 1-hour VSR to get even tighter entry. There is the 1-hour VSR. We are retesting it on the 5-minute time frame. So now we want to use the 1-hour VSR as a 1-hour POI. So we're going to need a 5-minute confirmation. The market comes in, okay, reacts, and then it tries to push lower. But do you see in this bearish push a 5-minute VSR? No. The market pushes above EMA, comes in a little bit again, and then suddenly, boom, goes down very massively. 5-minute VSR created here and a 5-minute VSR created here. You can enter down there on the imbalance creation, or you can look for a retest of the most recent imbalance. Where does your stop loss go? It doesn't go here, doesn't go here, it goes at the highest high, which in this case is this. Okay, the market takes a little bit of liquidity, launches another pullback, and here you could be sweating a little bit because you're running into drawdown. So your trade is currently in a floating stop loss. It lingers around the EMA, but then it breaks the EMA again with a 5-minute VSR. That is another entry. And the entries, both of these entries are below the EMA to confirm that the average market structure is bearish. You take the trade from here, and once again, your stop loss is not here. It's always above the highest high that retested your POI. All right, and this one went down. We saw it very nicely. Another example here. Now we are on GBP USD. Okay, trend. What's the trend? Bearish. Daily bearish imbalance in control. The daily EMA is kind of flat. We can see the last 4 days here have been pretty choppy, so not amazing, but we have taken liquidity here. So what I think is happening, the market will potentially try to rebalance. Can we rebalance? Where can we rebalance? Inside this daily zone. So can we trade into there? Let's see. We go to the forward time frame, and it was choppy, 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 no imbalance, no imbalance, no imbalance. The EMA was bearish, but suddenly we're breaking above the EMA and we're making a forward bullish imbalance, and we have the daily above as a target. Interesting. Can I try to go long towards that daily? Let's see. What am I gonna need? A 50-minute VSR. There is the forward being tapped exactly right here. It's above the EMA, which is great. However, on this push up here, it did not make a 50-minute VSR. It pulls back, no VSR, all the way until up here, okay? Now, this 50-minute VSR formed after the liquidity was taken. This is our low-hanging fruit, and the liquidity is taken. So the entry model is not very powerful anymore, and I will discuss this soon into some exclusive gems with you, because you don't want to be entering too high. You don't want to be entering the trade when liquidity is taken. Remember, we want to go from imbalance to liquidity, and we basically want to capitalize on this phase 2. Phase 1 is offering fair value, phase 2 is pushing towards liquidity, and phase 3 is taking liquidity. So when the market is already taking liquidity, you don't want to enter. And also, this is GBP USD during Asia. Look what happens. We took liquidity, it's during Asia, pull back, tested the EMA again, it tried, but it started building bearish market structure, and then it eventually reversed. Okay, interesting. What can you do from now on? This is where a lot of traders get lost, but again, use logic. Go back to the daily, go back to the 4 hourly. Let's go back to the 4 hour. Let's see what is happening. What is happening? There is our 4 hourly bullish imbalance. The market tapped it and fulfilled the low-hanging fruit. Great. What happens later? We go bearish, and then suddenly we go massively bearish down. Now what is happening? The market is showing us potentially that it doesn't want to go to the daily. And if this forward bullish push fails to really make another one and fail to do its job, then I suspect, again, as I told you, when an imbalance really fails to push higher, the origin of it becomes weak. So if I'm starting to get a little bit more of a bearish bias, are we reversing? How can I know? I drop one time frame lower. So I go to explore the 1 hour time frame. And what I see here is that the market tested the forward, it tried to push up, it failed, and then it massively pushed down with 2 1 hourly bearish imbalances. And we kind of tried to break below the EMA, but we could not. So what can I do is I can make a theory that, okay, I think that the market is going bearish. This forward zone failed to push up. This daily zone doesn't want to get retested, and right now I see the 1 hourly imbalances are guiding me lower. Is this a very high probability trade? No, because it's not really with the trend. You can see, for example, the 4 hourly EMA is flat, the 1 hourly EMA is a little bit bullish, but this is actually a trade we took live with the community very recently. The first trade was offered here. The market taps into the 1 hourly zone, comes a little bit deeper, and then it tries to push, then suddenly, boom, 5-minute VSR. We enter. As the VSR gets created, there is actually another little 5-minute VSR entry on the retest. Where does the stop loss go? The highest point of the imbalance. The market is also below the EMA, great. Pushes into drawdown and hits our stop loss. It's all right. Here is another rule for you. You can always give 2 attempts from a POI or 2 attempts on a trade idea, because the first one might not work out. We can see that the market went into the upper imbalance, tested it, reacted, went a little bit deeper, and then we have a 5-minute VSR here. But why I would not take this VSR is because we're way above the 5-minute EMA. So right now structure is bullish. I wait a little bit, the market came and tested the 5-minute EMA, responded, at the same time printing another VSR. Okay, I really start seeing sellers getting into control. The market retested the VSR, I'm still waiting. You see a lot of patience here. And then when this bearish candle printed, which is a really nice bearish engulfing candle, I can right now get into the trade. Why do I get exactly right here? Only because of the EMA. I really wanted to ensure that my entry is below the EMA. Okay, low hanging fruit is going to be the 1-hour liquidity. And if you remember, the biggest liquidity is going to be that weak hourly low. Look, you enter the trade, you get a nasty pullback once again, but we always have a safe stop loss, always at the highest high where the imbalance was retested. So not here, not here, above the highest high. Gives a little bit of a pullback, but then really the sellers kick in, take liquidity, and went all the way lower for a really good risk to reward. And again, the lesson here why I intentionally included this, because we took this live with the community. We took the first stop loss during the beginning of New York, but then it offered another one. So we took it again because we know that we strike twice on a trade idea. And then you can see here we have a little bit of a pullback. So the market took liquidity, but we still think that it's going to go to the following week low. How can we capitalize on this move lower? Use another time frame, 15-minute. The market massively pushed lower. Right now, what is happening? We're starting to build a story. That hourly bullish failed. We're starting to go down. The 1-hourly bearish are holding, and they're creating a 15-minute bearish. The market retests the 50-minute bearish. What do we need? We need a 3-minute VSR. There is the test of the 50-minute. The market reacts, pulls back, and then here is the 3-minute VSR. Entry on the imbalance creation, stop loss goes above, and you can see there is our low-hanging fruit, the 50-minute liquidity. The entry is taken before the liquidity is taken, so I can execute. Stop loss, not here, not above the imbalance, not random stop loss, always safe above the highest high where the imbalance was retested. It's below the EMA, which is great. Gives us a little bit of a pullback, pushes, takes liquidity, pulls back a little bit, and then it just attacks massively the following week low. We also took that trade. And if you wanted to do the 1 minute, it's a little bit better. Beautiful tap of the EMA, beautiful. There is the first VSR. Why did I miss that one? There is the first VSR. You get an absolutely sniper entry here with an extremely small stop loss. The first VSR below the EMA, but there is, for example, another VSR. You can take the trade from here. Stop loss above the highest high. Another VSR here, pulls back. Another VSR here. If you're waiting and waiting and waiting, the market keeps offering you opportunities to enter. There is another VSR. You can enter here as well. But stop loss doesn't go here. Doesn't go here. Doesn't go here. It goes at the highest high where the 50-minute zone was retested. So that is another way that you can take that trade. So do you see here? We took a 1-hour trade, and then we went and took a 15-minute trade, and we capitalized on a really nice overall trade idea. So now let me give you some exclusive gems. We do not enter when the closest liquidity is taken. Okay, the most recent liquidity on the POI time frame or the highest high in the entry time frame. So you can visualize it in different ways. I would recommend that again. If you have a 1-hour POI, draw the most recent 1-hourly high or low. That is your low-hanging fruit. Draw it, and if that gets taken, you do not want to trade after it gets taken. That is how it looks like. There is our POI. There is the highest high here. So imagine we are right now looking for the VSR, and that is the highest high to the left. We want to trade towards that highest high. So if the VSR is offered before the liquidity is taken, that is great. However, if we have a push and a pullback, there should be a POI here, and then the market massively pushes up and it takes liquidity, and you get the VSR after the liquidity is taken, no entry. Why? Because right now we are trading against the market mechanism. It has taken liquidity, and right now we expect some sort of a rebalance, but we don't know if it's going to rebalance and if it's going to go again. our trade opportunity is unfortunately gone, and that is going to happen sometimes to you. But it's gonna save you from a lot of stop losses. So here, for example, is a very extreme example. This is on Great British Pound again. We have a 1 hour POI. The 1 hour POI gets tapped exactly right here. It gets tapped, beautifully tests the 5-minute EMA beautifully. It tries to push up, but it doesn't give us a 5-minute VSR. You can see it's slow, it's slow, it's slow, it's slow, it's slow, it's slow. And then it tries again here, but it does not. And then suddenly, boom, massive 5-minute VSR. There it is. And this is where the VSR was actually created. Are you going to take that trade? No. First things first, your stop loss is going to be enormous. And second thing, the 1 hour liquidity, which is again, this is where the 1 hour zone gets tapped. The highest high is here. This is your 1 hour low hanging fruit. It got taken. So when the liquidity gets taken, you would expect some sort of a pullback. So you better then wait for the pullback and then engage. Okay. Here's another example. Again, on the pound, we are tapping into a 15-minute POI here. And the market taps it here, reacts, but doesn't give us a 3-minute VSR. Taps it again here, and then it gives us a 3-minute VSR. But do you see the highest high here, the 15-minute liquidity, the low-hanging fruit? It just got taken exactly when the 3-minute VSR was formed. So this candle opened, it took liquidity, and then it closed here, and that is when the 3-minute VSR formed. Well, I'm sorry, but liquidity has been taken. So you can take the trade from here, stop loss below, the market gives you a little bit of a push, but then it comes lower. Why does it come lower? Maybe it wants to come back and retest the 1 hour zone, because your 15-minute zones are going to fail when they take liquidity, and then they fail to go higher, and then they would like to rebalance a higher time frame zone. It's like a domino effect. Okay. Like this is the one of the examples that we had to look at. Imagine you have a 1 minute zone, it fails, it goes into a 50-minute zone, it fails, it goes into a 1 hour zone, it fails, it goes into a 4 hour zone, it fails, it goes to, it's like a domino effect. But first, again, you have to try the first one, because you don't know if that's going to be the one to push, and then you apply the entry model. But if the liquidity is taken, you don't want to strike. There should be let me see, what is that? So that is gold on the 3-minute time frame. So let's see. There we see. So, okay, so I'm showing you here why you want to trade before the liquidity is taken. There is our 15-minute POI. It gets tapped right here. We see taps in, tries 3-minute VSR, fails, tries 3-minute VSR, fails, comes a little bit deeper, tries again, goes a little bit deeper. And here is where we get a 3-minute VSR, the first 3-minute VSR. And as the 3-minute VSR closed, we closed above the EMA, which is great. You can take the trade from here. Stop loss goes under the lowest low. Not here, not here, lowest low. We suffer a little bit of a drawdown. It doesn't look good, it doesn't look good, but then suddenly, boom, another 3-minute VSR. So you can also take the trade from here. It is a really good closure above the EMA, by the way, a really good one. And look, straight to the liquidity. So if you try to take a trade from here, you immediately hit stop loss. And if you held the trade for more, hoping that it's going to go, you also hit break even maybe, or the stop loss. So again, liquidity is taken and full blown reversal. This is why we don't enter when liquidity is taken. And we also look to exit, take maybe a partial position, so close half of your position, or go break even when your liquidity is taken, because again, you really don't know what is going to happen next. All right, so a beautiful long trade here with a beautiful risk to reward. Take it at the liquidity, because then you never know when it is going to reverse. All right. Another exclusive gem for you. I've never shared this one publicly but for those of you who are still here, listen up. This has been a really big game changer for me. I have a few entry models based around this little gem. And the gem is to always watch one time frame lower than your POI time frame for opposing imbalances. Remember that the entry is 2 time frames lower than the POI, but 1 time frame lower than the POI can always give you a little bit of trouble. That is how it looks like. So if you have a 4-hour POI, and then if you go 1 time frame lower, which is the 1 hour, if the 1 hourly on the way down, it didn't have any bearish imbalances, the price is going to give you the 15-minute VSR, and it's going to run really fast to the liquidity. However, if you have a 4-hourly POI, and then getting towards that 4-hourly POI, you have an unretested 1-hourly bearish imbalance, and you get the VSR, and then the market encounters that imbalance, the imbalance is going to give you trouble, because these zones, they are really powerful, by the way. These low volume nodes, these zero orders, they tend to react a lot. So if you're looking for longs from the FOH and you get a 50-minute bullish, but that 50-minute bullish VSR is tapping into a 1 hourly bearish imbalance, you might expect a little bit of a pullback. In fact, you might even sometimes expect a stop loss. And if that happens, but then the market gives you another VSR, you enter again. Because remember, we have 2 bullets from a trade idea, and a trade idea is usually from the same POI. Okay, let's see how that looks like. Opposing imbalances example. Let me see, is this correct or should there be another chart? 50-minute POI, 50-minute liquidity, 50-minute POI, 50-minute liquidity. Okay, there, yeah, okay. So first we're looking to trade from this 50-minute zone to go higher, and then we're looking to trade from this 50-minute zone to go higher. Here is the first 50-minute zone. It gets tapped right here, and we get a 3-minute VSR above the EMA, everything good, it tries, and then it hits our stop loss. Then we get a second entry with another 3-minute VSR, and that one went successful. Why? So when I was taking stop losses like that, I always ask like, okay, why is that happening? I'm annoyed. Why does it happen? Go one time frame higher. There was a 5-minute bearish into the 50-minute bullish. The market taps the 5-minute bearish, candle 1, candle 2, 3, 4, 5, successful, and then it went to take the liquidity on the bottom. And then after that liquidity was taken, the market just impulsed back up again. And then when this 5-minute has failed right now, with this candle, there is nothing to stop it anymore, and it's eventually going to go to the 50-minute liquidity. Okay? So 50-minute zone, 5-minute opposing, one time frame lower. 1 hour zone, 15-minute opposing. 4 hour zone, 1 hour opposing. Daily zone, 4 hour opposing, one time frame lower. There's another one. Yeah, there it is. For example, there is that 50-minute second POI. We tap in, and there is a 5-minute against us. And look at this. Reacts, 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 and then finally it breaks right here. And then look, it unlocks because they were like seller, 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 seller. Are we going to go down? Are we going to go down? And then this candle said no. The buyers took control, and then just boom, it just unlocked. And if you look at this on a 3-minute, for example, this is where the 50-minute zone gets tapped. We went a little bit deeper, and then the 3-minute VSR got printed above the EMA, which is great. So you take the trade from here, and stop loss goes under. But you see you're sweating here a little bit. Oh shit, oh shit, oh shit, oh shit, oh shit, oh shit. And then here we get another 3-minute VSR. Okay, and then again, if you take the trade from here as well with a safe stop loss, that is the best entry. Why? Because right now you really know that this 5-minute has failed, and I have an entry model for this. Okay, it's getting a little bit more advanced, and I have to make this video 20 hours if I want to teach you this entry model, but it's just absolutely bonkers profitable and extremely powerful. And the win rate is really high because you always ensure that you wait for everything to fail before you take your entry, and then literally the trade has no other thing to do but just to go to the liquidity. Because if we're bullish, and this is the only thing to stop price from being bullish, and you wait for that thing to fail, and it fails, it goes bullish, right? It's absolutely crazy, okay? So there are 2 quick little gems for you. Don't trade when liquidity is taken. Wait for a new rebalance and a new entry model, and always watch one time frame below your POI time frame. So let us quickly recap right now. We know the process of bias, POI, and entry. Who is currently in control? Are we in a trend or a consolidation? Are imbalances holding, or are they failing? Where are our most recent imbalances? What is going to be potentially our POI? What is the overall structure which we look through the EMA? Our overall analysis is going to be daily, 4 hourly, and 1 hourly. Okay, you want to see those aligned, or at least 2 to be aligned with a clear liquidity target, because sometimes, let's say, the daily is going to be bearish, as we saw a couple of examples, but if the 4 hourly time frame is turning bullish and the 1 hourly is turning bullish, I can try a long because I have 2 time frames that are aligned. Especially if I have a clear liquidity target on the daily, maybe I will try to go against the daily, but I need to two of them to be aligned. Okay, and always build the story of the market. What is holding? What is failing? Where is it going next? Is this imbalance holding? Good. Where are we going to go next? Is this imbalance failing? Okay, good. What is the origin of that imbalance? Because that is where we're going to very likely go next. After you determine the trend, after you determine kind of a POI, you always have to ask about market positioning and the 3 phases that the market can be at. Is it rebalancing, pulling back into an imbalance right now? Is it already rebalanced and then starting to go towards liquidity, so seeking liquidity, or is it already taking liquidity? So then of course you have to stop and look for a rebalance. And this repeats, right? This is the market language in my eyes. We've taken liquidity, we pull back to rebalance, we rebalance, we seek liquidity. We've taken liquidity, we pull back to rebalance, we rebalance, we seek liquidity. We've taken liquidity, pull back to rebalance, right? And then until we reverse. But when we reverse, we do the same thing. And of course, the other scenario is that we have a consolidation without any imbalances. Then it just goes from liquidity to liquidity. All right. What is then the POI that you will use based on the market positioning and the trend? What are you going to actually do? What is the liquidity that you will target? And then based on the POI, what is the entry model that you are going to use? All right. Now, you literally have it like this. This is the plan. That is it. You have everything to really actually go from a losing trader to a break-even trader and really start making some money. Now, there is a lot more stuff that I can teach you. There is a lot more entry models. There are a lot more details and really advanced stuff that are really going to make you better. But that is an extremely solid foundation that you can really stay on and be really comfortable and confident to trade. Just go and test it. But now, it's practice time. However, what is the best time to practice, right? What is the best way to practice? So right now, we want to transition a little bit to talk about another little thing, which is how to improve as a trader, okay? So we're going to talk about different ways. And as we talk about these different ways, I'm going to try to practice together with you to show you how to actually improve as a trader. So let's talk about it. So improving as a trader is all about data and experience, because the more you trade, the more you experience you get, the more data you get if you journal, right? And then the better you get. So it's basically experience plus data, all right? Now, how do you get experience and how do you gather data? This is what we're going to talk about right now. Executing in the actual market gives you the experience, while the data is going to give you the conviction and trust in your edge. Because what I just taught you right now, it is going to make sense. It's going to be like, wow, man, this is amazing. I'm going to go and smash the market. But immediately once you encounter the first setup live and you start panicking, this is not on me, right? This is on you. Why? Because you don't have the conviction and the trust in the strategy. You've never executed it. You've never journaled a single trade. You've never gotten the data in the backtest to really know deep inside, okay, this thing is working. This is why these videos that you see online, like, okay, how to become profitable in 10 minutes. This is the only strategy you need, like a 10-minute video. Really? And you can really just go in and start executing that and print money? No. It takes time. It takes a lot more time than what we have already spent together in this video. Okay? So there are 4 paths of improvement. The first one is backtesting. This is going over past data and applying your strategy so you see how it performed in the past. You have paper trading, sim trading, and demo trading. It's literally the same thing. This is trading live, but with simulated funds. So no real money, but you trade live. While backtesting is trading the past. Forward testing is just looking at charts live and doing markups without pressing any buttons. That's all. And then case studying and hindsight backtesting is looking at past data that is played out and just doing markups. Not really clicking buttons, not trading, but just doing markups and journaling them. Okay, so those are the 4 paths of improvement, and later I'm going to give you the steps through which you have to potentially go if you want to master a strategy, whether this is going to be this strategy or another strategy, it doesn't matter. So right now I want to cover them all and give you the pros and cons of all of these ways. And with that, we're also going to put in a little bit of practice with all of these ways so I can actually show you how to do it. Okay, so first we're going to talk about backtesting. Okay, what are the benefits of backtesting? Well, firstly, it's a great training tool. Not only it helps you build visual experience, but you also execute. When you're backtesting, it's basically a simulation trading. You know, the Formula 1 guys, they do simulated driving in these big machines, right? It's not the real thing, but it gets kind of close to the real thing. What is really good about backtesting is that it actually gives you good data and an overall impression of the strategy and its performance. It helps you build some confidence that your strategy has a positive edge, because if you see it working and it's nice, you start getting a good feeling, like the dopamine hits, okay, that thing is working, so I can probably look to apply it. Now, backtesting has a lot of drawbacks because backtesting is not live trading, and your live trading will never be the same as your backtesting. There is a very big mistake that traders think, okay, in backtesting, I made all of this money, so right now let me go live and I'm gonna crush it. It's never gonna be this way. All right, so keep this in mind. There are emotions in live trading. I mean, there are no emotions in backtesting. There is no waiting, there is no patience, there is no performance, there is no stress. You're just sitting and you're backtesting. Boom, boom, boom. I'm gonna take this trade. Okay, let's try. Boom, boom, boom. But in the live markets and when real money is on the line, it's a completely different ball game. Okay. A very big trap that you might go with backtesting is the backtesting loop. You backtest for a bit, then you go trade live, you take a couple of stop losses and you say, no, I gotta backtest more, I'm not good enough yet. And so you just keep doing backtesting, backtesting live, backtesting, backtesting live, and you just never really build that live trading performance and confidence because you just keep going backtesting, and backtesting is not live trading, okay? It is in the past, it is what worked a year ago, but it not might work today. So past performance is not live performance, okay? When you backtest, you're not really in the zone. You cannot pay attention to everything in backtesting. You're gonna miss details because you can backtest 1 year of price action within a day, let's say. But it's gonna take you 365 days to do this live. And when you do it live, things are slower. You pay attention to more things. You pay attention to this, you pay attention to this. Like backtesting is just robotic. It's just boom, 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 boom. And you really miss out a lot of details that you would have caught in live. Okay. And the worst thing about backtesting is that it gives you fake confidence. You can be great on paper, you can be great in your backtesting, it can be really good, but then when you go to the real arena, you actually get absolutely smashed. Okay, so backtesting is good, but I just don't recommend you to do it a lot. Do it at first, gather some confidence, do it for a bit, but don't do it way too much. So right now, my battery just died, but I want to show you how to backtest the right way. So I'm going to show you two ways. One is a professional way and one is a little bit more clunky. So with that being said, let's check them out. All right, back on the charts. So I want to show you the first way to backtest, which is on TradingView. I don't love it, and I'm going to show you why later when I show you the second way to backtest. But what you basically do is you first pick a pair. Let's, for example, do Euro USD, and let's say we want to backtest. The beginning of March. So there is this thing here, bar replay. Now I believe this one is a paid thing for TradingView. I don't think they have it on the free version, but I could be wrong about that. But basically, then you hit the replay from the point where you want to start, and that triggers the replay mode. And then what you would do is you would just start performing the frameworks that we learned. Okay, start from daily, hourly, 1 hourly, find your POIs, and then find your entry models. And then as you start taking trades, however, there are two ways to go about it. And you should always, we're going to talk about journaling a little bit later, but you should always journal. And I'm going to give you a journal for that, so you have no excuse not to journal. So for example, let's try to take real quick a few trades. Now, what do we have on the daily time frame? There are no imbalances on the daily whatsoever. The daily MA is bullish, so I'm not really interested into anything right now. I can very quickly check the hourly time frame, and there is also nothing on the hourly. So let's wait a little bit. Okay, the market opens. Let me just wait. Let me just print 1 day here of this price action. Okay, wait. So you can immediately hit replay. Like, this is the bad thing about TradingView, is that you can cheat, right? So I pressed 1 day right now and I cheated and I returned it back, you see? But let's see, for example, okay, the daily time frame is really nicely expanding lower. Where can we potentially go? I see a daily reaction area, and then ultimately we can go towards this low. Okay, so how can I trade bearish right now? Do I have a daily bearish imbalance? No. So I'm gonna check the hourly time frame. I go to the hourly time frame. Okay, do I have a hourly imbalance? Well, I have a hourly imbalance all the way up here, which is not ideal. So then I would go to the 1 hour time frame, and I'm gonna wait pretty much for London session to start. So I'm gonna wait for Tokyo. There is Tokyo. Okay, London session is starting. What did we just do? Well, we are taking liquidity. And you can see I constantly flick through the different time frames. All right, we're right now taking liquidity. What do I want to see? I want to see a potential rebalance of a 1 hourly zone potentially. Let's see. Okay, nothing is rebalancing. Nothing is rebalancing. Did we miss something on the 15 minutes? Not necessarily. Okay, so this market is just impulsing towards our liquidity. Now, for the first time, we are pulling back into a 1 hourly bearish imbalance. Now, I'm gonna very quickly go and check the 4 hourly time frame. And what really sucks about TradingView is like the candles have kind of already printed, and I don't love it. But what we see is that potentially there is a 4 hourly bearish imbalance forming, but you don't see when it's also going to form. So another really big drawback of TradingView. But let's say I want to take, again, let's say bearish imbalances on a 1 hour, 4 hour is bearish, we're below the EMA. I want to take a trade from this 1 hourly zone. What I would need is a 5-minute VSR. I go to the 5-minute time frame. There is the market tapping, so I'm going to wait for a 5-minute VSR. Okay, this one was not it. And you just click here, you click play, and you wait. You wait, there is my 5-minute VSR. All right, 5-minute VSR. I can quickly check if there is something on the 50-minute against me, and there is nothing on the 50-minute against me. So I'm gonna enter from here. All right, so then you can click your buy and short and long positions. Okay, and you plot it on here, and you set the stop loss. Now they added a thing where, and my most recent liquidity is this low. Why this low? Because that is the 1 hourly low hanging fruit, the most recent low here. Now they did add, so they have this paper trading thing where, for example, right now, but then it doesn't really tell you how to calculate risk. So for example, you can right click and you can do create limit order. All right. And then I want to place a, like I haven't backtested on TradingView. No, I want a market order. And then how do I set a stop loss on TradingView? But you can literally take a trade. Okay. But it's with a very random lot size. So then you can drag the stop loss up here above this high. Oh, it's not a random stop loss. Actually, it's just 1,000. So that seems like, what account am I trading with? Where does it say? Oh my God, I don't know what account am I trading. How much money do I have? Anyway, I set my stop loss above here and I can drag my take profit at the liquidity, which is 1.5 R. Confirm. Now this sets the orders. Okay. And now you continue to click play. Let's see. And you can also see your take profit here. I mean, your floating profit. Let's see. Okay, we hit take profit and we actually went to all the way to the lowest point. So now what you do now is really important. I will share with you a Notion template, the Fanatic trading station. I hope you know how to use Notion. You can open up the backtesting journal, and here you're going to open up, for example, you're going to name this one and you're going to click here and you're going to click new page. When you click new page, it's going to populate hard time frame bias, lower time frame entry, and then there are some extra stuff right here. Okay. So what now you want to do is you want to go back to TradingView. This is the hard work. And you go to the daily time frame and you start taking screenshots. And you can even use here, there is a thing that is called call out. You can use the call out here and you can say, so you can click and drag and you can say daily was bearish, looking for these bearish liquidity targets. Okay, and you can mark this bearish liquidity target. Okay, now what you do is you go here and this the camera, take a snapshot, copy image, you copy image, and then you go back to Notion and you hit Control V. And now you have your chart that you can later on review. And you do this for all the time frames because that is the hard work, everybody. But if you're not willing to do this hard work, right, then you zoom in and you say, okay, we push down, no 4H retest. So I went to 1H. Again, camera, copy image, Notion, Control V. Great. Then you go to 1 hour. Okay. Call out. 1H imbalance got retested in New York session. I dropped to 15 minutes to 5 minutes to look for VSR. Copy image, Notion, Bingo. So that is my top-down analysis. Okay. And then I go to lower time frame entry. I go to the 5-minute time frame. There is the 5-minute time frame, and I take a screenshot again. 5-minute VSR under the EMA, targeting low-hanging fruit. Copy image. Boom. And now here you have a lot of other things, right? So you have the day. So what day is that? The time of day. So you can, for example, go and check. Like, this is if you really want to get good data. Okay. That was Tuesday at 8:20. Okay. So that was on Tuesday at 08:20 New York time. Entry model was, oh, look at how many entry models there are. I have to work on this. Entry model was a 5-minute VSR. Higher time frame POI was a 1-hour imbalance. The stop loss in pips, you probably don't need this. And we have a 1.5 R. Our risk was 1%. And the date, and you also have the pair, let's say, but in this case, you're going to do EU. And this is going to populate here, which is going to be really good to review later on. It was a win, 1% risk, 1.5 R. And as you go and make so many of these, you're going to start seeing the patterns. Okay. And then you continue. You remove everything. And in this case, I am just going to wait, for example, for the new Asian session to close, because that is when I start trading. There, London is opening, and I repeat the same process. Okay, so that is how you backtest on TradingView. Okay. All right, what did the daily do? Oh, the daily has taken massive liquidity. Okay, so I mark everything out. Daily liquidity. Okay, we have a daily imbalance above us. So can we go all the way to that daily imbalance? We could, but first I want to check the 4-hour. Can we push from something on the 4-hour? Well, the 4-hour actually had here a 4-hourly bearish imbalance, but this 4-hourly bearish imbalance, candle 1, candle 2, candle 3, it's failing to push. And right now this candle is taking liquidity. Is this a bullish sign? I'm not sure. Let me go to the 1-hourly time frame. Okay. Now the 1-hourly EMA is bearish, structure is bearish, and we're overall bearish. I'm not 100% sure of this idea. Now we're pulling back into this 1-hourly zone. Is this a high probability trade? No. Because we are bearish on the daily, we're bearish on the 4-hourly. We cannot just try to go long. But hey, let's say we want to go long. I just want to show you. Okay, so I go to the 5-minute time frame. Okay, and I'm going to be looking for a 5-minute VSR that goes above the EMA, and I'm going to be targeting here. Let's see if we get a 5-minute. 5-minute VSR. I pressed a little bit too fast, so that is where we take the trade. Now, if you want to do the paper trading, you have to be a little bit careful, because right now if I click, you can create limit order like that, and yeah, then I'm gonna do a buy, but it executes here, and then you can drag your stop loss here. And then in this case, you can see, right, we're gonna take liquidity for a 0.6 R, which is not great. I can try to go for a 1.5, but where is this 1.5 R going? Do I have something objective? Well, let's say I want to target this 1-hourly reaction area. I mean, this trade is bad, but we're gonna try it. Okay, so we execute this trade. Okay, let's see how it plays out. We can set our stop loss under here, and now it's suddenly $55. Why? And then take profit. Let's say we go here. Confirm. Let's see how it plays out. Oh, damn! We should have went for the take profit just at the reaction area. Like, look at how strong these reactions. So I can right now go break even. How do you go break even? You drag your stop loss exactly where your entry is. So right now, if the market reverses against you, you're going to exit with a 0. And there is our take profit. And right now you resume the same thing. All right, you resume the same thing. You go to the daily time frame and you start typing. Okay, you go to Notion. You open up another one, again, EU. And then you open up a new page, all right, and you start once again. Back here, daily time frame. Daily time frame took liquidity. I expect a potential rebalance. Good. Screenshot, Notion, paste. 4-hourly time frame. And you want to be intentional with it, okay? Not just boom, 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 take some trades. You can do a quick boom, 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 take some trades, you know? But this is really the hard work. So here what I can write, 4H imbalance got tested, but failed to push lower. It's failing. So can we go long? We can check 1H. Screenshot. back, and so on and so forth, right? We go to the 1 hour, and then we can say, okay, we saw this 1 hourly bullish imbalance, and then I go to the 5 minute, and I saw this 5 minute VSR, okay, and then I want to be targeting potentially this 1 hour reaction area and also the EMA, because that can definitely give us, like, look at the response that it's giving us. Look at how the market starts chopping at the EMA. And then you continue. There is your one trade. And then again, same thing you keep doing. There is Tokyo, all right, London starts, and we reset. Now, what did the market do? You go back to the daily time frame, okay? You delete everything. What is the trend? Daily. There is a daily bearish imbalance that got created. Good. Can we pull back to rebalance it? We could. There is a most recent liquidity. Good. The market took liquidity first, but it has right now potential to rebalance. But is it going to pull back into this daily zone? Let's see. Now, is this forward zone closed? No, it's not closed. Okay, is it now closed? I don't know. Okay, so let's say I want to take a short trade from that daily. So is the market gonna come into the daily? No. And you can see on this day we didn't take any trades. Like, there was nothing, so we go on to the next day. Kind of the same overall bias prevails. You check the daily time frame. That imbalance is still above. I check the 4 hourly time frame. There are no imbalances on the 4 hour. So I kind of just really wait right now. Really wait for something to happen. Oh, we massively flushed lower and we created this 1 hourly bearish imbalance. So now maybe the market doesn't want to pull back all the way up here. So can I trade it short towards this liquidity and then potentially towards this low? Let's see. Okay. Oh, wow. That was a crazy retest of that 1 hour. If I go to the 5 minutes, did I get a VSR? I did get a VSR here. And it was just before the liquidity was taken. So yeah, in this case, you can see I was on the 1 hour and out on the 5 minutes. So the market already went. All right. So I can try, for example, a trade like this. This is definitely not a great trade because it's very close to the liquidity, but you can try. All right. And you try it out. Let's see. And we hit stop loss on this one. And then again, you journal everything. You take note of everything, and then you just keep going on to the next, okay? So that is how you backtest on TradingView, and what is really important is that you take note of all of these. So then at the end of the day, you can see, for example, this was 1.5, and then we took, for example, this one right now was a stop loss. So you type -1, and then at the end here, you can get, you're gonna get some statistics, but it should be giving you, okay, I'm gonna work this around and make sure it's proper. But yeah, this is how you backtest on TradingView. But right now I want to show you the better way to backtest. So the better and the more professional way to backtest is to use FXReplay.com. It is a software that is specifically designed for backtesting. It is a paid software, but within my resources, I'm gonna include a discount code. It should be Fanatic, and that is going to save you some percentages. To just help you out enroll in this one, but it is a $15 per month or $30 per month pro. This one has seconds data, futures and stock data, AI, journaling, unlimited. You can try with this one first, but personally I love this tool. I backtested a lot, although I don't do it anymore. So this is how it kind of looks like. You have your testing here, you have your sessions. These are all the trades that I have taken. It kind of gives you an overall kind of snapshots of everything. And then basically when you start backtesting, it is going to give you amazing data. So let's say, for example, here I see this is a completed backtest. So I can go to view session analytics, and this is going to give me everything about this backtesting session. So it started from pretty much, yeah, from January 2024, at the beginning of 2024, and I have ended it pretty much towards the end of 2024. So this is 1 year of backtesting. This is actually my future strategy. I have executed 461 trades with a win rate of 60%. The return during this year was 63%. It gives you the average risk to reward. It gives you the ideal average risk to reward. So that actually told me that I can increase my risk to reward a little bit. Profit factor is very important. Anything above 1 is a profitable strategy. Total winner, total losers, by buy and sell. Win rate, there it shows you by hours, which hours are most profitable and which are not that profitable. It shows you which days are more profitable and which not. And then it shows you the overall returns per month. All right. And then it shows you also the trades broken down by day. It shows you how many trades you're taking a day average, how many trades a week average, and how many trades a month on average. So then you can later on plan. But what it's really nice about this thing is you can journal them on the spot. So you can see I have taken screenshots for all of these trades that I have taken. So I have taken 460 trades, and every single trade I have screenshotted. Win, loss, stop loss, it doesn't matter. I have screenshotted everything. Okay. So basically, yeah, it's really nice. It's really nice, and you can do a lot of these things. So let's do, for example, a test. So what I want to do is I want to start a new backtesting session, and let's say we want to do a gold backtest account balance. You do, let's say, $10,000, and assets, we're gonna do gold. Let's say, there we go. We select gold, and then select chart layouts. Yeah, this one is, yeah, I don't want any chart layout. Initial date. So let's say you want to backtest, for example, from the 1st of January this year, and the end date, we're going to click all to update, so that it's going to update as we get more data. And then we're going to click create session, and that is going to take us onto the charts. And why I love it is because it's TradingView charts. So we're already used to TradingView, so we know how to do TradingView. You have to spend, however, a little bit of time to polish everything. Okay, so remove this in this indicator again, go to settings, change your body, change your this, change your yeah, basically the canvas, the background, like do it how you want. So this is what I currently have. And what you also have to do is a few things here. We have to add a few indicators. So you can click on indicators. Of course, you want to add our exponential moving average, same as TradingView, everybody. So 50 moving average, great. There we have the 50. Now again, you can, I want to make it a little bit bigger like that. Great. And then what do we need? If you want to use market structure, you probably have fractals here. William Fractal, is that? Yep. You actually have fractals, which is great. I want to, oops, what did I click? I want to do sessions. So that is really important. So we're going to do custom session indicator by FXReplay, which is great. And then we're going to go to the settings, and we're going to change the settings. So here we see New York, Asia, London. So we go New York. Again, you know the drill, guys. New York starts from 6 and it goes into 11. This one, this is session 2 Asia, starts from 18. Okay, 18, and it ends at 2. And then we have from 2, that's for London, and it ends until 5. And this is gonna make our session windows. I don't want to see any vertical lines. The colors to me look fine. And there we go. We're all set up in the matter of 1 minute. Now, we start the same process. Again, add your time frames here as a favorite. It's the same as TradingView. Now, what do we have here on gold? For example, at the beginning of the year, we have the first thing that I see is a daily bearish imbalance. So sellers are currently in control. The EMA, however, is bullish. What is the last thing that the market did? Is it took liquidity. Here, what would I expect to happen? I would expect to pull back potentially and to offer some fair value. I will then transition onto the following time frame to see what is happening on the floor. Do we have any imbalance on the floor? In fact, no. So we have taken liquidity here. We don't have any imbalances. So I totally think we can attack this high and this high, because when the market has taken liquidity, but it doesn't have anything to rebalance, it's going to seek the liquidity anyway. And then I can go to the 1 hour, and what I'm going to do is I'm going to go to the New York session. So I'm going to start clicking. There's Asia. Our first liquidity got collected. This is a brand new backtest, by the way, so I really don't know what is happening. Okay. Oh, click a little bit more. Let me do that. Let me do that, this vertical line, so I can actually see where it starts. Okay, great. Now, what is happening? Did we tap? Okay, so we did not tap into this daily imbalance. Okay, we didn't tap into that daily imbalance. Cool. The hourly time frame, however, is giving us a hourly bullish. However, this is not an extremely high probability trade. Why? Because we're trading against structure. The market is beautifully bouncing from the 4-hour EMA. However, for the sake of it, let's try a trade. I'm going to go to the 15-minute time frame, and what I'm going to be looking for is for a 15-minute VSR. Let's see. Okay. All right, not yet. Okay, this is not looking good. Actually, 15-minute bearish. All right, so we really didn't get a 15-minute VSR. And right now, it seems like that the hourly time frame is actually failing this imbalance. So what can I then forecast? I can forecast that if this hourly imbalance failed, we can very likely go to the origin. And you can always mark these things. So origin of 4H. Oh my God. Origin of 4H. Okay. And so can I try to trade it short right now? Let's see. Do we get any 50-minute zones bearish? That's a 50-minute bearish zone. And this one got tapped. Okay. Cool. That is a 50-minute zone. All right. So let me check if there is on the 1H. Okay. So we have this on the 1H, but I will first try the 50-minute. And then if the 50-minute fails, then I can see if we get into this 1H. And I'm looking to target this origin on the 4H. So right now we're in the 50-minute and we're pulling back. And the most recent liquidity on the 50-minute is going to be this one. Let me make it full screen. So what I need to do right now is I need to go to the 3-minute time frame. Is that a VSR? I don't think so. Wait a little bit more. It is a VSR, but it's an extremely small. Hey, missed the trade. Let me check the 1 minute. We got a 1 minute VSR. Okay. Let's just, for example's sake, okay, let me not be extremely perfectionistic. Let's say I want to take a trade from here. Now, how do you do this? You have to do the buy and sell tool, which you can find here, from here, start them, okay? And exactly where you want to enter, place the tool exactly here. Then drag your stop loss exactly where you want to place the stop loss, and drag your take profit exactly where you want to place the take profit. In this case, I would go for a 1.5R. Then what do you do is you click on this one, and you have to create an order here, okay? Order. And once you have first clicked on the thing, on the sell tool, and then create order, it is automatically gonna define everything. So I want to do 1% risk, okay? It's a sell side, entry, stop loss, take profit. They're all done. And then what you want to do is save and journal. So when you click save and journal, that is going to open up the journal. And what you can do is you can take a very quick screenshot. So where did this thing go? You just click here and it automatically takes a screenshot of your entry. All right. So then, for example, right now, I'm just going to start playing and it's going to immediately show you the profit and loss. So here you cannot cheat. You execute. If I skipped a little bit, I cannot go back and say, okay, I'm going to take the trade from here. No, here you're really executing. Okay, so right now we're taking liquidity. I would like to go break even. How do you go break even? You take your stop loss and I'm going to drag it exactly where my entry is. So right now, if this goes against me, I'm going to lose nothing. Let's see if it's actually going to hit take profit. Take profit hit. Okay, so here you can see realized P&L. $149. It also includes commissions and includes everything. It is a great software. So what you can do right now is this little thing should be on another window. Okay, you can keep it on a separate window or like on your other screen, and you just click again, add screenshot. And now what you can do once again is you do the same. You go to the volatility time frame, okay, and you get your call out, start it, and you say, okay, 4H is failing. I am targeting weak low. And then again, you need this thing again, which is right now on my other screen, and I just click here and that's gonna take the screenshot. And then when you click save, this saves the trade. And also later on, when you open this trade and you want to view it, it's gonna show you the screenshots that you took, and you can basically review the trade. It is amazing. Okay, so we took the first trade, and basically what I would do right now is I will delete everything, okay, and I will just go towards the next New York session. There is here a thing, go to New York session. You can do custom settings. So I wanted to go at start of New York session, which for me is gonna be 6, not 6:36. There, save. Okay, so now if I go to here, go to New York session. Come on, go to New York session. Is it 6? No, why is it glitching? Hello, go to New York session. Okay, there we go. So we teleported to today's New York session, and I'm gonna delete everything. And that's wrong a little bit. Okay, now is the New York session. Oh, I'm sorry, I have to change my time here. I'm gonna go to New York. Okay, great. And then we'll repeat, everybody, the process. Now we go back to the daily time frame. Ooh, what do we have right now is a daily imbalance retest. Okay, can I look for shorts? I probably can, but we're overall bullish market structure, so it's not the best thing to do. Let me check the volatility time frame. Do we have something on the volatility time frame? No, we actually do have a hourly bullish imbalance. Okay, so what am I gonna do in this case? It's a little bit 50-50. The market structure on the hourly is bullish. The daily market structure is bullish, but we're tapping into this daily bearish imbalance. So let me maybe try to short from that imbalance. Let me see if I'm gonna get a 1 hourly bearish imbalance to maybe short into the hourly zone. Let's see. Boom, 1 hourly bearish imbalance. Let's see. And now there is my 1 hourly bearish imbalance. Now what I would do is I can use, so I can already enter here, by the way, and look to targets. Like the target is not having a great risk to reward. But because I'm not very sure of this setup, I want to go to the 5-minute time frame right now, and I want to wait for the market to retest the 1 hour and give me a 5-minute VSR. Let's see if that happens. Nope, runs away. Oh, pull back. Okay, good. Everything is as it is. I always check. So forward time frame, we haven't tapped any imbalances. Let me see if we get a 5-minute VSR. That is not a 5-minute VSR. And it seems like, okay, it seems like we just invalidated this 1 hourly. Now, why did we do that? Well, because we're just absolutely bullish on gold. Okay, and now what do I do, everybody? Well, I immediately ask the question, okay, what is next? We're right now making a 1 hourly bullish imbalance. Can I go long? Can I go long? Well, yeah, 4 hourly is bullish, 1 hourly is bullish. Let's see if the market is going to pull back into this one, but I think we are outside of session. So I'm not taking this trade because it is outside of session, and you can see the market just starts really getting slow. So then what I do is I delete everything. I go to New York session, and it teleports me at the new New York session. And again, everybody, you repeat the same boring process. Yesterday, the market imposed. We're pulling back into this daily imbalance. So far, candle 1 on the daily time frame, it hasn't done much. And right now, we're in a candle 2. Okay, I am a little bit bullish, but I still feel it can go down. Do we have something on the 4-hourly time frame? Absolutely not. So I am not interested in trading this day. I can go to the 1 hour, maybe see if it's gonna do something. There is a very little 1 hourly zone, but this is definitely not something that I'm interested in. Why was I not interested in this 1 hour zone? Oh my god, it was a perfect 1 hour zone. It gave a 5-minute VSR, and it went for a 1.5 hour. But you see right here, all right? You cannot go back. You cannot cheat because I didn't wait on this one and I didn't execute the trade. So right now, that's it. I didn't take that trade. So this really gets you as close as possible to live performance, because I can journal this right now. Cool, I can log it in my Notion, in my trading journal, but I didn't take it on FXReplay, so it's not in my P&L. So that is not my performance. So you have to be really, really, really careful. Okay, let's do one more day because I don't want to make this way too long, but I probably want to take one more trade. Okay. Back into the daily again, every day. What is happening right now? This daily bearish imbalance has failed. Why? Because we have candle 1 and candle 2, and candle 2 broke above candle 1's high. Okay, good. Now we're having a daily bullish imbalance. Now I am really bullish on gold. How would I tackle it though? Would I wait for the market to pull back into the daily? Or I will go to the 4-hourly and check if there is something to potentially push it on the 4-hourly. Unfortunately not. There was a 4-hourly bullish imbalance here. Candle 1, candle 2 failed. Where is the origin of that 4-hourly bullish imbalance? It is here, and the market attacked the origin. So we have taken liquidity and we don't have anything to rebalance on the 4-hour. And I think we can go down to the daily, but we can also continue going up because we have taken liquidity on the downside, and maybe we can go take liquidity on the upside. Let's see what is the 1-hourly time frame doing and what it's gonna do towards the opening. Okay, the opening gives us a 1-hourly bearish imbalance in New York session. We are closing below and retesting the EMA. So I can say, okay, I'm a little bit more bearish. Let's see if we can get to that daily zone. I'm going to drop in this case to the 5-minute time frame, and I'm gonna look for this 1-hourly zone to get retested. Okay. We tapped into the daily. Straight away, we tapped into the daily. Now we have to look for longs because we tapped into the daily. So I'm immediately gonna shift to the 1-hour time frame, and I'm gonna look for a 1-hour VSR. Okay, it didn't give us a VSR. Now we're outside of session. And now we go down again. That's backtesting, guys. You really have to be very careful. Now, We didn't take any trades here. Now, again, we are tapping into this daily zone. We go back to the daily. Candle 1 came in, rejected. Right now, candle 2 is coming in pretty deep. Okay, so can I still look for longs? I go to the Volatility time frame and I see the Volatility time frame gave us a bearish imbalance. That is not great. So can I go long right now? I need the 1 hour VSR from a daily zone, remember? So let's wait for it. There's my 1 hour VSR. Now what I can do is, let me just take a trade, guys. Okay, so what I would do in this case is I would wait for this to pull back. But let's say we take a trade from here. That's a massive swing trade. Stop loss goes under the lowest low inside the daily imbalance. And our liquidity is here. Really not a great trade. Okay, let's try to set, let me show you how to set the limit. So let's say I want to enter on a retest of this 1 hour imbalance. And then I beautifully want to target 1.5. Click on this and then go to order, okay, and it's gonna immediately know that you're gonna be setting a limit. All right, so everything stays the same. 1% risk limit. It knows the stop loss, knows, and then we click save and journal. All right, that is gonna open the journal. You can take a screenshot before, for example, the trade. Minimize this, and right now we have a limit at the imbalance open. So let's see if it's gonna get retested. Beautiful retest. Now we are in the trade with a buy limit. So now let's see if it's a take profit or a stop loss. Another imbalance got created. Let's see if it's gonna push price higher to our take profit. Okay, London session is opening right now. And there is New York. So now I can even start looking for new trades. So what is the volatility doing? The volatility time frame has a volatility bullish imbalance here. So can it pull back? It could. The 1 hourly time frame is very choppy, by the way. So let's see how the 1 hour time frame is gonna develop. Okay, and it hit our take profit. Beautiful, beautiful trade, really beautiful trade. Daily zone, 1 hourly VSR, retest, beautiful move. And now again, you see now we are already $300 in profit. Now again, you can pull out the thing, take a screenshot of the result, go to the daily time frame, show the zone. All right, go here to this thing again, screenshot that, and then you click save after all of your drawings. Now we've made 2 profitable trades. Delete everything. All right, go to New York session and you just continue. We've had a massive expansion. All right, volatility time frame, what do we have? We have a volatility zone. Are we gonna pull back into that volatility zone? Let us wait and see. You wait and see, you wait and see. Doesn't pull back, you can then go to check out the 50-minute and so on and so forth. And then as you have taken, for example, 100 trades, you go back to return to dashboard. All right, and now we have to find our session. There is our backtesting session, view session analytics, and now you're gonna see everything. We've taken 2 trades, 100% win rate, average risk to reward 1.5 R, and then basically everything is gonna be here. This the time, the day as well, and so far in January we've made 3%. It's gonna show you the trades, and then if you go to trades right here, it is going to show you exactly the trades that you took. There is your gallery. Okay, and it's what is also going to show you, it used to show like the maximum risk to reward. So you can see we could have went for a 5R on that trade. We took a 1.5, we could have went for 5. On this trade, we took a 1.5, we could have taken 2.26. And this eventually is going to show you the perfect risk to reward that you can get. So this is FXReplay. I totally recommend it. I've used it a lot. I've had different strategies here. It is of course a paid thing, but I think it's totally worth it. So that is how you backtest. All right, now we know how to backtest. So the next way to improve is to demo trade, paper trade, or what is also called as sim trading. So what are the benefits of demo trading? It is first of all better than backtesting. Why? Because you do it in the live markets. So you get a better replica of potential live performance because you have to wait, you have to analyze, you have to focus, you have to execute, you have to adapt. And I believe it's better. Like backtesting can give you a lot of data for a short period of time. However, like demo trading in the live markets, it's gonna take you a lot of time to get a lot of data, okay? But you do it live, so that is what matters. It is a great first step before you start live trading. It's good. Now, the drawback of demo is you're doing it with paper money, so you don't have emotions involved. You can very easily execute and make profit, and you can get like a fake confidence. You're like, all right, on demo, I'm killing it, let's go live. And then you go live, deposit your real money, your hard-earned money, and you take a stop loss and your confidence just get shattered, right? It's not good. And then you might say, okay, I maybe need to demo trade a little bit more, all right, to build a little bit more confidence. But your confidence that you build in demo trading, it's fragile. When you go to the live market and you hit a stop loss, it's immediately destroyed. It's really similar to backtesting. The confidence you built in demo trading and in backtesting, it's fragile. It's not real. And then with backtesting, with demo trading, sorry, you can be a little bit reckless because it's paper money. You're like, all right, I'm gonna take a trade here, I'm gonna take a trade there, I'm gonna test this, gonna test that. It's okay, but you're just not serious. You're not serious with it. And too much demo can give you bad psychology habits. It's only good for brand new traders to get used to the execution platform, to get used to the strategy, to kind of really get the ball rolling, but don't do it for more than a month. Don't do demo trading for more than a month, okay? So how do you actually demo trade? Let's go on a side quest, because if you're a brand new beginner, completely new, you have no idea how this platform works, how these brokers work, I have to make this for you so that you're not lost. Now, how do you open trades on demo? You open up a demo account. How do you open a demo account? You go pick a broker. Any broker is fine. Just do your research. I'm not here to recommend brokers. I'm not here to recommend anything and make money out of that. Different brokers operate and are regulated in different countries. Preferably, you want to have the regulation either by the FCA, this is in London, or to be regulated in America, or to be regulated minimum in Cyprus, the CySEC. Based on your country as well. So for Americans, you don't get access to a lot of brokers. So do research. What is the best broker in my country that is regulated? Ensure that they're good. Okay, read reviews. That is your job. Then you download MetaTrader 5, which is going to be the most basic platform. You also have CTrader. I'm going to give you a quick tutorial on MetaTrader 5 because this is what I use. When you open an account in a broker, they're going to give you credentials. These are going to be your login credentials. You're going to open MetaTrader 5. And you're going to log in with your credentials, and then you're going to start opening the charts. All right, you want to trade on MetaTrader 5. You're going to polish them a little bit because they're going to look a little bit crazy. Okay, and then what you have to do is you have to calculate your risk per trade. Now, you can do manual risk calculation, which I'm going to show you how to do, or you can do automatic risk calculation with an expert advisor. Okay, which I totally recommend. It's called Magic Keys. I have a physical version. This is how it looks like. All right, there it is. So you have so many options, and it calculates all the risk for you. All right, so totally recommend that. Now, let us go into Google. Okay, so I personally trade with IC Markets. Okay, do research, see if they're supported in your country. That is the broker that I trade with. Again, I'm not going to leave any links because I'm not affiliated with them. They are fine, however. So first things first, when you go to IC Markets, all right, you have to make a registration. So see, all right, this website is regulated this, we continue, we go where we should go, start trading, okay, and then you, of course, make a registration. Anywhere you are, see if your country is supported, all right, first name, last name, email, mobile, tell us about yourself, boom, 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 make your registration. So when you make your registration, then you can log in as a client. Okay, and basically I am right now going to log into my account. So then you're gonna have, for example, accounts, withdrawals, and all of this stuff. Live account, you can open a live account, for example. That's my live account here, or you can open a demo account. Now for this video, of course, we're gonna open a demo account. And again, open new demo account. You choose MetaTrader 5, you do row spread because you want to trade with row spread. Now, what is the difference between a standard account and a row spread? A standard account has a big spread, all right, but it doesn't cost you commission. This gives you row spreads, but it costs you commission. So I prefer this one. Currency, if you're in Europe, maybe you do Euro. If you're in the US, you do USD, doesn't matter. Leverage, it doesn't matter as well. Like, let's do 1 to 500, it doesn't matter. Like, you can do one. Very likely, if you're gonna opening a live account, you're gonna have a 1 to 30. So you better do it exactly like this. And let's do an initial deposit. Like, let's say we want to trade with a $10,000. Okay, or maybe you want to trade, let's say, with $1,000 because that is what you plan to deposit. Now then you click proceed. okay? And this should right now create an account for you. And when this creates this account, you're gonna get your password, all right? So that is going to be your, so there is the login, okay? And there is the password. So now then what you want to do is you want to go to downloads and you want to download MetaTrader 5. So click download again, download, click here, and you pretty much install it, okay? Go through the installation. It's gonna install. I don't know why I'm installing it. I have it, but all right, congratulations. We are waiting for you. Let's go. You click finish. That is gonna open a website here. And now somewhere on your desktop, you're gonna have MetaTrader 5. Now, this is where it gets a little bit complicated, okay? Now, let us now have a lot of stuff here. Let me close all of this. So basically, first things first, you're not gonna have any accounts. So here on view, you want to open the navigator, okay? Open the navigator first, and then you go to accounts, and then you want to right click here, and you want to log in to a trade account. Now we go back to the website and we go and find our demo account, which is, so now I have two, which is, let's say, this one. So we copy this, that is our username. We copy it, we go to IC, we place it right here. And then we go and we copy this, the password. We make sure we copy it the right way. And then we paste the password and we click save password. And then we also have to check the server, which is IC Market SC Demo for me. Yours is gonna be different. So I'm gonna do IC Markets SC Demo and I'm gonna click OK. And now this should potentially connect. We'll wait for it to connect. There we go, it connected. It had some fancy sounds. You're gonna get some crazy stuff happening here, okay? Now, what do you do next here is you go to view and you go market watch, okay? Market watch. And here you have to click to add and you have to add the different instruments. So Euro USD, GBP USD, and this, okay? Then you click, right click and you go chart window. And this is going to open a new chart window, for example, for Euro USD. Now, what I like doing, for example, is change my chart a little bit. I will go to properties and I will just remove the grid. Or I can just do scheme. I will do black and white and I will remove the grid. I will click none and then I'm gonna click OK. And that is gonna give me a very nice chart, okay? And so basically right now we are in the demo trading platform. So this is where we're gonna be executing our trades. What I personally do is I analyze, okay? I analyze on TradingView. So I can go to TradingView right now. And let's say we want to take a trade on EU, okay? We're gonna perform our analysis. Boom, 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 boom. We perform. Let's see. Let's say we want to take a long trade right now. So I'm looking for a long trade exactly right here. So I can, of course, say, okay, I'm gonna look for a long trade like this. All right. However, how do I actually execute this? So this is where, of course, everybody, I would recommend that you get the magic keys. Now, they're going to give you a tutorial and everything. Now, I don't have it here, I believe. But let's say you don't have this tool and you want to execute a trade. Now, you have to do it in a manual way, which sucks. And I actually like using my phone. So if you want if you're not going to use magic keys, okay, you can download MetaTrader 5 on your phone and use the same login credentials to log in from your phone, okay? But if you want to do it from here, you have to click create new order and you want to do a market execution, okay? And then basically you have to determine what lot size you're gonna use. How do you determine this? You can do it in a manual way by going into Google and typing position size calculator. And I really like this one on MyFX book. Okay, so position size calculator on MyFX book. You can go home here, Forex calculators, position size calculators. We are on Euro USD. Our account is in USD. The account size, what account size did we pick? I think we picked $1,000. The risk that we want to risk is 1% and our stop loss. So our stop loss determines our lot size. Okay, so we can go back to TradingView. And what is my stop loss? It's this one here, 32.2. That is 32 pips. That is 32 pips. Now the market is moving a little bit, so let's round it up. Let's say 35 pips. I want to round it up for a 35 pips. Okay, as you can see, 0.035. Remember, this is the pip and this is the pipette. So we do 35 pips and I type 35 pips and I click calculate. And that gives me 0.03 lots. And that is going to be $10 worth of risk because 1% out of $1,000 is $10. And then I go back to MetaTrader and I type 0.03. And then you have to set up your stop loss level. You see, it's a little bit slow. Now my stop loss is gonna be here at 14.4030. So I type 1.144030, and let's say my take profit, I want to be at this high at 1480. 1.1480, and then I click buy by market. Congratulations, you just did your first trade. Okay. And then of course you're gonna get, you can move your take profit up and down. So drag it and move it here, drag it and move it here if you want. And your stop loss is down there. You can see, for example, if right now my stop loss gets hit, I'm going to lose minus $10.38. All right. That is it. Now let's say I want to move my stop loss under this low. I can do that. Come on. Why it doesn't move? Okay, just moved. Got a little bit of a lag. And now you can see I'm going to lose $3.45. I can go, for example, on the 1 minute time frame to see exactly where I entered the trade, which is right here. And basically right now we're demo trading. Okay, we are demo trading. Now, let's say we wanted to enter. Let me give you one more example. Let's say we have a 50-minute zone here, which we do not. And right now we want to enter on the 1 minute time frame. So I go to the 1 minute time frame and I want to enter from here. And I want to place my stop loss here. Again, another example. How many pips is that? That is 11 pips. So I'm just going to round it to 11. Okay, 11 pips. Position size calculator. I just changed the stop loss to 11 pips. Calculate. And now this gives me 0.09 lots. Okay, for a smaller stop loss, you're going to risk more, but the risk is still going to be the same. So then I go back right here. You can also click this thing here so you can get more space. And again, there was actually a thing where you can do one-click trading. Okay, so for example, here I will do 0.09 and I'm just going to click buy and I'm long. But then, however, and then when you click long, you can drag your stop loss. So you can see I dragged from the entry down to set a stop loss. So if I set my stop loss here, you can see I'm going to lose $6. And then from the entry up, you're going to set a take profit. So now if the market goes up, I'm going to get executed. Let it set here. And I'm going to win $13. And if I lose, I'm going to lose $3. All right. But we have two stop loss levels right now because we have two trades. And this is MetaTrader. This is also how I personally execute my live trades. That is what I do. I still do it like this. Okay. However, I use an automated thing that does it all for me. I don't have to go online. I don't have to check my pips. I don't have to check my risk. I don't have to check anything. Okay. And then what you can also do is you can go to view and you can click toolbox. Okay. And then you can go to trade right here. And this is going to show you your current running trades. And that is going to show you the potential floating profit and your floating loss. Okay, and you can pretty much see them here. You can also look at them on your phone. And that is how you demo trade. And basically right now, you can see we executed right here. So I can go to TradingView. And this is where I executed here. And so basically my stop loss is actually 7 pips right now. And I can right now monitor this trade on TradingView. Okay, but I am executed in my broker because you can actually, by the way, trade on TradingView with IC markets. Okay, you just have to do, how do we do that? You just have to go to trade. How do we do this? Trade here, and you can find IC markets. Okay, you see which IC markets you are. Okay, connect, and then you literally connect with your email and with your account, and then it's gonna find your, so let me actually check it out. Okay, so I just logged in. So what, however, you have to do is you have to right now type Euro USD and you have to find IC Markets. And when I click on IC Markets, now I can basically trade it. Now I just have to check. This is another demo account. So it's not the demo account that we have. But if you do it this way right now, you can execute directly from TradingView. So let's say that you immediately want to take a trade from here and put a stop loss here and a take profit here. You right click on this, create limit order, and that is automatically gonna calculate everything, or you can just do markets. Okay, you have to include your risk somewhere, percentage balance. Let me see, risk euro, risk of balance. I want to do 1% risk. Oh my god, it's so complex, everybody. This is why I do it. So okay, so you can do like so let me see, 5 lots. Yeah, so 5 lots right now is 1% of balance, and you can click buy, and you're basically entered into a buy. We entered the buy right here, and our stop loss is you can move the stop loss, for example, below here, and you can see we have $352 of risk. Now, I would totally recommend that you actually get magic keys so you don't have to deal with all of this stuff. But right now, you actually see your live trade executed right here on TradingView. In order to close it, just click close position, and you are out. All right, this is not my live account, right? No, this is some demo account. Good. And then if you go back, for example, to MetaTrader here, there are our trades. Our first trade is right now at a profit for $2, and then this trade is a little bit of a loss. If I want to close this one, I just click here, closed, and you can see where you entered and where you closed. And if I want to close this one, closed, boom, and this is where we entered, this is where we closed. And that is how you demo trade. This is how you open a demo account. This is how you log in into MT5, and this is how you start trading with manually calculating your risk. But if you want to do, for example, automate it with magic keys, I will also leave a link in the description and in the resources, so you can get that as well. All right, fanatics, we had a look how to backtest, we had a look how to demo trade, we opened up your demo trading accounts, and we learned a lot. So right now, let's see what are the other ways to improve as a trader. One way is to do forward testing. So what are the benefits of forward testing, and what actually forward testing is? It is just observing. It is just observation and also pretending to take trades, which is going to build your pattern recognition. Now, why this is good is because you are observing the market without any emotions. You don't have to stress about execution. You don't have to stress about anything. So it's a really good way to just learn and to just like memorize the pattern and to see them develop live. So forward testing is also live, looking at the markets live, but then you just pretend that you're trading. But in order for this to be useful, you must journal every trade that you take, because you're not taking them, but you have to really be intentional with it, and you have to journal every valid setup, so then you can also gain the data. Because remember, experience and data are the two most important things to improve. So are you gonna backtest, are you gonna demo trade, are you gonna forward test or do case studies to gain that experience and to gain that data? But you still have to journal. It is a good way to see the patterns develop live before you start executing. So just to kind of get used a little bit with the edge, it is a really good way. And there are also no emotions, so you can perceive the patterns more objectively and memorize them without stressing too much, like, should I enter here, should I enter there? You're a little bit more relaxed. Now, the drawbacks of forward testing is that if you are not intentional with it, it is just useless. So you cannot just say, all right, pretend I'm gonna take a long here, it hits stop loss, all right, I'm not gonna journal it, I'm not gonna do anything with it, I'm just going to sweep it under the carpet. If you do this, it's not gonna help, it's useless. And it can also build a little bit of bad habits. You might get used to just forward testing, and then when you go live, you might actually hesitate to click the button to open the trade. And then you might end up just forward testing or just paper trading the trades, which is not good. So basically, what is a forward test? It is very simple. Let me go, for example, to a random chart. So here we have the DXY. And you would perform your overall analysis, okay? We've done that already quite a few times. Daily time frame, let's say bullish. Hourly time frame, let's say is bullish. And let's say that, for example, here we wanted to take a long. We had this hourly bullish imbalance. And let's say you were paper trading here and you saw, so let's say the market was here, okay? And you're like, okay, so right now I'm gonna try a 4-hourly time frame short. So I'm looking for a 50-minute VSR. There is my 50-minute VSR. So right now, pretend that this was happening live, by the way, because I'm on replay right now. Instead of going to open the trade on demo or actually taking the trade, you would just say, okay, let's pretend that I'm taking this trade. So you would take your buy tool, which is right here again, and you would place it and you would put the stop loss below here. And you would say, okay, I'm going to target, for example, let's say 1.5R. There is a liquidity point right here. So this is where I can potentially look to manage my position. And then you will just watch the market develop live. That's it. So you're watching, okay, it's pushing good, great. You can continue to read the market. Do we have any new 50-minute zones? No. You can go to check out the 1-hourly time frame. How is the 1-hourly time frame looking like? What do we have? Okay, there is the 1-hourly liquidity, we're taking it. So maybe I want to try to go break even or something, right? So you watch the trade live and you watch it, and there we go, we hit take profit. So that is kind of a forward test. And then what you have to do, however, is once again, you go back to your journal. And you do daily, 4-hourly, 1-hourly, and everything, and you mark that trade. So for example, what would be, let's say, what would be a forward test right now? Well, this 4-hourly zone here, candle 1, candle 2, candle 3 tried to push and take the liquidity, but it failed. And right now we're taking the liquidity on the opposing side. So are we going to go bearish? Well, how are we going to go bearish? Let's say, whoa, we actually saw here a 1-hourly bearish imbalance. Okay, cool. How do we trade a 1-hourly bearish imbalance? By having a 5-minute VSR. And then of course, there's your 5-minute VSR. You might have taken it from here, but let's say I want to go short right now. And I'm just going to say, okay, right now I would go short and I would put the stop loss here and I would look for a 1.5R. Here you can actually see the risk to reward here, by the way. And now you wait. So you pretend that you executed the trade. Now, of course, it's very important to take note of it and journal it. And now you have to wait. You have to be patient. You have to read. So when this 50-minute imbalance forms here right now in just 50 seconds, this imbalance is going to form. Or you can say, okay, I'm just going to put a limit here at the 50-minute and I'm going to wait and see how it's going to play out. So basically, this is your forward test. And then you wait. And when it taps, and then you just observe it. But then at the end of the day, what is really important is that you journal. You journal all the setups, you take note of them. Every single evening, I'm spending like 30 minutes to an hour just going over the market and all the setups that were presented, and I'm journaling them in complete details, okay? And that is what helps you learn. So that is forward testing. Right now, let's say I'm in a forward test, I'm in a paper, it's also called paper trading. So you're like, okay, I'm taking a short trade here. Let's pretend I'm just gonna paper trade it, or I'm just gonna forward test it. But then again, you have to take note of it. That is really important. So that is in general forward testing. It is a pretty easy way to kind of build a little bit of a visual experience and to boost your memory. The final way to improve is doing case studies, or I call it hindsight backtesting. Now, I really like this, by the way, and this is one of the main ways that I have worked a lot to improve on. It's really good. So what are the benefits of case studying? This is like active learning. So like learning from a student book, but actually going and learning from the market, okay? But why is it like a student book? Is because we are going to be learning from textbook examples. Really, that is kind of the aim of case studying, to find something that worked in the past and to really dissect it to pieces. I also give my private members assignments to do this because you are intentional. You take screenshots, you ask questions, and you're like a scientist on the charts. It is a great habit to improve pattern recognition. You put on some music, you just go and you make 2 to 3 case studies daily, right? It's a really enjoyable time. I do this daily, but I do it like I call it an end of day markup. So at the end of the day, I literally go over the price action of the day and I mark up everything that I can see, everything that I took, everything that I could have taken, put some music, journal everything. It's a really good time, and it really helps you to keep making that visual memory, to keep improving it, but also to learn new things and discover new things. And after you make 100 case studies like this, you have huge database of what good trades look like. My members, the first thing that I make them is to make 40 case studies, and then we review them together to see if what they're doing is right. And then I make them live trade, then they take another 40 live trades, then we cover them again. And by the time they do this, they have already journaled 80 to 100 trades and they're done. All right. They have really put in the reps. They have seen 100 different trades play out. Now they're really learning. And also the lack of emotion makes you fully focused and objective on price, which allows you to understand better and to just, as I told you, be like a scientist on the charts. Now, of course, as with everything, there is a drawback, and the biggest drawback is that it's hindsight. You find something that has already played out and you go and study it. You don't train your execution skills. But again, this is what perfection looks like. That's another hindsight. That's another drawback. Apart from hindsight, you're looking for perfection. You find what perfect setups are according to the rules. And you basically try to memorize them. Again, as I told you, it is like learning from a student book, like the perfect theory. But in the live markets, again, you will very likely force setups, so you're never going to be perfect. All right. So doing the case studies, it's not representative of live trading. So I really like this, however, so I want to show you how you would build a case study by also journaling it in Notion. Okay, so how do you make a case study? Now, or what is called hindsight backtesting. So you find something that has really worked and you strip it to pieces. Now, this can be finding a daily imbalance that worked or a daily imbalance that failed. And it's literally, again, getting lost in the charts. But what I like, for example, my members to do is to find stuff that worked out and once again to really strip it to pieces. So let me right now again find something that I like, that there has been a very big move, and I will try to potentially break it down. Now we have had a look at the recent example, so let's go something like way in the past. And let's say I want to test like a daily imbalance, and the first one that I really see and kind of that I like is this, for example. There is a daily bullish imbalance, and I see that this daily bullish imbalance went to the liquidity target. Okay, so what I'm going to do right now is I'm gonna go and hit the replay too, and I want to really break this chart down to pieces. I would first go to the weekly time frame and I would ask, okay, how is the weekly time frame looking like? Well, the weekly time frame had a weekly bullish imbalance. Okay, so is the market gonna pull back there? How do we know? We drop to the daily because the market pulls back into the daily. It pulls back in Tuesday, and then Wednesday plays out. Then we consolidate for 2 days, and then on Monday it actually rocketed. So how could I have capitalized on this long trade? I would drop to the Volatility time frame and I would see what is happening. Okay, the market is bullish. We have here a little bit of a Volatility bearish zone. Okay, so I would type this, I would mark this Volatility bearish zone, and then suddenly the market massively moves outside of that daily zone by a creation of a Volatility bullish zone. Okay, so can this be a long trade? It definitely can be. Stop loss below, and then towards the liquidity we have a 1.5R. Okay, so you see, so this is, for example, a case study that you can make. And then what you would do is you would go to Notion, to the trading station that I will share with you, and you would start building what I call your trades magazine. All right, so this one should be Trades Magazine 2026. And then, of course, you say, for example, trade number 1. This is on Euro USD. This is the date, the time of the day, the higher time frame, zones, the entry model, and everything. And you would click again here. You would go new page, and you would fill all the things. So higher time frame bias and entry management. And what did I learn from this trade? And when you put 100 things here, you're going to be so much more improved. Okay, so then here I would take a screenshot of the daily once again. And I would put annotations. So daily imbalance retest. I would screenshot this and I would put it here. Then I would go to the Volatility time frame and I would say, okay, so there is a Volatility bullish imbalance and I'm trying to take a trade as a swing trade. So I have a daily imbalance and I have a Volatility VSR. That is a lot better. But then I can say, okay, did I actually have a 1 hour VSR here? And I would zoom in. And I would see, okay, there is a very little VSR. Now, can I take this trade? I could, but it's below the EMA. I don't like it. But here is the real 1 hourly VSR. Okay, so you can say 1 hour VSR. Now, this is also above the EMA, and it has definitely broken that Volatility resistance area. So then I can take a trade from here. Where is my stop loss going to go? Under there. And where is my take profit going to go? Well, you can see I actually reached 1.5 exactly right here. Why right here? Well, I see here there was a liquidity point to the left, which is this New York high. Okay, so what I'm gonna do right here is, again, there is 1H VSR above the EMA, 4 hourly bearish imbalance has failed, 1.5R. and I'm gonna take a screenshot of this, okay, and I'm gonna put it into entry and management. Then what I can also do is I can be like, okay, well, this one actually moved very nicely to the upside. So is there any way that I could have traded this move? I saw, for example, that on the Volatility time frame, there was here, after we pushed up, we created this Volatility imbalance. And look, the market actually ended up pulling it back. After pushing, it took liquidity from here. It took liquidity from here. It has to rebalance. We know that. And then it pulls back to rebalance. So now I want to really zoom in right here, okay, to see how I could have traded then this move to the highs. What do I need? I need a 50-minute VSR. I would go to the 50-minute and I would exactly look at where this volatility was tapped. This volatility was tapped right here. We reacted, we test the EMA, test the EMA, test the EMA. There is our 50-minute VSR. Okay, so can we take this trade? I mean, yes, we can. We can take the trade from here. Stop loss goes under the lowest point of the volatility zone. This gives us a really nasty drawdown, almost takes our stop loss. And then where are we gonna go? We can go for even for the daily liquidity. Look, beautiful trade. Volatility zone, 15-minute VSR. That is part of the plan. If you didn't take this trade, the market still pulls back a little bit, tries, pulls back a little bit, tries. There is another 15-minute VSR. Okay, can I take this one? I can, right? And you can take note of all of these things, and then I go. So for example, I took this one and this one. Okay, so mark them up like that, and then this one, mark them up like this, separate them a little bit, and then I can say first 50-minute VSR above EMA from 4H imbalance. And then this one is a second VSR. Second VSR, seeing that the 4H imbalance is holding, it gives us a re-entry above EMA again, safe stop loss. All right, and I screenshot this. Again, you can see I'm intentional with it. And I'm just like, okay, buy, sell, right, boom, boom. No. All right, and then I can continue going. Okay, so I journaled all of these trades. Well, the market still ended up like making this very massive push. Can I enter somewhere within here? And I go in and I study it. So is there some other volatility zone? Not really. After this massive push, not really. So was there any 1 hourly zone here that I can find? Look at this. All right, there is a 1 hourly zone. Not 1G, 1H. There is a 1 hourly zone, and then there is another 1 hourly zone. Okay, so what entry do I need from a 1 hourly zone? I need a 3-minute VSR. Sorry, a 5-minute. So if I go to the 5-minute, let me see. Okay, we pull back into this 1H, but then it consolidates. And then when it printed the 5-minute VSR, it actually overtake one of our rules. The market took liquidity when we had the VSR. So can we take this trade? No. But I would journal it, okay? Here is the 5-minute V from a 1H imbalance, but it took liquidity on the 5M. Can I enter on a lower time frame? On a lower time frame, maybe. Okay, so I will take a screenshot of that, and at the same time, I can even look at the other one. Look at the other one. The market beautifully tests the 1 hourly. Absolutely beautiful. 5-minute VSR here. 5-minute VSI, I enter on the imbalance creation. There is the low-hanging fruit liquidity. And basically, there is our take profit here. On this push, like you get a 2-hour trade, I would always take a 2-hour trade. Okay, and here I would say here we got a perfect 5-minute VSR. And then I would take the screenshot here. All right, I would go back again. I will put this. Now, I will be a little bit more detailed to really show where these 1 hourly zones are. But then what I would say is I would be like, okay, so how can I actually enter this trade? And I would go and I would break it down even on the 1-minute time frame. And this is where I can already tell you like that we have different entry models. So we also have an entry model for the 1-minute time frame. Unfortunately here, I can definitely say that this price action here is something else. This is some crazy shit happening here. So I would definitely not be taking this trade. All right. And do you see how many trades right now we discovered? Just what we found is we found this daily zone that tapped and went to the liquidity. And then we found a volatility entry. Then we found a volatility retest entry. We also found a 1 hourly VSR entry here. Then we also found some other entries. There are probably some more entries that we can find right here if we really look deeper. And then again, you can just resume doing it, right? You just go, okay, wow, the market impulse, it gave us another volatility zone. Okay, now the thing here is in hindsight, because right now I'm starting, I would backtest. If I right now start doing candle by candle, I would backtest. So what I would do for a hindsight backtest is I would play the candles and I see, okay, this 4-hourly zone did not play out. So what I can do is I would be like, okay, if I know that this 4-hourly zone did not play out, where is the market potentially going to go next? It's going to go to the origin of that 4-hourly zone. Where is the origin? I track it. It's right here. Why is it right here? Because trigger your fractals. That is the swing low. That is the origin of this push. All right. So then I can ask a question. Okay, cool. How can I trade into this? Do I see any 4-hourly zones that were retested? No. So let me see the 1-hourly. And again, I get lost in the chart. Look, 4-hourly taps, it tries to push, fails. Taps again, tries to push, fails. It actually started giving me here a 1-hour zone. How can I trade this 1-hour zone? Okay, then I go and find it. All right, then I go to the 5-minute, for example. I see, all right, did we get a VSR here? Let's see. Nope. This is where we got the VSR. Right here. Stop loss goes above the highest high. Did we take liquidity before the VSR? No. So there is my trade. 1.5 hour. Just got missed here at the bottom. Almost. So I journal this trade. And then I'm going to be like, okay, but the market really went down a lot. So how can I take another trade? And then I go and study again. 1-hourly time frame, we don't have anything. Let me check the 15-minute. Do we have something on the 15-minute? Well, unfortunately, not really. We have here this 15-minute zone, tapped, reacted, then it came up again, then it had a 15-minute bullish zone, and then that 15-minute bullish zone failed. Well, then you can say like this is, we also have another entry model for failed imbalances. Okay, but now I'm getting very advanced, but I have discovered all of these things by doing exactly what I'm showing you right now. Then I would go, for example, on the 1-minute time frame, and I would see how price action developed inside this 50-minute zone. It tapped, reacted, and then just massively broke. So this is actually an entry that we would take. We would, let's say, place it a little bit higher. That is a failure of an imbalance entry. And then we would go once again for, let's say, for 1.5 hour. That got tapped down there. And this is how you do hindsight backtesting. Okay, it's just getting lost in the chart. And if you build the habit to do like 1 or 2 or 3 per day of these, I promise you it's gonna be great. It doesn't have to be just textbook trades. You can oftentimes go and be like, okay, like just be curious. There was the daily imbalance here. Why didn't this daily imbalance go up? And how does it look like not going up? Then you go and explore it on the 4-hourly time frame. Okay, why? Well, why didn't this daily imbalance go up? Well, why? Well, because it had a 4-hourly bearish imbalance. What happened with that 4-hourly bearish imbalance here? It never got tapped. What happened actually is the market made this liquidity low and it has this liquidity high and it just maintained in a range. So this is a perfect example of a choppy market. Mark this up. Okay, and that is how literally you improve, and that is how you do a case study. All right, and basically right now we are wrapping it up very slowly. So what is the best way to improve, you might ask, out of all of these kind of ways that we covered? Well, there is my favorite quote from Jesse Livermore, one of the most legendary traders. Only the game can teach you the game. What does that mean? Is that you have to play the game in order to learn the game. That is with everything. You cannot learn how to play chess by just reading a book or watching videos. You gotta play it. You cannot learn how to play tennis if you just watch videos or you study theory. You gotta go and play it. You cannot learn how to trade if you just watch this video and then you don't do anything. You have to go and you have to do it. So the best way to improve is to just trade. Okay, and you train yourself in the real arena with money on the line. So here again, this is no financial advice, by the way. I should have said this from the beginning. Disclaimer, okay, no financial advice. Everything that I say here is educational purposes for entertainment, okay? But what I always kind of suggest to my members is they go a little bit through case studies and then just have a very small live account, like $100, or get a cheap funding challenge that costs you like $30 to have something on the line. Because when you have something on the line, you're going to get emotions, you're going to get stress, you're going to have to be patient, and then you're really going to face the real reality of trading. All right. And your emotions will then give you signals for your mindset flaws that you need to work on. You're going to get a lot of fear. You're going to be greedy. You're going to hesitate to take a trade, or you're going to overtrade and take random trades. You're going to be doing a lot of stuff. It's really a very big journey that you're going to embark on. And most importantly, you will learn from the live market, not from the past. The live market is your best mentor. It's always gonna tell you if you're right or wrong. And then if you are intentional with your studies, and if you really go and check out things and try to study from the market, that is the best feedback that you can actually get. Journal daily, ask questions, reflect. You are in the present, not in the past. You're in the present. Every evening, that is my favorite time, I sit down and I just devour the charts for the day. This happened, this happened. Why did that happen? How could I've done better? Why did this happen? What can I do about it? This was my trade. How could I make my trade better? How could I have avoided my stop loss? And I just ask all of these questions, and that is how I improve. All right. What's the only drawback of just trading? It takes time. It takes time, and you will not see immediate results, which will disappoint you and discourage you. And that's reality. That's trading. However, if you don't have the discipline, if you don't have the commitment to do this for 3 to 6 months without giving up, then maybe trading is not for you. I'm sorry. But if you spend with me 10 hours on this video really studying all of this and being intentional with it, then that is a really good thing, actually. So now you have to commit to do this. All right, because if you live trade for 3 to 6 months, you will learn 100 times more than doing all of other methods combined. Live trading is the best teacher. So you might ask me right now, okay, Leah, what do I do right now? So let me give you a step-by-step improvement protocol. When you learn something new, either a new concept, a new strategy, I personally always put it through a testing period. I don't backtest, I don't do a lot of stuff. I actually mainly forward test, but live. I literally live trade it. I'm gonna live trade it for 2 months to really see if that thing that I want to implement works. Recently, I added volume profile, for example, to my trading. Apart from imbalances and liquidity, right now I use volume profile, and I had to do it for a month and a half to watch it daily to really say, okay, this tool actually makes sense and it complements my strategy very well. So then I added based on objective data. Now, backtesting first. Spend some time backtesting the model, see if it works, actually get some initial data to know if it's worth pursuing. Because the fastest way to get some data is to backtest. Because with backtesting, you can probably backtest 3 months of data within an hour. All right, and then you can see, okay, this shit that this guy told me just doesn't work at all, so it's not worth pursuing. All right, so I would first backtest something to see if it actually works. Then if I see it actually works, I would start doing some hindsight case studies. I would spend 1 hour per day going back in the past, doing case studies, all right, to memorize the patterns and to study. At the same time, I would start forward testing and demo trading, okay? Before actually live trading with real money or on a challenge account or anything, I would do a little bit of a forward test, a little bit of a demo trade for maximum 1 month, no more. Because you're losing time demo trading and forward testing, you better actually get really into the game. As soon as you backtest a little bit, you've developed some case studies and you have observed the market forward testing or demo trading for a little bit, you kind of see how stuff develops in the live market. Well, you're kind of ready to already live trade. So combining live forward testing or demo trading with hindsight case studies is amazing combination. For a month, you can get enough of an impression whether a strategy is working. So this is why I have designed my program to be minimum 3 months, because in the first month, for example, my student is gonna study the course, they're gonna devour all the information. Then in the second month, they're gonna do a little bit of backtesting, they're gonna do some hindsight case studies, they're gonna look at the other members' trades, they're gonna look at my trades, and they're gonna have to start getting a feeling of things a little bit in the second month. And then in the third month, they're literally ready to live trade. They have already built the confidence, they already have the knowledge, and many of my members within 3 months, they get funded and they even get a payout because they follow that process, all right? And then after you've done these 3 things, live trading. You either open a small live account or you purchase the cheapest funding challenge that you can get and you just start live trading. Don't start big. Don't deposit big sums or don't buy the biggest challenge like a 200K account. No, you don't need that. Start with the smallest one. You just need to do live trading with something on the line. And even if you get like a $5,000 challenge account for $30, it's still something. You have still paid for something. It's not demo, it's not forward test, it's not back test. You have still paid and it's live and there is something on the line. Okay? However, for all of these steps to actually work and really stick in your mind, there is something extremely important that must be done. And you probably know what that is, and that is journaling. Okay, Journaling is really the key to improvements in trading, and that is the real heart. And it's boring. You see me making these case studies, taking all of these notes, spending time screenshotting, putting them in Notion, yes, but during this process of doing this, this is when you're actually learning. That is when your subconscious memorizes these patterns, because you're intentional to sit down and type these things down. And most traders are always skipping this part, and that is why they never make progress. Why? Because they don't document anything. You don't know where you started, what kind of knowledge you had, what kind of trades you have taken, what is bad for you, what is good for you, what works, what doesn't work, what's your win rate, what's your risk to reward, what's your average stop loss, what is this, what is that. You don't know anything. So if you cannot measure something or track it back in the past, how can you improve it? You cannot. All right. And journaling is how you gather data about yourself and your strategy. It helps you track performance, win rate, risk to reward, timing, setups, everything. And it helps you to also remember your trades, so that when the next time you see a good trade, immediately pings in your mind. It helps you to learn all the details, what works and what doesn't work, timing, POI, setups, pair, entries, confluences, everything. It helps you also to get to know your feelings in the live markets, so you can become self-aware. I always make my members type as they're trading live. So this is what I'm feeling, this is how I'm feeling. I make them type what they feel before, during, and after the trade, so we can really recognize their psychology from start to finish. So we see, do they have fear, do they have hesitation, do they have any bad mindsets. It's great to track your progress and see the natural evolution of you as a trader. It is really fun when I make my traders make 40 trades, and the first 20 trades are kind of wrong a little bit, they suck a little bit, but they also get constant feedback from me. And then the final 20 trades, they're great. Okay, but if only all of them had the patience to go through and stick to those 40 pairs, 40 trades, and actually do them, the success rate will be a lot higher. But not everybody's committed to doing that. That's reality. All right. And I've made all of my biggest discoveries through journaling and doing hindsight case studies. The aha moments, those invisible patterns, the real edge, all I found through intentionally journaling my trades and just asking questions. Why did this one work? Why didn't work? And so on. And if I have a discovery, say, okay, this trade is hitting a lot of stop loss, because anytime I trade from a daily zone, if there is a hourly zone that is opposing, I take a stop loss. Is this correct? And then I have 100 trades from the past that I can go and revisit, and I have screenshotted all the time frames, and I do a little bit of a study. I go through all of those trades and I see which hit stop loss, which hit TP, and suddenly I see, all right, that is a pattern, and I can immediately verify that pattern because I already have the old data to consult with. All right, this is the work that all professionals do. At the end of every session, we do end of day review and markup, and in the trading station, you have it. So for example, if I very quickly go to the trading station that I'm going to share with you, it is going to be more polished when you receive it, but you have a live trading journal where you can do your live trades. You have a trades magazine where you can do your hindsight case studies, and you also have a backtesting where you can do your backtesting. But I have also included these weekly reflections where, for example, you can do week 1 of January, you do the date, feelings here, you can do the feelings at the end of the week and some notes. And if you click open and then add a new reflection, this is going to populate with some really nice things that you can explore for yourself. So for Monday, for example, how did I start my day? How do I feel? How's the mood? Am I optimal? Okay. What's my plan for today? Then London session, as you're trading, you're typing down. New York session, as you're trading, you're typing down. And then at the end of the session, what am I happy with today? What lessons did I learn? So here I put all the lessons that I learned from the day, any insights, any emotional insights, or any technical insights, okay? And then essential daily habits, you can change these, and I do this every single day, all right? And then how do I feel about the trades I took this week? I will talk about all the trades that I took, main impressions at the end of the week. How do I feel about the trade performance? How do I feel about my work ethic, emotions before, during, and after? So this is our weekly journaling, and we actually do this in Discord as well, in my Discord channel. How do I feel myself? Add my learnings, things I will do more, things I will do less, and anything else that I want to be grateful for. Okay, I will share this with you, and if you have the discipline to do this daily and do your case studies and do your trades magazines and really gather all of these case studies with details like that, and you review them very often, that is the way to improve. All right, so right now we are going to transition into something important, and we're going to talk a little bit about it before we wrap up this video, and that is psychology. So going forward, let us touch a little bit about psychology. So firstly, when you start with anything new in trading, there is something that I call the losing learning curve. And here's how it looks like. So we have X and Y axis, and here we pretty much have on the bottom your understanding and your market experience. And then of course, on the left here, we have the net profit. So we're gonna start from zero with zero experience and with zero understanding, and of course, not a lot of money. However, what happens for a lot of traders at first is they always tend to get this sort of beginner's luck. You make a little bit of profit and you think, wow, this is too easy. But then of course, you're gonna lose it all. Then you're gonna make it back up again. You're like, okay. So if I can make all that, I can make a lot more. And then you constantly are gonna keep going in a very volatile fashion for the first, let's say, a year. Like, it really depends on what your experience is right now. But this tends to repeat with any new thing that you start. Is it a new strategy, a new concept? Everything has a losing learning curve, because in order to learn the ins and outs of something, you have to lose. Okay. But then if you turn the losing towards learning, then that is when you really make an improvement. And then when you go towards the beginner stage, which is like having big wins and having also big losses, you go to the intermediate stage where you're starting to have small wins and small losses, and basically you enter into a very long break-even cycle. And you start kind of really oscillating around break even. You're not like really getting any crazy wins anymore or any crazy losses, but you get some wins, you get some losses, get some wins, get some losses. You just oscillate. And usually at that time, you're going to start kind of going in a little bit of a downward curve. You're going to maybe blow some challenges. You're going to be failing to pass them. You're going to spend a lot of time not succeeding. You're going to be losing some of your live money as well. However, what I call this is the grinding period. This is literally your losing learning curve, because if you continue losing, but you continue learning from all of these losses, very slowly you're going to start making those incremental changes. And then with those incremental changes, very slowly you're going to start seeing some profit, some profit, some profit, some profit. And the more, of course, you grind, the more you learn, the more profit you're going to get. And suddenly you get into pretty much the payoff cycle, which is when you become a consistent trader. And consistent profitability is not like this magic things where you're like, all right, I'm consistently profitable, I'm gonna make money right now every month. No. What a lot of traders out there are gonna lie to you about consistent profitability is they're gonna be like, make 10K a month, make 1K a month, get funded in 1 month. It just doesn't work this way, because the market always moves in cycles, as you know. And not every cycle is going to be amazing for your trading strategy. Not every period is going to be amazing for your psychology. You're going to lose. That's a fact. This is why you're going to be getting some losses, but all of your wins are really going to go on top of your losses, and then you're going to become consistently profitable trader over a long period of time. So it's really important to understand this losing learning curve and not to really give up when you start something new, because you're going to go through that curve. Now, with the learning and with the losing learning curve, the next thing that you have to observe is your strategy versus psychology. So what you're going to hear very often is that trading is 90% psychology and like 10% strategy. Is this true or is it not true? Well, basically, a solid psychology with a bad strategy, you're going to be a losing trader. Or if you have a solid strategy, the best strategy, that the most profitable trader on earth gave you that strategy, but you have a bad psychology, you're still going to be a losing trader. So with that said, you need both. Now, is it like 50-50? Is it 60-40? Is it 90-10? Every kind of individual trader is going to tell you something different, right? I can tell you it's 90-10. You're going to hear somebody else is like 50-50. You're going to hear somebody say like it's 60% technicals and 40% psychology. The thing is, you need both. That's it. Like, what's the percentage? It doesn't matter. You need a solid strategy that is profitable, that is proven to be profitable, and then you need a solid psychology so that you can actually show up and execute that strategy. That's just how it works, all right? But you also need something extra that not a lot of traders are actually telling you about that, and that is accountability. According to me, this is the trifecta of success: having a solid strategy, a solid psychology, but also having accountability. Getting around people that are doing it the same way as you do. Having a mentor to always tell you what is right, what is wrong, what is good, what is bad. Giving you feedback, keeping you accountable to continue showing up doing the same thing. All right? Because again, to really learn, to really go through that losing learning curve the right way, you need to have somebody to tell you what's wrong. Because you're going to take a stop loss, but if you do not know how to learn from that stop loss, you're just going to keep taking stop losses and you're not going to know why. But if you, for example, share your trade, let's say with me, and I tell you, well, this is what you did wrong, this is what you can do better, immediately you're 10% better because you're not going to make that mistake again. You have that accountability. Then if you make it again, I'm going to keep you accountable. And that is what is really going to push your learning curve to to just make it a lot faster. That's just how it is. Okay. So you also need some guidance and some accountability. Now, as you start trading right now, potentially, there is going to be a really fine line between your strategy and your psychology. And you're going to be wondering, okay, so does my strategy suck or is it my psychology suck? So you really have to differentiate between technical problems and psychology problems, because sometimes you might make a technical mistake, but you might blame it on your psychology, and vice versa. Sometimes you might make a psychological mistake, but blame it on the technicals or on the strategy. So to try to kind of visualize this point, let's say you take a stop loss during invalid timing. So you traded Euro USD during Asia and you take a stop loss. If you don't know that EU doesn't work during Asia, you're going to be like, okay, so is it a psychological one? Did I go FOMO? So basically, yeah, it would be a psychological mistake if you knew that EU doesn't work in Asia, but you still took the trade. So now that is an emotional mistake. That is a psychology mistake because you went FOMO and you broke your rules, knowing that the rules are not to trade EU during Asia. Okay. And then it would be a technical mistake if you did not know that EU doesn't work in Asia. So you followed what you thought is the plan. All right. So this is where I tell you that you need accountability and you need mentorship and guidance, because let's say you want to go trade EU in Asia, but you actually don't know that EU doesn't work in Asia, and then there is nobody to tell you, and then you might blame it on 1,000 different things. So there is always that fine line. You can see like these two things are very close together, but what is the correct one? That is the hard thing to potentially pinpoint. So to make things easy, I would suggest that you really master the strategy first, because that is your foundation, right? A very solid strategy is your foundation. Before you look into your mindset and your psychology and you start kind of fixing yourself, because you have to, okay, ask yourself, do I really have an edge? Do I really have something that is objectively working? Do I really know how to execute the system to the T? Right? Because if you don't know your strategy, it's just going to be extremely easy to go emotional and just go all over the place. All right? And why I believe that strategy is really the foundation. This is why I actually believe trading is a bit more strategy than it's psychology, because you really need to nail down your edge. Because once you nail down your edge, that is going to make it easy on your psychology. Okay? Because if you know perfectly what you're looking for and what your edge is, it's going to be very hard to get emotional. It's going to be very hard to go FOMO. Like, you really need to be an extremely emotional person if you're told trade EU only during this time with this setup. And then if you don't do that, well, that's your fault. That is where your psychology kicks in. But if you really have step by step, you know, at any single point in time, what to do. Do I trade? Do I not trade? How do I trade it? And when do I trade it? It is then just extremely hard to make any mistakes. Okay. And then of course the psychology part becomes the discipline, the patience to wait, and of course to not micromanage your trades and to do stupid stuff. Okay. And then for example, when you really know your edge, you are going to know if you take a stop loss, if it was a valid stop loss based on the rules. So then of course you accept, because that is the game. Or if you made a psychological mistake, which would be like trading outside of the rules. Okay. And then as you start leveling up, you're going to get what I call learning mistakes. Okay. And learning mistakes are something that you did that is like according to the plan, but you find something that can potentially help you avoid that mistake. So you say, all right, a learning mistake. You add a little addition to your trading plan, and that is how you get always these 1% better. That is how you go through that losing learning curve. You take a stop loss, you ask, why was that a stop loss? What can I do better? And then implement that. It's just a constant feedback loop. But what you have to do is learn from that feedback loop, and of course get somebody to tell you what is right. But again, you don't know, like in trading, you never know what is right or wrong, but still having like a foundation and a baseline really helps. So when you master your strategy and when you really get an edge, then your psychology is really going to determine your success. okay? Because what would matter at that time is how you show up, the focus that you're bringing to the table, the discipline that you have to wait for your setups and not do stupid stuff, the patience you have, and your emotional control. That's it. And these things, trust me, are very hard. Very hard. When strategy aligns with psychology, that is when your results are going to rocket. You're going to start seeing yourself being a lot more calmer. You're not going to have any crazy desires to make it in trading. You're going to be extremely patient. You're going to be waiting for your setups. You're not going to care that you're not going to be making money today, this week, or this month even. You just play the game. And that is when really your results start, your equity curve starts growing. It's not going to go in a straight line, but it's going to grow. And then basically psychology becomes the edge. Why I also believe that trading is not like 90% technicals and 10% psychology is because everybody can learn the same technicals. I can teach you my strategy from A to Z. I do that with a lot of traders, but not all of them are like making it as quickly as others are doing, or maybe are making it at all. Why? Well, because out of 100 people, probably only 10 to 20 will turn profitable. Why? Because of their psychology. Because trading psychology is just a whole science. There's just so much that goes behind it. There are a myriad of emotions, biases, flawed mindsets, unrealistic expectations, putting things on a pedestal, hating on yourself, being angry with yourself, and then they all stem from fear and greed. You really have to look deep, and it's very personal. You will get to explore your traumas, your past kind of traumas that have shaped your mindset to who you are today, because trading, trust me, will bring them all to the surface. I'm really grateful that I actually started trading because it really made me dive deep into my own traumas, into my own upbringing and stuff, because for me to become profitable, I had to let go of a lot of fear. I had to let go of a lot of perfectionistic conditioning, for example, from my parents. It's like stuff like this that are really deep, and you really have to pinpoint that stuff because it's going to be what is stopping you potentially from succeeding. Okay. Now, basically, I already said it, but there are two emotions that are pulling our string. Every emotional and psychological problem stems from those two emotions, and those are fear and greed. This is what the market is driven on. It's driven on fear and greed. When things get fearful, when traders get fearful, when times get tough, when there is a war, where there is like inflation and this and that, and we're all gonna die, the market drops. It goes down. And when there is optimism, everybody's happy, everything is good, the market goes up, people get greedy, they buy more, and this is what brings price up. Okay, and those two emotions are going to create two categories of emotional traders. You're going to have the greedy traders. These are going to be reckless, aggressive. They're going to overtrade. They're going to revenge trade. They're going to over-risk. They're going to push for big moves. And usually they're going to have very big egos. Very hard to work with. A lot of discipline is required. What usually those traders are going to do is they're going to be blowing accounts constantly, over-risking, blowing accounts. After making some progress, they're always like in these massive swings, making some progress, blowing it out. They're going to be having big red days. They're going to be having periods of success followed by disasters. At a moment, they feel like they're making it, all right? But then the next moment, they feel like they've lost it all. So these are usually the greedy traders. And then the second camp of traders are the fearful traders. These are afraid, timid, worried. They're always overthinking. They're always like the victim. They're hesitating. They're doubting. They're taking small profits, right? They're very just fearful, all right? And these traders usually are going to have a very break-even trading, very break-even performance. They're going to make very minimal progress for a very long time, all right? And they're always going to have that feeling of stuckness. Why can I not break out of this cycle? Why am I keep stuck? Why am I in this break-even stage? Why can I just not start growing, but I stay stuck in this one place? It's usually all based on fear. Fear to take your trade, fear to hold your trade, fear of yourself failing, fear of risk, lots of things. It goes really deep. So basically, to start bringing a little bit of awareness onto you right now, you might be brand new or you might be trading for a year. The first step usually is going to be awareness. I have in my bootcamp that you can actually join a 6-step framework, which is called the Atomic Framework. And the first step, the A of Atomic, is awareness. Really becoming aware of what type of trader you are and becoming aware of your emotions. So reading all this, which category of trader are you? All right, are you the greedy or are you the fearful? Are you a combination maybe? Combination is tough, okay? So becoming aware of what emotions control you is the first big step towards building a solid psychology. That is when you start working on your psychology and you really have to become aware what emotions are actually driving you. And then those two emotions are going to branch into many sub-emotions. It's a whole science. But of course, for the end of this video, I want to talk a little bit about psychology as well. There are a lot of other resources, but let's just have a look at the most common ones to really kind of just make you think a little bit about it. We have the fear emotions. So fear is a natural response to uncertainty because the market is 100% uncertain, and a fact that you have to accept. This is, by the way, something that is really stopping a lot of traders from becoming profitable and keeping them in that stuckness. Is they just are so arrogant that they just cannot accept that they just don't know what's gonna happen next. They just cannot. They always think that there is a way to know what's gonna happen next, and that's it. I can always win. No, you just never know. And until you truly accept this at the core of your core, right? You're just gonna always have fear, and you're always gonna have greed because you don't accept the fact of the market. It is an uncertain thing. And if you fail to do that, if you are afraid of uncertainty, if you don't like it, what you're gonna start getting, first, you're gonna get risk aversion. That is protecting yourself from the pain of losing, not wanting to take risk because you're afraid of the uncertainty and you don't want to lose. So what you're going to do is you're going to start decreasing your risk. Every trade, you're going to micromanage your position. You take a long, goes into a little bit of profit, go break even fast. I don't want to lose, right? You're going to be taking small profits, right? Your target might be up here, but then the market moved a little bit. All right, let me take it because I'm afraid it might go against me, all right? You're going to be skipping trades. This trade doesn't look good. I don't want to take it. You skip. You're going to be cutting losses fast. Oh shit, this went into my, it went into drawdown. Let me just cut it, right? And you're always going to be afraid to take bigger risk on good trades. Risk aversion. Fearful traders, they overthink and doubt, getting anxious and worked up when facing uncertainty. All right. So you are on the charts, you're analyzing, and you're getting ready to take a trade. However, you start over analyzing. Is this the right way? Is this this? You start panicking. Oh shit, what if this is the wrong trade? Is this really the good trade? What if it hits stop loss? What if it is? What if it that? And you kind of start thinking negatively about a trade, which is called negative future. You expect some negative things to start happening. And eventually you kind of skip a trade, or you're going to close the trade prematurely. You're going to start questioning yourself, your strategy, the market, the edge. Like, is this really for me? And you get into all of this massive cycle of just beating yourself down. That is the fearful trader. You have fear of loss or fear of failure, a deep, lingering feeling stopping you from achieving your full potential. Why? Well, because you're just afraid. You're afraid to take a loss and you're afraid to fail. Now, why is this? Is it because you want to prove to your family, to your friends, to yourself, to your spouse, to whatever, right? All of these things are causing you either fear or greed. You're either too greedy, too excited to prove, or you're either too fearful to fail, right? The two sides of the coin. So usually you're going to get pain after losses. You're going to start self-sabotaging yourself. You're going to be having a lot of self-doubt. You're going to constantly be questioning yourself, your strategy in the market, and you're going to associate trading failure with life failure. Now, you can never fail in trading until you kind of just give up and dump it, right? Just because you took a stop loss or you blew an account or you're having a bad period, that's not failure. But many traders, especially these that are really fearful and that they really don't want to fail, they perceive this as really bad. And then they take this and then they transition it into their own personal lives, all right? And then that is going to lead to depression, burnout, and really bad things. So you see, trading can actually destroy your life. It can be pretty bad if you really go in that spiral of emotions. So the second step actually of my atomic framework is the triggers, identifying what actually triggers your fear. And that is by asking some key questions, right? When and why? Very important. When exactly and why exactly do you feel the fear? And what exactly is causing it? Really getting to the core of your emotion. Is it maybe a strategy gap? All right, so not knowing what to do in certain moments, that causes a little bit of fear, a little bit of hesitation. So you encounter a unique moment in the market or a time frame, and then you don't know what's next. That's a strategy gap. Literally, your fear is telling you, hey, I don't know what to do here, so I have a gap in my strategy. But if you know what you do, if you have the strategy, right, but you still have fear, then maybe it's a mindset problem. All right. So you know what you should do, but you just fail to execute on it. Okay. And then really start digging deep. I work a lot this with my private members because, again, they are given all the strategy, they know it all. But if they still fail to stay consistent and stay in that break-even cycle, usually at that time, it is emotions. That is what is stopping them. So those are the fearful emotions. And now we have the greedy ones. So greed is basically, at the core, an excessive desire for more than is needed. So read that again, because if you are greedy in your trading, you just have an excessive desire for something. You want to make it fast, you want to make it big, you want to go big, you just want more than what you need. And this is why we started this big course, this big masterclass with your why you're trading and what do you need out of trading. You don't need $100,000 this year. Maybe you just need to make 10K from trading to pay for something, right? But the greedy traders, they have an excessive desire. Greed will trigger when you have fantasies about trading, when you have unrealistic expectations, and also a really big ego. You're very arrogant towards the markets, right? And you're very stubborn as well. Usually, greed represents in many different emotions, but one of them is anger. So that is your inability to assess risk. You get so angry that you don't care about risk anymore. You just snap, you don't care. And then you start over trading, especially after a loss, which oftentimes is the trigger to get angry. You revenge trade when your setup didn't work. You get annoyed from losses. You get really angry at the market. And you try to push your opinion. You try to fight the market. And the market is always going to fight you back. Always. All right? That's anger. You have overconfidence. Pumped up, right? And then that overconfidence is causing you to become unable to remain probabilistic. Usually that can trigger after a winning period or after like a win or two. You're like, all right, man, I know this shit. And then what you can end up doing is taking a random trade, taking average setups. You're going to over risk because you're overconfident. You're going to keep pushing your opinion onto the market, thinking that you are the market maker. All right. And the market is always going to snap you. They're going to slap you in the face and they're going to bring you back to equilibrium. Okay. Then, of course, you have hate of loss or hate of being wrong. Now, the fear for is a fear of being wrong, but where it goes more towards greed is the hate. Like you just cannot take a losing trade or you cannot have a losing day. So if you have a losing day so far, if you take a losing trade, I just hate it. I cannot do that. And then what that makes you do, of course, overtrade, revenge trade, especially on a losing day. You try to bring it back, but again, the market snaps you back down, you blow your account, and you just want to prove yourself right. But of course, you can never prove yourself right to the market. The market is the market. It doesn't care about you. It doesn't care about anybody. And you cannot push your opinion onto it. But if you do, where does it come from? Big ego. You have to know yourself. Okay? And most importantly, unrealistic expectations. Having fantasies about the market that are just impossible. Pushing for fast results, being very impatient, taking average setups, thinking that everything is gonna work, comparing yourself to others, like somebody has already made it and you're like, okay, I should be doing it like him, trying to be in every single move in the market. No, these are all things that just cannot happen realistically. But if you think they can, you have this fantasy and that is gonna trigger greed and you're gonna stay stuck in a loop, all right? So greed is usually harder emotion to work with because it's very hard to identify the root of your greed. All right. So how do you do that? Heavy journaling, heavy introspection, and also mentorship and guidance to talk with me. For example, I had a very long one-on-one session with one of my members recently, and we really dove really deep. He was actually a little bit more fearful, but he was also a little bit greedy. He was unhappy with his performance, so he was pushing it. But what we found out is that he was having a life problem, a family problem. All right. And then he brought this into his trading and he had some unrealistic expectations that trading is going to fix his life. So he really brought all of his bad emotions from his life into trading, turning this into an unrealistic expectation and anger. And then it just really backfired. But it was really hard to get clear on that. We really had to ask a lot of questions and look deep. So these are the deep stuff that you are going to have to work one day, depending on what your experience is. And if you want to take the first steps, here are 3 books that I can recommend. First one is the classic Mark Douglas Trading in the Zone. Second one is also by Mark Douglas, The Disciplined Trader. They're kind of overlapping, but I have gotten a lot of insights from both of them. And the third one that I can recommend is The Mental Game of Trading by Jared Tendler. This one has really helped me a lot, by the way, because it really speaks to the trader. Really like pinpoints the exact problem, and it also gives you a really nice system on how to deal with it. However, what you should know is that books cannot fix you. They cannot. This is why I always think that this accountability and mentorship is the third pillar of success, because no matter how good you are, if you don't have somebody to talk to keep you accountable, or to be around people that are making it, you're gonna start doing some stupid stuff. And oftentimes you are unaware, and you just cannot see your problems because somebody has to see it from a third person. And it's very hard for you as an individual to look at yourself from a third person, especially when emotional. But these books definitely help a lot. And what can also help you is my psychology playlist on YouTube. So you can go to my channel, make sure you're subscribed as well. Hit the like if you enjoyed. If you're here up until now, thumbs up. You're probably gonna make it if you spend so much time that far. Okay, but check out the psychology playlist. Now, going forward, you're gonna make mistakes, but let me prepare you for them. The most common mistakes going forward. First one, strategy hopping, changing something after a slow period. All right. The market gets a little bit choppy, gets a little bit slow. All right, something's wrong. I need to add a new concept. I get a new mentor. I buy a new course. I buy a new strategy. I introduce different entry models to really tailor for every single market. I add new confluences, and you just change everything. But the moment you change something in your strategy, it will take you a few steps back. Why? Because there is a losing learning curve for everything. If you start a new approach, or if you add a new concept, or if you add a new indicator or a new tool, you're going to lose at first. Why? Because you don't know the ins and outs, and you have to lose in order to learn. But again, if you add something new, it's always taking you like 2 to 3 to even 5 steps back. And then you have to climb back up again. But the rewards, if you do it successfully, are going to be bigger by implementing that new thing. But again, once you find something that works, again, don't change something that's working. Find something that works and stick to it. You have to accept, again, deep inside, that is a psychology issue, is that there will be slow and there will be crazy periods, right? So don't try to fight them. It is what it is. You cannot control what Trump is saying. You cannot control that the war is going on. You cannot control that inflation is, you cannot control these things. So don't be angry. Don't be crazy. Don't take it on the market. It doesn't care. Okay, so just wait and adapt. That's it. That's what the real Zen trader does. Okay. The second thing is trusting lies and flashy gurus. Now, if you're here, you're probably not this type of person, but a lot of people are trusting like these flashy stuff and trusting people that are showing a lot of flashy stuff. Now, what you should know is that most of these are lies, really built to get you imagining that you can do it as well. But what that does on a hidden kind of level is it's feeding into your unrealistic expectations. And one of the worst things to have in terms of your trading psychology is unrealistic expectations. So you will be very emotional with following such people because you're constantly gonna want to be like them. You're constantly want to make more, and you're gonna see yourself failing, and then you're gonna see them potentially succeeding, which a lot of times is actually a lie. Okay, so don't trust anybody. Okay, follow and learn from people who are humble. That's my own opinion. Okay, follow people who show charts, who show results, and who actually teach you stuff, not just show you like a lifestyle and profits and the day of the life and pretend to be trading, because most likely they're not trading. Okay, so be careful with that. And usually those lifestyle people, they have a lot of subscribers. Why? Because people like watching that stuff. Right? People like watching that stuff, and then they think they're making it. But I can go and rent a Lambo right now. I can film myself in a Lambo. I can rent this, and I will be looking like the most successful guy. But deep inside, it's not. Okay, so be careful who you trust. All right. And then another one is try to combine 100 things into one big system. Right now, you will keep on learning, very likely. Okay, based on what your experience is. You watch this video, amazing, but you're gonna be like, I need to watch 50 more videos. And then I'm gonna learn everything about the market to build the ultimate market strategy. I'm sorry, but you will get overwhelmed and you're not gonna make it. This is what I did. I'm kind of I really like learning things, so I thought, because I was smart at school and I found it easy to learn everything, I was like, okay, I'm gonna learn everything that there is about trading, and if I know everything about trading, I'm gonna make it, right? If you know everything that there is to be a doctor, right? So I guess you have made it because you have all the knowledge and all the experience, but it doesn't work in trading. Doesn't work in trading. You have to stick to one thing, you have to stick to one mentor, you have to become good at one thing. That is the secret. Simplicity is the market's biggest secret. And all of these things out there that are complex, they are just to take you away from the truth of the market, which is simple, works. That is my biggest discovery, because I didn't trust this, but once you actually make things simple, it just starts working. But it takes you ages, it takes you years to actually learn this truth. So I'm telling you, from now on, you might not trust me, but if you spend 1 or 2 more years in the market, and then when you learn 50 things, but then you start cutting all of these 50 things to like 2 main things, you're gonna say, Ilya was right. Right? And also another trap is trying to make it fast. Going for big accounts, like big funded accounts, going for big profits, wanting to quit your 9 to 5, and like really pushing it hard. But the more fast that you want to go with trading, the slower you will go. The thing is, once again, start small. Make your first $100, be patient, take things slowly. Because when you take them slowly, you're going to grow better, because you're going to be without emotions, you're going to be without any sort of expectations, and you're actually going to be executing the plan. Okay? So those are the most common mistakes going forward. Make sure to avoid them. And you're going to be asking, okay, what now? Well, we're getting towards the end. So what you can do, of course, if you enjoyed this video, you can rewatch certain parts of the videos if you wish. Like, for example, the beginning part with all the foundations. Maybe you don't need that, but maybe the technical part, you can check it out again. You can check out all the additional resources that I'm giving you. You can check the YouTube channel. You can check all the videos that I have that are really going to help you build a really good base of foundational knowledge. And I would really recommend you show up in my weekly outlook and setups that I have been publishing every Saturday for 325 weeks at the time of this recording. That is years. 325 weeks I've posted a weekly outlook and setup. And there I really share what I feel about the market, what I think it's going to go, and I give you scenarios, because again, we never know what's going to happen in the market. All that we have to do is adapt and flow. All right? And start taking action. We already know how to become a better trader by journaling, backtesting, case studying, demo trading, all the stuff that we talked about. Start taking action. All right. But if you're happy with what you've seen so far and you really want to take it a step further, and you also want to work with me, of course, let me show you how I can help you going forward. So I have a coaching program that is currently called the Fanatic Way. And this is the Fanatic Way roadmap that you're going to go through if you decide to join us. In the first phase, we're going to have the learning phase. That is usually your first, let's say 2 months, month and a half. It really depends on how fast you learn. That is really learning and building a reliable strategy. You're given all the content that you need. Second phase is week 8, where you actually revisit the lessons, and that will help you fill in the gaps. You immediately talk with me and Mihai, our head coach. We figure out what your gaps, you revisit something lessons, you have assignments that you submit, everything is checked. Then you're given the green light to potentially build your trading plan with us. You're provided a template to build your trading plan and decide which approach and which pairs and which timing suit you best. We do that together based on your lifestyle, based on your job, based on everything that is going on with your life. And then starting from week 8 to 12, it's starting pretty much to do case studies and to really get your hands dirty. You collect data, you strengthen the strategy, and you get feedback on your case studies. Truly for me and our coach to see that you understand the strategy, you're journaling the right way, you're doing everything right. You get the feedback on that. We go over what I call trade magazine, right? Potentially, let's say 20 trades. That is during your 3rd monthly call, because we do monthly progress calls with members to really check up on their progress, okay? And then basically we talk one-on-one to talk about your psychology, what you're doing so far, how do you feel about trading, have you had any kind of, especially when you're starting, do you feel like certain emotions? We discuss your psychology worksheets, because we have a psychology course as well, and I'm going to be giving you worksheets to work on. We discuss these, and then after you're really given all the green lights, this stuff can go a lot faster, but that is kind of the average that you can get. You start your first challenge or your first live account, depending on what you want to do. So you're actually trading live, either on a challenge or on a live account. No demo, none of this stuff, because we really want to get you into the real game of trading. And then basically get funded, or you pass your first challenge, and then potentially secure your first payout. So that is the roadmap. Basically, being with you every step of the way. We have broken down as well for members that are more perfectionistic and really want to follow a schedule. We have broken down with all the different lessons for every single week. And every single week you submit assignments. You get, of course, those assignments checked by me. You receive text or video feedback, okay? And then you have your monthly calls, all right? You continue, and basically you can see by week 6, you should be finished by the course to then start collecting your trade magazine. Yeah, basically here you revisit, collect the data, and then you start case study for around 2 to 3 weeks. We go over your magazine to see if you're doing things right. And if you are, we discuss psychology, you jump on your live challenge, then you pretty much have 4 weeks to live trade. All right. So basically, I want to show you what is inside right now so you can get a feeling of it. But if you truly want to level up with me and with my program and with the community, which is amazing, the Fanatic Way program, the promise is to get you out of a losing or a break-even cycle or the stuck feeling that you have within 3 to 5 months. That is on average what it takes. 3 to 5 months for my students to get fully funded. So to pass 2 phases of their challenge if they want to do a challenge or if it's a one-step challenge. Okay, but depends on the person and the past experience. Some have done it within 1.5 months, some have done it after 6 months. And then usually, once they get that first milestone that really proves that what they're doing is good, that they're actually working, they really get that boost of confidence. And then usually within 1 or 2 months, they also get their first payout from a prop firm if this is what they want. So you can check the program on tradingfanatic.com. You can check some testimonials. You can also check reviews on Trustpilot. But right now, I'm actually going to go and show you around. So here is the website, tradingfanatic.com. You can go here. You can look around, right? There are a lot of reviews popping here from real people, by the way. Of course, here you see what is included. If you go to what is included here, see what's inside. You can actually see, for example, 32 hours bite-sized content. You can check out the inside as well. That is for every. We have the Fanatic Way, that is the main course module. And then we have the Fanatic Flicks, which is where we do the one-on-one session recordings, the webinar recordings that we host every Thursday, any trading breakdowns that I'm doing, my trades, other members' trades, and also case studies and one-on-one session recordings. You can see what's inside, of course. We have the community, which is amazing. You're going to be getting daily forecast, daily trade shouts from me before we take a trade. We have our live webinars. You get one-on-one sessions. And basically, you get 24/7 support and guidance. I have a coach that is within the community as well, who is always taking care of our members. And you can very likely see his name within the reviews. Okay, these are the prices, any questions, Q&A, and all of this sort of stuff. But once you get inside, basically, you're going to go to your dashboard and you're going to be getting access to the Fanatic Way and to the Fanatic Flicks. And then you literally start. There is the Fanatic Way. Welcome to the program. It is a really bite-sized chunks, right? To not make videos too long. You basically cover everything. There is a lot of stuff. So we start with a trading plan. You're going to be getting assignments where you literally submit your assignment and I check it for you, all right, every weekend. And then you go and you learn everything. There is a lot of modules. I'm not going to show you what's inside, but basically we start with the beginning here, learning the concepts, and then we go into the level up, learning the entries, the approaches, the trading plan, psychology, and then we give you the journey to go forward. And then, of course, we have the Fanatic Flicks, which is a lot of content. You can see we have a lot of trade breakdowns here, 60 trade breakdowns from which you can learn. These are live trades executed by me, okay? And then we have the webinars and the workshops. So usually I recommend new members to start from the last one and then go back. But every week we spend minimum an hour to 2 hours breaking down the trades, going into Discord, breaking down every single trade, and of course having a lot of new things that are not in the course. You can check out the reviews by clicking here, student results. There are some of our student results here. That's kind of the wall of success. You can go down, you can check them all out. And then even all the way down here, you're getting some more reviews about the Fanatic Way program. You can also go and check out Trustpilot. We have almost 200 reviews. Most of them, well, pretty much all of them 5 stars. I think we just get very little lower ones, but you can definitely check. You see Mihai is going to be mentioning a lot. That is our head coach. He is really, really amazing. And then within Discord as well, you're getting welcomed in Discord. I welcome you personally. We can even do an onboarding call if you wish. There are again the successful stories. These are real members. Dominic, right? Great coach again. I joined the community just 2 months ago and now I have a 6-figure funded account, right? So you see for 2 months. I told you on average 3 to 5, but yeah, we have a lot of case studies here, but you can check them out on the results page. General psychology, reflections, announcement, program updates, suggestions, live trade discussions here. This is where we talk. It's where we talk about the things, right? I do daily analysis every single day. I break down my trades, full transparency with executed trades and results. My trade magazine, we look at the CO2 report, and then we have the executed trades of students. This is the most valuable part because you get to see how members are executing, and this is no any random kind of just shouting, because I've been in a lot of communities and a lot of them are just extremely noisy. Here, you're not allowed to post a trade if you don't break down every single time frame, all right, in detail, and you also don't share the execution, because if you share in executed trades, you must have an executed trade and show that it's actually you took the trade, all right? And this is where we're going to be giving you feedback. So if I go, for example, to an old trade, you're going to be getting, let me see here, some of them that we checked. So you're going to be getting feedback from different members, from me, from Mihai as well. All right. Of course, if really feedback is needed. And then also what we have is a competition. If you really share all of these trades and you share the proof, you're being given points. And then after you win points, we have the contest where you are given prizes, challenge accounts, and one-on-one sessions with me, which is pretty fun. And then every week you're going to get the webinars, of course. You see what an incredibly interesting webinar, a clear and easy to understand explanation with the volume profile, which is something that we've been looking at. New content here. These are the one-on-one sessions, and yeah, so much stuff. All right, so we are literally at the end right now. I truly hope you enjoyed this very big masterclass. Please make sure to subscribe and like the video if you did, and leave me a comment. Leave me a comment. Let me know what you think. Let me know if you have any other questions, maybe for a part 2. Let me know what you want to see more. I plan to do some more videos on psychology as well, maybe a big masterclass on psychology. I plan to do volume profile and a lot of other shorter videos to really dive deep into all of these concepts. But I just gave you an incredible foundational kind of strategy and a really strong foundation to go forward and really level up on top of that. If you want to level up with me, you can go to tradingfanatic.com and join me there. If not, you can check out the YouTube, you can check all the resources. Just be aware of all the mistakes that we mentioned a little bit earlier. Really hope and genuinely hope that you enjoyed this. If you did, again, let me know, and wishing you good luck, good trading going forward. Stay consistent, stay committed, stay dedicated. You can absolutely do it. I'm sure of you. If I can do it, you can do it. But all you have to do is just put in the hard work. Okay, put in the hard work and get some guidance, because it's so much easier. All right, let me know what you think about this video, and I'm gonna talk to you on the next one. Bye from me.